then the longer-term starting position of significant overvaluation means there could be farther to go in that adjustment process. Currency strategists reckon that the dollar is about 17 to 20% overvalued, so there could be significant move to the downside.
And let's get to the final update on the global market front this morning. European markets, they had closed mixed in yesterday's trading session. They started mixed also as well. So with FTSE closed for a bank holiday, as investors were looking ahead of the latest economic data and corporate earning reports that were due this week. The German DAX ended 1% higher almost in trade, while the French CAC fell more than 0.5% in yesterday's trading session. So that is something that we'll be keeping an eye out on. But that's the global market wrap that we have for you all this morning. And Vamakshi, it's an muted handover that we have for the Indian markets as well.
Well, absolutely a muted handover coming in from the global markets. But, that was all on the global market action. But how will all of these overnight cues impact our own Indian markets? We now have our research team joining in with how the trade setup looks like and the stocks that are likely to be in the news. First up, we have Hormaz joining in to get us all the cues from the market space that we need to watch out for. Hormaz, good morning.
Amakshi, good morning. And it was a cautious handover on expected lines heading into a major event being the FOMC policy, and of course the cautious tinge is percolating onto our own markets as well. But for us, it has been that case over the last 4 to 5 trading sessions, even though we ended higher yesterday, but a similar script following, failing to hold at higher levels. What may also keep the sentiments in check today, of course, are the rising tensions at the India-Pakistan border and the Ministry of Home Affairs ordering a civil defense mock drill across 244 districts tomorrow. So that may keep sentiments in check, and that is evident from the GIF Nifty as well. Now, what's also indicating caution is that yesterday we made a lower high on the charts when it comes to the Nifty, as yesterday's high was lower than that of Friday's high. We did cross 24,500 yet again, but failed to sustain at those levels. So that becomes the first level to cross, then followed by Friday's high on the upside. On the downside, though, it is yesterday's low of 24,400 that comes in as the first line of defense, followed by last week's lows, which include the likes of 24,290 and then 24,038, which was the low of last week. Of course, on the Nifty Bank, it ended below the 55,000 mark, but what kept the losses in check was HDFC Bank, which stood tall and withstood pressure from all other banking heavyweights, be it Kotak, be it ICICI or Axis, and it was HDFC Bank that ensured that the Nifty also ended in the green. The earnings season continues. Keep an eye out on the wires and cables companies, and also watch out for Tata Motors today as the shareholders vote for their CV business demerger. But for now, a cautious start in the offing.
Okay, cautious start is what we're watching out for today. But now over to Ria, who's here to tell us what are the important stocks to watch out for in today's trading session. Good morning, Ria.
Well, yes, let's take a look at the stocks that are going to be in focus today. First up, we have CoForge on the back of its Q4 numbers. Now, the net profit has increased by around 21.2% sequentially. Even the rupee revenue has gone up by around 4.7%. Margins this time around have come in at 13.2% versus 11.9% that we saw in Q3 of FY25. For DCM Shriram, the net profit and the EBITDA both have seen increases of around 52% over the previous year. Even the margins have seen an expansion coming in at 14.1% versus 11.1% in Q4 of last year. For IHCL, the revenue has gone up by around 27.3% on a year-on-year basis. Margins have come in at 35.3% versus 34.6% in Q4, so largely stable margins for IHCL. For CAMS, the revenue and EBITDA have seen increases of around 14.7% and 11.2% on a year-on-year basis. Margins, on the other hand, have contracted a little bit to 44.7% versus 46.1% in Q4 of last year. For J&K Bank, the net profit has gone down by around 8.5% on a year-on-year basis, but the net interest income has seen an increase of around 13.3% over the previous year. Shifting away from earnings, IEX has come out with its business update for the month of April. The traded electricity volume has gone up by around 26%, and the real-time electricity market volume has gone up by around 48% over the previous year. 2 pharma stocks will be in focus today. First up is Glenmark Pharma. Now, ICNO's Glenmark Innovation has received the US FDA Fast Track designation for ISB 2001, and Sonoris Pharmaceuticals will be in focus since they have acquired the US FDA approved ANDA for topiramate from Wockhardt. For Paras Defense, the stock will be in focus since they have signed an MOU with an Israel-based company called Heaven Drones to form a JV in India for the development and production of logistics and cargo drones for defense and for the civil market as well. And lastly, Cyient will be in focus since its arm Cyient has received an order levying a penalty of around $26,779 from the IRS in the US.
Well, thank you so much for that, Ria. That's quite a comprehensive list. And finally, we now have Mangalam joining in with cues from the F&O space. Good morning, Mangalam.
Good morning. So if you look at the Nifty, it is consolidating around higher levels. We're facing some supply over 24,500. We've been facing supply about 24,450 to 24,550 over the last few trading sessions. And yesterday, even as we closed about 114 points higher, we actually closed about 60 points lower from the day's high itself. And the bigger culprit was the Nifty bank led lower by Kotak Mahindra Bank and SBI. No problems with the broader markets. They continue to do well. But overnight, the developments at the border have kept the GIFT Nifty gains in check, along with the weakness that we've seen on Wall Street itself. GIFT Nifty suggests an absolutely flat start. The only worry is, are the flows getting a little too lopsided now? Because it's the 9th session where both the FIs and the DIs have bought together. The FIs bought 500 crores and they bought for 13 sessions in a row. The longest streak since, April, May 2023. In fact, in just the last 13 sessions, the FIs have gone ahead and bought $5 billion in cash market. That's the highest continuous purchase that we've seen all the way since November, December 2020 itself. So that's the question. Even on the index futures side, if you look at the Nifty futures premium, yesterday itself, it jumped from 54 rupees to around 92.5 rupees. And the FIIs continue to buy in index futures. They bought about 530 crores, added about 2,900 longs, covered 717 shorts. And with that, nearly all the shorts are out of the system. The FII contracts on the short side are sub 5,000 and their long exposure is now at an even 49.51 is their long short exposure right now. The 24,500 call writers fairly active, telling you levels upwards of 24,550 will continue to face supply, but at lower levels, we might see some support around 24,300. But if there were any further downsides on account of border-related issues, there have been a lot of put buyers at 24,000 itself. So that's something we'll keep an eye out on. Also watch out for Manappuram. That stock entered F&O ban yesterday.
Thank you so much for that, Mangalam. But on that note, we're going to slip into a very short break and we'll get you the latest updates where India and Pakistan relationships stand. Stay tuned.
Welcome back. You're watching Power Breakfast on CNBC-TV18. Let's get you an exclusive now. GST authorities have turned up heat on global digital service providers. As the digital economy surges in India, the GST authorities are now ramping up enforcement efforts to bring foreign digital service providers under the tax net. Timsi Jaipuria now gets us all the details. Timsi?
As the digital economy surges in the country, the Goods and Services Tax authorities are ramping up enforcement efforts to bring foreign digital service providers under the tax net. Even after already having significantly expanded the definition of online information database access and retrieval, that is OIDAR services, in October 2023, CNBC-TV18 has now learned through sources that the Directorate General of GST Intelligence is still coming up with cases where such platforms and entities have not registered in the country and thus are neither reporting business generated from India and nor they are paying the due GST. Keen on bringing these foreign digital service providers under the GST net, DGGI is now pushing for registration, higher compliance from these online platforms which are not registered in the country. In its efforts, sources said the DGGI is sending emails and warnings to Indian firms that are using these foreign platforms seeking compliance. DGGI, which is the enforcement arm of Center for GST, is also asking Indian payment processors to block payments to these non-compliant foreign firms. Not just this, DGGI is also accessing forex transaction data from banks and has also sought aid from the Reserve Bank of India to enforce cross-border compliance. DGGI is also seeking suitable amendments to the law to empower itself so that the agency can take action against such non-compliant websites. Just to remind our viewers, the GST mop-up from these online services has grown up from 80 crores in FY18 to over 2,600 crore rupees in FY24. Meanwhile, experts attribute this growth to the broader scope of taxable services, the change in definition which actually came in October 2023 through amendments. Now to be seen is whether this DGGI action against non-compliant online service providers actually garners some more fruitful returns or not, something that we'll have to wait and watch for.
Thanks so much for that, Timsy. But let's move on. Nearly 2 weeks after the Pahalgam terror attack, India has curbed the flow of water to Pakistan through the Chenab River. Sources say that authorities have emptied the Bagliha Reservoir and shut the gates. Authorities claim that the water from Chenab River will not flow into Pakistan's Punjab province via the dam till India refills the reservoir. India has already suspended the decades-old Indus Waters Treaty with Pakistan. The Home Ministry has also asked several states to conduct mock drills to strengthen their self-defense preparedness, and the last time such a drill was conducted was in 1971, the year in which India and Pakistan went to war on two fronts. Parikshit is joining with us to give us more on this front. Parikshit, tell us more about these mock drills and its significance as well.
The Ministry of Home Affairs has ordered several states across the country to carry out mock drills on the 7th of May. This is to prepare ourselves in the wake of a hostile attack. Now, these measures have been recommended by the MHA. On the 7th of May, we will see exercises, drills across the country for operationalization of air raid sirens, training of civilian students on civil defense aspects to protect themselves in the event of a hostile attack, provision of crash blackout measures, and also provision for early camouflaging of vital plants and preparation for evacuation plans. Now, all of this can be seen as part of contingency planning on the part of the Government of India and the Defence Forces. We've been seeing since the Pahalgam attack regular meetings at the Ministry of Defence. The Prime Minister has been meeting NSA, Ajit Doval, the Service Chief, the Defence Secretary as well. So the feeling is, yes, that we have to respond to Pakistan. We need to retaliate for that terrible attack in Pahalgam where 26 people were killed. But at the same time, our response has to be a calibrated one. It has to be a responsible one considering India's stature. But at the same time, we need to be prepared for any eventuality. So this is how you would describe this mock drill. It is part of contingency planning to prepare our civilians, to prepare our forces in case there is any kind of hostility, despite our restrained and measured response to Pakistan.
Thank you so much for that, Parikshit. But let's slip into a very short break now. Up next, we get you news and updates revolving around US President Donald Trump in a special segment, Trump Watch. So don't go anywhere.
Welcome back and thanks for staying tuned into Power Breakfast on CNBC TV18. Now getting you the latest on Trump-related developments. We have Dia joining in with us as always in our special segment, Trump Watch. Dia, over to you.
Starting off with a significant move in US-India trade talks, India has proposed zero tariffs on steel, auto components and pharmaceuticals on a reciprocal basis up to a certain quantity of imports in its trade negotiations with the US. People familiar with the matter said, adding that beyond this threshold, imported industrial goods would attract the regular level of duties. Turning to the auto sector, Ford suspended its full-year financial guidance and said President Donald Trump's auto tariffs will take a toll on profit, joining rivals stung by volatile global trade policies. The automaker expects the duties to reduce 2025 adjusted earnings before interest and taxes by about $1.5 billion on a net basis this year, it said, while reporting a first-quarter profit that beat expectations. The company's total tariff impact is about $2.5 billion, $1 billion of which the company expects to offset through actions such as using so-called bonded transportation to shield parts from levies as they cross international borders, Chief Financial Officer Sherry House told reporters. Now, moving on, President Donald Trump signed an executive order looking to limit federal funding for gain-of-function research that involves altering pathogens, suggesting the efforts could have been responsible for the outbreak of the COVID-19 pandemic. US President Donald Trump said he wanted to work with Turkish President Recep Tayyip Erdogan to end Russia's invasion of Ukraine after the two leaders spoke by telephone. Trump added on his Truth Social network that Erdogan had also invited him to visit Turkey and that the Turkish leader would be meeting him in Washington. Trump, who promised to end the Ukraine war within 24 hours of starting his second term in January, has been pushing Kyiv and Moscow to reach a ceasefire deal. The Trump administration is offering undocumented migrants $1,000 and paid travel if they agree to leave the U.S. voluntarily. The latest effort to ramp up mass deportations and slash enforcement costs. The Department of Homeland Security said migrants who self-deport using the CBP Home app will receive the stipend once it's verified that they have returned to their home country. That's all for today. Now back to you, Vinny.
Thank you so much for that, Dia. But that's all the time we have on this edition of Power Breakfast on CNBC-TV18. Thank you so much for tuning in. Up next to Bazaar Morning Call.
The impact of Pakistan's airspace closure isn't just limited to Indian airlines. Several foreign airlines are also choosing to avoid flying over Pakistan, even though the restriction officially applies only to Indian carriers. So as we have been reporting that international flights from North India are the most hit as they now have to travel to Mumbai and Ahmedabad and then proceed to their journey. We learned from airport officials that Mumbai ATC is now handling nearly 135 more flights of Indian as well as foreign airlines ever since Pakistan closed its airspace. Many flights operated by foreign airlines like Lufthansa's Delhi-Frankfurt flight, British Airways' Delhi-London flight and Air France's Delhi-Paris flight have chosen the longer route avoiding Pakistan airspace. There are others like Etihad's Delhi-Abu Dhabi and Oman Air's Lucknow-Muscat flight sometimes avoiding the Pak airspace, meaning there are days when they fly over Pakistan and then there are days when they fly over Mumbai and Ahmedabad. Now, interestingly, not all foreign airlines are avoiding Pakistan airspace. American Airlines, for instance, then United Airlines, KLM, these three airlines are mostly using the Pak airspace to enter India. So why are some foreign airlines taking the longer routes, even when they are allowed to use Pakistan's airspace? That's the question. So as expected, when we asked these airlines, they said this is a precautionary measure keeping in mind passenger safety. There are two main concerns behind this rerouting of flights. First, since tensions continue between India and Pakistan, any sudden retaliation from either side could leave these foreign airlines stranded in the sky if they don't have enough fuel to divert to another airport. And second, in case they are forced to do an emergency landing at a Pakistani airport, then that could jeopardize the security of Indian passport holders on board the flight and
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Tuesday morning, good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, good morning.
Morning. Hi, good morning. Well, bulls continue to chug along. The news flow around trade deals is still keeping everybody sort of at the edge of their seats. So lots going for this market.
News on trade deals, but no trade deals as yet. So I think that's the way to put it.
It's coming. You can keep saying it. But actually, let's just hear it from the man, right? This is Treasury Secretary Scott Bessent yesterday, basically making that same point.
I think we're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week. So when you think about uncertainty, uncertainty, a lot of it is generated by, I have asymmetric knowledge, so I'm not uncertain because I think it's going well. Other people don't know what I know. So
you have to share that with us then.
Well, I can say that I am highly confident that we have 18 important trading partners. We'll put China to the side. The 17 other partners, many of them have approached us with the very good trade proposals. President Trump is going to be involved in all of those. He will be the final decision maker, and we'll see where that goes. I think we could see substantial progress in the coming weeks. We'll see. That I think it's Stein's law, that which is not sustainable doesn't continue. So 145%, 125% tariff levels are the equivalent of an embargo.
Yep.
And we're reading every day what's happening with factories in China. And from an academic point of view, I can tell you that the history of trade battles, we are the deficit country. The surplus country always has the most to lose.
Okay, lots of noise there. I mean, Treasury Secretary Bessent was sort of made a speech at the Milken Institute. It was a pitch about making in America. And of course, after that, CNBC sat down with him. And that's essentially a portion of the interview that we played out for you. In case, because of that noise you missed out, let me just quickly recap what he said. I mean, he said administration is very close to some deals on trade. Some deals could come as early as this week. And he went on to say that the China trade progress could come in coming weeks as well. Basically, they start talking at some point with regards to China, but some deals coming very soon, as early as this week. So, and of course, I mean, with regards to India, he said in the past, not this time, not last night, that India remains one of the first countries with which the US perhaps will get a deal going. Okay, now, the markets and what they did, we had a 9-day winning streak, and it was kind of getting unsustainable. So we broke that streak. S&P down about 0.6. NASDAQ was down about 0.7%. The 10-year yield about 4 basis points higher at about 4.35%. Dollar index 99.82. But I think this morning I saw the dollar index back at about close to around 100. The ISM services data was better than expectations, 51.6 compared to 50.3, which was the poll. I mean, you look at all these numbers, the GDP number, you look at the jobs data, you look at this ISM number, etc. And is this all kind of, in a way, quote unquote, brought forward data because of the tariffs? I think that's essentially what we have to see. The PMI numbers perhaps are more current and indicative of sentiment going forward. Oil prices about 1.7 lower. We are at about $60.28 as of yesterday, and we're at about 61 this morning. So this is important. Yesterday, crude sensitives, especially the oil marketing companies, sort of rallied hard. So that's a space to continue to watch. Now, just to tie in the levels here, the Nifty traded yesterday within Friday's range. I mean, if you just look at the high and low on Friday, because it was such a large move on Friday, we were within that. But we ended about 0.5% higher. The next level on the upside for the Nifty is 24,545, which is nothing but the 61.8% retracement of the entire fall. Yesterday, by the way, we took out the high of 24,457 by just about 3 or 4 points, but we ended above it. So the next logical level is 24,545, which, by the way, we got to on Friday, and then we completely fizzled out and ended flat. Major support 24,080 on the downside. Resistance for the Nifty Bank will be around the 56,000 mark. I mean, the levels have not changed. The Nifty Bank kind of underperformed the broader market. And of course, support here comes in at the 30th of April low, which is 54,723. GIFT Nifty will come up on your screen, gives you a quick sense of how we're likely to start. It's kind of flat, 10-point change this morning. Surabhi.
Absolutely. I mean, and flat is actually the word on Wall Street as well, because if you're looking at futures right now after yesterday's decline, a little directionless. It's going to be all about the Fed meet outcome. And it's supposed to be quiet. I mean, in the form of rates, we all know no rate change is expected, no rate cut. But the commentary, as usual, is going to be watched out. Asia this morning, first of all, a couple of markets are still closed for regional holidays. So we don't have cues coming in from Japan or South Korea. These are the ones that are open. And you can see a nice rally in some of the regional markets that are up and about. On the currency front, now, I mean, Monday was, a day of weakness for the dollar index. Now we're seeing a little bit of that recovery come in. And the yen has eased back to levels of about 144 to the USD. It touched 144. Now it's gone back to 143. So it's very range bound on the currency trade as well. Speaking of trade deals, there's a Bloomberg report that's talking about us, India. And according to that report, it's saying that India has proposed zero tariffs on steel, auto components, and some pharma imports, but up to a certain volume threshold. So up to a certain threshold, it will be zero tariff on a reciprocal basis. Above that threshold, there will be the usual tariff that will be imposed. So let's see, lots of trade talk and deal talk doing the rounds. The Nifty, despite all of this, I mean, the fact that banks were underperforming yesterday, it continued its winning streak, managed to put on that 0.5% because there's now participation coming in from other pockets of the market as well. Yesterday, consumer stocks, Reliance, all of them were firing. So the rally does have more legs. It's not a one-trick pony, so to speak, at least from what it appears right now. And flows have been very, very supportive. Yesterday, again, you had, buying from both the FIIs and the DIIs. The FII number was not as big as what we saw on Friday, but nonetheless 500 crores of positive numbers coming in from FPIs, and domestic institutions bought equity to the extent of about 2,800 odd crores. The flows, not a problem at all. Lots of individual stock action to focus on. First of all, we have a listing. Ather is going to be making it to the market today. Just reminding our viewers, the company raised, when we're talking about fresh issue, that's money coming into the company, that was about 2,600 crores. The price band was 304 to 321. If you go by a lot of the reports, the so-called grey market, it's supposed to be slightly quiet and muted, maybe 5-6 rupees at the pop. That's what the expectation is. Today is a very important day for Tata Motors as well, because finally the board is going to decide on the way forward for the demerger. So you get, one share of the CV business for one share of the existing business that you hold. So that's an important shareholders meeting that's coming up. Lots of results to keep us busy, and I'm just flashing up the list for you, and lots of very interesting large mid caps as well. So there's Godrej Consumer, BOB, HPCL, MGL, there's Aadhar Housing, CG Power, Kajaria Ceramics, Nerolac, I could go on and on, KEI, Radico Khetani, even Polycab, especially Polycab worth watching considering the stellar show that we had from RR Cable yesterday. Last but not the least, watch out for Yes Bank. There are different reports, both in the Mint and the Economic Times, and different papers reporting this, different wire agencies also reporting this, that Sumitomo, the Japanese banking giant, it is very close to getting RBI's blessings to take a large stake in the bank. Some say it could be as much as 51%. So let's see. Some reports suggesting there could be an open offer triggered. So Yes Bank definitely going to be on the radar as well. Nigel.
Well, the markets are clearly telling you that in the near term, we have a bit of a resistance zone. So that 24,550 to around 24,600, that appears to be a near-term stubborn resistance. Because for the last few trading sessions, it's close to around 8 sessions, we've consistently visited the highs of the day at around 24,350 to around 24,600. So that's the resistance zone that we're talking about. You'll see we're just 150 points away from that level. But the problem is this level is continuously getting rejected. I'll tell you what, if we can close above this level, then we are set for a fresh leg on the way up. Eye on the border though. I think that's the reason why, in fact, in the near term, we are seeing some bit of consolidation and some kind of resistance at the highs. But the longer we go through this consolidation phase, the sense you get is the breakout could be even bigger once all of this does clear out. So let's see how that goes. What about the FIs? What are they doing? They're pumping in some money in the cash market, and in the futures market, they've been covering their shorts and they're gradually moving to the net long position. And even in yesterday's trading session, they added some longs. They're still net short, 51.5% positions on the short side. But now they're moving to that even Stevens part. So that's why if you look at the FI net shorts, that's come down to just 5,000 contracts, while the clients, they're net short by close to around 27,000 contracts or thereabouts. But what are they doing in index options? It appears that in case the market is going to break away, there is some out-of-the-money call buying that we're seeing. Even in yesterday's trading session, they bought more calls than puts, though they're writing pretty much one put for one call. At least that's what we saw in yesterday's trade, which brings us to the options data. The 24,500 call, well, it added close to 50 lakh shares, and the 24,000 put as well. And these are the most active strikes, and this is the broad range that we're looking at. So let's get the levels up for you on the screen. In terms of a downside, just for the day, you don't want the recent, the recent low. That's the low we saw last week, around 24,200. That's your reference point on the downside. While because this 24,600 mark has been getting resisted, we're likely to see that this is the broad range for the day itself. The Nifty Bank, yesterday as well, we saw some unwinding of positions. You had a couple of result, disappointments out there. And that's why there was some unwinding of positions, which is causing the Nifty Bank to see some kind of selling from the top. But I think the Nifty Bank is in this broad range. The recent high as well as the recent low in that vicinity of around 54,000 on the downside and around 56,000 on the upside. That seems to be the level. In the last 10 sessions or so, we have gone there more than thrice, and that 56,000 mark has got rejected. So we'll see how the Nifty Bank goes. Those RSIs that had popped up to a very, very high number, to around 76 odd, that's cooled off a little bit. So let's see whether or not the Nifty Bank is ready to take up the mantle again.
All right, and I think China is back in terms of
trading action. Yeah.
And where it is showing up in a meaningful way is gold prices. Gold prices are
2.5% higher.
About $100 since day before yesterday.
Just one more point. This Trump uncertainty is just causing a lot of companies to go ahead and pull away their guidance. Ford overnight, they pulled away their guidance. Mattel as well, they have pulled away their guidance. I think 20% off their total goods. Yeah. So the Barbie prices are set to go up, I guess. So.
Yeah.
He said, right? You remember a couple of days back, he said, why do, young, wonderful girls need so many dolls? Why do you need 100 dolls or 100 toys? You should have like few. That's what he said to American young girls.
Just connect to my doctor.
All right, let's welcome in Matt Orton, Chief Market Strategist at Raymond James Investment Management. Matt, good to have you with us here. Good morning. Thank you for joining us. I mean, I think what the Treasury Secretary said, that I don't know if you heard that soundbite we played out. This was in an interview with CNBC last night. He said, well, I have, the information flow is asymmetric. I have information, so I'm very confident. You don't have it. Markets don't have it. So you're kind of nervous. And he said, well, some deals could come as early as this week. But even as that may be the case, Matt, do you think markets generally have run up and kind of have repriced completely? I mean, recouped all losses since the April 2nd Liberation Tariff Day. So now you're going to run into some hard data. Even as news flow gets better on tariffs, headlines get better, markets have recovered. What's your sense?
Hey, good morning, Prashant. It's always great to join. And that's really the key question I think a lot of investors are trying to digest is, to what extent will we see the hard data start to roll over? I don't think anyone would argue, I certainly wasn't arguing coming into this year, not knowing anything about what tariffs were going to look like, that economic data was going to slow because it had been so high for such a long time, and we knew we were going to be pulling back some fiscal spending in the US. Tariffs obviously accelerate that. What I think is critical, though, and what Besant has been alluding to, is that the administration has been listening to the markets. The administration has seen the market reaction to, I'd say, some of the worst inclinations or the negotiating tactics, per se, of tariff policy. And you're seeing those left tail scenarios be removed. We're finally talking about trade deals. I'd love to see some of those trade deals get signed. I think perhaps India, Japan, South Korea are probably going to be amongst the first ones that we see. But that at least, I think, gives a signal that the tariff policies as it stands and as we're likely going to get to, in and of itself, isn't enough to drive the economy into recession. I think that's reflected in the strength of the hard data that we're seeing. And from the market perspective, a lot of companies that are tied to the technology sector, a key part of the overall market, remain in really, really good shape. We've seen great earnings and they haven't pulled their guidance. They've actually maintained or increased their guidance going forward.
Matt, hi. Great to have you on. So in the midst of all this uncertainty, what's the sense? Broadly, do you see the U.S. market heading higher? I mean, it now believes that some shape and form of these deals will start coming through. So from a market standpoint, is the direction still up for the U.S. and then markets like India?
Yeah, it's a good question, Serbi, and I think you want to look at it in two phases. Number one is what's going to happen in the short term. And in the short term, I'm a little bit cautious. Short term meaning the next couple of weeks to a month. And that's largely because a lot of good news has already been priced in. We get the FOMC on Wednesday, as you mentioned earlier in the program. And I think that can be a catalyst to maybe have the markets pause for a little bit and say the Fed is not here to come to the rescue should we see hard data start to roll over. So I think the bond market has some repricing to do. I think the rate cut expectations are too high. And I think that could lead to maybe some sideways movement, some consolidation. And that is a good opportunity for long-term investors to start to use opportunistically. Because as you know from our conversations over the past few months, I'm very glass half full with respect to where the economy and the market can go over the next year plus. I think earnings will continue to be strong, but the key message that I give to clients when using downside opportunistically is that this isn't a market that you want to buy as the market. You want to lean into specific stocks, specific sectors where there's durability with respect to earnings growth. And I think that applies to markets like India too. A lot of good news has been baked into the Indian market. I've been encouraging clients to use India as a ballast in portfolios, but a lot of the high quality names that have been my favorite picks over the past year that I've really leaned into in weakness, these high quality names have reported great earnings. And I think the outlook looks very, very bright. So I'm still encouraged by India. I don't want to chase the upside. I want to let the market come to me so I can continue to slowly and opportunistically add.
All right. Hi, Matt. Always good to hear your thoughts. Well, as you have mentioned in the past, India is your preferred market, but stocks is something that you like. So give us, first I want you to comment on the European markets. Last night I was just pulling out some data with regard to how equity markets are, how far away are they from all-time highs. And the DAX was 0.5% away from those levels. So the European markets clearly have bounced back. What's your view on the European markets? And since you spoke in India, you like high-quality names. Name a few for us.
Absolutely, Nigel. So Europe is really interesting. I came into this year optimistic on Europe, particularly banks and defense companies. And I think the story for Europe is one that's still characterized by central bank easing. So financial conditions are going to get easier across continental Europe. You have growth that has likely bottomed. We're probably going to see trade deals come, but what's most important to, I think, the European story is the fiscal impulse you're getting from countries like Germany that have committed 500 billion plus euros to rearming the continent. So I think the defense play has a lot of legs to go, even if you do get ceasefires. So I think there's a lot of good investment opportunities across continental Europe. Again, I might want to lean into financials, defense, perhaps some consumer-oriented companies more in the luxury goods space, and avoid some more of the names that are still tied up to China, because that's an area that I think is going to suffer from dislocations, at least in the short to medium term. You flip to countries like India, some of my favorite names, my biggest overweight by far right now is still ICICI Bank. That's been a name we've talked about a lot. I think it's the highest quality private bank in the country. You've seen really, really strong earnings. You've seen net interest margin strong, loan growth improving. There's really not much not to like about the stock going forward. So again, I would use any sort of dips opportunistically. And other names that I had been accumulating kind of later in the year on some of market weakness, like HDFC Bank, they've also reported very strong earnings, net interest growth, and they're finally starting to see loan book growth, which is a really encouraging sign about the Indian economy and the state of their business as well. And another name that I lightened up maybe a little bit too much that I think I might look to add to that reported earnings yesterday was M&M. Mahindra & Mahindra reported really strong earnings. I liked the growth, the surprisingly strong growth in the tractor segment. You're seeing them in a really strong SUV market cycle. So again, that plus some of the mergers that they're starting to do, that looks like it could be a continued growth story to me.
All right.
Yeah, absolutely. In fact, Matt, we spoke with the management, the M&M management. They were here in the studio yesterday, and indeed, I mean, that's what we were quizzing them. They seem to have found that sweet spot between volumes, pricing, and how do you get that margin up and about as well. So yeah, M&M was quite the stock yesterday.
Absolutely. And Matt, it's always great speaking not just macros, but stock-specific stuff with you as well. Thank you very much for joining us, Matt.
Thanks.
Great conversation, as always. We'll take a quick commercial break here. And before we do that, as always, let me just quickly run you through what's lined up here in terms of interactions. So at 8:35, J&K Bank will join us on the earnings. 9 o'clock, we have the analyst at JM Financial Institutional Securities talking about the recent fall in oil prices and, of course, increases in CNG prices in Delhi. Vikash Kumar Jain, CLSA, is the market master of the day at 9:50. 9:30, the management of CoForge. That's a big beat that's come through last night. The management comes in. So, we'll have Sudhir Singh talking to us about that. Anuj Kumar of CAMS will be with us at 9:40 to talk about their earnings. Ajay Kumar Srivastava of Indian Overseas Bank at 9:50. And towards the end of the program, it's our special segment. It's the economy. Latha in conversation with Pranjul Bhandari of HSBC on India growth later this year.
Well, time to slip into a short break, but we got a lot of stock-specific action we're going to be focusing on. We get that on the other side of the break. For the time being, I give you a sneak peek. Indian Hotels, CoForge, OneSource Specialty Pharma, DCM Shriram, Glenmark Pharma, IEX and Yes Bank, all of them will be reacting to positive news flow, while we have CAMS, Cummins, as well as pharma stocks that will be reacting to negative news flow. Slip into that break and come back. We'll get into further detail.
Welcome back. So Qs are not too bad across Asia. Some of the markets are shut, but the ones that are open, for instance, Hong Kong is back. I mean, it's pointing to a recent 0.5% kind of a move. Lots of stocks in focus as well, and we will get down to that in just a bit. The implied open, let's look at that as well. It'll come up on the screen because while Wall Street futures are flat, Asia is not bad. And therefore, we're getting a slightly positive start, at least for now. Okay, let's get to stocks then. And we have our team standing by with the CNBC-TV18 list of top stocks for the day. Guys, morning to all of you. Indian Hotels came out with numbers, Mangalam, with everybody checking in and taking these dream vacations. I'm guessing they were looking good.
Well, there is no surprises there. It's a great set of numbers that has come in, and it's a good performance that continues. The stock has been quite a wealth creator and currently very close to its record high as well. And the consolidated numbers are further aided by Taj Sats consolidation. Remember, they had added Taj Sats, the air catering business, in July itself. So 27% revenue growth, 30% EBITDA growth, margins crossing that 35% mark, and net profit growing at around 28.5% as well. Hotels, year on year, there was a mild decline in the revenues and EBIT, but that was largely done away with strong occupancy as well as ARR. So occupancy grew to 80.1% and average room rate grew by 14.4%. Remember, from 18,368, it's jumped all the way up to 21,013 itself. The company maintains its outlook for FY26, 30 new hotels, focus on total RevPAR growth, continued momentum of new businesses, and they're also adding a new kitchen at Jewar Airport for TajSATS. All these factors should do well for the stock, expected to be in the green today.
All right, Mangalam, thanks a lot for that. Well, let's hop across to Rima. She's tracking CoForge and the numbers look quite good. Rima, tell us more.
Indeed, it's a good quarter, particularly delivering on the growth front. Yet again, the company's top line has gone up by 3.4% quarter on quarter, slightly ahead of the CNBC-TV18 poll of 3.1%. They've wrapped up FY25 with a 32% top line growth. But remember, that includes the Cigniti acquisition. Deal wins are strong, which means it positions the company well for the upcoming year. In Q4, highest ever deal wins at $2.1 billion. But that includes that large $1.6 billion Sabre deal. But even if you strip that out, you would still be at a run rate of $500 million. The company's 12-month executable order book has gone up by 48% on a year-on-year basis. The management held a conference call yesterday where they reiterated, they said they're confident about achieving the $2 billion revenue aspiration by FY27 and also on expanding margins. Remember, the stock is corrected. It's down 22% on a year-to-date basis. MK today upgrades the stock, citing the recent underperformance and the correction in the stock price. Jefferies maintains a buy, and their revised target stands at 9,000 rupees per share.
Absolutely. And that's essentially the big outperformer. And Sudhir Singh, and we've discussed this over the last many weeks, how confident the CoForge management has been in the past. And of course, the guidance coming through equally strong. It's also, of course, come off the lows, right? 6,000 to 7,500 in short order. So market was kind of well prepared for these strong numbers. So we'll see what the stock does. It'll be an interesting day. You'll hear from the management at 9:30. One source specialty pharma in focus now. Ekta is here with details. Ekta, morning.
Morning. Well, I'll look at the Q1Q numbers because that'll give you a more realistic picture of the company. Revenue was around 426 crores, so it was up around 9% Margins have improved quite significantly, so all the way to around 42.8% this quarter versus 36.15%, and a profit of around 98.5 crores. Now, in terms of the FY guidance, FY25 guidance, they've met it because they had guided between $160 to $180 million and EBITDA of $55 to $61 million. So they've met that guidance there. And in terms of what they are projecting in the next couple of years, revenue growth guidance of over 30% between FY25 to FY28 and steady state EBITDA margins of 40%. FY26 is expected to be a pivotal year for one source. Probably expect the stock to be in the green today on the back of numbers.
Got it, Ekta. Thanks a lot for that. Let's hop across to Ria. She's here to tell us about DCM Shriram. Ria?
Well, DCM Shriram has reported quite a good set of numbers in this quarter. The revenue has gone up by around 20% on a year-on-year basis. Both the net profit and the EBITDA have also seen increases of around 15% over the previous year. Even on the margin side, we've seen an expansion coming in at 14.1% versus 11.1% that we saw in Q4 of last year. Taking a look at the chemical segment specifically, caustic soda volumes were up around 29% on a year-on-year basis on account of the capex that the company has undertaken. Overall, lower input prices and operational efficiencies have led to improved cost structure for this segment. For the sugar and ethanol business, the domestic sugar volumes and prices have increased by around 19% and 5% respectively, both on a year-on-year basis. Overall, we've also seen better margins in this segment on account of higher sugar prices. The management has also commented on the results, saying that demand for caustic soda has improved, but chlorine has remained under pressure, and hence ECU prices are still suboptimal. They've also said on the sugar and the ethanol business that has remained largely stable, and sugar stocks for the sugar season 2025 are expected to be lower, which will support sugar prices going ahead. So overall, good set coming in for DCM Shriram, and we're expecting the stock to open in the green today.
Okay, Ria, thank you very much for that. Well, on to Ekta, who's with us in the studios today. Ekta, Glenmark Pharma on your radar. Morning.
Morning. Well, yes, one of their molecules under development, ISB 2001, has received US FDA fast track status. Remember that this is a molecule which is being studied for relapsed multiple myeloma type of cancer, that if in case, 3 treatments don't work on it, then this is the kind of drug that you go to. The drug is, the fast track that they've received from the US FDA enables expedited drug approval. And remember that they've already been granted orphan drug status in 2023. It's currently in phase 1, and the complete results are going to be shared on June 2nd, 2025 at the American Society of Clinical Oncology. HSBC had written some time ago on this, and they've written a note today as well. Don't have that note as of now, but HSBC is basically very bullish on the fact that this molecule could be an out-licensing opportunity and a re-rating trigger for Glenmark.
Okay, all right. Thanks a lot for that, Ekta. Well, let's go across to Vamakshi. Cummins, that's the stock in focus. The global parent went ahead and withdrew its guidance, and the commentary on India was weak as well. So we're bracing for a weakest set in Q4. Vamakshi, tell us more.
Well, absolutely, Nigel. Very good morning. Cummins definitely in focus after its parents reported its numbers for the first quarter. Now, the first factor that came out is that they've withdrawn the guidance. They've withdrawn the full year forecast, and they say this is on account of tariff-related uncertainties. Now, keep in mind, earlier they had shared a guidance wherein the parent was expecting a revenue degrowth of -2% to a growth of almost 3%. The power gen revenues for the global parent were expected to expand by anywhere between 5 to 15%, while for the India region as a whole, they were expecting a growth of nearly 10%. But now they've gone ahead and withdrawn this guidance given the tariff-related uncertainties. The second important point that came through from the earnings con call is that the revenue for all Cummins entities in India, which includes Cummins India, some other entities as well as JVs, in the first quarter, the revenue saw a downtick of almost 14%. The third point is the power gen business in India for the quarter ended March saw a revenue downtick of almost 11%. The revenue has declined as compared to the previous year, and this is mainly on account of the pre-buy that came through on account of the emission norm change in the same quarter last year. So therefore, given the kind of commentary that came through from the company, especially on the power gen business, which constitutes nearly 40% of Cummins India's revenue, negative read-through for Cummins, expect the stock to open lower today.
Okay, all right, Vamakshi, got that. Thank you very much. Cummins on our radar as well. Let's move on, talk about IEX. It came out with its business update. Vivek, morning, how does it look?
Well, good morning. That's right. So IEX is in focus. It's on back of the fact that the company has given the operational update for the month of April. So the traded electricity volumes, as far as the DAM market are concerned, up almost 26% on a year-on-year basis, 10,584 million units. The day-ahead market volumes up 3%. And when you're talking about the electricity market volumes, it's up almost 48%. Market clearing price, despite much higher volumes, remains quite steady at 5.2 per unit. The company attributes this to higher sell-side liquidity as far as volumes are concerned. Now, when you're talking about the renewable energy circuit, it's dipped on a year-on-year basis, but this is off a lower base and it's been quite volatile. That has been the trend as far as the REC market is concerned. A total of 2.9 lakh REC certificates were traded in April. It's a good set of, it's a good print as far as the operational update for, the first month of FY26 is concerned. Expect some green on IEX today.
All right, Vivek, thank you very much for that. Let's talk about the other company, which we're going to speak to a little later. CAMS in focus. Vamakshi is here with details. Vamakshi, morning.
Good morning, Prashant. Not such a great set coming in from CAMS. When we look at the revenue, the operational profitability, as well as the net profit, it's a mild miss as far as the consensus estimates are concerned. The revenue is seeing a degrowth of almost 4% sequentially. The operating expenses, on the other hand, are rather flat. Therefore, the EBITDA margin has come under significant pressure, down nearly 200 basis points, coming in at 44.75%. The net profit has also seen a sharp fall of almost 8% sequentially. Let's also look at how the different segments performed this time around. The major degrowth drivers for the company is the MF assets-based business, which saw a downtick of almost 5.4%. The MF non-assets-based business also saw a downtick of almost 4.4%. Think 360 AI and CAMS KRA2 reported a degrowth in their revenues. But on the flip side, side, good performance and in fact very strong performance came in from CAMS Pay, up nearly 44.5%. CAMS Rep 2 saw an uptick of almost 26%. So mixed performance as far as different segments of CAMS are concerned. Let's also look at the company's operational performance then. Overall AUM saw a downtick of 1.5%. The equity AUM too fell higher by almost 3.1%. But keep in mind that the decline in the overall AUM as well as the equity AUM is much lower as compared to the decline that has been seen in the wider industry. So this is slightly positive. CAMS has also managed to gain its market share in AUM as well as the equity AUM. So therefore, it's a marginal miss, going with a mild red for this counter.
Okay, all right. Thanks, Makshi, for that. And in fact, we'll be speaking with the management, Mr. Anuj Kumar. The management personnel at CAMS is going to be joining at 9:40 a.m. We'll talk more about these trends. Back to Ekta then. She's watching out for a couple of other pharma stocks as well. Which ones are these, Ekta, and what's the news?
Well, I will be watching out for the pharma index because I expect a sentiment negative to at least weigh down. This is after the US president signed an executive order to boost US drug manufacturing. Now, it's important to understand that they are not disincentivizing imports at this point in time. What they're trying to do is reduce the approval timeline for pharmaceutical plants to be set up in the US, because there were some indications that it can take as much as 5 years. So according to him, 5 years is too much, and hence we need to expedite that process. Remember that the likes of Roche, Novartis, Eli Lilly, J&J, they've already indicated that they're investing in the US in terms of manufacturing. Now, what else do articles indicate today is that the FDA could enforce stricter reporting by foreign API producers. Non-compliant overseas plants may be publicly listed, could see surprise foreign inspections. Now, remember that a lot of the pharmaceutical companies are already used to complying by all of this, but this could be an additional sort of scrutiny which could weigh down negatively on sentiment-wise. Now, the bigger picture and the larger picture is that the industry is facing uncertainty over tariff rates and timing. So the US, remember, imports over $200 billion in terms of prescription drugs. He's indicated that the government has indicated that we could hear in terms of imports probably in the next 2 weeks, import tariffs in the next 2 weeks when it comes to pharmaceuticals, and hence that is the larger picture which could weigh down.
All right, Ekta, thanks very much for that as well. Yes Bank is the next one that we want to highlight. Abhishek has got details on what he's picking up. Abhishek, morning.
Morning, Prashant. So as per LiveMint, Sumitomo gets RBI's nod to pick up 51% stake in Yes Bank. Now, this may value the lender at around $1.7 billion. Now, SMBC will either buy less than 26% or, they may do a merger through share swap. They may also buy up to 26% and then give out an open offer. SMBC's voting right in Yes Bank will be capped at 26%, and SMBC will buy up to 51% stake in Yes Bank at market price if need be. Now, CNBC-TV18 has not verified this news report independently. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. We'll keep an eye out on that one. Well, let's do a quick recap of all the top stocks we covered for you. We have Indian Hotels, CoForge, OneSource Specialty Pharma, DCM Shriram. We have Glenmark Pharma, IEX, as well as Yes Bank. All of them will be reacting to positive news flow. On the flip side, 3 of them will be reacting to negative news flow. CAMS, Cummins India, and Pharma stocks. Let's take that mandatory break, come back, and we'll have the management of J&K Bank. They'll be waiting to discuss the past quarter's numbers and how do they see things pan out going ahead. Later on, Prakash Diwan as well will be joining in for some fun market check. Welcome back. Hope you're having a good morning. Well, as promised, let's get straight to the management of J&K Bank. We're currently joined by the MD and CEO, Mr. Amitabh Chatterjee. Hi, Mr. Chatterjee. Good morning and good to see you. Well, before we start off with this conversation, focusing on your numbers, post the Pahalgam terror attacks, wanted to just lend all the strength, all the support to you, your personnel, all the staff at J&K Bank as well. The nation's with you all in this time of trouble, and we're going to pull through and we're going to conquer. Before we get to the numbers. But let's talk about business first. For J&K Bank, give us a few basic details. How much of your business comes out, outside Jammu and Kashmir? If you could give us a breakdown as of now, and how do you see things panning out from here on?
Okay, thank you. Thank you very much. Good morning. I hope I'm audible.
Absolutely.
Regarding your question, well, it's about 67 and 33. 67% of the business is in Jammu and Kashmir and 33% in the rest of India.
Okay.
So it is slightly shifting now, maybe because of obvious reasons of diversification. So that is how it is at the moment.
Well, there must be a very, very challenging phase for you, sir. As of now, the way you look at it, how do you see growth going ahead for the business? And I guess the focus will be on the non-J&K book, given the the current trouble that we're seeing.
Yes, if you are mentioning about the Pahalgam attack, yes, there would be some effect of that on the tourism, and all of us here we are looking forward to the Amarnath Yatra coming out successfully, so that we can have the tourists back. Apart from tourism, I think much of the remaining business will be as usual. The main contributor to the GDP of this UT is, of course, agriculture. So, if you want to ask me about the impact of tourism to the banking industry here, it would not be much, because we have done an assessment. The total exposure to the tourism, including the hotels and the transport, would be around 1% of our total portfolio. So direct impact will be not much, and in the past also. Sorry, yeah, please.
Right, sorry. Mr. Chatterjee, good morning. So, but direct and indirect, sir? Dependence on tourism?
That's what I was saying. Dependence on tourism for the bank directly is only 1%. And in the past, when this is not the first time this geography has witnessed such incidents. So in the past, the maximum stress that had happened because of such incidents was 14% of stress, which actually during the next 2 to 3 years came down to 2 to 3% only. So the resilience is very strong, and the propensity to repay and to maintain good, credit. The people of Jammu and Kashmir have a high propensity to repay and not to default. So that way, I don't see any direct impact. Indirectly, yes, of course, tourism also contributes 10% to the GDP here. So there will be impact on the other sectors, and that we'll have to wait and see how much it impacts the bank.
Mr. Chatterjee,
yes.
Sorry, you said in past instances, it's been the impact has been about 14%. What was that number? 14% of?
14% of the total portfolio. I mean, I said the total portfolio is 1% of our business portfolio. I mean, that is the total advances, the loan. So it was about 2,500 crores would be the total exposure, and the impact on of tourism would be around 1,000 crores only.
Okay, so you're saying that so if we understood that correctly, sir, tourism and allied sectors constitute right now 14% of your book. Is that right?
No. That is
1% of your book.
1%
okay, 1% of your book. Okay. So what was the 14% number, sir?
That 14% I meant was the NPAs went up in that particular sector to up to 14%. So that is around 140-50 crores, that's all.
Got it. So within the tourism part of your book, which is just 1%, which is of course very small, the impact was 14%. Got that. So let's talk about growth, because in the quarter gone by, the bank has shown very robust growth. I mean, whether I look at it year on year, 11%, even quarter on quarter, 8.5%. Is this growth coming in from the J&K part of the book or the non-J&K part of the book? And since right now you're saying that the impact should be limited, what should we expect over the next 1 or 2 quarters in terms of AUM growth?
See, the normal growth that will happen in this geography would continue to happen because a lot of dependence is on agriculture. So agriculture, this is the season, and we have seen post-March also substantial credit takeoff in the agriculture sector in our bank itself. So I do not see any reason why that will not grow. And to get back to your question, the growth that came in the last quarter of previous financial year, it primarily came from the corporate banking from rest of India. So that always will remain as a second line of defense for this bank. Essentially, as I told you, almost close to 70% of the business happens in this chain.
Fair point, sir. Got your point. Just can you give us some sense of a number so we know for FY26, since you're saying right now the Pahalgam impact is fairly contained. For FY26, should we expect your book to grow at what, 11, 12%, 10%, some range?
Yes. 12% would be a fair assessment, and of course, it might be more depending on how it pans out.
And NIMs would be closer to that vicinity of around 3.8 to 4%?
I don't think so. If you look at the repo rates going down, the NIMs will be under a little bit of pressure. I expect it. I would be happy anything around 3.7.
3.7%. All right, Mr. Chatterjee, thanks a lot for joining in. Appreciate you giving us some guidance. Things still a little bit uncertain out there, but we look forward to chatting up with you. And please stay safe and sending all the strength to you as well as your team.
Thank you very much. Thank you.
Well, let's get in Prakash Diwan then, our market expert. He's here to help us out with some fundamental analysis. Hi, Prakash. Good morning and good to see you, Ben. Well, what's your pick from the banking pack? You heard what J&K Bank, had to tell us about their business. Things uncertain over there. But a couple of large funds as well, they had put in some money out there and they were quite optimistic about a turnaround. Unfortunately, with these uncertain events, we'll have to see how things pan out. You have Yes Bank, where there's a potential deal. Sumitomo is looking at picking up a stake. That's what unconfirmed reports indicate. And yesterday, you had a couple of these banking names, like a Kotak Mahindra Bank, that did see some selling. So what do you like from the banking pack?
Good morning, Nigel. So let me also just add on the J&K Bank. It was a lovely discussion that you managed to have with the management. The numbers of the last quarter, wherever you see the improvement, actually tell you how much on track this growth was, before this attack happened and derailed, or at least has created a pause of sorts or question marks around it. But actually, if you see, the local economy out there is shaped up so brilliantly. It's just that the people have to realize what's beneficial for them and continue supporting that. But the numbers very clearly tell a very different picture, and there's enough to read between the lines. On the banking side, the way I look at, I told you, it's the private sector, largest banks which will take off first, which they did with the ICICI, HDFC, and Axis of the world. Kotak also did its bit, of course. But it's now, the smaller banks or the mid-sized banks that will start contributing because, they are the ones who are much more agile. And as the credit offtake period starts kind of picking up, you'll probably see that. So if you recall, we mentioned about DCB sometime back when the numbers came. I seriously think that's like a bank which is underrated in terms of what it is capable of doing. It has very strong CASA franchise, lends to the right segments, doesn't do very stuff which is very adventurous, except for, the yesteryear's plan to grow branches, which they stopped. So, when you look at something like that, you believe that if the cycle needs to kind of take off and ROA start kind of moving strongly, these are banks that you need to look at where the delta is higher. Otherwise, you'll probably have, even Federal is good, but Federal is, saturated at some point. They'll have to reinvent themselves, and that's why, the numbers weren't very encouraging, or the market reaction wasn't equally encouraging. So that's a point. But I would look at a smallish bank for sure at this point in time. Otherwise, the biggies like ICICI and all definitely continue to hold promise, but that's more of an institutional play. Retail investors could probably look at something smaller. They don't need very high liquidity on a daily basis.
Prakash, morning. Would Yes Bank be one of the smaller banks to look at? It's in deal zone now. We don't know pricing. We don't know whether open. I mean, there are different reports. One suggests there will be an open offer. Others suggest it could be some different sort of a different structure which doesn't involve an open offer. So we don't know a lot. What are your thoughts?
No, good morning. So absolutely, the bride is ready, but whether the marriage will happen and who's the group, what's very peculiar about this is that there are lots of things that need to kind of get stitched up before a deal actually happens in terms of permissions from other lenders and other creditors and so many of the investors themselves. There's a lot of equity at play with the biggies like SBI and all, also a very clear stake there. My sense is every rise in Yes Bank will probably be seen as an opportunity for a lot of the investors of the past to exit. It's been quite some time, almost 4 or 5 years, that it's been languishing in this zone. So a lot of people will find exits rather than look at buying into the dip. So you'll see selling pressure because the equity is bloated, and till all of that gets to stabilize at some point, the equilibrium arrives. I don't think it's a great delta. It's a special situation thing. Let's wait for what comes through. Then it'll probably be easier to assign some timelines to it. But right now, I think it's just a lot of hope that's building on it.
I was just looking at it. The peak for Yes Bank was February, 9th February to be precise. That's when the stock touched 31. I'm forgetting who was the suitor or the buzz back then. But it was, again, similar sort of buzz that got the stock to that level. But that was 31. Today we're talking 17. So let's see. That's Yes Bank. Prakash, CoForge, another good quarter. Your thoughts? And what would you do with the stock?
So, this is a very consistent player, keeps delivering in its segment. But, how long will this brilliant runway last, given the situation in the US and particularly rest of the world? I mean, I would believe, some of these stocks are priced to perfection at some point. It'll be difficult for them to be able to keep delivering as per expectation. So it's good to temper down your expectation. I'm sure, once we hear the management, you'll get to understand a lot of things that are going their way and some which are not. So once that's understood, it's probably easier. But I'm staying away from IT generally, by and large, at the moment, because, things could reverse very badly if something goes wrong on tariffs, or the countries that come with these bilateral agreements are not very significant or relevant or impactful. You'll probably have a little bit of dilution on that. So I would stay away from IT. Of course, no taking away the fact that the numbers have been brilliant. Company continues to deliver, but it's priced to perfection.
Okay, all right. Prakash, request you to stay with us for the time being. We take a short break. You come back. We'll have Prakash still with us, and Mitesh and Sudarshan will be joining in to give us their technical calls. Don't go anywhere.
Okay, welcome back. We've got, 7 minutes to go for the pre-open session, which will kick off. I mean, nothing on it, actually. 10 points, 11 points is all we have. Sudarshan and Mitesh are with us with what they'd want you to do in terms of specific trades. Gentlemen, good morning. Great to have both of you here. Mitesh, you go first. 0.5% gain yesterday. And is there more coming, or it's going to be a little more cautious, measured from here? What's the sense?
Good morning. So, yesterday I was believing that we could possibly see some more upsides immediately. What the way the price structure shaped up, and I was hoping that the indicators would again start climbing. That has not happened. So I think we might be in for consolidation. 24,520 is an area which I would want closing above that. I think once we get that, then there will be much more comfort to take long positions. Otherwise, I would wait on declines to buy. Though on individual stocks, we do have long biases.
Okay, all right, got that. Thanks for that, Mitesh. Sudarshan, what about you? How are you feeling about the markets?
Good morning. Well, not feeling very well. I mean about the markets. See, yesterday was a narrow range day. Now, narrow range days usually lead to an eventual breakout or breakdown. Given the fact that we are in a slightly confusing atmosphere, it's difficult to say whether we are going to go down or go up. So my view is that do nothing in the Nifty unless we see a decisive move out of a narrow trading range. So either we trade above 24,600, which is far away from the opening price, or below 24,300. So there is a 300-point zone where no trading should be done. If we have a decisive breakdown, we'll go much lower. If we break out above 24,600, we'll go much higher. The chances are this may not happen today. That's fine. If that doesn't happen, don't trade.
No, fair enough, and hope you feel better soon, Sudarshan. What would your trades be?
Oh, no, I was feeling fine. I said
He's
the markets
feeling fine,
are not
the
very
markets.
good.
I thought markets are fine and you're not feeling fine. I got this backwards. But go on.
Well, it's an all-long strategy today, and simply because even as the markets are sideways, there are stocks that are doing interesting things. Adani Enterprises is a buy. We had a big up move. So wait for a minor dip and then go long with a stop under 24.15. Jubilant Foods is a buying opportunity, stop under 706. Another FMCG ITC is a buy, the stop under 412. And finally, Hind Petro is a buying opportunity with a stop under 402. This is probably a better idea. Focus on mid caps and let the index be.
Yeah, I mean, the Adani stocks all surged 9, 10, 12% across the board. HP, of course, was the other big outperformer yesterday, shown through 7% or so by close. Mitesh, what would your trades be?
I have more of buy calls. I think Aarti Industries had a good price action yesterday. So buy here with the stop at 442 for targets of 470. CESC is a buy with a stop at 162 for targets of 171. And Inox Wind is a buy as well. Keep a stop just around 169 for targets of 180. One sell call, there's Federal Bank. Keep a stop at about 195 half. Look for targets of 182.
All right, Mitesh and Sudarshan, thank you very much, both of you, for joining us with that perspective. We'll take a quick commercial break here. We're going to come back with a pre-open session. That's in about 3 minutes' time. Dayanand Mittal of JM Financial Institutional Securities also with us on, of course, the big fall in oil prices. It's a big disinflationary boon for global markets, global economy, but we'll drill it down to individual stocks that Dayanand likes at the back of this. Stay with us.
Welcome back. Just about 15 minutes to go before the market opens. We'll start getting our pre-open rates very shortly as well. Prashant, let's talk about wire and cables. Yesterday, RR Cable was the star. Today is Polycab's turn. So let's see if the numbers will be as good or not. Never a dull moment here. Do you like anything in this space? KEI, Polycab, RR Cable, any of them?
If you own them, it's worth holding on for the simple reason that the upcycle continues to favor most of these plays. But what's going to be interesting, what's going to be very interesting is the derivatives that go into manufacturing of all of these, so specialty polymers, whatever companies are there in that. So one of them happens to be from the Supreme group of companies. They supply a lot of these raw materials. So I think the space is expanding. The unorganized to organized shift is right there. It's going at full momentum. And the other thing is that all the lapses that you saw, leakages that you saw in terms of cash sales and all, it's completely out of the way. So there's a very different pace that they've set up, the organized pace. Competitive intensity has taken its toll, brought valuations down, but they're still richly valued given the growth expectation. So if I had to pick any of them, I would wait for weaker times in the market. But yeah, I would believe all of them, and we'll of course get to see what Polycab's the numbers tell you as far as the industry trend is concerned. But it seems quite promising.
Okay, all right, Prakash. I think the casualty of the morning could be Cummins. Because the global parent, they withdrew their guidance, and the commentary on India is very, very good. I'm just looking at a couple of sales notes. The India power generation revenue could come in that vicinity of around 850 crores approximately, which will be a degrowth from what we saw in the previous quarter, which was around 1,250 crores. And on a year-on-year basis as well, it will compare with around 940 crores. And because of that miss, it will lead to the India business as well missing estimates. How would you approach the stock?
So Nigel, that's a very important point. While everything's been very, very rosy in terms of numbers for till now at least, some of these, realities tell you that things are not so. I mean, a lot of the business are not out of the woods. And you triangulate this with the IEX data in terms of power consumption, the trading of power that's going on, and we are getting into peak power consumption months for the next 3 months at least. With all of this, what it tells you is that there's going to be a shift in terms of leadership and the supply chain. Now, some of these players which enjoyed, very superior demand trajectory will probably have to compromise or live with something where there's a shift that happens to lower cost or smaller units and, more fragmented distribution and things like that. So my sense is you'll probably see a lot of the transformer companies do better, and a lot of the BESS, play will start kind of contributing to power, which it hasn't in the last year. So I think a lot of people are gearing up for that, and that's where you should focus on. There are very few companies of scale, but whichever are there, you could probably gain much more than just the pure power generating, equipment. So I do agree there will be a pause, but Cummins has always done this. It's delivered even after these setbacks. So let the setback get digested, and if it's weak for some time, you'll probably start doing a little bit of bottom fishing here. But I think it will give you some time. 2,500 is where it will start kind of getting more attractive.
Okay. All right, Prakash, thanks very much. Great having that perspective. You have a good day, and we'll connect again soon. Well, the pre-open has kick-started, so just a quick glance. It's flat. It's very much in sync with what the implied open was telling us. 15 points higher on the Nifty. That's the sense for now. Let's put the spotlight on the oil and gas space. Of course, there's the fall in crude oil prices, which we have to take stock of. And then yesterday, IGL took a price hike. That stock was surging almost 6-7% higher. So let's discuss all of this with Anand Mittal, oil and gas analyst at JM Financial Institutional Securities. Anand, great to have you on. Let me actually start with IGL as a story, as a stock. Yesterday, of course, lots of excitement. They've taken this 1 rupee hike, I think. They took one in April. Now they've taken one in May. What's your sense on the stock? Because otherwise, there's a lot of regulatory overhang. Every now and then, this gas allocation ends up becoming a bit of a problem. And then more importantly, they are an NCR, entity, largely NCR based. And the policy in NCR, seems to be shifting a little more towards EVs. In fact, in between, there was this whole talk of completely phasing out, the three-wheeler fleet and making it all EV over the next 1 to 2 years. Your thoughts and call on IGL.
Yeah, thanks, Surbi. Thanks for having me. So yes, I agree. IGL, we have a structural sell on IGL and MGL, given both are CNG dominated companies with 70% volume comes from CNG. And as you rightly mentioned, there are two key structural challenge here. One is the APM allocation, the cheap APM gas allocation is on a gradual decline, though partly they were protected because this was largely replaced by new well gas, which is not very expensive, 20% higher than APM. So they were largely okay. But on a medium to long term, given new well gas is part of that APM portfolio only, and overall APM portfolio is on a gradual 6-7% annual decline. So most of this APM allocation has to be replaced by LNG imports, which is at least 50 to 70% higher than the APM prices. So structurally, the pricing power in CNG will gradually deteriorate. And second key structural reason challenge for this both these companies are that the EV policy, which particularly in Delhi, government is implementing on a kind of fast track pace, given the pollution concerns there, that impacts the terminal growth in both this business. So there's no visibility whether after 10 years IGL CNG volume will grow at 0%, 3%, or maybe -5%. So that's the reason we continue to maintain our sell rating on both the names. However, valuations are reaching are at a comfortable zone. They're trading at 13, 14 times P. So from that perspective, there was a bounce on these names given the price hike that it took. Yeah. So except for those trading bounces, which will keep happening depending on valuations. Yeah. Otherwise, I think from medium to long term, it's a structural sell on both the names.
Got it. Gas availability, and then the other is just this whole push towards EV. Before we talk about overall the fall in oil prices, then just to talk about also GAIL, if that's under your coverage, because yesterday there was a report suggesting that the regulator, PNGRB, is holding some sort of an open house. And once again, they'll talk about pipeline tariffs. What do you make of that if you caught that news? And what's your call on GAIL?
Yeah, so for GAIL, this pipeline tariff revision is long overdue. For them, this APM gas price assumption or the gas cost assumption that PNGRB had assumed during this 2023 tariff order was only $3.5 odd. But post that APM got deallocated for the gas transmission business, so they had to use LNG largely, which comes at $10 plus. So that reset in the tariff order needs to be done. PNGRB had done that reset for GSPL a few months back. So it's a matter of time before it's done for GAIL. And there's a public consultation document which PNGRB has floated, which suggests a sharp 30-35% hike in GAIL's tariff, largely basis the correction on the gas cost assumption. So largely it's a matter of time before that hike comes. So we have a positive view on GAIL, primarily because of that long pending tariff hike, and also the transmission volume, given India is gradually moving towards gas, improving in its energy mix from 6% to 15%, maybe not by 2030, maybe more longer term. So that should give a good 5-6% transmission volume CAGR in the medium to long term. And valuation also is reasonable for GAIL. So we like GAIL as one of our top pick in the gas space.
So GAIL is your topic, and you're factoring in at least a 30 to 35% upward revision in tariffs, in the pipeline tariffs, right? You're making that in your estimates. Got
Yeah,
it.
just that because we don't know the timing, we are doing it gradually over 2 years.
Sure.
Right. Dayanand, hi, morning. Oil marketing companies, what are valuations at, and what's your top bet?
Yeah, so the entire oil PSUs, OMCs, ONGC, Oil India, as you know, is a more top-down sector. So a lot will depend on two factors: where is crude prices stabilizing at, and second, what will government do in terms of either excise duty hike or fuel price cut. So first on crude price, so this OPEC surprise hike for second month took us also by surprise. I think there's a conflict between Saudi's short-term interest and long-term interest, and so does for US president as well. So though both parties would like crude to be at a relatively higher level, around 70, for Saudi, it helps them given their fiscal break-even is around 80, 85. And also they need to keep selling stake in Aramco to fund their Saudi 2030 vision. Also for US president, this helps him to use energy as a key source of export to bridge the trade deficit. So long term, both the key players in the oil market would like oil to be at a relatively higher level. But in the near term, Saudi is trying to protect its market share and ensure the two defaulting countries in OPEC plus, Kazakhstan and Iraq, fall in line in terms of complying with the output cuts. So it's a kind of a threat in our view to these two parties to fall in line. And for US president also, I guess this is more as a negotiating tool to get Russia and Ukraine agree on the negotiation. So low oil price means Russia has less bargaining power. So yeah, short term maybe oil remains soft, which might be positive for OMC's marketing business, hopefully till government changes in its view on excise duty and fuel price cuts. But in the medium to long term, we are structurally negative on OMCs, more because of the huge capex which they keep doing on refining and petchem, which tends to be value destructive in nature. And also valuations for both HP, BP are at 1.5 times price to book versus historical 1.1. For IOC, is largely in line at about 1.1 time price to book.
All right. I have more questions, but out of time there. And thank you very much for joining us this morning, and we'll have you back. We'll continue and pick up on some of the points that you've made on that one. Well, a 9-10 call. Sudarshan and Mitesh are with us. Sudarshan, what do you have?
Jubilant Foods. Consider buying Jubilant Foods with a stop under 706.
Okay. And Mitesh?
I'll go with a buy on RT Industries. Look at targets around 470 there.
Okay, Jubilant Food and Aarti Industries are calls coming in from Sudarshan and Mitesh respectively. Just the pre-open has come to an end. If you can just quickly put the Nifty Bank and CoForge up. So Nifty is up 40 points. The Nifty Bank will come up on your screen. It's flat. Nifty Bank underperformed yesterday as well. And let's just look at what CoForge is settled at after the big beat yesterday. It's about 5% higher at the end of, I think, the pre-open session has ended. And just maybe look at Cummins as well, because that's what we want to put the spotlight on next. Cummins, of course, the parent is suspended guidance. Stocks are on about 4%. Vamakshi is here with details on Cummins. Vamakshi, morning.
Well, good morning, Prashant. Well, absolutely. The parent has gone ahead and withdrawn its guidance for 2025. Now, keep in mind that earlier they had guided for revenue to grow between the range of -2% to 3%. The global parent power gen revenues were also expected to grow between 5 to 15%. And the India region, which includes all of the entities of Cummins Inc. in India, was expected to see a growth of almost 10%. And they've gone ahead and suspended this guidance. The second important point that came through from the con call is that the India performance was very weak this time around. In fact, revenue for the India region as a whole saw a downtick of almost 14%. And thirdly, but the most important point that actually impacts the listed entity in India, which is Cummins India, is the power gen performance this time around. In the quarter gone by, they say that the power gen revenues in India saw a degrowth of almost 11%. They say that this is mainly on account of the pre-buy demand on account of the emission regulation change that took place in the same quarter last year. Now, keep in mind that for Cummins India, power gen as a whole is a very significant contributor to their revenues. So therefore, a decline and some soft commentary coming in from the parent company does impact, it does have a negative read-through for Cummins India. So therefore, the stock resultantly is down nearly 4% in pre-open.
Okay, all right, that's Cummins, which is in the limelight. By the way, look at Mahindra & Mahindra. I guess with the notes coming in and the analysis after another stellar quarter, there seems to be some follow-through action on the stock. 3150, it's inching closer and closer to its 52-week high. And another stock worth focusing on, of course, is going to be JSW Steel, because what we're also picking up from sources, and I think we'll have Sapna joining in just a bit on this. It seems the government may take a view on what it wants to do, whether it wants to become a party at all in the whole legal process that's underway right now. We'll get you more on that in just a bit. But Vivek, let's go back and recap the monthly update for IEX.
Well, that's right. So the monthly update for IEX, if you're talking about the combined, taking into account all of the segments that the company operated, it's still a healthy 20% year-on-year growth as far as volumes are concerned. In the key market, that's the day-ahead traded electricity volumes, it's a very strong print, 26% on a year-on-year growth, coming in at over 10,584 units. Now, when you're talking about the market clearing price in the day-ahead market, it stayed quite steady despite the much higher volume. This is at close to 5.2 rupees per unit. This is on account of the fact that the company says that there has been much higher and much better liquidity as far as the sell side is concerned. The company says they're expecting volumes to inch up further on account of the upcoming peak demand summer season. As far as the renewable energy certificates was concerned, it's seen a significant dip, but remember, this has been a very volatile segment as far as IEX is concerned. 2.9 lakh REC certificates were traded in the month of April. It's still a good print as far as IEX is concerned.
All right. Thanks very much. 2% higher, Vivek, on IEX. Indian Hotels is the next one. Mangalam has got details. Mangalam.
It continues to do well this time around as well. 27% revenue growth is what we've seen. The EBITDA has actually jumped by about 30%. And all of that has reflected in the net profit, which has jumped by about 28%. Of course, the overall consolidated numbers were also aided by the Taj Sats business acquisition. But internals are fairly strong. The occupancy at 80.1%. This was slightly higher than 79.4% on an increased room base. And the average room rate also at 21,000, 14% higher than the same time last quarter itself. And this makes it the 12th straight record quarter for Indian hotels. The outlook for FY26, not particularly bad. 30 plus hotels to be added, focus on total revenue per available room growth and capture the growing MICE segment, which is basically the events, meetings, as well as conferences. And you have continued momentum coming in from new businesses, Ginger, Ama, Cumin, as well as Taj Chambers. And they are expecting for Taj Sats as well, new business coming in from the new airport kitchen at Jewar. So all these factors looking good for Indian hotels. Brokerage is also positive on the stock.
All right, Mangalam, thanks very much for that. Just a couple of seconds to go for market open, and we'll have rates coming up on the index, and then we'll go across and look at stocks. The Nifty is up about 20 points, so it's a more settled kind of open, 24,486 or so. The Nifty Bank is up about 0.1, that's 50 points, 70 now. Mid and small cap indices, 0.18, 100-point bump on the mid cap index. The big outperformer yesterday, of course, was the mid cap index. Small caps, lesser so yesterday, about 0.25% higher on small caps as well to begin the day. For the Nifty and the Nifty Bank, it's quickly kind of sort of blinking. It's turned into the red, but barely so. So it's a little directionless this morning as we begin the trading session. The heat map, and then of course straight into individual and specific names that are opening up. It's mixed, as the Nifty itself has indicated. Mahindra on one side, and I think on the other side you've got a couple of these pharma names, Sun, Cipla, Dr. Reddy's. Surabhi.
Okay, so M&M holding on to that 2% gain for the time being. Nifty is suddenly blinking a little bit of red. On the upside, Bharti Airtel, M&M, ONGC, SBI Life, Hindalco. So it's very, very scattered, really no clear trends. Eternal and Trent, two names from the consumption basket, still tracking some green. Nestle has, just about an 8-9 rupee move on it on the upside. But pharma is all down, and this is what Ekta was telling us, that there is nervousness about what lies ahead. Right now, the Trump order that came in yesterday only talks about boosting local production, pharma production. It doesn't talk about limiting imports, but let's see. Cipla's ready, Sun, everything is down. Reliance is the other one, which is down this morning. Geofinance, Reliance, these are other big names on the downside. But everything put together, it's very, very quiet on the Nifty. Now again, about a 20-point up move. So it's flip-flopping, but the bulls are fighting back hard.
Well, that's right. Well, let's pull up a few stocks, actually, some good earnings reactions that we have. DCM Shriram, the margins expanded by 300 basis points. So that stock, in fact, has opened up gap up. The EBITDA number has gone up by more than 50%. DCM Shriram is the one that I'm talking about. Let's pull that up on the screen. CCL Products, the other one that's bursting away. Margins clocking 19.5%. The absolute EBITDA number was up by 35%. CCL Products, the other stock that's bursting away. Hind Rectifier, volumes not very, very high, but those numbers look good. Order book as well is high. And working capital days have come down over the last few years. So that's the other one that's up close to around 10%. Patel Engineering, I saw a flash, when we started our bazaar, that they've got an LOA worth around 1,300 crores from the Maharashtra government. So I guess that stock is higher. But remember, it's been a relative underperformer and it's corrected sharply from the top. Swiggy, yes, it was swigging it away. The stock was up close to around 15%. The street likes some commentary that the management had said. It went up on very, very high volumes. The lock-in ends in the next few trading sessions, so we'll have far more stocks that will be eligible for trading. For the time being, it's cooled off a little bit. And Mahindra, what a beautiful stock that one is. It saw a sharp pullback in the month of February when there were the fears that Tesla is going to come in there. I'll tell you what, the stock is just 3.5% away from making a fresh 52-week high. So that's the kind of bounce back that you've seen on that name. And JSW Steel, there is hope that there is going to be some kind of rationality, some kind of some kind of news flow in favor of them, because as of now the street was factoring that maybe that Bhushan Power and Steel asset gets taken away from them, and you don't know how much of the money will they recover. For the time being, there appears there is some movement on that front. We'll get Sapna to explain to us. That's why the stock is more or less flattish. But CoForge, the stock of the morning.
Just to add, and we'll get Sapna in some time on this to explain, what seems to be happening is that the government, and there's no clear view yet, but it seems, and she spoke with the Financial Services Secretary, And it seems that there is a thinking, because this could cloud perhaps the IBC process, other resolutions that are underway as well. So the government is considering whether it wants to take a view and perhaps become a party in the matter in some way or not. So those thoughts are out there in New Delhi, and Sapna will tell us more. By the way, Yes Bank is up 7%. The Japanese coming, the big name doing the rounds is, of course, Sumitomo Mitsui. Stock's up 7%.
All right, well, so we got 10-point lower on the Nifty, 24,450 is where we are at. Let's just look at the CoForge stock for a quick bit, and it'll give you a quick sense of the reaction coming through. 4%, I mean, numbers are outstanding, but remember, the market, the stocks, of course, come up quite nicely from lows of about absolute lows of about 6,000 rupees to about 7,600 as of yesterday. And, expectations were strong from CoForge. And of course, they've delivered maybe even better than what the expectation out there was. No question about what they've done relative to the rest of the industry. Apart from that, I think we are still kind of sort of, opening up. Market breadth overall, I spot more down than up now on an overall basis. Indian hotels is the number one volume-led loser right now. It's down 3%, 780 on Indian hotels. So it's got very large volumes on it, 2.5 million shares off the block. Cummins India is down 7%. I think we highlighted mentioned this earlier, but 7 lower now. Second largest volume-led loser. Nigel spoke about Swiggy, which is down about 2%. Paytm is coming up with large volumes as well. It's down 2.5%. Oro Pharma, if you want to talk about pharma names, Oro is down 4%. The rest are down 1%, 2%, 3%, but Oro is the big one, which is down 4.5%. Sun, Cipla, etc. I can spot as well. We spoke with RR Kabil, and the stock ended about 14%, 15% higher yesterday. It's down 2.5%, so it's just a little bit of a pullback that you're seeing. I can spot other pharma names, Divi's and Glenmark and Lupin. So these have all, by the way, got decent sized volumes, which are there. And something like a Kalyan Jewelers is down about 2% as well to begin the day. It's completely swung now, fully 2:1 on the downside in terms of declines to advances ratio. Although, we'll have to see where we kind of go from here. On the upside, apart from what we've already mentioned, NetWeb was a big winner yesterday. NetWeb is up about 2% once again, on top of what we saw yesterday. OneSource Specialty, which is the CDMO company which Ektam highlighted in the morning, it's up 2%. So about 1695 or so. Tejas Network has had a very volatile last 2 weeks, 4% this morning on Tejas Networks. DCM Shriram, I think we did mention this.
Yes, DCM Shriram.
Yeah.
10% on DCM Shriram, 1110 on DCM Shriram. So big volumes as well coming through. And then I think we can look at a few other names.
Couple of
Yeah.
more names. Tatva Chintan, the stock is up close to 10%. Big move is what we're seeing on that one. And Unicommerce eSolutions, that's the other one. It's moving high on very, very large volumes. That is well up close to 7%. So select stocks with regard to news flow, with regard to good numbers, the street actually is gobbling them up. CCL Products, I think DCM Shriram, you mentioned, Hind Rectifiers, and a couple of other names.
We're just pointing out that the market started with a bit of a flare, including mid-caps, and now suddenly the color is a little different. It's not too much. mid-cap index hasn't lost too much, but from the peak, it's down about 0.5%. So there's some element of caution creeping in, and advanced decline ratio, as of now, is negative.
Yeah, absolutely. Well, let's just welcome in Vikash Kumar Jain. He's India strategist and head of India research at CLSA. Is with us. Vikash, good to have you with us here. Thanks for joining in. What's the view now, Vikash? Markets have come up quite nicely from the lows. Trade headlines, etc. at the margin have also started to get a little better, but are we already kind of sort of pricing that in? What's your sense?
Hi, thanks for having me, Prashant. So I think, firstly, this is a very interesting time in terms of lack of predictability, and it kind of is humbling when we try and predict markets, that the kind of uncertainties that we are dealing with. And whenever we think about it, my thought process has always been that we need to think of things as probabilities and think of how narratives will eventually play out. There are 2-3 possibilities as I see over the next 2-3 months as things could become a little bit clearer. Firstly, we've had, in terms of announcements, the headlines was the worst at the start of April. Things have looked a little less, little bit more de-escalatory from that point onwards. However, de-escalation itself may not be good enough. Finally, we need to find solutions in terms of what's happening around global trade. And that solution is what the market will seek. Market is currently assigning a higher probability of a solution getting reached. Solution should be read as quick trade deals with most of the trade partners, implying a relatively muted impact on global trade on a slightly medium-term perspective. However, the test of that will be over the next 5-6 weeks. See, so far, bar nobody other than the stock market participants or financial market participants in the first half of April has really felt the brunt of what could play out if there is a global trade war. That will start being felt, starting with people who are involved in global trade, like the port operators in the US and the ship operators. Then it would flow down into logistics operators, and then finally the consumers, because there's been a lot of stocking ahead of this. And then when that stock kind of goes away, all of this, in my opinion, is going to become more visible in June, in second half of June and early July. Incidentally, the 90-day deadline to kind of get on a trade deal also starts becoming much closer towards the end of June, because that's, I think, 9th of July or so. So I would say we're getting to a point where things can again start flaring up if solutions do not become visible. And, that's what we need to appreciate, that we are in a little bit of a calm period where markets can go up on the basis of expectations, but those expectations really need to play out.
Vikash, hi, morning. You know what? I don't envy the job that you folks have right now. There's so many moving parts and so much uncertainty in the world that to predict, where the market is heading is not easy. But we're going to ask you exactly that, right? So like you described, there are two camps right now. The Nifty for the year is actually positive. It's up 3% in 2025, so great turnaround. One of the camps is saying that irrespective of what's happening with global trade, money will come into India because we'll be better than the rest. So the flows will keep the market elevated. There's a second camp which says earnings are a little muted. And let's not forget, we have a big geopolitical situation here at home. I mean, even right now, the market, for instance, is volatility. It's turned very swiftly just this morning. And this is a reality of how we are where we are. Which of these two camps would you be in? And therefore, what is the call for the year?
Like I said, that, I'll say all of this with all humility in terms of, being accurate or not, but just to kind of assess each of these camps. And in the way I look at markets, I try and pay a lot of heed on where expectations are. And after this phenomenal rally that we've seen, and what a turnaround it has been. January, February, the first 2 months, India was the third worst performer amongst all the large markets in the world. And March, April, it ended up being the best performing market in the world. But all of that is, that 3% scoreboard that you said actually hides a lot of excitement in terms of volatility that we have gone through. But I think what we need to look at in terms of expectations is simply where we are right now. India is the most expensive market in the world, most expensive. And that's where what is the starting point for us. What we need to appreciate, and this is something which we bring out even in our note from today, in the first quarter, the only segment of the market which was seeing active increase, a clear increase in active weight for both FIIs and domestic mutual funds was the mega cap stocks. What I define as mega cap is the top 10 large caps. Everything else, that means other large caps, mid caps and small caps, is where they reduce their weight. Now, that just tells you one thing about this rally that we have seen. This rally in India has been driven by the need to find a place to hide. It is not a rally which has been driven by some kind of a beta where you are playing for the excitement of things continuing to get better from very good. That's not what is the foundation of this rally. And that is something that one should bear in mind. So the ones who are celebrating that India should be better off in a global trade war are correct, but that celebration should be muted, because if there is genuinely a proven global trade war, as one could fear, then in that setup, India will do well. But that definition of doing well does not mean that India will go up significantly. It simply means that India will fall lesser than others and India will outperform. But the other side of it is suddenly, if you see the US market, they've from that big collapse, I mean, we almost had a 15% rally. That's like what a rally it has been in the last 25 days or so. That is suddenly also raising hopes that there is going to be trade deals. Now, if trade deals really play out, which is the other side of the coin of, this being only a temporary trade war caused by humans so that someone could get a better deal. If that is the angle, then suddenly the next leg up in the market will come from people who are part of global trade or countries who benefit from global trade coming back on the table. So I think that's a nuance that one needs to kind of think through. It's very difficult to imagine a situation where India goes up more than globally things doing right. So that's a difficult situation.
There's a lot of caution. We're reading between the lines and you're very cautious. So what, best case, flat from here for the rest of the year? I mean, 5% up. Can you put some sort of a numerical range to this?
I think, let's talk about the good case. The silver lining for us is, yields have gone down significantly. And if I were to compare equity and bond valuations, they are not as inflated as typical equity in itself. So, I mean, equity to bond valuation is at a point where you can say they have been around the median levels for us in the last 13, 14, 15 years. So that's one silver lining for us. So I think for the market to even give a little bit of more positive return, the one thing that needs to hold is bonds, our bond yields should not really rise from here. And that is something that is not an easy ask. Although, for someone who's looking at things in a very simplistic way, you can say that, yes, RBI is going to cut rate more. So ideally, that should be easy to hold. But if you were to compare our bond yields versus all of the global bond markets, it looks pretty expensive.
All right, Vikas, before we let you go, I think that FMCG basket was your anti-consensus call after being underweight. I think you turned relatively positive. And Staples, I think, was your top bet out there. Does that hold? Do you see that being the relative outperformer for this year?
Yeah, so I mean, as you would have guessed, that I am not really in this to play a lot of big upsides. And in that setup, Staples continues to be our big overweight in the India focus portfolio that we had. We made a few changes a couple of weeks back, but we've kept Staples as the big overweight. So because we are just trying to find that defensive, which can give us a little bit of return, because we believe that should be that should allow us to outperform the markets.
All right. Vikash, I mean, no, absolutely. And I think some of those points are very well taken. By the way, Vikash, on IT services, we're speaking with the management of CoForge up next, which of course has been the outlier in the IT. Persistent and CoForge, of course, have been doing relatively much better than the rest of the IT services space. What's the big view there? I mean, do you have a view? I know, it's well established. There's a fair bit of uncertainty, etc. But what we are seeing is not just in terms of the trade uncertainty, but technological changes, etc. Is it a bit of a big issue?
So, they are, I would say, let me just kind of IT services, the big view is, since we are in a headline-driven market, for us in India, these are the stocks which will be the headline-driven stocks. Because if something goes wrong with global growth and with US growth, then this is where people will actually be finding their ways to exit or to kind of go short of the ones who can. So that top-down setup isn't great. However, over the last 5-7 years, these companies have come up with very clear cash return policies in terms of either dividends or buybacks, etc. And on that basis, some of them are now coming to levels which one could start seeing people who are more bottom up in their thought process could start seeing some kind of comfort coming in, because after a long time, these are coming back to long-term average, near long-term average valuations. Some of the large caps one. So without going stock specific, it's a little bit of a fight between the bottom up and the top down. I would say the point where the top down news flow starts waning, or the power of that starts waning, is when one should focus on the bottom up more. That is my personal opinion.
Okay, all right, Vikash, great chat as always. Thank you very much. Take all your points on board. We look forward to the next one again soon. Have a good day. Well, with that, let's actually touch base with the management of CoForge. The stock has been reacting to another good quarter. Strong revenue growth has come in, beating estimates. The deal intake is at an all-time high, and the deal pipeline's been looking very strong. TCV numbers looking very good. Sudhir Singh, CEO at CoForge, is with us now for some perspective. Sudhir, great to have you on. And we, of course, remember our last interaction because you always told us that FY25 was an exceptional year and you're poised for good growth. And that's what it is. I mean, 32% constant currency growth in the last year. Now, what about this year? Tell us, and if you could break this down, how much is it organic growth, this 32%? Because you're saying that FY26, you'll build on FY25. So give us some sense of the growth that we can expect, blended as well as the organic.
Well, we don't have a clear guidance for this year, and we don't offer a guidance. But FY25, as you very rightly said, has been an exceptional year. FY26, we believe, is likely to be another exceptional year. We are extremely strongly poised. At this point in time, our 12-month signed order book is 47.7% higher than at the same time a year back. And you might have noticed that through the year, which was FY25, the total order book came in at $3.5 billion US. So at the current point in time, FY25, rightly observed as an exceptional year, sets the way for what sets us up for what we believe is going to be an exceptional FY26 as well.
So should we expect you to reach that $2 billion revenue guidance earlier than what you had earlier said? Earlier it was FY27. Why haven't you just pulled up the timeline because of what you're seeing?
Well, we don't offer revenue guidance, but as we said yesterday in the investor call, we'd be very disappointed if all that we did in FY27 was just hit $2 billion. We believe we have a shot at doing slightly more than that. $2 billion was the guidance earlier. We are not revising the guidance, but we would be disappointed if, given how FY25 has shaped up, how FY26 is poised to perform, if we don't do slightly better or materially better than that $2 billion guidance for FY27.
I think they've not brought the guidance forward because I think it would have been too much for the market to take.
I think it's rephrasing, saying now FY27 will be materially better than 2 billion. So, interesting way of rephrasing it.
It'll be good. Sudhir, hi, good morning and congratulations. The numbers have come in stronger than what you guided for, and you've been sort of consistently sounding very bullish. So I just want to, I have a quality, the numbers we have, right? And you said on the call as well. Tell us a little bit about what you are doing that others are not being able to do, Sudhir. The secret sauce, if I can put it like that. Is it the segments that you're in which are perhaps doing better as compared to some of the other segments which other companies are catering to? Or is it your sales engine? Just three kind of sharp points, what you think you're doing well.
I think a very fair question. Let me just offer you three sharp points, as you said, in return. Number one, our sales approach tends to differ somewhat in that we focus on large deals driven growth. What that means is we're looking for wallet share increase. We're not just looking for or waiting for client budgets to go up or go down and to then keep moderating or taking up our guidance. We go for large deals, 14 large deals in FY25, 5 in the last quarter itself is a testament to that. So that's reason number one. Reason number two, and I've said this, and I've had the pleasure of speaking with you repeatedly, is an execution intensity that is uniquely our own. We follow a three-step process, not just in sales, across the organization, which is plan, execute, debrief. Plan, execute, debrief, plan, execute, debrief, with debrief being the most important. We've done that for 8 years. When you build that execution DNA into a team, not just the sales team, the solutioning team, the delivery team, the alliances team, the partnership teams, then it becomes a moat. Then it becomes a growth driver, which is second to none. And finally, reason number three is a very deep, a very industry-led engineering focus. The $1.56 billion deal that we announced with CoForge, with Sabre, again was engineering-driven, AI-powered engineering-driven. That's reason number three why we're growing.
Sudhir, on Sabre, and obviously that's powering you big time in terms of the deal flow, right? I think it's what, 1.6 billion was the total value of the deal. But there seems to be some concern on the financial health of Sabre. They seem to be deeply indebted, I think $5 billion of debt, etc. So could the receivables, not this year, but in the future, could they be at risk at any given point in time?
Well, the Sabre deal was very hotly contested. If I were to reflect back in the last four, two of the players that we went up against were the large caps. So it's been a very sweet and obviously a very material deal from our point of view. Sabre has, and you would have noticed that just about a week back, divested their hospitality business for $1.1 billion, significantly bringing down their debt outlook. We remain very cognizant of the partnership that we have with Sabre, which has been robust. It's of more than 20 years standing. We're very aware of their financial standing at the current point in time. And as we've said, when the deal was also signed, we've got very strong commercial structures in place to make sure that just about any contingency that comes up is something that we address directly, squarely, and very, very early.
All right. Hi, Sudhir. Good to see you, Ben. We did track what Sabre did, with deleveraging their balance sheet, and that would be good for you. Your organic revenue growth for the past year was around 14% approximately. Now you have this big deal of Sabre as well. So would it be fair to assume that the organic growth could be in high teens from around 14%? It's going to be better, so it should be in that vicinity of, say, 15 to around 20%. Should it be around 18 to 19%? I'm looking at a couple of sell-side notes, and they are estimating that. Add to that the inorganic growth, we should be in the vicinity of, as a consolidated entity, to grow by around 23, 24%?
Well, we don't, as I said, we don't offer numbers. I've seen some of the reports that you alluded to. All I can tell you is the confidence, and I suspect you can sense that from my tone and from the investor call yesterday, is sky high. It is not riding off deals that we will sign in the future. So that pipeline is very strong. It's also off the back of the signed order book that we have. So without getting into numbers, we believe organic growth will be very strong. And we will, as always, keep looking for inorganic opportunities if we find something at the right valuation through the coming year.
Okay, all right. Sudhir, let's focus on a couple of aspects. You've said that your margins will improve as well. As you head towards that $2 billion target, what's your take? Where do margins settle at? I think for this year, you're guiding for around 150 basis points improvement. So once you hit that target, where are you headed in terms of targeted margins? And also tell us a little bit about the wage hikes. Will that be happening in the first quarter? Is it postponed a little bit?
Well, margins, we've been very clear. By the time we hit $2 billion, our reported EBITDA, I'm talking reported, not adjusted EBITDA numbers, reported EBITDA will go up by another 140 bips. We believe we are firmly on track to get to that. As far as wage hikes are concerned, we did our wage hike 3 quarters back. At the end of 4 quarters, which is going to be 1st of July, is when we will step back, look at the market, and take a call on wage hikes going in at that point in time.
Sudhir, just a sort of quick word on this entire AI business as well. Do you believe the common kind of narrative is it will not impact, but you just see the headlines from around the world, right? Salesforce saying that they're not going to hire any coders and programmers for the rest of the year. Microsoft saying 30%, I think it was 40% of the code already being written is being done through AI. For Indian IT services companies, is it a bit of a, not an existential threat, but what's your sense? How will this play out?
Prashant, if I reflect back on our growth and if I reflect back on why we are growing, one of the biggest reasons that I would attribute to is the way in which our sales engine has pivoted towards, and solutioning engine has pivoted towards AI-led deals. It's been the extent to which not just the delivery team, but the training function at CoForge has been able to, at scale, train folks, starting off with foundational AI-based training, and the extent to which our sales pipeline is getting impacted by firms like Salesforce, by firms like ServiceNow, by firms like Microsoft, which are key partnerships for us. So from our vantage, at least from my personal perspective, I can say that AI is an incredibly, and we all know this, powerful general purpose technology. We realize that technology spends are only going up. We also realize that technology spends will pivot. As long as a firm, as long as a team is able to pivot with speed and align with the opportunities that AI is throwing up, good things will happen. Out of the 5 large deals that we closed in the current quarter, 3 would not have happened had the solution not been led with something, with a framework that was completely AI underbid led.
All right. Well, that's...
Sudhir, just one more point, Sudhir. You briefly spoke about some inorganic growth. Is there something that we should be hearing about in the near future?
No, there's nothing that's imminent. As I said, we keep looking at opportunities. If something does come up through the year, we will absolutely bite on it, provided the valuation is right, provided it is a strategic fit. So nothing that's imminent. But as always, we continue to look at opportunities. And our acquisition track record, as you know, has been 100% in terms of making them successful.
All right, Sudhir, we wish you all the best of luck. And of course, that Signity acquisition is sitting with SEBI, I think, and that perhaps will go through as well. Thank you very much. Thank you for joining us, and good luck to you and your team as you continue to execute. Because I think, from what I heard, it's all about execution and the way CoForge is going about it in the current environment. It's a nice numbers, 7777 on CoForge. It's up about 3.75% right now. Well, there's a review petition coming, and that's the big story which our colleague from Delhi, Sapna, is telling us. This is CNBC-TV18 exclusive source-based information. A Supreme Court has, of course, scrapped the Bhushan Steel acquisition by JSW, and there is a review petition, we understand. Sapna, tell us more.
Well, it's all very early stages, so this is what we are given to understand. Probably a go-ahead has already been given. So sometime soon we may see some action on this front in terms of both the banks filing a review petition as far as the JSW BPSL deal being termed as illegal by SC is concerned. Having said that, if you observe yesterday, the DFS secretary was also extremely clear that within the government, they have actually studied the order with all the lenders, and a view is being taken in the government. Most likely they will finalize this very shortly. Obviously, all the legal opinion will have to be taken on board. So, just to give a background, Prashant, I think this week all the preparations are likely to unfold, and maybe next week, you could see action coming in. So one piece we have already put out in terms of PNB and SBI are likely to file the review petition, and we have to keep a close watch on this story. It's a developing story.
All right, no, absolutely, and it's an important one at that. Reviews are rare, but one is being planned, as Sapna is telling us. This is early, but I think we should see, as she said, action in the next week. Sapna, thank you very much for that quick update. We'll come back with the management of CAMS as we decode their fourth quarter earnings. Stay tuned.
Welcome back. Well, let's focus on a couple of names. Before we do that, just pull up the intraday chart of Cummins. The stock actually has seen a bit of a recovery from the low point of the day. It got smacked back. I think it was down closer to 6.5% or thereabouts. Currently, it's pulled back a little bit from the low point of the day. So keep an eye out on that one. But as promised, let's get chatting with the management of CAMS. Their quarter four performance was a little bit lower than what some were estimating on the street. What's the outlook from here on, and how do you see business shaping up? Well, we're joined by Mr. Anuj Kumar, the Managing Director and the CEO at CAMS. Hi, Mr. Kumar. Good morning, and thanks a lot for joining in. Well, for the past year, you ended up with a revenue growth of close to around 25%. What are you targeting in 26%? And if you give us a broad breakup of this growth between your different businesses.
Sure. Good morning, and thanks for having me on the show. Just to kind of decode what happened in the fourth quarter, I think it kind of demonstrated the resilience of our model. Like indices, especially the large cap indices, fell almost 14 to 15% at the bottom in this 3-month period. If you see the results, our revenue went down only by about 4%, out of which you can think of about a 1.5% contraction coming because of business reasons, which is absolute volumes and business-related revenues, and about 2.5 to 3% adjustment because of a price adjustment that we were doing over a period of time for one of our large contracts. So it shows the resilience of the model, both the MFRTA business, the KRA business, and part of the payments business, not the whole of it, get impacted every time investor sentiment is down in the mutual funds and capital markets. So I think that's fantastic resilience. Last year was a great year. Like you said, we grew revenue by about 25%, profit by about 30%. In this year, I'm just cognizant of the fact that some of this price reduction that we had to do, about half of it has played out. The balance half has to play out over the rest of the year. So we don't give any forward-looking numbers. I think an overall revenue growth rate in the order of early teens is perhaps what you will see in FY26.
Okay. All right. Early teens. Got it. A couple of more aspects, sir, with regard to the profitability. You had mentioned in the past that we could be looking for some yield compression. Given that yield compression that we saw partly in the past quarter as well, will you be able to maintain margins in that mid-40s that you have been doing? And what are the levers you have to offset the impact of this yield compression?
So I'll give you the good news first. The good news is that in the non-MF businesses, we've grown in excess of 20% in the last 2 years. We're projecting about a 25% growth this year, which means wherever we have a platform functioning, I've already invested in the platform in sales and product, and any revenue that comes largely will flow to the bottom line. So non-MF has been a great story. Despite whatever happened, all the puts and takes, including the price in the fourth quarter, we are holding operating EBITDA at just short of 45%. Now, that's again a great testament to the resilience of the model. So again, my estimate is that in FY26, you will largely see one of the two numbers, either 43 or 44% operating EBITDA for the year. For the initial quarters, it may be more like slightly under 43, but we are almost confident for the year we should be able to return about 44%.
No, got that. In terms of the in terms of pricing from here, right? As you said, you took a price adjustment, Mr. Kathuria, with one of the customers. What would you have pricing leeway this year, or you think pricing perhaps moves the other way, a little bit under pressure as market environment, etc., remains a little uncertain, or it doesn't work like that? Just explain that to us, sir.
So the way it works is that in the digital era, the era of differentiated services is ending, which means that you will see almost a near uniform, I would not say uniform, but near uniform price across large clients. So I think that's the adjustment we made. In the non-digital era, till about 3 or 4 years back, we had some differentiated pricing that is going away. So you will see a small yield compression from here in FY26, largely led to this contract. Like I said, 50% of the adjustment we've taken in the fourth quarter, the balance will happen in the balance part of the year. But at an absolute level, we are confident that between 43 to 44% operating EBITDA should be delivered over the year in FY26.
So the non-MF business will grow at about 25%. On the MF business itself, Mr. Kumar, just give us some perspective. There's been a fair bit of debate on this whole SIP stoppage, etc., and whether eventually there's a fair amount of redemption pressure building up as well. What particularly are you anticipating on the MF business if the market continues to be range-bound?
I will just give you one headline. Read the collection numbers from SIPs, which grew in 4Q over 3Q and have successively grown over the quarters. Some attrition in SIPs has been a part of the marketplace for a very long time. A 40 to 50% first-year attrition is seen. But if you just watch what the collections have been, they've been extremely positive, and that's been a great sign. We believe the middle and bottom of the pyramid is holding this entire structure up. The Choti SIP and Jan Nivesh and those kind of things, as they get launched, will bring one brand new segment into the market. HNIs have not been holding up the MF market. So we are very positive that as the glue in the behavior of investors continues to demonstrate what it has demonstrated, they haven't panicked in the last 8 months and hopefully will not panic, you will see absolute growth from where we are.
What should we expect? If we talk about the revenue split, say by FY27, what will be the contribution of MF versus non-MF? And if you could give us some sense on margins on both these businesses as we look at the next 12 months.
The MF margins are in excess of 45%. The non-MF margins are in the range of 25 to 30%, which is a very good number. Remember that most of our businesses are of the order of a platform. So whether I take Account Aggregator, MF Central, Bima Central, all of those are typically platform businesses. So today, think of the margin split as in excess of 45 for MF, in the range of 25 for non-MF. Given the fact that most of them are platform businesses, most incremental revenue goes to the bottom line. So over a period of time by FY27, we believe that non-MF revenue contribution should be of the order of 17 to 18%. It's about 14% right now. It will continue expanding. And from a margins perspective, we see us recovering back to 45 and 46% in the next 2 years.
All right, Mr. Kumar, thank you very much for joining us and running us through all of that. Very, very useful information there coming through. Appreciate it. Well, let's move on to the next management. Indian Overseas Bank is the bank on our radar next. Fourth quarter numbers came through. Advances saw healthy growth. Margins have improved, while loan growth momentum is also healthy. We'll talk about the numbers on Indian Overseas Bank, but we'll also talk about the entire JSW Bhushan Steel issue. Mr. Ajay Kumar Srivastava is Managing Director and CEO at the bank. He's with us now. Mr. Srivastava, good morning, sir. Prashant here.
Good morning.
Our colleague from Delhi, Sapna, just told us that lenders are considering, and it should move forward next week. Hopefully, I mean, this is source-based information, that they are considering a review petition in this regard. Indian Overseas Bank recovered, the numbers that I have, about 760 crores from this resolution, which was about 2.6% of your net worth, which is about 2.6% of your net worth. Could you first tell us if you are privy to these discussions, sir, in terms of a review petition?
Yeah, in fact, these discussions are going on since the time the order came out. And the plan is yet to be finalized, and all the options are being discussed, and those options are on the table. Maybe in a couple of days, the action plan will be finalized. But having said that, from IOB side, what I have to say is that the 760 crores we did get. And in the worst case scenario, even if we are supposed to refund it, I have to say that we are having sufficient cushion in the balance sheet, and this can be handled it very efficiently without creating any adverse impact on the balance sheet.
I got that. So let's just take it one by one. First of all, you are confirming that discussions have been ongoing since the judgment, right? And a review petition is also very much at the table, but nothing has been decided. And perhaps action in the next few days is likely, right? I got that clear.
Yes, it is under discussion only at this stage. Nothing has been finalized. And as I said, that all options are on the table.
As review petitions are, the admission of review petitions are generally very rare in the Supreme Court. I mean, that's essentially just the history of it, sir.
I can say that nothing has been decided as yet. Everything is on the table only at discussion stage. Maybe in a couple of days you will come to know.
No, absolutely. I completely agree, and it'll be a joint decision in that sense, whatever is decided. But what I was coming to is, as things stand right now, how will you treat this? I mean, if, say, for example, the judgment has come and that's it, what happens? Will you have to, this money goes back to JSW? How will you treat it, sir, this recovery?
See, we are prepared for all the eventualities, and as I said, as far as IOB is concerned, the 760 crores, in the worst case scenario, if finally it happens, and that if is a very big if. If it happens, we are having sufficient resources available in the balance sheet to handle it without creating any adverse impact on any of the numbers of IOB.
Will you have to create additional provisions, sir? That's what you're saying, right? And you'll be able to. The balance sheet is strong enough to be able to handle that. That's essentially what you're saying.
Exactly, yes.
Okay. All right. Hi, Mr. Srivastava. Good morning, and thanks for that detail. Couple of questions now. I tracked the asset closely, actually, and the asset today is in far better shape than what it was, say, 5 or 6 years ago. Are you optimistic? In fact, you can realize a bigger value from this particular asset whenever it goes for rebidding. And also, according to you, do you believe JSW Steel will be eligible to rebid for this asset?
It will be difficult to comment on that because lots of legal issues are involved. And the legal team is working on it. And I do believe that whatever decision happens, of course, it will be in accordance with the law, and whatever, I do believe that whatever is good for the Indian economy overall as a whole, and for the banks, that type of decision will come out. That is what I believe in.
And maybe you can get a bigger value than what you got earlier because the asset is in far better shape?
Exactly, that can also happen, yes.
So that means that while there is a review petition, in the event there is a liquidation, I mean, your interests are more than covered, even if you have to pay back the 760.
Yes, absolutely.
Okay. All right, sir. So let's see. I think we have a next very important couple of days as far as this matter is concerned. And thank you for sharing the on-ground perspective with us. Now, I just want to come to the business itself, Q4, and want to start by understanding the asset quality picture, sir, because your slippages have increased quite a bit and you have taken high write-offs as well. Let's actually get those numbers on the screen for our viewers. Slippages at 2,753 crores, far higher than Q3. And there we go, write-offs at 3,000 crores. So with the write-offs, obviously, the GNPA ratio is looking fine. So what happened, sir? Where are these slippages coming? What were the write-offs? And what are you seeing on asset quality?
Yes, so asset quality is perfectly fine if you look at the numbers. And there is one information which is already in the public domain regarding MTNL. And IOB was having an exposure of 2,330 crores in MTNL. That slipped in Q4. And against that, we have made 100% provision. And that is how the slippage ratio, the numbers you are seeing slightly at a heightened level as compared to previous quarters or last year also. If you take that 2,330 crores out of the total slippages, then total slippage for the bank as a whole, for the year as a whole, it's only 1,200 crores, which was 1,500 crores last year. So it's only one-off incident, one account. And that too, the balance sheet was so resilient that we have made 100% provision against that. And that is how GNPA and NPA, none of the ratios have been impacted.
Got it. Just a second, sir. When we had the visuals from Ather Energy's listing, maybe we can get them back up. It's an important one for the market, considering the way Ola went, not the best of experience for a lot of investors. Now, this is the next, the second pure play EV company to list. It's a quiet listing, which is what was expected. It was always supposed to be quiet. The subscription levels were also not the biggest, steady, about 1.5 times the total size of the book. There's over 2,000 crores of money, fresh money that's coming into the company. There are some existing shareholders that are selling as well. Big day for Ather Energy over there. But back to IOB. So what you're saying is that explains the slippage point, that it was all MTNL. But otherwise, asset quality looking good. So let's talk about growth, because growth in the fourth quarter was very strong for you. FY26, what is your loan growth target?
Yeah, last year also the guidance was 12 to 13% of growth in credit. This year also the same guidance continues, and anything about 13%, between 13 to 14%, 15%, that is what we are looking at. And in addition to credit also, I have to say that since entire industry is struggling for deposit growth, the guidance which we gave last year was to the tune of around 10%. And we almost we are there, 9.86% growth in deposit we could show.
So 13 to 15% loan growth target is on the higher side. When you talk to most banks, most talk about 10 to 12%. So 15% sounds fantastic. What will drive it? Which segment? I mean, are you seeing a revival in corporate loan demand? Will it be MSMEs? Which segment?
It's all segment. If you look at the portfolio of IOB, we are having retail, credit, retail, MSME, agri and corporate, all equal proportion to the tune of 25 to 26%. And there's no concentration on any one area. So retail, agri and MSME will continue to grow, like we have grown around 20% over last year. And corporate, of course, will be we are going to pay special attention to that corporate sector, mainly on those industries where government's PLI scheme is operational. So those sectors we are eyeing at.
Okay, and just a quick outlook on the margins, sir, as well. Again, they've held very steady year on year, but as we look at the rate cut cycle, I mean, how quickly will you be repricing your deposits, and what should we expect on NIMs, say, over the next couple of quarters?
Yeah, there will be some pressure on the margin. Our NIM stands at 3.58 as on 31st March 25, and we do hope that there will be some moderation, but we are very hopeful that we can maintain it between 3.4 to 3.5.
Okay, all right. So we'll leave it on that note. Thank you very much. Very helpful conversation. Lots of perspective on not just the JSW asset, but the slippages, the NIM, and the overall growth prospects. So looking confident as far as growth this year is concerned. That's Indian Overseas Bank. Back to the market, quick check, and things have turned for the worse, actually. The Nifty is down about 0.25%, Bank Nifty is down 0.5%, and mid-caps are falling a little more. Nervousness on the street. Mitesh is back with us. Mitesh, what's the advice now? Index and stock calls?
Good morning again. I think the Nifty, is traveling clearly around this 24,500, 520 mark. So wait for that to be cleared or wait for a decline to buy into. But on the stock side, I have one buy and one sell. IRB Infra is something which is slightly turning negative. So sell here with a stop at about 46 for targets of around 42.5. And Hero Motors, and in fact, the auto pack is doing well today. So Hero Motors, that's a buy. Keep a stop below levels of 3,800. Look for targets of around 4,000.
Interesting names there coming through. Well, 60 points lower on the Nifty. Mitesh, thank you very much for that. And we'll come back with more a little later. We take a quick commercial break here. We're going to come back with some specific stocks which are in focus and what's moving around. Market breadth is firmly down. 700 up and about 1,700 lower. Stay tuned. Coming up. Okay, welcome back. I think the markets, of course, under some pressure, about 50 points lower, not very much. 24,400 odd is where we are now trading at. Maybe just look at sectorally what's going on, because, of course, we're going to talk about stocks as well. The PSU Bank Index with a 1.5% cut is the top loser. The real estate index is down about 1.25%, and the Nifty Pharma Index is down about 1% as well. Actually, these are the three large indices which have got cuts over 1% right now. Otherwise, lots of 0.5% cuts, but nothing very major. The auto index, the Nifty auto index, perhaps is the sole large sector which is in the green. And I think it should say a big thank you to what's happening as far as Mahindra & Mahindra is concerned. I don't think there's anything else happening as far as the other auto stocks. Okay, actually, Hero is not doing badly either. So, actually, the top two gainers on the Nifty are Mahindra and Hero. 3% on Mahindra & Mahindra, and Hero, which is up about 2.75%. So that's that. iSure is up about 2%. I'm looking for some other auto. Bajaj is up about 1.25%. Yeah, so it's actually a bit of a sectoral move, led by, of course, what's happening with Mahindra. Let's actually talk about that particular name, right? Mahindra & Mahindra. And Sud is here with what the street made of the numbers and the commentary posted. Sud, over to you.
It seems to be a good day for all the auto stocks, but especially talking about Mahindra and Mahindra, it's a consensus buy by brokerages. Most of the brokerages remain positive after Q4 results that company has posted. Amongst all the auto names that have posted results so far, M&M's results were the strongest one, and even brokerages are positive for the FY26 outlook for both these segments, auto as well as tractor, and target prices as high as rupees 4,000 per share. So first talking about Kotak Institutional Equity stake, it maintains buy call target here is 3,500. It says company is firing on all cylinders and strong FY26 outlook that company has given for across verticals, and it expects company to continue outperforming industry even in FY26. Jefferies too maintains buy call and it has a target of rupees 4,000 per share. It says company has delivered 12th consecutive quarter of double-digit EBITDA growth, and there is a room for further re-rating with strong growth outlook and improving franchise. For Jefferies, Mahindra & Mahindra remains its top pick in the auto, also in the list of preferred buy list, and it sees 18% core EPS CAGR over FY25-28. CLSA maintains outperform call and it has raised target to 3,652, but it has lowered FY27 earnings estimate by 1.5% on higher depreciation expenses, and that is related to electric vehicles. Nomura too maintains buy call and it has raised target to 3779 from 3681. It says company has reported industry-leading results, and Nomura maintains company as its top pick, and it expects SUV CAGR at 14% over FY25-27, and it believes that BEV, that is born electric vehicle, will be a key driver of sales growth. So overall, it's a consensus buy. Most of the brokerages remain positive on M&M after Q4 results, as well as regarding the outlook for FY26 that company has given.
All right, so thank you very much for that. Cummins is the other one on the way down, though. Vamakshi is here with what they've done with regards to dropping the guidance. Vamakshi.
Well, absolutely, Prashant. You know, the first point that came through from their Q1 2025 numbers is that they've withdrawn the full year forecast, and they have done this on account of the tariff-related uncertainties. Now, earlier on, they had guided for revenue growth in the range of -2% to +3%. The power gen revenues were expected to see an uptick of 5 to 15%, and the India region as a whole was expected to see an uptick of 10%. But given the kind of tariff-related uncertainties that are unfolding, they've gone ahead and withdrawn this guidance. The second important point is the performance of the India region. So India region as a whole for the company saw a degrowth of almost 14%. Now keep in mind, this is not just for Cummins India, which is the listed entity, but there are several entities of the global parent in India. So this degrowth of 14% is for all of these entities combined. And the third point, which is the most important point for Cummins India, is the performance of the power gen business. Now for Cummins Inc., the power gen revenues in India saw a degrowth of almost 10%. They say that this is mainly on account of the pre-buy demand that we saw on account of emission norm changes in the same quarter last year. So therefore, given the kind of degrowth that we're seeing in the power gen business for the global parent, it has a negative read-through for Cummins India, and that is because a significant portion of their revenue comes in from the power gen business specifically. There could be some downward revisions to the earnings estimates for the quarter four for Cummins India. Overall, negative impact, negative sentiment. Overall, going with the stock is down and out in trade today.
Okay, all right, Vamakshi, thank you very much for that. It's a pretty comprehensive explanation of what's happening with regards to Cummins, about 5.5% lower. Now, news reports suggest that Sumitomo Mitsui Banking Corp has gotten the RBI approval to buy 51% stake in Yes Bank. But I think we want to provide a clarification on this story, which Latha is going to help us with. Latha, over to you. What are you picking up?
Okay, well, the flash will come up in a minute, and what it will tell you is that the story is incorrect. Banking sources, usually very reliable, have told us that this story is incorrect. Reserve Bank has not given any nod to any entity to acquire 51% stake in Yes Bank, and that is because there is no application pending in front of RBI from Sumitomo Bank. So this story is baseless, comes from sources who are usually reliable. And we also contacted some legal people who normally work for the Reserve Bank, who do central banking issues. And they say the law allows an entity, if found fit and proper, to hold up to 26% stake in a bank Like, for instance, in Kotak Bank, Mr. Uday Kotak holds 26%. That is the maximum that can be allowed under RBI rules. 51% would be very, very unusual. It has happened in the past. In Catholic Syrian Bank, you had Fairfax. But it's an extremely unusual situation. This is what the legal source told us. But the important point for us is that this story is entirely incorrect because there is no such application in front of RBI. That's what we are picking up now.
Well, that's quite great. Not only is there's no approval, there's no application.
That's the point.
Stocks coming off. It started to come off a little bit. Was up 4.5%. Has given up a little bit of those gains as we speak. So that's that. Well, we'll take a quick commercial break here. I'm going to toss it across to Lata once again. On the segment is the economy. And she has Pranjul Bhandari today from HSBC on India's growth prospects later this year. Stay tuned. Coming up.
Welcome to It's the Economy. HSBC India has put out a very interesting report on consumption trends in India, which will be of a lot of interest to actually stock market investors also. The chief India and Asia economist, Pranjul Bhandari, says that until last year, India's agri and informal sector saw low consumption due to climate and other shocks, while the formal sector grew very strongly. Starting this year, the agri and formal sector may do better due to low inflation, benign monsoons back-to-back, while the formal sector consumption may go down because of tariffs and other problems hitting GDP growth. Now, an equities person will probably interpret this that consumer staples may do well here on, and we're already seeing it in Marico's numbers, and discretionary consumption may slow down. Well, that's my inference. That's not Pranjul Bhandari's. But let me get Pranjul Bhandari, the economist from HSBC herself, and the author of this very interesting analysis. Pranjul, good morning. Thank you very much indeed for joining us. First, present your thesis to us.
Okay, thank you very much, Lata. So, look, I think if there's one thing you want to track in the economy this year, it should be consumption. Because at a time when external demand is impaired because of all of these tariff-related uncertainties, those economies that can unleash domestic consumption firepower are the ones who will see much stronger growth. So where does India stack up on this front? I like to break up India's consumer into three parts. One is the agricultural informal worker, the other is the non-agricultural informal worker, and third is the formal worker. Interestingly, all these three groups make up 1/3 of consumption each. They're equally sized groups. In the last couple of years, both the agri and non-agri informal sector worker was doing very poorly as consumption was weak. Overall consumption growth was about 4.5% below overall GDP growth. Whereas the formal sector, the third group, was doing much better. They had the benefit of high wages, equity market returns, which were very strong, access to personal loans, which were rising very rapidly, and they were consuming a lot. Unfortunately, they only made up 1/3 of the consumption basket. And if you look at overall consumption was not very strong. But everything is having a reset this year. The informal sector, agri and non-agri, are doing much better. There has been a bumper crop, wheat, rice. For the urban informal workers working in small firms, commodity prices are falling, which will be good for their profitability. Inflation is falling, which will be good for their real purchasing power. So 2/3 of consumption is doing well now, whereas the remaining 1/3, which is formal sector, is going to fall. But overall, after many years, we are going to see consumption growth actually being fairly strong, in fact, stronger than overall GDP growth, simply because the informal sector is going to do better than before.
Okay. Well, that's actually very good from an equity angle as well. Was my inductive leap correct, Pranjul? Since I'm a stock market reporter, I tend to look at it as staples may get more demand now because the bottom of the pyramid will be better off.
Yes, absolutely. I think you got that right. And I can already see that not just in the equity market results, but also in some of the macro data that I track, that rural wages have been ticking up in the last couple of months. Very interestingly, in terms of the share of unpaid workers in India are very large. They are falling, and the share of paid workers is rising, which is good for the informal sector incomes. And finally, we are also seeing very interesting thing in GST collections, that domestic GST collections are rising, which means that the small firms are also doing well. So we are already seeing this in the data.
Yeah, actually, Nielsen put out an interesting data as of December 31 when they analyzed, and they also said that small firms are seeing more demand. One assumes that they are in smaller places. But Pranjul, you're also, you put in a caveat saying that overall growth is going to fall. What are your growth numbers, and are they even lower than 6?
So look, overall growth numbers are going to fall. And, let me put all of this in context. Consumption growth is going to be better than before, but investment growth is likely to be worse than before. The formal sector, which was doing well, people like you and me, Lata, with proper wages, access to social welfare, people like us were doing very well in the last couple of years. But if our consumption softens in the next couple of quarters, then remember, we are also the investing class. We have the surplus, we buy houses, we take mortgage. That demand is likely to come down, and that's a very important part of investment growth. So my sense is this is going to be a year in which investment growth will be lower than consumption growth. Completely the opposite of what we saw in the last couple of years, where investment growth was higher than consumption growth. So one thing that's going to be weak is going to be investment growth. The second thing that's going to be weak, I think, is personal credit growth. The demand for personal credit growth is going to fall. If the formal sector is not going to be buying houses, then the demand for housing loans will fall. If the informal sector is now finding enough incomes, they may not take consumer loans to make their consumer needs. From both consumption and investment loan perspectives, credit growth may actually fall off compared to the last couple of years. The only silver lining here is that it's good for the consumer, for household to go through a period of deleveraging, because when the new growth cycle starts, they will have much healthier balance sheets. But I want to put all of this in context. Informal consumption will be better than before, but investment growth could be softer and credit growth could be softer.
Oh, that's a very interesting and convincing thesis, Pranjul. I just want to correct one of your premises. You began by saying that people like you and me, please, media and journalists have not seen increments in a very long time. It's a highly disrupted sector. But I hope you and your ilk are doing very well. To come back to the growth pace itself, the IMF and even the Reserve Bank have pulled down growth estimates, the Reserve Bank from 6.7 to 6.5. But on the street, I got much lower estimates. The numbers I got were between 6.1 and 6.3. Have you recently downgraded GDP growth forecasts?
Look, our GDP growth forecast for this year, with enormous amounts of error bands, because we don't know where the tariff storm will rest, is 5.9% growth, which is about 50 basis points lower than India's potential GDP growth. Look, this assumes that our reciprocal tariffs will be at about 26%. Right now, of course, for 3 months, it's been put at 10%, but we don't know where it will be after 3 months. In case our reciprocal tariffs are not increased very much, then I will be very happy to upgrade my growth numbers. But, even if I upgrade my growth numbers, I'll probably upgrade it by about 10 or 20 basis points. The reality is that global growth, global trade, has been disrupted in a major way. And I think in a quarter's time, we'll start seeing that in our GDP growth numbers.
Okay. Well, just to play the devil's advocate, the factors that could be propelling growth, we have this income tax rebate, income tax cut, which becomes effective from this month. No, actually, now from last month, from April. So a little more consumption, money is available in the hands of people to spend. And inflation is falling for all of us as well. Interest rates are falling. The 10-year yield, when was it last at 6.3? I think COVID years, 2021. So cost of loans is lower. The expectation is that this will also keep the formal sector and consumption propelled. You're not buying that part of, higher take-home pay and lower cost of capital, lower cost of interest can push up consumption?
Look, 5.9 to 6.1% real GDP growth in a year where global growth is likely to fall, countries like the US are going to come to a near recession-like situation, is actually a very strong growth outcome, Lata. And I must say within this, I'm buying what you're saying, that consumption will do very well. But remember, on the other hand, investment, which gave us a lot of boost in the last couple of years, will not do very well. Household demand for real estate, FDI inflows around the world, which propels corporate investment, I think all of that is going to be very weak. So we have to keep both of them together. I also agree with you that the income tax cuts are going to help the formal sector consumption, but I think only on the margin, because this is the sector which tends to save more than they spend. Their marginal propensity to consume is a little lower. So I don't think the income tax cuts can solve all the problem of the formal sector. So while I agree there will be relative winners and losers, and I think the informal sector in a crude way could be a relative winner because, weather is supporting them, low inflation, low oil prices are supporting them. On the other hand, we must remember that this is a year in which growth everywhere is impaired. So overall growth will be a bit softer than before.
Okay. Yep, 5.9 would be a bit of a shocker, but you're not alone in that sub-6 number. There are a couple of people who are extremely worried about the global headwinds. And as you say, even in the formal sector, I think the upcoming interview is going to be with Indian hotels, and they are shown 30% profit growth, 35% margin. So yes, there are exceptions there. But Pranjal, since I have you with me, I wanted to ask you this inflation question. There was a large expectation of disinflation because China is not able to push its goods, or Vietnam is not able to push its goods into America, and therefore there will be general disinflation in Asia. But lately in India, there have been 2 or 3 things which is worrying inflation forecasters. One, anti-dumping duties on steel, and therefore local steel products could get expensive or have gotten expensive already. The other one is just now, after a 2-year hiatus, we saw milk prices being raised by Amul and some of the big milk producers. So do you think RBI's 4% inflation forecast is under threat?
No, I don't think so. I think it's very clear to me that we are in a period of low inflation for the foreseeable future. I think the biggest thing that's worked for us is food inflation coming down. And it's not just a story of vegetables and fruits, which is generally just a 3-month story. It's a story of lower cereal prices, which have been a big pain point for the last couple of years. We've finally been able to get enough rice and wheat production over the last 4 to 5 months. Government granaries are full up. And this, once this is full up, it becomes basically a cushion for the next year or 2 because cereals can be stored. So because cereal is falling, cereal inflation is falling, I think it makes low inflation a little more sticky. So I would say, we are doing well from that front. Also remember, 3 months ago, we were so worried about the currency depreciating and the FX pass-through of that. Now the currency is much stronger. That whole FX pass-through story has subsided. And finally, we have oil prices which have come off in a major way. So I think we should keep all of this in context. I agree there are some sectors like steel where the story is different, but the overall macro story, I think, is firmly for lower inflation. In fact, I would say that inflation could be much below what the RBI is projecting. RBI is projecting about 4% for this year. My sense is it will be closer to about 3.7%. Basically, creating a lot more space for the RBI to continue with its, soft monetary policy.
I'm being warned I'm out of time, but what's your forecast in terms of RBI cuts? Is the end repo rate 5.5 or does it go even lower?
5.25 for me, so 3 more rate cuts to go. This would basically mean it's going below neutral policy rates, which is what you need if growth is weak. And
yeah,
we
no,
have
fair
to-
enough. If you have an inflation which is going to be under 4%, under their mandate, they will have to go under their understood real rate. That expectation is very much there. Thank you very much, Pranjal. Out of time, but that was a very interesting conversation. Pleasure speaking with you. Have to wrap up on Bazaar. Chartbusters coming up after the break.
M&M is the top Nifty gainer. Brokerages are positive. Jefferies and Kotak continue to remain bullish on the stock following a strong set of numbers from the automaker.
Shares of Cummins India correct 5% after its parent company withdraws its guidance for 2025 on tariff uncertainty. The Indian power generation business has also seen 11% decline in revenue in the quarter ended March 2025.
Indian Hotel sees profit booking. The stock is lower by about 3.5%, even as the company has posted a good fourth quarter performance. Stay tuned. MD and CEO Puneet Chhatwal will join in shortly to discuss the numbers.
Yes Bank gained 5% in early trade on reports that Japan's Sumitomo Mitsui Banking Corporation will pick up 51% stake in the bank. The stock, though, comes off the day's high after sources tell CNBC-TV18 that such reports are actually incorrect.
Electric two-wheeler maker Ather Energy lists with gains of about 1% to its issue price. Thereafter sees some selling in light of the market weakness right now. CEO Tarun Mehta will also be joining in to discuss the company's post-listing strategy.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as you can see, all the top indices should come up for you. Actually, to the top of the screen, it's telling you that the markets have come in for some mild profit taking today. The headline index is down by close to around 80 points. The Nifty Bank is down close to around 350 points. Odds are that at 54,100 on the Nifty Bank will hold out. However, the Nifty is lower. I think besides the headline index, Mangalam, the other two indices, the mid cap as well as the small cap indices, they're coming for some, more selling pressure. And that's why the advanced decline ratio is firmly in favor of the declines as we speak.
Nigel, cues for consolidation. That's exactly what is coming across right now. And, news overnight with regards to developments around the border and the mock drills, etc., are, not really denting sentiment, but ensuring that people are a little cautious and ready in terms of booking their profits as well. We've seen a good run. The Nifty holding around that 24,375 mark. We have a lot of results which are actually being rewarded fairly positively. We have CCL products, for instance, which is up 14% after a solid set of numbers that came by. And the decline in crude prices has meant that we've seen decent traction for names like C8 as well. Reported its results last week, has continued to do well, currently at the high point of trade for that stock as well. And then we do have a bunch of others which are seeing some bit of profit taking, most notably from the travel and tourism space. We have Indian Hotels, a good performance coming in, the 12th record quarter for the company. But despite that, remember, this company's seen a stock price surge as well. So maybe some bit of profit taking is what we're seeing on that stock. Indian Hotels is the one that we're talking about. So let's go straight across to Puneet Chhatwal, who's the MD and CEO of the company, who joins in to discuss more about the quarter 4 results, but more importantly, the FY26 outlook. If you look at it, the company on its part has said that they are looking to open 30 plus hotels. They're looking to, focus more on the revenue per available room, the RevPAR that is, and at the same time are also looking to channelize the growth coming in from the MICE or the events segment itself. Puneet Chhatwal joins us now. Thanks a lot, Mr. Chhatwal, for joining in. In the conference call, you did say you're confident of double-digit revenue growth in FY26. If you could quantify that top-line target for us, is it mid-teens, is it low teens, is it low double digits or high double digits? And if you could break that up for us across, brands, occupancy, same hotel growth, pipeline additions, and average room rates.
Thank you. Always a pleasure to have this call with you, Mangalam. We are looking for anything which is between 12 to 15% top-line growth, obviously very strongly driven by the Taj brand, and also a strong contribution, anything between 35 to 40% from the new businesses, which is Reimagined Ginger, the Tree of Life, Ama, and Cumin. The other brands are also in a growth phase, which is Vivanta, Gateway, and Selections. But the majority of the growth coming in on a very strong basis will be from the backbone, that is the Taj brand, and also very strong contributions from the new businesses, which at a high margin also help or have helped us in the past in retaining and also increasing our margins. Occupancy remains robust in most of the Indian markets. I think the only place where the occupancy or rates are not increasing at a very high level, I repeat, at a very high level, is Goa, because it had seen very, very big highs in the last 3 years. So I think for some time, some consolidation is needed, and then it will start going up there too. But Delhi, NCR, and Mumbai remain very strong. The month of April for our company has seen a 17% growth. May is looking good. This is 17 versus last year April because of the excessive heat and the code of conduct. All in all, I think the outlook is positive. Also because instead of 55, there are 70 wedding dates in this financial year, which is the highest that we would have seen in the last 3-4 years. And with all the delegations coming into India, the foreign delegations interested in doing more business with India, I think it's helping a lot, especially in the capital city of Delhi, to grow both rates and occupancies.
Got it. All right. Hi, Puneet. You're sounding confident about business. Good start to the year as well. And as you said, the quarter 1 will look much better because of higher weddings as well as on a lower base. So I think as you have guided the street as well, that we should be looking at on a combined quarter 1 and quarter 2 together, because there'll be a bit of lumpiness. So we'll keep that in mind. Let's focus on a couple of aspects. As you said, new businesses will contribute close to 25 to 30% of the total mix. What is the growth you're penciling in there? I think from around 400 crores, you've grown that to around 600 crores. This year, what do you look to end it at?
We think we should easily get anything between 800 to 1,000. That's what we are targeting. And mainly this year, driven by Ginger and towards the second half also by Cumin and Ama. Cumin has been doing quite well. It achieved almost a GMV of 150 crores. We're expecting it to touch 200 this year, and Ama to get closer to 100 crores over the next 2 years. I think this year it'll go closer to 60 in GMV, and then finally to 200 because of the addition of 100 bungalows in last financial year and 100 in the previous one. So we expect to see an acceleration in openings in that homestay business this year.
Got it. And what targets would you set for Taj Sats, which did about 1,051? You have a new kitchen coming up at the Jewar Airport. Chambers, 150 crores is what you garnered in terms of fees in FY25. What's the target for next year? And the management fees itself, that's about 562 crores. What's the target for next year?
I don't think there are targets, Mangalam. The only thing you can expect compounded annual growth on management fees of around 20% or fee income by 20%, like we have had last year, despite the base becoming much larger. But we're also going to open more hotels. So last year we opened 26. This year we'll be opening 30. And many of those hotels that you open take 5 or 6 months to get, get off any kind of teething issues, another 2-3 years to stabilize. So a lot of openings that have happened in the last 2 years and will happen this year and the next year will keep adding to the fee base significantly. And also with the new additions and the new conversions that we are doing. So you can expect management fee income to keep growing at 20%. Chambers is not something which we want it to be like a mass business. It's a very selective business. It's a very tough criteria to become member of Chambers, but because of the growth in the footprint. So we renovated last year the Kolkata Chambers in Taj Bengal. As we speak, we are renovating the Taj Mahal Palace Colaba, which is doubling in its size. We'll be adding a new Chambers when we open Frankfurt in this financial year. So that will give us international presence in Frankfurt, London, and Dubai. So given that footprint, I think even Chambers is expected to keep growing at a similar pace as you have seen in previous years.
All right, Puneet, kudos to you as well as the team in terms of operational efficiency. Margins have perked up as well, but what are the levers you have in place now to, further improve margins from here on?
Well, Nigel, so if we turn the clock back, we used to do, 12 to 14% margins till 2015. And the first time when we guided on 25%, not many people believed us. Now we are at 35 on a consolidated basis, and on standalone, it goes as high as 47, 48%. I think these are very healthy margins. If we can maintain those, in the same level, I think we are doing well. We should not forget we are a capital and a labor-intensive sector, and we need to keep investing into our properties, and not everything is capitalized. Some goes into the normal day-to-day maintenance of the wonderful iconic assets that we have, and that is a key. We want to maintain the exclusivity, the luxury status of the Taj, and keep renovating our old gingers into the lean luxe proposition with Cumin. That means insourcing of food and beverage, unlike what was done earlier. So finding the right balance between investments, capex, margin expansion, and the growth, so that we are positioned well, not just from quarter to quarter or year to year, but for the decades to come.
Take that point. Just a final question before we let you go. Puneet, you've been credited for turning the business, a very strong business, around on all fronts, be it the balance sheet, the revenue, or diversifying away from the main brand as well. The one fly in the ointment, however, is the holdings that you have in some companies. You have Taj GVK, where it's around 25.5%. Oriental Hotels, it's about 33.5%. Wondering if there is some sort of restructuring taking place out there as well for you to further consolidate all your positions and streamline basically the holdings that the company has across the board.
We've done a few of the consolidations in our drive for simplification, but as we are a part of the Tata Group and Indian Hotels is the oldest operating company of Tata Group, we honor all our partnerships and all our contracts. If any partner comes to us and wants to exit a business or wants to give us a larger share, we will be very happy to look at it. Today, with net debt zero and with a lot of gross cash, we are very well positioned to take advantage of within group or outside the group companies for any M&A activities that might come. But as and when it is that far, Mangalam, I will be happy to share that with you. But at the moment, we don't have any such activity going on.
Nothing in the near future? Nothing can we hear from you on Oriental?
You mean Oriental Hotels?
Yes.
OHL? No, I first thought you were talking about Orient Express. We exited that long time.
No. Oriental Hotels.
No, nothing that you can hear from us on any of the companies that are there, and definitely not on your channel live.
All right, Puneet, good to have you on the channel as always. Thanks a lot for speaking to us here on CNBC-TV18. It's been a great year, and you've started off FY26 on a positive note. We look forward to interacting with you on and off the record as the year progresses.
End on that note, I always do on your channel, the best is yet to come.
Always.
Got that, Puneet. Thanks a lot for joining in, and that comment as well. Definitely, guys, for better times going ahead. Well, let's focus on the next management, though. Aether Energy, that's the one that listed and had a pretty good listing. The stock actually had opened up in the green. However, from the top, we have seen some profit taking. Markets aside, let's understand business. We have with us Tarun Mehta, Executive Director and CEO of Aether Energy, who joins us on the show. Hi, Tarun. Good morning. Good to see you. Well, it's been quite a journey for you. So congratulations on getting listed on the Indian bourses. And we welcome you to the stock exchanges, and we look forward to interacting with you, as this journey progresses. That said, post raising some money from the market, well, your balance sheet is looking in much better shape. And now a lot of focus will be on the operational efficiency. So give us a couple of numbers. What kind of a volume growth can you guide for this year? And what kind of a market share are you looking at? The last time around, I recall you were telling us that it had perked up to the mid-teens. But what is the range we should work with for the year? Go ahead.
So last year was FY25 was a pretty important year for us. We finally launched our more mass premium product Rista, and that's really starting to turn things around. Historically, Aether used to be very strong in South, where we continue to maintain our leadership position as recently as last quarter. But the rest of the country is where we hadn't pushed aggressively enough in the past. With the new product, we found a lot of success. You will see market shares have trended up really, really well in the states of Gujarat, Maharashtra. Gujarat particularly is a great success story at touching and crossing 20% market share multiple times. I think this product is finally starting to take us mainstream, especially in the non-South markets, which is also where a lot of our expansion is going to come from. But even before that expansion really kicks in, you will notice in FY25, 3-quarter data that's already out there, we've already grown 45% in volume. And remember, this growth has come only on the back of most of this growth has come back on the back of new product. The distribution expansion that this product unlocks is still a journey ahead of us. So we are extremely bullish about the near-term growth because of distribution, because of how Rista, our new family scooter, is landing in the market, and generally how well the India premiumization story is really, really taking off, where Aether really plays in the center of it.
Indeed, Tarun. Tarun, we have a little bit of a timeline, but we have understood that business, and you have made a couple of these points as well pre-listing. If you could tell us, because of this new product launch being accepted so well, and because of the higher market share that you have in Gujarat as well, what is the volume growth you can guide us for this year? And what should be the targeted market share? In Gujarat, you've done much better. From early teens, you've gone to mid-teens. Where do you see this number stabilizing at? 2 numbers, growth and market share.
Overall, I think both margins and volume and market share, all three should trend really well this year. I am personally definitely expecting an even better trajectory than what we saw in FY25. Gujarat was, in my opinion, just the starting experiment. I think there are states of Maharashtra, Madhya Pradesh, Orissa. I would say all these states have responded really well, and we are very, very, very excited about them. Obviously, I can't give you a specific guidance yet, But wait for results and wait for more commentary. But these are the places where I'm very excited, and only one of those states is where I'm still talking about the actual numbers. As all these states really start to fruition out, very bullish.
So last year, in the first 9 months of this financial year, volume growth was 45%. You believe you can better it over FY26 because of the product that you have as well. And a large part of that, while it comes from your new product, also comes from distribution expansion. If you could give us some sense on how many distribution centers are you likely to open over the next 12 to 18 months? You, as of filing, had around 265 experience centers. So then by that measure, we'll get a sense on how your volumes are likely to pan out as well.
Now, stores have been expanding very, very, very rapidly in the last few months, particularly, and you will keep hearing about this in our commentary going forward. Let me just give you some context. 260 odd stores by December. Most of our industry peers are at between 700, 800. We even hear 1,000 plus stores already live. There are hundreds of cities across the country where Aether has not even opened its first store. And honestly, we held ourselves back in opening stores in these cities in the past because we had a very premium product which would not have been the right fit in these markets. But with Rista, I think all those cities are fair game for us. So honestly, we think that the timeline is right for us to now take our distribution at the same level as our peers. And because we have a capex-like distribution model, because it's via partners and dealers, we are very confident of being able to scale up our distribution really, really rapidly in the coming few months. So, but that's a headroom for growth here. We are at about 260. Our peers are at about 800, maybe 1,000. And I believe those numbers are probably the right long-term numbers, maybe even short-term numbers for us to focus on.
So how long before you get to the industry level of 700, 800 dealerships? And because you can scale up a lot faster, does that happen in FY26? Does that happen in FY27?
No specific guidance. No specific guidance.
Right. We tried a lot.
No, Tarun, but you have to give us this number at least. What about on your cash flows? The cash flows are still negative, and last time we spoke, you told us it's headed in the direction that you turn into a positive number. This regulator has got you on board. They are happy with the performance you have listed. No one's toying with the law. You can tell us now. When do you expect to turn cash flow positive? Will it be FY26 or is it FY27 or is it later?
I will still skip specific guidance like this. What I can talk about, however, is that in our case, because we are comparatively not as capex heavy as some of our peers, we believe the journey from EBITDA break-even to PAT and cash break-even is going to be a pretty small one in our case. Like literally the largest capex that we've called out is for the next large mega capacity at Aurangabad. But outside of that, stores are not ours. We are not into cell manufacturing. So our overall capex is relatively light. So I believe our EBITDA break-even timelines and our cash break-even timelines are going to be very, very close to each other.
Okay, if you could give us a sense of...
Obviously, I'm very positive, very excited.
Right. If you could give us a sense of at what capacity utilization or at what volume run rate do you break even?
Actually, capacity utilization is a very old way to look at this, and that actually has a limited impact in overall profitability. We've seen our capacity utilization go from 25 to almost 40, and I think just this last festive, it was touching 60%. Capacity utilization has gone up well, but the bigger impact on profitability is really coming on back of volume, which is why I'm again and again keeping us focused on how volumes are trending up, because fundamentally the unit economics that we have cracked, and remember, our unit economics is a very clean one. We don't run our own stores. We have very limited dependence on subsidies. It's only one central government subsidy of 5,000 rupees. So the margin is quite fundamental and quite dependable. That's trended really well. So margins are at a good place. It's all eyes on volume now. As the volume grows, and hopefully on the FY25 trajectory or better, I'm very bullish on profitability in the short term.
One question that everyone's been asking is you're functioning at a lower capacity utilization level, yet you're going ahead in your increasing capacity. One would argue that it could give negative operating leverage. But you're saying you're seeing the path where demand is going to be strong and your volumes are going to rocket. When do you hit 1 million units of capacity? You're going to be at around 1.45, I think, post this capacity addition. 1 million, the target by when?
Yeah. So our current capacity is 35,000 units a month. Just see our trajectory on this case. October 23, we were 10,000 units in the festive month. October 24, next festive, we've scaled up to 21,000 units on a total capacity of 35. At this rate, honestly, I'm actually worried about this coming festive in October 25. I think business is scaling up really well. Customers have responded really well. So I'm very bullish on capacity utilization. Our next increment of capacity is another 42,000 units a month, which is what's coming up in Aurangabad. And then there is another phase 2, which is an incremental 42. So that's how you add up to 1.45. But phase 1, Aurangabad, over the next year or two, will scale up to roughly about 1 million. And obviously, I'm bullish about getting to sort of moving on the trajectory really on the same timeline.
All right, we take that point, Tarun. Thank you so much. We tried our best to get in some guidance and, numbers and specific timelines, but you were good enough in skirting all of those. But mind you, once you report your results, we're not going to leave you. We're again going to push you for all these numbers, operational profitability, market share targets.
I've mentally signed up to do this every quarter.
Perfect.
Do this dance.
That's your responsibility as the owner of a company towards shareholders.
Tarun, for today, you go ahead and you celebrate this feat. It's a big day for you as well as the team. So celebrate it. We look forward to chatting up with you soon, and hopefully we'll get a couple of more numbers out of you. But for the day, celebrate it. Well, on that note, though, I think we should slip into a short break. Come back. We'll continue to focus on markets.
Welcome back. The cut is deepening a little bit, but nothing really which is worrisome. So in this market, what do you do? Get you a few ideas for profit. And this one comes in from Money Control Pro. Bharat joins in with a stock that he's been tracking. Bharat.
Challenge will be semi-hotels limited. The demand momentum continues to remain strong, both for the corporate and the leisure side. We expect the company to deliver double-digit growth in quarter 4 FY25. The hotel industry upcycle is expected to sustain over the next few years, with demand expected to outpace the supply. This is positive for the pricing growth and a positive development for hotel players like SAMHI. SAMHI Hotels' GIC deal to create an investment platform for upscale and higher properties is a significantly positive development. As a part of the transaction, SAMHI will provide 4 operational assets and 1 asset under development to the platform for 65% stake. GIC on its part will infuse rupees 750 crore for about 35% stake in the investment platform. The platform will significantly reduce the leverage for SAMHI. We expect SAMHI's debt to EBITDA to reduce from 4.9 times currently to 3.5 times post the deal. The deal will not only deleverage SAMHI's balance sheet significantly, but also enhance the growth prospects. At the current market price, the stock is trading at an EV by EBITDA of 13 times FY26 projections. We expect SAMHI's multiples to re-rate year on, and hence recommend investors to add this one more. Thank you.
Okay, thanks a lot for that, Bharat. Well, we'll time to slip in a short break. Come back, continue to focus on markets. Welcome back. Well, as we speak, the market's seeing some bit of a recovery from the lows of the day, Mangalam. So, we're trying to defend, I think, the 24,350 mark on the downside. On the upside, we have seen resistance numerous times come in at around the 24,550 odd mark.
I'm looking at a couple of stocks as well. Paytm, for instance, has now fallen to the low point of trade, and that ahead of its numbers today. So we'll keep an eye out on that. But as we wind up on this edition of Chartbusters, you stay tuned to CNBC TV18 as Trading Hour comes up next.
Hello and welcome to Trading Hour. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Hormis Fatakia. And as we speak, at 11 o'clock, the Nifty is at that 24,400 mark, a cut of about 63 points, 0.25% gone on both the benchmark indices, and the mid-caps are underperforming today. That's down close to about 0.8%. It almost feels like yesterday we took 2 steps forward and today it's 1 step back. We've not given up all the gains of yesterday because yesterday the mid-cap index was up, 1.8, nearly 2%. But half of the gains of yesterday have been given up today. So some amount of profit booking. And the sectors which are weak are PSU banks, realty, capital market plays, the pharma index, the oil and gas index. These are the sectors under pressure. On the way up, it's all about auto. It's not just M&M, but even a Hero MotoCorp, Eicher Motors up in the green. And the FMCG index is evenly balanced.
They're biding their time, are the bulls. They're waiting for more clarity to emerge on what's happening at the border. There is also the mock drills that are going to take place tomorrow. So that bit of caution is still prevailing on the street. Of course, we are at yesterday's low, mind you, which is at 24,400. So that's that's the first line of defense that the bulls have for the index, and that's showing up as well. So indeed, 24,400 is where the index is, but there are plenty of stock reactions that are taking place, and the stock specific reactions have continued regardless of how the index has moved. CCL products, of course, there are plenty of earnings reactions like these. CCL products is now up 14% as that the highest point of the day after its results reaction. So that is a positive result reaction that's coming in. The negative one though is Cummins India, that has seen a slight recovery from the lows of the day, but it has still holding on to losses of around 4.5%. Yes, it was down at 7% at one point of time, and of course this is after the parent company suspended its guidance. So that is a bit of a negative rub-off that we are seeing on Cummins. And the other one is Paytm. That's down 4% as well. Both Nigel Mangalam highlighted this a few minutes ago on Chartbusters as well. At the lowest point of the day is Paytm reporting results today. So there are a lot of broader market names that you need to keep an eye out for in terms of results today, Rima.
Okay, so let's get in our first corporate conversation based on the numbers that are already out. The management of Kalyani Steel, the company reported a steady Q4 with profits seeing a 26% uptick. Margins expanded 300 basis points. We have with us Mr. R.K. Goyal joining in to talk about the quarter gone by. Thank you very much, sir, for joining in. We have the Q4 numbers, but if you could give us an indication of how Q1 is going to pan out for you in terms of volumes, realizations, what are the trends that you're seeing?
Good morning. As far as Q1 is concerned, I think it may be similar to Q4. We are expecting production performance to continue the way it was there in Q4 and market and all to be steady and stable. So we will have some similar performance.
Mr. Goyal, good morning. Thank you for joining in. How has demand looked like on ground so far? How was it in the fourth quarter and how has it been shaping up in the last 30-35 days of the ongoing quarter, particularly with regards to all the tariff-related dramas that you have been witnessing across the globe and the auto sector as well? If you can tell us, what is your exposure to the auto sector and how has demand shaped up?
As far as we are concerned, our auto exposure is almost 80%. And definitely these tariffs from US will have impact on industry, Indian auto component industry, which is exporting almost $8 billion worth of goods to US. So this may have impact. Definitely in short term, people will be cautious, even though there is a window for certain 3 months or certain number of days, whether they should export, they should not export. But at the positive side is what are the alternatives with the US? I don't think anybody can increase supplies to US where duties are lower. All other people who are supplying auto components to US has similar duty or higher duty. Until there is some slowdown in US about purchase of automobiles or auto production, exports from India in one way or other may continue. And hence, I don't see substantial downside in this part. And as far as the price part is concerned, yes, there is a pressure. But at the same time, raw material prices are also stable or going up. So costs are not going to come down. So we see it's a balanced quarter. As far as the domestic market is concerned, yes, you must have seen last month's number. There is definitely a slowdown, but that's typical of April, as people like to dump their inventory in March to on their customers. So it's okay, it's normal, and we expect things to be normal.
Okay, so far things are going on as it's status quo. What about price increases? I think you said costs are likely to be under control or similar to what they've been. Did you manage any price increase going forward? What is the outlook on price increases? And will you be able to maintain margins? Your margins spiked up to 21%. What led to that?
It's very, very difficult to say whether we will be able to maintain exactly the same thing because the market dynamics is not in anybody's control, but we are putting our best efforts to ensure that whatever performance we have in the last quarter, we'll put all efforts to ensure that we have at least similar performance.
Mr. Goyal, over the last 3 years, your annual top line has been around about 1,800, 1,900 crores, 1,900 to 2,000 crores, if I can say that, over the last 3 years. Now, you are at 100% utilization levels. Now, and also because of the top line growth being dependent on pricing, are we bracing for FY26 to be a similar flattish sort of top line growth here, or are you penciling in slightly higher top line, say within the 2,000 to 2,500 crore range?
As far as we are concerned, we are definitely trying to improve the bottom line at least. As you have rightly said, top line is not in our control as it is the market-driven prices and capacity utilization is close to 100%. But you don't know what sort of dynamics happens globally, what sort of geopolitical situation is, what sort of tariffs on China from US and some other European countries, what sort of tariffs on India and quantitative measures. So It's a highly turbulent and volatile situation. In this, commenting anything is very, very difficult. Only thing which is positive is we have a highly motivated team. We are putting all efforts to ensure that we perform better.
What about organic and inorganic expansion plans, Mr. Goyal? You had mentioned earlier to us that by 2028 or 2029, Kalyani Steel will be a 1 million tons per annum company. How, are you on track to achieve that? And if so, is there any inorganic growth plans that you have lined up for FY26?
As far as 26 is concerned, I don't see anything substantial to happen. But a lot of things are on the drawing board, and as soon as we are able to conclude something, we will come back and inform everybody.
Mr. Goyal, any capacity expansion plans for your own?
It includes everything, whether capacity expansion, whether it is inorganic growth or everything. It is on the drawing board, and we have not been able to conclude as of now, but we'll come back shortly.
But this 1 million ton target stays, right, by 2028, 2029?
Target is definitely there. It stays, but we are working on it. So we will announce when and in, and what sort of cost and what sort of product mix, what sort of... We'll come back to you.
Is the current uncertainty a reason why you are perhaps holding back from making any firm plans or commitments in terms of expanding your capacity?
Yes, current situation, geopolitical situation within the country, situation with our neighbors, everything is a concern.
Okay. What about the Odisha project that you signed about a year back? Have you firmed up funding? What is the timeline for this capex to come on stream? And if you could give us the breakup of how you will fund it between equity, debt.
You know, we are working on the finer details. And once we are able to do that, then we will be able to come out and say, yes, we are going ahead with the project and we are putting up this project and this is the total project cost. Few more months it will definitely take.
So by the first half of this year, we'll have more clarity on it. First half of FY26, Mr. Goyal?
Absolutely. It is like that. We are trying to expedite it as fast as possible.
Now, what about Kamineni Steel, Mr. Goyal? Have you closed that acquisition? When does it start contributing to your balance sheet?
As I mentioned before, Kamineni will be part of our Odisha project. It's just a belt shop. It will be integrated with our Odisha expansion.
All right, Mr. Goyal, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. And the management there of Kalyani Steel expecting market dynamics to remain stable as the fourth quarter was as well for the company, and expecting to make efforts to improve the bottom line because the top line growth is a function of pricing. So the stock there 0.7% lower as we speak now. But by the way, there has been a substantial recovery from the lows for the Nifty, still around that 24,400 mark. What's also not doing well today though is Indian Hotels. That too is now among the top losers on the Nifty 500, 4.25% lower there as well. Godrej Agrovet is seeing a bit of a rebound after the hammering that it had taken post the results, 5.5% higher on that stock. And RR Kabel continues to move higher where it left off yesterday. Strong session yesterday, another 5% added in today's session as well. Take a short break. On the other side, we tell you more buzzing stocks like CoForge and M&M and why they are buzzing in today's session. Stay tuned.
Welcome back. Let's focus on JSW Steel and the Bhushan Power acquisition case. The Supreme Court has scrapped Bhushan Steel resolution plan. The government is now mulling options on how to approach the judgment. Also, sources tell CNBC-TV18 that the bankers, PNB, State Bank of India, are likely to file a review petition in the Supreme Court on this order. Sapna Das is now joining in with the latest developments. Sapna.
Yeah, that's right. We are given to understand separately that probably PNB and SBI will be taking action soon in terms of a review petition on GST ruling. No timelines mentioned as of now. It's early days, so we'll have to see how this really rolls out. But this is something that the banks will be completely in consensus on. Having said that, if you observe what the government, basically the DFS Secretary yesterday in Bombay has commented, and he has made it very clear that, they have already reviewed the judgment order with all the lenders, and a view is being taken within the government. Of course, the opinion or the legal opinion has also been taken on board, and very soon the government will take a call as to how to be, what kind of approach can be adopted on this front. So I think this is clearly a developing event and developing story, and we'll have to keep a close watch on this. But both government and bankers completely on board in terms of taking further steps. And as I've just mentioned, separately sources have indicated that SBI and PNB will be acting soon.
We'll keep an eye out on these developments. Sapna, thanks a lot for that. We, in fact, spoke to Indian Overseas Bank earlier today, who's one of the creditors in this case, and listening to what the MD and CEO had to tell us there.
Discussions are going on since the time the order came out, and the plan is yet to be finalized, and all the options are being discussed, and those options are on the table. Maybe in a couple of days, the action plan will be finalized. But having said that, from IOB side, what I have to say is that the 760 crores we did get. And in the worst case scenario, even if we are supposed to refund it, I have to say that we are having sufficient cushion in the balance sheet, and this can be handled it very efficiently without creating any adverse impact on the balance sheet.
Okay, let's talk about CoForge. That's been a big mover today. That's now up, I think, close to about 2%. I think we should get up. Sorry, CoForge is indeed up close to about 2%. Let's quickly run you through the numbers. One, the street likes the top line growth. Revenue growth continues to be industry leading, very strong for the company, 3.4% in Q4, and for the full year, it's 32%. Also, it's not just FY25, FY26, in the management's word, is going to be another exceptional year. What's driving that confidence? The order intake. Last in Q4, the order wins were $2.1 billion at an all-time high, led by the Sabre deal, and the 12-month executable order book is up 48%. So their confidence is not riding on the deals that they will win, but just purely executing the deals that they won in hand. And third, when we asked them about their FY27 guidance of $2 billion, he said very, specifically that we will be disappointed if we don't do better than $2 billion. If all that we manage to do by the end of FY27 is $2 billion in top line, we will be disappointed. We could do materially better. Also, the company said reported margins will be higher by 140 basis points by the time we hit $2 billion. The stock also had corrected 20% on a year-to-date basis, so that is supporting the up move. And finally, the brokerage verdict will come up. Nuvama says it's the top pick in their sector. Their target price is 9,400. Jefferies, 9,000. MK upgrades the stock to an ad with a target price of 8,200.
There are a couple of brokerages that I was reading up. There were price targets in excess of 10,000 rupees as well. So it's very, very bullish commentary on CoForge from the management and from the brokerages as well. So let's hear it from the horse's mouth. Sudhir Singh, the CEO at CoForge, spoke to us earlier in the day, and this is what he had to say on the road ahead for the company.
FY26, we believe, is likely to be another exceptional year. We are extremely strongly poised. At this point in time, our 12-month signed order book is 47.7% higher than at the same time a year back. And you might have noticed that through the year, which was FY25, the total order book came in at $3.5 billion. We'd be very disappointed if all that we did in FY27 was just hit $2 billion. We believe we have a shot at doing slightly more than that. Our sales approach tends to differ somewhat in that we focus on large deals driven growth. What that means is we're looking for wallet share increase. We're not just looking for or waiting for client budgets to go up or go down and to then keep moderating or taking up our guidance. We go for large deals, 14 large deals in FY25, 5 in the last quarter itself is a testament to that.
There's one more IT company you should watch, and that's KPIT Tech, because they've made an acquisition. You know, I think if you remember that KPIT Tech in all their conversations, the last few have been talking about how they need to be present more in China, because China is leading the entire EV revolution. In terms of technology, they're right on top. So KPIT needs to enhance its presence in China. So they've done an acquisition which helps them. So the company's made an acquisition today, it just came out at about 10:15, of CareSoft's engineering solution business for $191 million. Two reasons. One, it strengthens their focus on the commercial vehicle segment, basically trucks, off-highway segment. So that's a positive. And secondly, the company says it will accelerate their presence in China. The company they've acquired has a deep understanding and relationships with Chinese OEMs and suppliers, and they have a long-standing presence in China, which will accelerate KPIT's foray into the country. So two reasons. One, commercial vehicle. Two, the China presence. This acquisition of $191 million that I spoke about will include a $25 million variable consideration, which will be paid in cash or other equity shares in the next 4 years. So that's contingent on the performance of the acquired company.
Making moves is KPIT Tech. It is interesting because the management continues to remain bullish on the prospects going ahead, even though they did not offer specific guidance during its earnings for FY26, although has been the norm previously as well. Although the management, of course, they spoke to you and they mentioned that they continue to remain bullish on the road ahead.
They said they'll revisit. You know, once things settle down, maybe they'll come back and give a guidance for, you know, FY26. But as of now, things are just too uncertain and fluid.
Too uncertain indeed. And joining that list of this whole host of companies who are either suspending guidance or are refusing to share what lies ahead for them. But we take a short break. The Nifty still at that 24,400 mark. Discuss market technicals with Mitesh Thakkar and trading ideas on the other side. Stay tuned. Welcome back. Still at that 24,400 mark is where the Nifty lies. There are a lot of earnings that we need to be watching out for in today's trading session. Of course, just before we get to that, look at CEAT. That too, after some very strong management commentary, is growing from strength to strength. Another 4.5% higher on that stock as well. So positive moves coming in from CEAT. Of course, that is also a derivative of the fall in the crude oil prices, which has had an overall cascading cooling effect on a lot of these oil sensitives, including tire stocks. CEAT, the last 1 month is up 25%. CoForge, we just spoke about that in the previous segment, is off the highs of the day, but that of course does not take away from the fact that the stock has rallied almost 22% in the last 1 month. So the move they've already seen before the results as well in CoForge. And pull up HPCL, that too is reporting results today. So you keep an eye out on HPCL. There was a very sharp mover yesterday, Rima, and it's down at the lowest point of the day now, 2.5% lower, but of course another 12% surge in the last 1 month.
Actually, both BPCL and IOC came up with very strong numbers. They were a big beat. Their marketing margins were aided by inventory. Refining margins were also higher than what the CNBC-TV18 poll was. So let's see what HPCL does today. Today is, of course, profit booking because yesterday it rallied on the back of the plunge in crude oil prices.
And HPCL is also having the biggest exposure to the marketing segment. So it'll be interesting to see how this fares after considering how peers have...
No, sorry. There was IOC, which has the LPG under recoveries higher.
So that is also one of the factors. And even Sudarshan, we were speaking to him in the morning and he was mentioning that the Q4 numbers may not matter much for these oil marketing companies because the fundamentals have shifted very drastically when you compare the fourth quarter to the first quarter, be it the crude oil prices, be it the fall in, be it the appreciation in the rupee. And as we speak of Sudarshan, he's on screen, but he's not here to talk about HPCL. He's here to focus on Mahindra and Mahindra, and that's because brokerages continue to remain positive on the stock, expecting the company to continue its outperforming industry growth, Sudarshan.
So in a weak day of trade, one sector is buzzing in trade, and that is the auto sector, and especially one company that is amongst top Nifty gainers is Mahindra and Mahindra on the back of consensus buy that we are seeing from brokerages after company reported a strong set of earnings in Q4 of FY25. Even outlook that company has given for both its segments, auto as well as tractor, is looking very positive for auto segment. Company is saying for both SUV plus EV growth range that company is saying it would be in high teens, and even it's almost the same for tractor segment as well. Now coming to the brokerages, Kotak Institutional Equities maintains buy call target here is 3,500 crore. It believes that company is going to continue outperforming industry growth, and tractor segment especially is expected to continue its uptrend in Q4. Company has reported margin of 19.4% in tractor segment, and that was at a multi-quarter high level. Coming to Jefferies, it also maintains buy call, and target here is 4,000 per share. It says company has delivered 12th consecutive quarter of double-digit EBITDA growth, and it believes that it may report 12% volume and 18% core EPS CAGR over FY25-28. And further to that, Jefferies believes that there is a further room for re-rating as company may report a strong growth in FY25 as well as franchise is improving too. And for Jefferies, it remains one of the top picks. For CLSA, it maintains outperform call and it has increased target to 3,652, and it says that ROCs and new BEVs will help it further push market share in SUV segment going forward. Last is Nomura. It also maintains buy call. It has increased target to 3,779. It says company has reported industry leading results, and it also has Mahindra and Mahindra as the top pick, and it expects SUV CAGR at 14% over FY25-27, and it believes the electric vehicle, or say BEV, that is born electric vehicle, will be a key driver going forward for Mahindra and Mahindra. So after a strong set of earnings for Q4, all the brokerages too have positive stance on Mahindra and Mahindra.
Indeed.
Thank you very much for that. M&M till sometime back was the top Nifty gainer with a 3% up move. Now it's overtaken by Bharti Airtel, and Bharti Airtel is now back at record high levels, crossed the 1900 mark. So that's the top gainer right now on the Nifty. Now, pharma is in focus after US President Donald Trump signed an executive order to boost US drug manufacturing. Ikta is joining in with the details.
Well, thanks for that. You know, the larger picture for the Trump administration is to probably move a lot of the production when it comes to pharmaceuticals back home into the US. So this executive order was exactly focused on that. It aims to fast-track approvals for the US-based manufacturing plants and increase inspections and fees for foreign facilities as well. They've mandated public disclosures of API sources and public disclosures of non-compliant overseas facilities. Now, overall, analysts say that, it is not really a disincentive when it comes to overseas manufacturing. The move is to actually accelerate US-based approvals. So the larger picture is to shift the balance of the global pharma production. If you know already, the likes of J&J, Eli Lilly, Roche, Novartis, all of them have already announced investments in the US. Now, the other bigger thing to watch out for is the pharma tariffs. The pharma tariffs could probably be announced in the next 2 weeks by the Trump administration. They've already, or they are close to concluding the Section 232 investigation by the US government, which basically examines the national security implications of importing drugs and APIs. So overall, that would be the larger picture to watch out for. As of now, analysts say that companies with a manufacturing presence in the US could be more resilient, such as Aurobindo, Cipla, Lupin, Glenmark. Those with a branded portfolio such as Ajanta, Torrent and Alchem could also be better placed. Valuations, however, till there is more clarity for all of these Indian generic companies would be under pressure.
Thank you very much for that. Mitesh is now back with us. Mitesh, slip some more. There is some, you can't call it momentum, but now we're closer to 24,350 on the way down, inching towards a 100-point loss. What have you made of this little bit of a slide?
So, good afternoon. I think, there's some more evidence that we're back into the consolidation zone, which is basically 24,500 to about 24,000, maybe in the worst case 23,850. I think we've been trading near the upper end of the range. I think a good chance that we will possibly see the markets get lower to about the low end of the range. There's a middle point pivot at 24,240, but that's the first support area, and eventually I think we can even test 24,000. So basically, it looks like consolidation time in the markets.
What about specific stocks, Mitesh?
Yeah. On the stock side, almost I have one buy and one sell. Tradera is a sell with the stop at about 166.5 for targets of around 155, 156. And M&M is on the buying side. It opened well and then slightly slipped off. So giving you a good entry point for short-term traders. Keep a stop just below levels of 30.18 and look for a target of 31.50.
What about some of these oil marketing companies, Mitesh? HPCL, BPCL. HPCL is reporting results today. It had a very strong move yesterday, giving up some of those gains. What are the charts indicating going into the results?
See, I like all of them. In fact, the entire pack does look interesting to me. And I would, be buyer on declines. The strongest in the short term does look like IOC. It's had a rally from over 135 to 150. It's coming back. I think around this 142, 143 mark would be a good entry point with a stop below 138 and 155 kind of a target can be looked at. Similarly, HPCL, BPCL also have had some rally, and you would want to buy them, but the strongest to me, for me, is IOC.
Thank you very much, Mitesh, for joining in. Get into a break. On the other side, we'll talk markets with Trideep Bhattacharya from Edelweiss Mutual Fund. Stay tuned. Welcome back. As promised, let's talk markets. Trideep Bhattacharya from Edelweiss Mutual Fund is now with us to discuss the market fundamentals. Trideep, you've been fairly positive on the markets the whole while. I mean, you've not held on to a lot of cash positioning as some of the mutual funds have. So what has been your approach now? So first, the fall in the first quarter of this calendar year, then this big snapback and recovery in April. What has your positioning been and what have you been doing?
Yeah. Hi. Hello. Thanks for having me on your show. I would say that all this while markets have been making a transition from an extreme macro uncertainty, which was there beginning of the year, when we had no clue about our own country's spending, about Trump's spending patterns, and also the geopolitical issues, to now where two of these major issues are kind of resolved. The only issue that is left unresolved is the earnings uncertainty, which we are kind of going through as we speak in the earnings season. And markets have been climbing this wall of worry over the last 2 or 3 months. And you're right. I mean, we haven't held cash, and hence, when the market caught a good bit of coming out of macro uncertainty, we caught that we were positioned in the right way. But we still think that the earnings part of the uncertainty is still not gone away. I think it will take probably a couple of quarters more to come back. But that's lesser of a worry than the big uncertainties that have been looming large on our markets, over the last few months.
Trideep, good morning. Thank you for joining in. So by when do you expect this earnings uncertainty to stabilize? And once that does so, or even in the current juncture when it has not stabilized, is there a pocket or are there pockets where you would look to deploy some of your funds? You've not held on to much of your cash. So where have you deployed those funds?
Yeah. So, overall, the context I would lay out is, since national elections last year, economic decision making in India actually suffered till about December last year. But Jan, Feb, March onwards this year, we have started to see economic decision making pick up. That has resulted in order flow announcements in various different sectors like defense, infrastructure, etc. Now, for this to translate into earnings, it will take a few more quarters before companies actually take action. So putting these together, and also if you look at the consumption softs that have been given in the budget, crude oil fell about 25%, which is a meaningful fillip, and also rate cut. My sense is as we get to the second half of fiscal year 26, we will get an earnings rebound starting to come through, particularly in the consumption side, where I think the ducks are lining up quite well. So, as you said, that the areas that we have been deploying money in the weakness that we have seen since the beginning of this year have been in areas like consumption, have been in areas like rate beneficiaries like NBFCs, where valuations are still reasonable. And third, select consumption areas like, for example, tires, where we think that along with rate cut beneficiaries, the input costs will also stand to kind of help them in good stead as we get towards the back half of this year.
We'll come to that. By the way, look at the way the markets are sliding. The mid-cap index is now down 1 1/3 percentage point. Commodity names are slipping. So you've got Nalco, SAIL, Hindustan Copper under severe pressure. PSU banks have been weak. Bank of Baroda, which reports its numbers, is down nearly 2.5%. But even a PNB bank is sliding right now. Stocks like Unicommerce eSolutions came out with numbers. Numbers look good. The stock was up 10%, but now it's up only close to about 5%. So there is pressure, which is visible. And across the board, the entire Adani complex is seeing profit booking after yesterday's big rally. So Total Gas down. You also have cuts coming through in Adani Green, Adani Ports, Adani Power, Adani Energy Solutions, across the board. 2 to 4% gone on that. Tell us a little bit more, Trideep, coming back to the stocks and the themes that you like. Tire, you said that the commodity prices, the decline in commodity prices, or perhaps the input for tires could be benign, and that could be a driver for earnings growth for tire. In tires, which is the segment that you like in particular? Which one would you bet on?
Yeah. So tires as a sector has gone through a good round of consolidation over the last few years. They have become a little more capital disciplined, which they were not there about 4 or 5 years ago. So the sector health has improved. And on top of that, now we have a situation where capacity additions are a little limited, and particularly in two-wheeler, companies exposed to two-wheelers and replacement tires are the two areas that we are positive on. And we think that from a profitability standpoint, margin standpoint, things might be scraping around the bottom. Of course, there could be demand-related challenges if the global growth comes off and stuff like that. And hence, we like domestic tire companies which are exposed to domestic space, a higher replacement, segment, and also two-wheelers. These combination is, I think, a good combination to kind of look at a few select tire names within the space where things could turn out to be well over the next few quarters.
Now, what about the wires and cables space, Trideep? This has been in the news for the last couple of months. Ever since the news of Ultratech entering this field, it has suddenly sparked off a huge interest in this entire area for the likes of the incumbents. We saw one of these companies report results the day before. It had a very strong reaction to it yesterday. It's continuing from that in today's session. There are a couple of others reporting results today as well. Now, in the view of this rising competition, where do you position yourself within this building materials space, if you could put that wires and cables into it? And or are there better opportunities other than wires and cables just because there is this fear of competition intensifying?
Actually, we are long this space right now. We think that as an ancillary play to real estate, where real estate stocks and sector have done quite well, building materials and also wires and cable plays into industrials as a combination is a good place to be from a growth standpoint. Yes, the competition in this sector, like in few others, have actually increased. There are many other sectors like paints, cement, where high gross margins and reasonably decent margins are being challenged by high competition. That, I think, India Inc. will have to grapple with as listed companies. That's a separate challenge. But that said, the demand-related drivers in this segment continues to remain robust, which is what you saw in a couple of results that you've seen in the past, and I would say that you would see in future as well. That doesn't shy away from the competition-related concern, which will come in a couple of years' time. But what we need to understand is companies with strong positioning, with moat in the segment that they operate in, will continue to kind of get a fair share of the profit pie. Because in this segment, to get capacity, get the approvals in, and to operate takes itself about 2 to 3 years. So it's easier said than done.
Okay, it's the performance was fairly electrifying for RR Kabel at least, and the stock is still continuing to hold up. What about Mahindra and Mahindra? Is that a stock that you'll own in your portfolio? Because that continues to surpass estimates.
So in your question related to tires, as I said, one of the favorite segments within autos and auto ancillaries are basically two-wheelers and tractors. While I can't be stock specific, I think companies which are exposed to those two subsegments are areas that we are overweight with regards to OEMs and also wherever we can find exposure to in the case of ancillaries. And I think the numbers of some of the companies that they have reported so far kind of bear that out. We continue to remain positive in that space.
Well, Trideep, there's this other almost consensus trade is the banks, private financials. Everybody has been saying there is value in private financials. There is value in private financials. Yes, there have been moves where HDFC Bank and ICICI Bank have hit record highs just recently. But in absolute terms, well, ICICI Bank may have outperformed, yes, but for HDFC Bank, the returns have been almost close to negligible, even if the stock is at a record high. What do you do in private financials? Do you stick to this proposition that, okay, fine, there is value, so I will stick to it? Or do you go looking for pockets where say, okay, fine, I'm getting returns, value or not, or value or no value?
So we are big proponents of looking at valuations, particularly for financials, because it operates between the liking space of FIIs as well as domestics. So around about late last year, there were extremely tight regulations. Valuations were on the lower side, and the previous quarter numbers were quite bad, relatively speaking, for financials, particularly the banks. And in that context, that's when we actually increased our weightage relative to financials in general. and have been able to kind of play this rally through with the right stock selection. At the moment, though, we think a good part of that rally is done. We think that low-hanging fruits with regards to low valuations, very tight macro conditions has given way to easy macro conditions and reasonable valuations. So from here on, stock-specific execution will be more dominant than valuation as a factor. And hence, we've actually, in the sectors that I mentioned, that's why I mentioned NBFCs relatively as a space where we still remain kind of overweight, because we think that rate cut beneficiaries with regards to their earnings is yet to play out. But I think a good bit of banking rally banks overall, particularly PSU banks and select private sector banks, are have done their bit over the last few months overall.
Thank you, Trideep, for joining us today. Need to get into a break. As we do that, some good news for our viewers, because India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. You can get instant access to all our breaking news stories, our articles, financial world updates at your fingertips. So download the CNBC TV18 app now from the Apple or the Google Play Store, or just scan that QR code on your screen.
Welcome back, and convincingly below yesterday's low now. 24,365 is where the index is. 100 points lower is where things stand for the benchmark index at the lowest point of the day, and led lower by Reliance Industries and SBI too among the top contributors. On the downside, HDFC Bank, which stood tall yesterday amidst the pressure from all the other private financials, and SBI, it is today contributing towards the downside. But what's contributing to the upside is Bharti Airtel, as Reema was just mentioning, back at record highs. Mahindra and Mahindra too packing a punch in today's trading session. Now, interestingly, Cummins has again extended some of its losses. Now is down 5.5% as we speak. RailTel is down 4% as well. Sonata Software among the other losers, as is Kalyan Jewelers. Losses of anywhere between 3 to 4%, but holding on to gains and firmly at that is CCL Products, 14.5% higher. We'll be hearing from the management shortly. It'll be interesting to see what they have to say on the road ahead for the company. Shifting focus then to the earnings season, as we have been focusing on all through the last few weeks. Godrej Consumer, one of the big names, reporting results today, and they've already come out with their business update. But Mangalam is here with more on the potential fine print for GCPL. Mangalam.
Well, for Godrej Consumer, remember, after the debacle of the third quarter, the company has been focusing on reviving volumes, and that's reflected in the stock price as well. It's up around 18% this year itself, and there is recovery expected. Trading at around 47 times, largely in line with its previous 5 years average. The management has said that underlying volume growth in the fourth quarter is likely to be in the mid-single digits, and India revenue growth would be in high single digits as well. Club all of those numbers together on a consolidated basis, the street is expecting a revenue growth of around 7%. EBITDA actually declines by about 3.5%, which means there is a decline in the margins by about 200 basis points, and the net profit comes in at 483 crores. The absolute number is more important here versus the comparison, because remember in the base quarter there was an exceptional loss of nearly 2,400 crore rupees itself. 4 to 5% is the street's estimate of the company's guidance of mid-single digit volume growth, mid-teens underlying volume growth in home care, and there has been a decline in personal care. Why is that? Because of the big price hikes that the company has taken in the soap portfolio, which is transient in nature. Indonesia business is expected to deliver mid-single digit underlying volume growth as well, and there is stability that is expected in Indonesia along with recovery in Africa. The key to track, remember tomorrow the management will be hosting a press conference where they will unveil the outlook for FY26. So the FY26 and the near future strategy is something that the street will definitely pin its hopes on.
Thank you. And what about MGL? Sudarshan is now back with us to talk about what to expect from Mahanagar Gas this quarter.
So after IGL reporting a strong set of earnings, we are expecting MGL to report the strongest set of earnings amongst all the city gas companies. We might see an improvement in the margin on the back of the price hike, and the price hike taken by MGL was the most amongst all the city gas companies. So on the back of all these factors, also remember that like all these oil marketing companies, internals for even city gas companies, if you compare with Q4, now in the last 1 month or say 1.5 months of Q1 FY26, internals have improved. Crude has fallen, rupee has depreciated. So all these are like going to benefit city gas companies, not in the results of Q4 FY25, but going forward. Now coming to the headline numbers, profit may fall by 6%. Revenue is likely to come almost unchanged around rupees 1,784 crore. EBITDA may increase by 2% and margin too can see a minor expansion and can come around 18% or might be more than that. Now coming to EBITDA per SCM, which is one of the most important metrics for city gas companies, also known as the realization or say margin. EBITDA per SCM for MGL is seen rising 5% sequentially, but year-on-year, it might see a big fall, but more than year-on-year, what would be tracked closely is the growth that might see on a sequential basis. Now, in absolute term, EBITDA per SCM can come around rupees 8.73 versus rupees 8.30 that company had reported last quarter. Now, what exactly we would be looking in the management's commentary? First, if you remember, recently Maharashtra government has announced EV policy. Now, we'll have to see if there is any update that MGL has heard from Maharashtra government and if government is taking any action related to transition like what we have been hearing from Delhi government. Again, Delhi government is also draft, and after that minister had said that all these details that have been out in public domain are not correct. So we'll have to see what's the update from Maharashtra government. And second, if companies planning to take another price hike to protect the margin, we'll have to see that. And what would be watched very closely that after price hike that MGL has taken of rupees 3, has it managed to control the volumes or has it managed to see the volume growth despite that?
If you're a layperson listening to this, you would have answered all the questions with this very detailed explainer that Sudarshan has put out as to what to expect for MGL in this quarter. We take a short break, more on the markets, but we put the spotlight on what has happened in the Taiwanese dollar over the last 2 days. Stay tuned.
Welcome back. Cummins has slipped a little bit more. It's down over 5%. It had a gap down opening after the global parent company withdrew its guidance, the forecast for the full year, citing tariff-related uncertainty. They also indicated that the revenue of all Cummins entities in India, including the JVs, is down about 14%. So that has spooked the street to some extent. So Cummins is one of the big, drags today. Other than that, you've got Indian hotels too, which is down nearly about 4-5%. The numbers were fine, but the stock is weak in trade. Bombay Dyeing is reacting negatively to its numbers, and Bombay Dyeing has slipped about 4.25%. CAMS is down 2%. These are stocks all reacting to the earnings performance that came out over, just yesterday. On the way up, CCL Products has been a big mover. That's 14% higher. Unicommerce up close to about 5%. Again, an earnings reaction there. And RR Kabel continues with its gains from yesterday.
Oh yes, RR Kabel building on to those gains, and how 6.25% higher. And they are the ones building on to those gains. But the index, though, continues to remain 100 points lower. A stock that has come up in the last few minutes is Poly Medicure, and that is the second best performer on the Nifty 500 index as we speak. 6.5% higher on that stock as well, continuing to maintain those gains. 2760 is where Poly Medicure is. The last 1 month, the stock has surged 33%. So sharp gains for Poly Medicure. What is also holding on to gains is Newgen Software, 4.5% higher on that stock as well. And if you look at the top volume-led gainers, DCM Shriram is off the day's high, but is among the top volume-led movers in today's session. 4.25% higher on the stock is DCM Shriram. And Narayana Health now moving towards levels of 1850. Another 3% added to the stock in today's session.
Godrej Agrovet, I don't think we've spoken about it, 4.5% higher. Kotak has upgraded the stock today. So Kotak has upgraded the stock to a buy, calling the recent sell-off in the stock unwarranted. So Godrej Agrovet is now upgraded to a buy from an add after what we consider an unwarranted sell-off in the stock following the Q4 results that was subdued but along expected lines in a seasonally slow quarter. The company in the conference call cited a positive outlook for FY26. They have guided for a 16 to 18% revenue growth and earnings for FY26. So Godrej Agrovet has got that kick out today.
It shows that some recovery seeing from the lower levels for Godrej Agrovet. And of course, Yes Bank, off the highs of the day, now open 9% higher, is now up only 2% after CNBC-TV18 citing banking sources said that the earlier report that was calling for Sumitomo's acquisition of a 51% stake as incorrect, and the stock has come off significantly from the highs of the day. But with that, we call wrap on this edition of Trading Hour. From Rima, me and the team that put this show together, thank you so much for watching. Power-packed halftime report takes you through the next 60 minutes.
Stocks drift lower as concerns over US trade resurface. Realty and consumer durables are the big losers, while autos and FMCG eke out gains.
Mahindra & Mahindra stock gains after a better than expected quarter. It has several analysts revising their price targets. Most expect the auto major to continue growing strongly in tractors, SUVs and electric vehicles.
Banks led by SBI and PNB are likely to file a review petition on Supreme Court's order scrapping JSW Steel's acquisition of Bhushan Power and Steel. IOB tells CNBC-TV18 all options are on the table and a final decision is likely in a few days.
Pharma stocks slip after the US President Donald Trump signs an executive order to boost domestic production by asking the FDA to speed up approvals for local units and increase fees and inspections for foreign producers.
Ather Energy makes a subdued entry on the bourse's listing with a small premium to the offer price of around 325 rupees per share. The EV maker remains confident of growing volumes, market share and margins in FY26.
You're watching us here on Halftime Report. Good afternoon. I'm Mangalam Malu. With me is Ekta Batra. We come to you live from the CNBC-TV18 Motilal Oswal studio. It's a day of consolidation that we're seeing on the frontline indices. We have the Nifty down by almost 90 odd points. After a rally, this was on the card, especially given the uncertainties around the border.
Yes, absolutely, Mangalam. Well, it's definitely, a session where the markets are a little unsure at this point in time. So we have the mid-cap index also, which is under pressure, so down around 1.3% currently for the mid-cap index. The Bank Nifty also under pressure, down around 0.8%. If you see it, the advanced decline ratio as well, let's see whether there's any kind of improvement as the day goes on, but currently stands at around 1:2 on the Bombay Stock Exchange. Lot of stocks within the broader markets which are moving. So, for example, Adani Enterprises is down around 3% odd. IndusInd Bank is under pressure, along with the likes of BPCL and Cipla. So, a lot going on. I think it is geopolitics as well as the uncertainty in terms of what the Trump actions could be in the next couple of days, which is really weighing on the markets and sentiment. But let's shift focus to earnings season now. Godrej Consumer is expected to report its Q4 numbers. Mangalam, back to you then. What are we expecting?
So Godrej Consumer, we have a cheat sheet. After the debacle that we saw in the company in the third quarter, thereafter the company's focus was on reviving volumes, and that's reflected in the share price as well. Currently, it's mildly lower in line with the market, but if you look at the last 7 days or so, or the last 1 month itself, the stock is up around 10%. This year, the stock is up around 18 odd percent. So, a large part of the recovery is something that is priced in, trading at around 47 times FY27 price to earnings as well. What the management has said in its business update is that the focus remained on reviving volume growth, and that's come by 4 to 5% volume growth is what the street is working with this time around, because that's what the company said in terms of mid-single digit volume growth. And the India growth is likely to be in high single digits. Add all of that together, the street expects a near 7% growth on the consolidated top line. The number you're looking at comes up for you on the screen. 7.2% growth versus same time last quarter is what the street is expecting on the top line. However, the EBITDA is likely to decline. And the reason why you see that is because, of the high increase in palm oil prices, palm fatty oil prices, and that would reflect in EBITDA margins decline by about 200 basis points as well. So from 22% goes down the way to 20.01% itself. Importantly, the net profit, the number you're looking at should be 483 crores. And look at it at an absolute level and not comparison, because the same time last year, there was an exceptional loss of nearly 2,400 crore rupees. More importantly, just keep an eye out on the volumes. 4 to 5% is what the street is working with, and that will be led by high teens growth coming in the home care business and a decline coming in the personal care business on account of volumes dipping in the soaps because of the price hikes that the company had taken. Indonesia is likely to recover, so is Africa. The most important thing to watch out for will be the strategic outlook that the management makes for FY26 and beyond. They've invited the press tomorrow for a conference. Let's see what the company has in store. But the other stock on our radar is M&M, doing extremely well after the numbers came by yesterday. It's up nearly 6.5% from the lows of yesterday. Brokerage is positive on the stock as well. Sudarshan joins in to tell us what exactly the brokerages are saying. Sudarshan.
So it's a consensus buy. Do you know the interesting part in all the auto stocks? It's the only stock which does not have any negative brokerage call. All the brokerages are positive on the stock, and this after a strong set of earnings that company has reported for Q4 FY25. And now brokerages are also bullish on its outlook. It has given a very positive outlook for both of its segments, auto as well as tractor segment. So now we'll start with Kotak Institutional Equities. It maintains its buy call and target here is 3,500 per share. It believes that company will continue outperforming industry growth even in FY26 after a strong set of earnings that reported for FY25. And Jeff expects 12% volume and 18% core EPS CAGR over FY25-28. And after a strong set of earnings and growth that company has seen over the last 2 to 3 years, it believes that there is a further room for re-rating with strong growth outlook and improving franchise. Jefferies has a, So all these brokerages, even CLSA has a buy call on the stock, another Nomura too has a buy call on the stock, and it's on the back of all the strong set of earnings and the positive outlook. And that's the reason you are seeing the not big move. It has come off highs, but still up 2% in today's trade.
Okay, all right, Sudarshan, thanks very much for that. So that's M&M, that stock up around 2% odd. Well, we need to take a short break, but before we do that, here's a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now and submit your entry for SME Champion Awards Season 2.
Welcome back. You're watching us here on Halftime Report on CNBC-TV18. In an otherwise wobbly market, one of the stocks which is surging ahead is CCL Products. It's a solid set of numbers that the company has reported. A 15% growth in their revenue, a much higher jump in their profitability and EBITDA as well. So let's get chatting with the management. Chala Srisant joins in for a quick update on these numbers, but more importantly, the outlook for the year going ahead as well. Chala, first up, before we get chatting about the volume growth target and EBITDA per kg numbers, coffee prices, they've surged world over. Now, they don't impact your margins immediately because you have a cost-plus model. The coffee prices don't look like they're coming down in a hurry. In that, what could the impact be on client behavior, your incremental capacity utilization and domestic branded business? What are your thoughts?
So what we have seen is that most of the customers, they've started migrating from a long-term contract. Usually we have customers who are doing 2 years, 3 years contracts as well when the prices were stable. They've started bringing that down to 6 months to 1 year. So that is one significant impact. And as far as the coffee prices are concerned, yes, things have been volatile. But Brazil has actually been investing a lot in increasing the coffee throughput. So, in fact, this is one of the first years the crop is going to be coming in the next week or two. So we'll know how the flow is going to be in the next 3-4 days, actually. And that will give us clarity about how the prices are going to move going forward. So we're expecting that there could be a correction if the crop is good.
So what does this do to your incremental capacity utilization? Because you've laid out a fair amount of capacity, and if the contract cycles are shortening, then is there a case that you might have capacity which you may not be able to fill?
So that is the beauty of our business. If you look at it historically, irrespective of the coffee prices, we've been able to fill our volumes. So we keep adding new customers every year, and that's what we've been doing over the past years, and we're still continuing to do that now also. So irrespective of whether the prices go up or down, we're confident that our volume guidance will still continue, and we will continue to keep growing forward as well.
So if you could just expand a little bit in terms of the volume guidance, if you could just break up what you did this quarter, what you closed the year with, and what you are targeting for FY26 based on the pricing scenario.
So this whole year, we had given a guidance of around 1% volume growth for the current financial year.
So you're expecting as much as a 10 to 20% volume growth in FY26?
Yes.
Okay, so that range is quite wide. If you could just tell us what's it predicated on?
So one of the main reasons is because we are getting orders again on a back-to-back basis with shorter lead times. It's a little difficult for us to predict the way we used to predict earlier. If you recall, in the last couple of years, we actually used to give a guidance which was very accurate with a much narrower number. That was because of the long-term contracts that we used to get in place before the start of the financial year. So now, since we don't have that in place, we're keeping this range, a wider range at this point in time.
All right. What about, a couple of things. One, in the very near term, what is the EBITDA per kg target that you have for FY26? What was it in FY25? Because I remember the third quarter was 114 rupees. And over the next 5 to 10 years, as you increase your capacity, as you increase your footprint, what is your market share aspiration? Your global market share is still 7 to 8% itself, and India as well is 3 to 4% on the B2C side. What's your aspiration here? So very near-term EBITDA per kg and long-term market share.
So EBITDA per kg has moved up from that 114 to around 120, 125 range. And again, this is because of the product mix changes, new products that we are launching. So all these things have contributed positively. And we're also adding a lot of end customers that is helping us with this growth. We are hoping that we can continue with the similar EBITDA per kg going forward as well. And as far as the market share is concerned, yes, we're at about 7%, but with the volumes that we are growing year on year, we are hoping that within the next couple of years, we should be crossing that 10% mark as well.
Okay. If you could just highlight what might be the biggest variable that you see going into FY26 or the biggest headwind that you're probably bracing for, what would it be?
To be frank, our company has withstood almost everything, let it be from COVID to war situations, recession, you name it, tariffs, unpredictable tariffs, terrorist attacks, whatever it is. So whatever the circumstances are, we've always seen that because of our presence in India and Vietnam, we have an added advantage of being flexible. So even if there's an issue in one country, we have the ability to transition production to another country. So we're quite confident that whatever comes, we will be able to face it head on.
Everyone, no matter what happens, everyone needs their cup of coffee regularly, globally, I guess. So that keeps you resilient. Chala, you spoke about the global business. Let's talk about India, because your domestic business, you did have a target of 300 crores in FY25. Wonder whether you crossed that or not. And you still have 65 to 70% sales coming in from South India. You reach about 120,000 stores. What's your prognosis here? At what pace are you likely to expand here? What is the target here in terms of reach, in terms of revenue, non-South portfolio? What's the aspiration?
So yes, we did cross our 300 crores. In fact, The interesting part is for this year, it's our 30th year. We crossed 3,000 crores as a top line for the whole company. We crossed 300 crores in the bottom line, and we crossed 300 crores for the branded business as well. So number 3 seems to have a lot of significance for us in this year. And the domestic sale was actually around 450 crores. The brand was crossing 300 crores. And going forward also, we are expecting about a 40% top line growth in the domestic market for this year.
Wow, that's fantastic. 40% domestic growth. Just what did you do in the year gone by? What did you close at?
We had done about 450 crores.
Okay, all right. So just wanted to also narrow down on the balance sheet. You have debt of around 2,000 odd crores, if I'm not mistaken, as of the last quarter. So give us a sense in terms of where your gross debt stands. Yeah. How much of it is working capital? What is the plan to reduce it in FY26, considering that you're quite bullish in terms of your P&L?
So actually, we had projected that we should end between 2,000 to 2,200 crores, but we actually ended much lower. Around 1,800 crores is what we actually ended the year with. We had focused, we had done a little bit of renegotiation with some of our customers also for earlier payments. So all these things helped reduce the debt for us. And going forward, yes, there is a volume growth. So we are expecting a slight increase in the working capital. The term loans, we have about 700 to 800 crores of term loan, which is there, which we are going to repay within the next 3 years, and then we'll be debt free. It's only going to be the working capital that is that part of our regular business.
All right. And final question. What about the FMCG subsidiary that you have? What's the update here? You were dabbling in various categories. Is it still at planning stage? How much of that has been executed? What are the near-term targets here?
So the FMCG business has actually been merged with the parent company, and that's the update which I had mentioned about the 300 crores of branded business and 450 crores of overall sales within India. The subsidiary company right now, there's a kiosk vertical that is there, which we are still in the initial stages over there.
So no other categories that you're seeding, because earlier the story was that the FMCG vertical sits in a separate house. Thereafter, there could be perhaps some sort of volume, value unlocking there.
Yes,
so it reaches a certain scale.
There will be some new product launch. Yeah, there will be some new product launches in the next couple of months itself. So all that is sitting actually in the parent company itself. The vertical that we hyped off, that has only the kiosk business at this point in time.
Take that point, Chala. Thank you so much for joining in and giving us all those updates. It's number 3, which is lucky for you. Hopefully, as the years go along, those numbers keep increasing for you as well. 14% higher on the stock. And we have, the management giving a strong outlook for the next year. 10 to 20% volume growth, a wide range because of the variables. But the EBITDA crosses 120 per kg all of next year. Take a short break, come back. We also, after our daily dose of coffee, get our daily dose of pharma. Vishal Manchanda, who's the analyst at Systematics, joins in to discuss the pharma sector.
Welcome back. Well, pharma stocks continue to be in focus today. The US President Donald Trump has signed an executive order on Monday that aims to reduce the time it takes to approve pharmaceutical plants in the country as part of new regulations to encourage domestic manufacturing. Listen in.
That's what it's all about, right? Very important. We're going to have a big announcement next week on some of this kind of thing, but more related to costs, the costs of medicines and drugs, because we're being ripped off, as you know, very badly, being ripped off compared to the rest of the world.
Many actions that you've taken so far in this administration, sir, are related to onshoring manufacturing and onshoring supply chains. One of the most important supply chain issues we currently face as a country is our pharmaceutical supply chain. This is an executive order intended to promote domestic manufacturing of pharmaceuticals. It streamlines the permitting processes that go into building domestic pharmaceutical manufacturing sites. It centers a lot of the environmental permitting process, which is quite significant within the EPA, and it takes other actions designed to ensure that we're bringing pharmaceutical jobs and pharmaceutical manufacturing back to the United States of America.
Okay.
All right, and when asked about the tariff rates on the pharma sector and the timing, this is what the US President Donald Trump had to say.
President, on the pharmaceutical side, have you made any determination on kind of what those tariff rates may look like and the timing of those?
I have. I'll announce it over the next 2 weeks.
All right, so very important developments which have come in for the entire Indian pharmaceutical space. So now there is no immediate impact really, Mangalam, in terms of what could happen. It just, what the executive order did was that they are just looking to fast track approvals for US-based manufacturing plants. They're increasing inspections and fees for foreign facilities. They're mandating public disclosure of API sources, public disclosure of non-compliant overseas facilities as well. But overall, what they are doing is they are trying to, yes, shift the balance of the global pharma production. They're not doing it immediately with this executive order, but they are small pieces which will add up to a larger puzzle. Right. And it's not really a disincentive to overseas manufacturing as yet. The move is to basically accelerate US-based approvals. And you're seeing the wind blow towards the US in any case. The likes of J&J, Roche, Eli Lilly, Novartis, they've all announced investments in the US. The larger picture which we need to watch out for is the pharma tariffs, which could be announced in the next 2 weeks. The US government has concluded a Section 232 investigation, which basically is looking at the national security implications of importing drugs and APIs. So I think that would be the most important thing to watch out for. To talk more about this, we have Vishal Manchanda, who's joining in. He's the pharma analyst at Systematics, who's with us now. Vishal, hi. Thanks very much for taking the time out. What is your reading of this executive order?
So I think the regulatory incentives that have been announced, they broadly don't really change things too much from a economics perspective for the manufacturers. So these are, I think, that's the starting point, and they'll have to kind of do more to get manufacturing in the US. So I think this is just the starting point, and it's a massive task that US has taken up. And probably I don't think whether they can actually get too much of manufacturing despite of whatever they do to get manufacturing in the US. Because we know that the cost of manufacturing in the US is significantly higher, say 2x, 3x of what it is in the, say, India and China.
Okay, so that's exactly what my point was. How realistic is it to manufacture generic drugs in the US vis-a-vis India?
So I think one is the supply chain. So like every generic drug, every formulation has a unique supply chain. So even if you do the final formulation in the US, you would still be dependent on a country like India or a China for your raw materials. And if you want to kind of replicate the entire value chain for one formulation, even that's a massive task. And if you look at the US market, I'm sure there would be more than 5,000 different formulations in the US. So every formulation has a unique supply chain. And so you can So it very well shows how difficult it is to kind of get manufacturing done in the US, because ultimately the supply chain will have linkages to India and US, and that's where probably India. So that's where India and China can still control a lot of things.
Okay, all right. That point is taken. But Vishal, just wanted to get a sense that what is the most, which are the most resilient companies according to you at this point in time? You know, from an Indian standpoint, which have some presence in the US, which companies would those be, which can probably ramp up their manufacturing in the US and hence probably have, you know, their foot in the door?
I think I don't think companies will resort to ramping up manufacturing in the US, because even if they do that, they probably will still not be able to close the gap in terms of so markets. So like even if you put tariffs, say even if you put 25% tariffs, 30% tariffs, the tariffs have to be massive in order to ensure companies move their manufacturing to the US. And then we know the timelines of pushing manufacturing to the US. It takes 4 or 5 years. With all the acceleration they are trying to do in the regulatory process, if they might cut it short by say 6 months. So ultimately, I think execution is something I'm not able to figure out whether this can actually be executed. So that's the key issue, I think. And I don't think companies will go about moving manufacturing to the US. They might probably increase whatever. So like Cipla has plants in the US, they'll try to utilize those plants better. I think that's what we can see.
You know, the other part of that is the US FDA actually increasing their scrutiny on countries outside of the US. Do you see that as an incremental event risk for our players, or do you think this volatility will continue and we'll probably get the better out of it?
Yes, I think that's something we'll have to wait and see. They're also going to raise the facility fees and probably use that as a funding to do more inspections in India, China, and other countries. So I think that's something we'll have to wait and see how that pans out. But ultimately, I think with all of these things, if the supply demand gets imbalanced, there will be an inflation problem in the US.
Okay, there will be an inflation problem in the US. The other part was about the sourcing of the APIs. That has to be publicly listed, as well as the plants which are non-compliant have to be publicly listed. How would you read that?
I think listing the API source has become very important for the US, because they want to figure out what percentage of where is the supply coming from actually. They need to trace their supply chain. Only then probably they can actually formulate a strategy when they know how dependent are they on these markets in terms of the supply values. And API is a crucial component. So probably the formulation may be coming from India, but the API is still coming from China. And probably everything that is coming from India has a linkage to a Chinese supplier. So ultimately, you have to diversify your value chain. I think that's most important for the US. They have to ensure there are separate supply chains, not linked to the US, not linked to China or India. I think that's where they would be focusing on.
All right, take that point. And basis all that's happening right now, what stock, according to you, offers the best upside?
So I think in the large cap space, we kind of continue to like Sun and Cipla because of lower US dependence, 30% of sales coming from the US. We'll continue to avoid names with 40 to 50% sales coming from US and more of dependence on one product, two product for their profit. So I think Sun and Cipla would figure better among the names there.
Okay, all right. Thanks very much, Vishal, for joining in and speaking with us and giving us your perspective. So maybe not an immediate shift is what we can expect. Maybe a lot of companies will improve or utilize their plants better in the US. That's the view coming in. Well, staying with the pharma space, we now have with us Neeraj Sharma, who's the Managing Director and CEO at OneSource Specialty Pharma, joining in to talk about their Q4 numbers. Mr. Sharma, welcome to the show. If you could just start by giving us your performance on the margins, which was spectacular this quarter, over 40-odd%. What led to that improvement from, say, that 36% in the previous quarter? And what is the trajectory that we expect in FY26?
Yeah, thank you for having me on the show. So we have had a very robust quarter, but not just the quarter. We have had a very robust year, and a number of factors which have actually helped us increase our both revenue as well as profitability numbers. We have, as we have said, we have added a number of new customers, and added to these customer acquisition also are significant MSA executions we have done. A significant part of our business is coming from drug-device combinations, and here we have had a lot of new MSAs which we executed, especially our customers who are planning for second wave launch, especially of semaglutide in the next year. So combined with our other legs of the business, especially our soft gelatin capsules, our sterile injectables. So all put together, along with the new acquisition which we did of customers, what has really helped us drive both our revenue and our margin. And we see this trend continuing in terms of our the guidance which we have given. We have reaffirmed our midterm guidance, as we have said. We are going to be a 400 million revenue company by 2028, and also with a very strong 40% EBITDA range. So we have reaffirmed that, and that also all these factors which I mentioned, our continued expansion of our drug device combination business, a lot of it getting commercialized, actually starting from the current year or the latter part of current year itself, and then going steady state in FY27 and beyond, especially on semaglutide coming off patent in some of the large markets. Our soft gelatin business, where, as you're aware, we have expanded our capacities 3x over the last year, and a lot of new CDMO business coming on this. And finally, the sterile injectable. So all in all, all coming together to deliver our midterm outlook, which we have given for the business.
Okay, all right. Well, your midterm guidance seems to be quite strong, but I'm just going to narrow down on the opportunity from the entire weight loss scenario, weight loss drug scenario, with semaglutide going off patent in a couple of countries in the next year or odd. What is the opportunity in terms of financials which is lined up for you? Which are the companies that you have probably tied up with in terms of the semaglutide opportunity?
It's actually 100 plus countries actually which are going off patent next year. But the key ones which are very significant today are Canada, Brazil, China, India, and some of the countries in the Middle East, which are significant populations today and significant markets. And these are the ones which are going to be really driving the near-term numbers for us. And while obviously as a CDMO I can't share the names of customers, but I can tell you we have a very large and diverse customer base. We have said 20 plus customers who are with us for GLP, and these customers are really the who's who of the global generic industry, including global leaders, regional leaders, country leaders. And we see that with these customers of ours, we will be able to support them.
Sure, Mr. Sharma, Mr. Sharma, just a two-part question. One, how many suppliers or how many CDMO suppliers would be there typically for one generic company which is manufacturing semaglutide? And two, do you see maybe the market shrinking for semaglutide simply because there is going to be a lot of generic competition come through, and there are far superior molecules now which are under patent, which are in the space?
first question. To get a product like semaglutide to develop and to get into the market, a company spends anywhere between 25 to 30 million US dollars. So, with this significant investment, and it's a complex product, it's not a product where there are multiple suppliers for a company. So we expect, all our customers, us to be either the sole suppliers, or in some cases where, some companies might want to take some capacity in-house, we would still remain the principal supplier. So I think that's where it's not an area where you can have multiple suppliers for a company or for a product like this. That's the first part. And when it comes, where you expect semaglutide, what's happening in the market, I think right now there is such a huge demand-supply gap for this product. There is a significant market out there, whether it is for diabetes, whether it is for weight loss, the anti-obesity, and the supply from the innovator has been absolutely minuscule. So just to give you some figures here, in a large market like Brazil, less than 1% of the potential target population is having access to these drugs today. In a market like Canada, the same number is about 3 to 4%. So as you can see, there is a significant unmet demand, which is what is going to really be driven when the generics come into the market post market formation and patent expiry. So we see that to be driving over the next 4 to 5 years. Not only companies like OneSource, but all the generics who will get into the market. To your point on other new therapies, for sure, this is an area which is revolutionized. Remember, there are 1.5 to 2 billion people potentially who could benefit from these drugs. So every new therapy or every new drug which comes into the market is welcome, including some of the oral therapies which will be coming. So it's I think this is a revolutionary therapy, and it will be very helpful to people. And OneSource is really poised with our experience, with our expertise, with our
Mr. Sharma, we get that.
We are very well placed.
Right, we take that, Mr. Sharma. Just a final question before we let you go. You've announced a capex of about $100 million as well. What does that entail in terms of turnover ratio? How much do we typically garner of the capex that you do? That's point number one. And secondly, you did 32% margins in FY25 with a long-term guidance of 40%. By when do you reach 40%? I mean, if you have a glide path to that. So on margins and capex, the asset turnover, quickly.
Yeah. So we have already said that we'll be spending almost $100 million over the next 2.5 years. This primarily investing in expanding our drug-device combination capacity, which is what we really need to service our customers' demands. And this is a very, very attractive business. We are right now, we have closed FY25 just under asset turn of just under 2. And we see that, in near term to be at least 2.5 and a steady state asset turn of 3. That's what we are aiming for. And in terms of margins, we have said, you've seen how our margins have expanded, and we expect the 40% steady state margin. It's not far. We have already said that our first full year of commercialization of semaglutide will be FY27. So for sure, FY27 and beyond is a 40% plus steady state margin, what we are aiming for.
Okay, just before we let you go, maybe a one-word answer from you. Out of, say, the number of companies, looking at semaglutide, if you could name the number there as well, how many do you have in terms of, say, a percentage or an absolute form in terms of being the sole supplier or principal CDMO supplier?
So there's no one word. As I said, we have our customers, we have global customers, and through those customers, we expect them to have a very significant share of all the markets which are opening up in 2026.
All right. Take that point. Thanks a lot, Mr. Sharma, for joining in. Wish you good luck. We'll speak to you at the end of the next quarter as well. Once again, quiz you on all the things that we spoke about today as well. Take a short break. Come back. Focus on the markets as well. The Nifty down about 75 points. Sachidanand Tekar joins in with some trading strategies on the other side.
Investing.
Welcome back. Well, for the markets, it is under pressure, but let's talk about specific stocks right now. Exide Industries is in focus. The management says that they are in advanced discussions for battery manufacturing with two major two-wheeler companies and a three-wheeler company. Sudarshan joins in with these details. Sudarshan.
So we are seeing some recovery in this stock of Exide Industry. It's on the back of the commentary that company has given that currently con call is going on for Q4 FY25 results. Results were slightly below estimates, but now in the commentary, company has talked about certain orders that it's likely to receive. First, it's saying that it's in advanced talks with two major two-wheeler companies related to battery manufacturing. Also, regarding the three-wheeler, it's saying that it's in talks with few players, and there also it can receive orders for battery manufacturing. One update that everyone has been waiting related to what has happened towards the update on Hyundai agreement, that binding agreement that company had signed few months ago. Company had announced that earlier it had signed non-binding, which had turned binding. So what's the update to that? And on that, company has commented that it's as per whatever the company has announced. It's there in public domain, but the update is that battery manufacturing will happen very soon, and it's in the stage of product development, and that is company is making it ready, and it's going to be ready very soon. And once it's ready, it will start manufacturing for Hyundai agreement. So there is nothing negative as far as Hyundai agreement is concerned. The plan has been on the track. So on the basis of these comments, we are seeing a recovery in the stock of Exide Industries.
Take that point, Sudarshan. Thanks a lot for that. That's about Exide Industries. Currently marginally in the red, but has recovered from the lows of today's trading session so far as well. Speaking about today's trading session, let's get an update on how the FNO setup is. 2 days ahead of expiry, we're seeing some consolidation. The Nifty has been consolidating in this 24,400 to 24,500 sort of range. And right now, it's the Nifty Bank, which is lower for the last few trading sessions, below the 55,000 mark as well. Currently around 54,500 for that index. The mid-cap index also is under a wee bit of pressure. It's the groups which are in focus. Yesterday we had the Adani Group stocks doing extremely well. Today they're coming in for some profit taking. So Adani and Adani Ports from the broader markets. You have Adani Total and Adani Green as well. And then stocks in focus on account of numbers and guidances. So Indian Hotels seeing some profit booking down 5% after what was a very good quarter and good management commentary as well. But Cummins as well lower because the parent has withdrawn their guidance. Ahead of results, there is some sell-off that we're seeing in Paytm down about 4.5%. For the index, however, consolidation is expected. We're around 24,400 right now, and that's where the calls and puts are most active as well. 24,400 call has a premium of 60 rupees. So look at the 24,400 put, that has a premium of roughly 70 rupees. Add both of them together, you're looking for a Nifty range between 24,250 to 24,550. That's the consolidation that the street is expecting. Just keeping an eye out on CDSL. There has been a big spike in the open interest, still below the 95% threshold mark. But if it does continue to spike towards the remainder of today's trading session, we may see the stock enter the F&O band. That's about CDSL. And as we speak, at the bottom of your screen, numbers from Polycab. The stock did well after RR Cabal's numbers. Let's see how much of that is in the price already. On the bottom line, it looks like a beat on the profitability, 726 crores versus a CNBC-TV18 poll of 637 crores. We'll try and get the revenue and the EBITDA numbers up for you shortly. Okay, let's go to Sachidanand Uttekar then. Sachi, what do you make of the market so far? There is consolidation, and what does one do when it comes to individual stocks?
Good afternoon, Mangalam. Good afternoon, Ekta. I think the Nifty has been, lacking that strength to cross that hurdle of 24,450. For the last 3 trading sessions, we have seen narrow range bodies, but on the contrary, it has also not, breached below its 5-day exponential moving average support, which is placed somewhere close to around 24,350 thereabouts. So I think the overall range, is looking consolidative, as you rightly pointed out. The immediate range which is exhibited is somewhere close to around 24,450 on the higher side, and 24,250 looks like a decent consolidation support. So it's better to take positions on the long side when the Nifty displays a clear breakout above the 24,450 mark, or else on a decline near to that 24,250 consolidation support itself. So as of now, I think it's better to be very stock specific. One can look for buying opportunities within this ongoing bullish trend. The first stock on our radar is United Spirits. Now, if you look at the last 8 trading sessions, the stock was displaying a consolidation. It has displayed a firm breakout in today's trading session. The 1560 mark has been confidently breached on the higher side. If you look at the last couple of trading sessions, there has been a long addition in positions, and if you look at the overall pattern structure, it looks like a bullish flag formation, which is again a continuation pattern. And that's why we are recommending building long positions here, keeping a stop loss somewhere close to around 1555 on a closing basis. Fresh long positions can be added for a pattern target of around 1650. Disclosure would be that we have recommended this particular stock to our clients as well. The other pocket of strength is metals. Now, metals are showing signs of short covering. The stock which we like right now is JSW Steel. In the last 2 trading sessions, it has maintained its closing above its 200-day exponential moving average support, which is placed at around 960. And we have signs of short covering here, so we are expecting a good pullback towards 1,000 levels. And that's why we are recommending building long positions here, keeping a stop loss at around 960 on a closing basis.
All right, take that point, Sachi. We have some incremental details coming in for Polycab as well. It's a comprehensive beat on the top line. The EBITDA also above street expectations, and now the stock is up around 1%. Take a short break, come back more on the markets and stock-specific action.
Welcome back. Well, the Taiwan dollar posted its sharpest surge since 1988 amid trade deal speculations with the US. Prashant is here to explain more about this. Prashant.
Well, as they say, when fixed income and currency markets move, you better pay attention. And this is a story which is being talked about in exactly those markets, currency and fixed income, in a big way, but actually has got little or no attention in equity markets, not just here, but around the world. What has happened in Taiwan over the last 2 days is not normal. Actually, it's far from normal. The Taiwan dollar has surged 10% plus in just 2 trading sessions, a currency, right? This isn't just a currency move. Is it a signal? And that's the question that I'm asking here. Now, these are the moves that I'm talking about with regards to the currency, the Taiwanese dollar. It's pulled off a historic surge, up 5% last Friday, another 5% yesterday. So a 10% surge against the USD in 2 trading sessions. It's up a stunning 14% since the US dollar since the end of March. Mind you, we have not seen this kind of currency move, not even during the wild old days of the Asian financial crisis. So what is happening? Well, it is a classic case of a very long US dollar economy running into a weaker dollar. What do I mean by that line? The line that Taiwan is very long US dollars. Well, this table right here tells you the story. The private sector, along with the Taiwan Central Bank, together hold over $1 trillion US in reserves, foreign deposits and overseas investments as well. This is the breakup that I'm talking about. $1 trillion, over $1 trillion. So what's the problem really? Basically, as I said, the drivers for this sharp move are a mix of global macros meeting local factors. We all know that the US administration wants a weaker USD, US dollar. The dollar is sold off. The broader dollar, which is the dollar index, against a basket of currencies, is down 10% from 110 to about 100 in the last 4 months. So you have an economy, the Taiwanese economy, which is $1 trillion long on the US dollar at a time when the US dollar itself is facing a sharp slump in the value of the currency. So there is talk of exporters converting dollars. There is also a lot of chatter about how life insurance companies in Taiwan are responsible for some of this surge. So just to very quickly explain that life insurance point, because that's being discussed quite a bit, around 70% of the investments at Taiwan life insurers are invested overseas, mainly in dollar-denominated bonds and equities, of which only 30% match foreign currency-denominated life insurance policies. So there is a big mismatch here. Now, these life insurers in Taiwan do not 100% hedge the currency mismatch. So the chatter is that it could be that they are covering their positions in a very panicky and quick way. Added to this, there is also, of course, growing skepticism. And this is a broader point, but I think this is important. Broader skepticism around US economic exceptionalism itself starting to fade a little bit. The idea, what is exceptionalism? The idea that US assets should get a premium just because it is the US. The result, a dramatic forex reset. Now, Taiwan Central Bank yesterday clarified. They said 3 things. They said the US has not asked for this move. Basically, the fact that US has been accusing many countries that they've artificially kept their currencies depreciated, kept it very low. So the central bank in Taiwan said, no, this is not because of the US Treasury asking them to revalue the currency higher. They've asked corporates to stop panic selling the dollar. Most importantly and critically, they've also said that they won't fight the market. I mean, they essentially are not going to be in the market to stabilize the currency. The translation is that this is organic and it may or may not be over soon. There may be more left. Well, the currency sold off another 3% post the central bank clarification as the market took these statements by the central bank as not wanting to intervene. So here's the bigger question. Does Taiwan trigger a broader revaluation across Asia? Now, the economies which are big US dollar asset holders are Malaysia, Thailand, Philippines, Korea, also financial hubs like Singapore and Hong Kong. Could these be next? I think that's the other question. So yes, this is a Taiwan story, but it may be the first real test of a weaker dollar world in Asia. Is this a blip or the beginning of a bigger forex pivot? For India, here in India, the question for us is, will the damage be collateral at this stage? At least that's the question to my mind. The question is, if the rest of Asian currencies appreciate meaningfully from here, will it force that appreciation impact onto the Indian currency as well? Will we be able to hold on? It is an important question, well worth watching in the coming weeks and months. Back to you.
Okay, all right, Prashant, thanks very much for that. Well, we could benefit from a stronger rupee as well. Thanks very much. We will take a short break on that note. We'll get you more on the market stocks once we're back. Stay tuned. Welcome back. Well, under pressure for the markets at this point, just want to point out that Poly Medicure, which comes out with its numbers, that stock is up around 6% We have a couple of other stocks such as Narayana Health, which is doing well, so up around 2.5% for that particular stock at this point in time as well. On the downside, just watch out for a couple of these big volume movers. So IRFC is down around 2%, huge volumes traded on that one. Mazagon Dock Shipyard, which was one of those defense plays, has done well this year, but nonetheless is down around 1.5% at this point. Bharat Dynamics giving it company, and even Edelweiss Financial Services, watch out for that stock. It's down around a sharp 4% at this point. So a couple of these stocks which are buzzing around. For the indices itself, down 76 points for the Nifty. The Sensex is down over 200 odd points. The Bank Nifty down over 400 odd points, and the mid-cap index underperforming today, taking the brunt of the losses, so down around 1.4% currently for the mid-cap index. But CG Power will also report its Q4 numbers today. Markshi is here with more.
Well, a strong set of numbers is expected to come through from CG Power. When you look at the revenue, a growth of almost 25% is what our poll suggests. Revenue is expected to come in at 2,750 odd crores. The margins too are expected to improve by over 60 basis points to 13.5%, and the net profit too is expected to see a growth of almost 25%, coming in at almost 300 crores. Now, largely, let's look at what are the expectations with respect to the order inflow as well. Order inflow is expected to be healthy at 3,725 crores. The order book is also expected to show a very good, healthy growth and come in at 10,126 crores. Largely, when we look at the segment-wise performance, it is the power segment that is expected to outperform the industrial segment. Nomura, in fact, expects the power segment to post a growth of almost 32%, while the industrial segment is expected to post a growth of nearly 17%, similar to what we saw in the third quarter. As far as some key expectations, what do we watch out for? It will be the commentary on the demand outlook, especially for the short cycle products. Additionally, if you remember, the company had initiated an OSAT project a couple of months ago, and an update on the capex front out here would also be an important factor to watch out for. Largely, a good set of numbers are expected from CG Power.
Okay, all right, Vamakshi, thanks very much for that. So that's on CG Power. With that, it's also a wrap on Halftime Report. This is Lunch up next.
Stocks drift lower as concerns over US trade resurface. Realty and consumer durables are the big losers, while auto and FMCG eke out minor gains. Mahindra & Mahindra share surge after a better than expected quarter has several analysts revising their price targets higher. Most expect the auto major to continue growing strongly in the tractors, SUVs and electric vehicles. Banks led by SBI and PNB are likely to file a review petition on Supreme Court's order scrapping JSW Steel's acquisition of Bhushan Power and Steel. Indian Overseas Bank tells CNBC-TV18 that all options are on the table and a final decision is likely in a few days. Pharma stocks have slipped after US President Donald Trump signs an executive order to boost domestic production by asking the FDA to speed up approvals for local units and increase fees and inspections for foreign producers. And Ather Energy makes a subdued entry on the bourses, listing with a small premium to the offer price of 321 rupees a share. The EV maker, though, remains confident of growing volumes, market share and margins in FY26. Good afternoon, you're watching Business Lunch live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. It's a quiet day for the markets as we count down to some major broader market results in the second half of the trading session, and they've just started to trickle in. But for now, the Nifty remains in a cautious mode as we speak, still at that 24,375 levels, around about yesterday's low, which was 24,400. So it is important for the index to first hold on to yesterday's low and then build on. Of course, there are these geopolitical tensions at the border, the mock drills that are to be conducted tomorrow. That is also keeping sentiments in check. But of course, two names that you'd want to speak of just before we move forward. One of them is Polycab, and that reported results just a few minutes earlier. The results were a beat on expectations, but the bigger takeaway was the fact that the FMEG business has turned break even, and it is their first profit after 10 quarters of making investments. The stock nearing the highest point of the day, 0.7% higher. The company has also announced a 35 rupee dividend, which is the highest on record. So important to see what the company guides for in FY26. But for now, strong results from Polycab at the face of it. The other one is Sundaram Clayton, whose numbers you can see flashing at the bottom of your screen. The company has returned to profitability compared to a loss in the previous quarter, although that is aided by a one-time gain of 200 crores. So if you exclude that one-time gain, the losses have widened on a year-on-year basis, but revenues have gone up. So the stock is seeing a bit of a reaction here. 5.5%, almost 7% higher now is Sundaram Clayton, and EBITDA of almost doubling from last year. That is the bigger takeaway. The EBITDA doubling from last year. Margins have also doubled from last year, 5.5% compared to 2.7% on a year-on-year basis. So strong results from Sundaram Clayton, although the bottom line is reflective of a one-time gain. But the other big story of the morning was Ather Energy, the first mainboard IPO of FY26, the third largest IPO of the year so far. It was a subdued start to its trading history, ended listed at a 2% premium, has given up those gains, currently trading around about 4% lower from its issue price. And earlier in the day, we spoke to its executive editor and CEO Tarun Mehta, and he believed that this is what he had to say on the company's strategy going forward.
We are extremely bullish about the near-term growth because of distribution, because of how Rista, a new family scooter, is landing in the market, and generally how well the India premiumization story is really taking off, where Ather really plays in the center of it. Overall, I think both margins and volume and market share, all three should trend really well this year. I am personally definitely expecting an even better trajectory than what we saw in FY25. Now, stores have been expanding very rapidly in the last few months, particularly, and you will keep hearing about this in our commentary going forward. Let me just give you some context. 260 odd stores by December. Most of our industry peers are at between 700-800. We even hear 1,000+ stores already live. There are hundreds of cities across the country where Ather has not even opened its first store. But the bigger impact on profitability is really coming on back of volume, which is why I'm again and again keeping us focused on how volumes are trending up because fundamentally the unit economics that we have cracked, and remember our unit economics is a very clean one. We don't run our own stores. We have very limited dependence on subsidies. It's only one central government subsidy of 5,000 rupees.
The newest kid on the block, Aether Energy, currently a subdued start to its trading history. But here's a CNBC-TV18 exclusive then. The government is planning to make up the shortfall incurred from the cut in income tax through quick disposal of the pending tax cases. Sources are saying that the tax department has directed field formations to actively work on reducing pending litigations. Timsy is here with more on this. Timsy, what's the message to field formations?
In what could help the government to easily make up for the 1 lakh crore worth of revenue shortfall that the exchequer will face on account of the relief given in the new income tax regime in the budget, the Central Board of Direct Taxes aims to reduce pending litigation to garner some stuck taxes via quick disposal of pending cases. According to sources, the Income Tax Department has directed the field formations to actively work on reducing pending litigation in its yearly Central Action Plan, asking the field to target with an all-hands-on-the-deck approach on pending cases at commissioner level. The yearly action plan aims disposal of 2 lakh appeals at commissioner appeals level, which has as many as 10 lakh crore worth of disputed demands. Sources further shared that the plan directs field officials to compulsorily dispose top 1,500 appeals, urging to keep focus on liquidating the number of legacy appeals. A copy of the plan seen by CNBC-TV18 also shares that the tax department has told the field formations that there is no embargo on disposing appeals filed during the year. The taxman has also referred to a silver lining, stating that the number of pending appeals are for the first time in the recent past down from 5.49 lakh cases in April 24 to 5.38 lakh cases in April 25. The taxman has also lauded the fields by sharing that a record 1.72 lakh cases involving 6.22 lakh crore worth of disputes were disposed of during FY25 by Commissioner Appeals, and now to be seen as whether this daunting target gets achieved or not, and this performance continues, something that we'll have to wait and watch.
Timsy, thanks a lot for that. But stay on, because GST authorities have turned up the heat on global digital service providers. As the digital economy surges in the country, the GST authorities are ramping up enforcement efforts to bring foreign digital service providers under the tax net. Give us more details on that.
As the digital economy surges in the country, the Goods and Services Tax authorities are ramping up enforcement efforts to bring foreign digital service providers under the tax net, even after already having significantly expanded the definition of online information database access and retrieval, that is OIDAR services, in October 2023. CNBC-TV18 has now learned through sources that the Directorate General of GST Intelligence is still coming up with cases where such platforms and entities have not registered in the country and thus are neither reporting business generated from India and nor they are paying the due GST. Keen on bringing these foreign digital service providers under the GST net, DGGI is now pushing for registration, higher compliance from these online platforms which are not registered in the country. In its efforts, sources said the DGGI is sending emails and warnings to Indian firms that are using these foreign platforms seeking compliance. DGGI, which is the enforcement arm of Center for GST, is also asking Indian payment processors to block payments to these non-compliant foreign firms. Not just this, DGGI is also accessing forex transaction data from banks and has also sought aid from the Reserve Bank of India to enforce cross-border compliance. DGGI is also seeking suitable amendments to the law to empower itself so that the agency can take action against such non-compliant websites. Just to remind our viewers, the GST mop-up from these online services has grown up from 80 crores in FY18 to over 2,600 crore rupees in FY24. Meanwhile, experts attribute this growth to the broader scope of taxable services, the change in definition which actually came in October 2023 through amendments. Now to be seen is whether this DGGI action against non-compliant online service providers actually garners some more fruitful returns or not, something that we'll have to wait and watch for.
Timsy, thanks a lot for that. And coming back to markets, hear out some market opinion from CLSA's Vikash Kumar Jain. Now, he's striking a cautious note on the market rally, saying that India is currently the most expensive market in the world. Listen in.
India is the most expensive market in the world, most expensive. And that's where what is the starting point for us. This rally in India has been driven by the need to find a place to hide. It is not a rally which is being driven by some kind of a beta where you are playing for the excitement of things continuing to get better from very good. That's not what is the foundation of this rally. Because kind of IT services, the big view is, since we are in a headline driven market, for us in India, these are the stocks which will be the headline driven stocks. Because if something goes wrong with global growth and with US growth, then this is where people will actually be finding their ways to exit or to kind of go short of the ones who can. So that top down setup isn't great.
Vikash Kumar Jain there of CLSA, India being the most expensive market in the world despite being short of record high levels. Take a short break. On the other side, US President Donald Trump has signed an executive order to boost domestic manufacturing of pharmaceuticals. We'll tell you how this could impact Indian pharma on the other side. Stay tuned. Welcome back. Now, US President Donald Trump has signed an executive order to boost domestic manufacturing in the US, and this is aiming to reduce the time it takes to approve the pharmaceutical plants in the country as part of the new regulations. Now, listen into what the president had to say.
That's what it's all about, right? Very important. We're going to have a big announcement next week on some of this kind of thing, but more related to costs. The costs of medicines and drugs, because we're being ripped off, as you know, very badly, being ripped off compared to the rest of the world.
Many actions that you've taken so far in this administration, sir, are related to onshoring manufacturing and onshoring supply chains. One of the most important supply chain issues we currently face as a country is our pharmaceutical supply chain. This is an executive order intended to promote domestic manufacturing of pharmaceuticals. It streamlines the permitting processes that go into building domestic pharmaceutical manufacturing sites. It centers a lot of the environmental permitting process, which is quite significant within the EPA, and it takes other actions designed to ensure that we're bringing pharmaceutical jobs and pharmaceutical manufacturing back to the United States of America.
Okay.
Now, when President Trump was asked about the tariff rates on the pharma sector and the timeline of its imposition, this is what he had to say.
President, on the pharmaceutical side, have you made any determination on kind of what those tariff rates may look like and the timing of those?
I have. I'll announce it over the next 2 weeks.
Well, how do all of these developments impact our own domestic pharma companies? Ekta is here with a lowdown of that. Ekta.
Well, thanks for that. Indian generic pharma companies are in the crosshairs as US President Donald Trump has signed an executive order to boost domestic drug manufacturing. The order directs the US FDA to fast-track approvals for US-based manufacturing facilities, ramp up inspections of overseas plants, and increase inspection fees for foreign drug makers. It also mandates the public disclosure of manufacturing sources for APIs and names facilities that fail to comply with the US standards. The Trump administration has called the 5 to 10 year timeline to build new US pharma manufacturing capacity unacceptable, citing national security risks from dependence on foreign supply chains. While not explicitly a disincentive to overseas manufacturing, analysts say the move is a clear attempt to accelerate US-based approvals. The larger picture is to aim to shift the balance of global pharma production. Multinational giants like J&J, Roche, Eli Lilly and Novartis have already pledged significant investments in the US manufacturing as well. The bigger threat looms in Trump's warning that pharma tariffs could be announced in the next 2 weeks. This comes even as the US government nears the conclusion of a Section 232 investigation examining the national security implications of importing drugs and APIs. Analysts believe companies like Aurobindo, Cipla, Lupin and Glenmark may be better positioned given their existing US facilities, but one really needs to see the cost in terms of manufacturing eventually as well. Those with a stronger branded portfolio, for example, Ajanta Pharma, Torrent, Alchem, could also weather the shift, according to analysts. However, uncertainty around tariffs is expected to keep valuations under pressure, at least in the near term.
Indeed, we'll keep an eye out on these pharma names. The sometimes yes, sometimes no saga continuing for the industry. Now, US Treasury Secretary Scott Bessent said that some trade deals might come as soon as this week, with the Trump administration receiving very good trade proposals from other countries. He spoke to CNBC from the sidelines of the Milken conference, and he clarified that China tariffs are not sustainable and both sides have not yet been talking. Listen in.
I think we're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week. So when you think about uncertainty, uncertainty, a lot of it is generated by, I have asymmetric knowledge, so I'm not uncertain because I think it's going well. Other people don't know what I know. So
you have to share that with us then.
Well, I can say that I am highly confident that we have 18 important trading partners. We'll put China to the side. The 17 other partners, many of them have approached us with the very good trade proposals. President Trump is going to be involved in all of those. He will be the final decision maker, and we'll see where that goes. I think we could see substantial progress in the coming weeks. We'll see. That I think it's Stein's law, that which is not sustainable doesn't continue. So 145%, 125% tariff levels are the equivalent of an embargo.
Yep.
And we're reading every day what's happening with factories in China. And from an academic point of view, I can tell you that the history of trade battles, we are the deficit country. The surplus country always has the most to lose.
Scott Bessent, US's Treasury Secretary. Time to take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away. Here is CNBC-TV18's all-new app, where you get in-depth articles, breaking news updates and financial world happenings all at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that's up on your screen. Take a short break. Back on the other side. Welcome back. You're watching Business Lunch here on CNBC-TV18. Now, as hostilities between India and Pakistan continue to rise following the Pahalgam terror attack, the United Nations Security Council held a closed-door meeting on the Kashmir issue. Parikshit is here to tell us what were the key issues discussed in that meeting. Parikshit, good afternoon.
Well, at the outset, we must tell our viewers that this was an informal meeting requested for by Pakistan. They want to bring Kashmir at the center stage once again. They wanted to blame India, and they wanted to tell the world that this was a false flag operation in Pahalgam, and the Indian government was actually trying to pin the blame on Pakistani forces and Pakistani-based actors when it was not so. Now, this argument, according to our top sources, was not accepted by members of the UN Security Council. In fact, they expressed a lot of concern about saber rattling on the part of Pakistan, threats of using nuclear weapons. Also, the fact that Lashkar-e-Toiba was possibly involved. They also asked Pakistani diplomats as to why people were questioned about their faith before attacking them. So clearly, Pakistan's rhetoric was not accepted at this meeting. They were asked that there should be some accountability as far as this attack is concerned. They must cooperate with India in the investigation. So clearly, Pakistan's attempts to tarnish the image of India, internationalize the Kashmir dispute, failed at the UN Security Council at this informal meet that was called by them.
Right. You know, Parikshit, stay on, because the Home Ministry has also called for civil defense mock drills to be held across the country tomorrow. Give us more details on that.
Well, this is significant. The last time that such mock drills or warlike mock drills were carried out was in 1971 during the India-Pakistan war. We've not seen such mock drills nationwide across the country. Why is this being done? This is being done because our relations with Pakistan are at an all-time low. Hostilities are also high. Tensions are high as well. So we want to be prepared for any eventuality. And therefore, the Ministry of Home Affairs, which is the nodal body for the Civil Defense Department, has ordered drills in 244 districts. Now, why 244? Because these are areas where civil defense teams actually exist and their offices are there. Every state government has a civil defense department under it. Now, people like you and me can also volunteer to form a part of these civil defense forces, which are there to assist the local police and also the armed forces in case there is any kind of rescue and relief work that is needed in case of a disaster or hostile attack. Now, what is going to happen tomorrow? We are going to see nationwide drills in collaboration with the Army, Air Force, Navy, the police, anti-terror squads of different police forces. They will be assessing preparedness and response time of civil defense teams in case there is a hostile attack. So they will be mimicking a situation where there is an attack or there is a terror attack that has taken place in one location, and teams have to be responding to that. The efficacy of air raid sirens will be assessed. We will be seeing if all the training that has been given to civil defense teams to evacuate people, move people to bunkers, or train students to defend themselves, are all those training mechanisms in place or not? That is the large objective of this exercise. A report on the efficacy, the results, and the takeaways from this exercise will also be sent to the Ministry of Home Affairs later tomorrow. But all eyes on these drills, which will happen all across the country and all down to the village level as well.
Important updates there from Parikshit. Thanks a lot for that. By the way, just some updates that were flashing at the bottom of your screen just a few minutes ago while Parikshit was on his details about Bharti Hexacom, and TCIL has raised questions with regards to transparency in that deal with Indus Towers, and TCIL, being a government body, has a 15% stake in Bharti Hexacom. Mind you, that's a CNBC Awaaz story, our sister channel, quoting sources. So Bharti Hexacom now down to the lowest point of the day, where TCIL, a government entity having stake in Bharti Hexacom, has raised objections to that deal. Moving on, Israeli Prime Minister Benjamin Netanyahu has said that Israel will begin a new offensive in Gaza, which will be an intensive military operation aimed at defeating Hamas. Here's a report by NBC News' Matt Bradley.
Massive escalation in Gaza and a new strategy approved by the Security Cabinet to take land and hold it, they say, to prevent Hamas from taking it back. Prime Minister Benjamin Netanyahu calling it a powerful operation to defeat Hamas and free the remaining 59 hostages. We will not give up on anyone, he said. Israel says it will move Palestinian civilians to safety in Gaza's south, and will revamp aid distribution, they say, to keep it away from Hamas.
We're going to help the people of Gaza get some food. People are starving. Hamas is making it impossible because they're taking everything that's brought in.
Aid agencies say Israel's new plan uses aid as a pressure tactic and say its 2-month-long blockade has pushed Gaza to the brink of famine. At one of the only remaining soup kitchens, the wait for food is desperate. We are hungry almost every day, says this little girl.
Please, stop the war. Now. We die.
This woman says her husband, and her children are all ill. The new approach comes a day after a missile fired by Yemen's Iran-backed Houthi rebels evaded Israel's sophisticated missile defenses.
So this is the crater left by yesterday's impact. Nobody was killed, but just look at how close it was to this huge international airport.
Tonight, Israel launching retaliatory strikes against Houthi targets.
They're coming in from Gaza. By the way, just pull up Polycab that has surged to the highest point of the day now after its results. It has very convincingly managed to cross that 20 to 22,000 crore FY25 revenue guidance that it had given, and 22,000 crores is what it has reported, 20 to 400 crores actually for the year. Although it has not shared any specific number for FY26, it does believe that the international business too will see a very strong rebound in this financial year, supported by a robust order book and a favorable demand environment across key markets. Polycab at the highest point of the day, 2.75% higher. And just before we take your leave, also pull up Paytm. That is also going to be reporting results today. That stock too not doing very well for itself at the lowest point of the day, 4.5% lower. But with that, we call time on this edition of Business Lunch. From me and the team that put this show together, thank you so much for watching. Midcap Radar for the next 30 minutes.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Doria and with me is Vivek Iyer. Vivek, it's red across the screen after we had an exciting session yesterday. The broader end of the markets is also taking a very sharp knock in trade today.
That's right. Good afternoon, Vamakshi. So, one thing that we need to keep in mind is the fact that markets on par for course. The markets would have taken a bit of a breather post the stellar rally that we've seen. Strong reactions coming into quite a few of the earnings that have come about and quite a lot of news developments as well in today's trading session. So which is what we are tracking in today's trading session. We have a lot lined up on the show today, especially in terms of managements too. So let's start off with the top headlines. CCL products in focus after reporting their Q4 FY25 numbers. Revenue surges 15% while EBITDA up 38% on a year-on-year basis. The management tells CNBC-TV18 that their FY26 guidance is lower owing to a higher base.
Shares of Cummins India correct 5% after its parent company withdraws its guidance for 2025 on tariff uncertainties. The Indian power generation business has also seen an 11% decline in revenue in the quarter ended March 2025.
Yes Bank comes off days highs after sources tell CNBC-TV18 that reports of Japan's Sumitomo Mitsui Banking Corporation picking a 51% stake in the bank are incorrect.
Stocks drift lower as concerns over US trade resurface. Realty and PSU banks are the big losers, while auto and FMCG eke out gains. Well, it's a wobbly day for the markets. The Nifty, as of now, is somewhere around the 24,390 mark, trading with a cut of nearly 1/3%. The Nifty Bank too is down close to 1% in trade. Most of the sectoral indices too seeing significant pressure. The Nifty PSU Bank specifically trading with a cut of over 2%. The Nifty Realty too continues to languish in trade. But on the flip side, the Nifty Auto is doing quite well. The broader end of the markets, they continue to remain under pressure. The Nifty Mid Cap Index is also reeling under pressure, down almost 1.5%. The Nifty Small Cap Index as well down close to 1.6%. But lots of movers in trade. In our special segment Mid Cap Movers, we now have Hormaz to take us through the mid caps that are moving around in trade. Good afternoon, Hormaz.
Good afternoon, Vamakshi. Not good looking screen for the broader markets, isn't it? Both the mid cap and the small cap index at the lowest point of the day. But just to buck the trend a little, we'll start off with some of the gainers then in the broader markets, and they'll come up on your screen because they are the ones that are still in the green despite the mid-cap index being at the lows of the day. And Poly Medicure is one of them. Even as the mid-cap index is at the day's low, that stock is at the day's high, 8% higher for Poly Medicure. Godrej Agrovet, after that upgrade coming in from Kotak, calling the recent sell-off as unwarranted, is clawing back some lost ground after the hammering it received post the results. Newgen Software and CEAT too having a good day at the office. Earnings reactions, of course, they are on both sides of the spectrum, but CCL products, as you just mentioned, still slightly off the highs of the day, still holding on to gains of around 13%. Indian Hotels at the lows of the day. Cummins has clawed back a lot of lost ground. At one point was down 8%, now is around 4.5% lower, but CAMS has now declined to the lowest point of the day, 4% lower there as well. Well, PSU banks, as you highlighted, are sulking in today's trade, and that is ahead of Bank of Baroda's results later in the day. All of them at the lowest point of the day, losses anywhere between 3.5% to 5%. Stocks that are doing well on the back of volumes in today's trading session, some volume-led movers. RR Kabul continuing to build on from yesterday's gains. Yes Bank at one point was up 9%, is now down, is up around 1.75%. And Tejas Networks is up 3% at with very strong volumes. And lastly, stocks that are not doing well in today's trading session other than the earnings reactions. Look at Sonata Software is down 5%. Paytm ahead of its results is down 4.5%. Railtel after its results was among the top movers earlier this yesterday, but now is giving up some profit booking. And Star Health, an IPO price of 900, now trading at 360. Back to you guys.
Thank you so much, Hormaz. A comprehensive list as far as the movers are concerned from the broader end of the markets. You mentioned RR Kabul, second straight session of gains. Its peer Polycab just reported its numbers, a good set of numbers, a beat versus the CNBC TV18 poll, and that stock too is doing quite well in the session, 2.5% higher for Polycab. But it's now time for a short break. The management of Epigral joins us next to discuss their Q4 numbers and more. Welcome back to Mid-Cap Radar. Well, the sulking continues, especially as far as the broad end of the markets are concerned. Small-cap, mid-cap index, both of them have lost significant ground today, 1.4% each. A lot of uncertainty, especially with regards to earnings as well as management guidance. Well, a couple of stocks on the radar. First on the list is Exide Industries. Exide Industries, remember, the company delivered their numbers a couple of days ago. The company had a conference call today where some positive management commentary was highlighted by our colleague Sudarshan. Sudarshan mentioned that the management in its commentary said that the partnership with Hyundai is progressing on track, on schedule, and the company is also in talks with 2 clients as far as the battery manufacturing is concerned. Post the highlighting and post the conference call, the stock has perked up and now trading near the day's highest point. We did mention Polycab, but another stock in focus today is going to be one from the capital goods pack. Vamakshi, you've been tracking CG Power quite closely. What should we expect today?
Well, absolutely. CG Power is set to report its numbers today. Keep in mind that over the last 1 month, that stock has seen a very good run-up, up almost 17% so far in the last 1 month. But today, the stock is taking a bit of a knock in trade today, down nearly 0.3%. But despite that, when we look at the numbers, revenue is expected to come in at 2,752 crores, an uptick of almost 26% on a year-on-year basis. The margins too are expected to improve by almost 64 basis points to 13.5%. The net profit too is expected to see a very good growth of almost 25%, coming in at close to 300 odd crores. Largely, when we look at the order inflows, they're expected to be better. 3,752 crores on an average is what the analysts are penciling in. The order book is also expected to be very healthy, and it is expected to come in at 10,126 crores. As far as the segment-wise performance is concerned, the power segment is expected to post better growth as compared to the industrials business. Power segment is expected to post a growth of almost 32% as per Nomura estimates, while the industrial segment could see a growth of almost 17%. Let's also look at what are some of the important factors to watch out for. Con call is scheduled for the company at 3:30 p.m. later today. The demand outlook for short cycle products, we will be keeping an eye out on commentary that comes through on this front, and an update on capex plans of the OSAT business is also expected to come through. We'll be keeping an eye out on CG Power. Strong set so far, Vivek.
Well, thank you so much, Vamakshi. I know you track this particular name quite closely. Absolutely flat going to the results. There's going to be, depending on whether it meets or beats expectation, can expect an up move either side or a down move on the other side. Well, the other stock in focus is one from the city gas distribution space, and MGL is expected to report its Q4 numbers today. Sudarshan yesterday told us about how its peer IGL had hiked prices. What should we expect from MGL in today's earnings?
So beside the price hike, IGL had also reported the numbers last week, and those numbers were very strong. And now MGL is going to report its Q4 FY25 earnings, and it's likely to be strongest amongst all the city gas companies. We are expecting that company may report that margin expansion might be seen on the back of the recent price hike the company had taken, and the price hike taken by MGL was the highest if you compare with the price hike taken by other city gas companies. Now, if you talk about the headline numbers, their profit may slip 6%, while revenue may increase by 1%. EBITDA may too see an increase of 2%, and margin can come at 18% if you compare against 17.9% last quarter. Now, if you talk about the operational details about the EBITDA per SCM, which is the important metric for any city gas company, their EBITDA per SCM, or say realization, is seen increasing 5% sequentially, and it may come around rupees 8.73 versus rupees 8.30. On the volumes, volume would be very watched closely. If company manages to hold on to volumes that it had seen in the previous quarter, despite the price hike, it would be taken very positively, and volumes are seen flat sequentially and up 12% year-on-year. In the commentary, what exactly would be watching for? First, if there is any commentary related to recent announcement by Maharashtra cabinet that it has approved EV policy. If something company has heard from Maharashtra government, because Delhi government also had released draft policy related to transition from CNG to EV, which its transport minister had declined those details. But we'll have to see hear from MGL management if there is any update related to Maharashtra EV policy. Also, what is in if companies looking to take further price hike to protect margin. But as far as earnings are concerned, we are expecting a very strong set of earnings from city gas companies. Also, remember that internals that you had seen in Q4 FY25 have changed drastically in Q1 FY26 to positive.
Thank you so much for that, Sudarshan. Indeed, a strong set that you are expecting from city gas distributor companies, but MGL as of now reeling under a fair bit of pressure. But moving on, let's also focus in on Epigral. The company has reported a decent performance in the fourth quarter with very strong revenue growth led by derivative products. The board additionally has approved capex of 780 crores for doubling its CPVC resin and EHC capacity. The company's chairman and MD, Maulik Patel, joins us now. Good afternoon to you, Maulik. Thank you so much for joining in with us. Let me first start off by asking, 32% year-on-year growth in the revenue. You've also posted 11% year-on-year growth in the volume. So largely, when we look at the growth, was it largely led by pricing or was it a change of mix? And going into FY26, what are your expectations?
So mainly the growth in this financial year, last financial year, it was because of the CPVC and ECH expansion, what we did 2 years back. So this was the full year where we utilized maximum capacity of the CPVC, what we have expanded last year, and CPVC compound of last year. And ECH, which we have commissioned in 2 years back, I think it was the full optimum level we have utilized in the last financial year. So major capex, what we did in last 2 years, I think because of the volume, this growth is coming to the company.
Okay. Mr. Patel, also give us a sense, we want to talk specifically about the derivatives as well as the specialty segment. Right. FY25, what was the contribution? We understand by FY28, you expect this contribution from this particular segment to increase quite significantly. In the call yesterday, I think you've given a volume guidance in the range of 15% and EBITDA margin guidance in the range of 25%. If you could reiterate that guidance for us, and where do you see growth triggers in FY26?
So if you see last 3 to 4 years, we are continuously expanding on the derivatives and specialty side compared to our chloroalkali side, our expansion. So continuously we are doing it, and the volume is increasing is on the derivatives and specialty side, including the CPVC, epichlorohydrin, hydrogen peroxide, and the chloromethane. Now the future capex which we have announced is also on the CPVC and the ECH side, which will commission in the first half of next financial year. And that will add on our right now our market share is not market share, but the percentage which we are getting a revenue from the specialty and derivative side in this financial year, we have reached up to the 55%, 54% from the derivative side, which will increase further down the line after 2 years. Once we reach the optimum level of CPVC and ECH expansion capacity, it will reach to 70%. So our ultimately revenue mix will be 30% from the chloroalkali and the 70% will be on the derivatives and the specialty chemical side will be there in the future.
Sure, and generally the margins on the derivatives and specialty business, that is better than your other segment. So what would be your margin outlook going forward? Right now your margins have actually improved to 28% or so. So going forward, when your mix also moves towards the derivative side, what is the kind of margin you're expecting?
So as a company as a whole, we are giving a revenue guidance in terms of the EBITDA margin. We are giving as almost it is going to be around 25% plus or minus 2%. It is going to be there going forward as well.
Okay, so 18 to sorry, could you come again with that number?
It's a 25% plus or minus EBITDA margin will.
EBITDA. So you expect EBITDA margins to moderate despite the rising contribution from the derivative segment. Is that accurate?
Yeah, that's right. Because last couple of years, the chemical market globally was on the downward. So the feedstock cost, the feedstock raw material cost was on the lowest side. That's why we are having a little higher percentage of margin. But going forward, I think we are expecting the rise, the price of the raw material will increase. So that's why we are giving a guidance in the long term. We are giving guidance of 25% EBITDA margin only.
Sure, and you've also announced a capex 780 odd crores that is expected to start contributing from FY27 onwards. So you just give us an idea, what would be the kind of incremental revenues that will come on stream once this capex is commissioned? What is the kind of demand that you're seeing to support the kind of capex that you're undertaking?
So over and above the CPVC and ECH, what we are expanding in current financial year, we have also commissioned the chlorotoluene and chlorotoluene, which is also import substitute and first time in India. And so we are expecting we are going to achieve the revenue from all these three projects: chlorotoluene, ECH expansion, and the chlorotoluene, the CPVC expansion. We will get an expected revenue around close to 1,200 crore kind of thing once it reach to optimum level in coming times.
Understood that. Maulik, also give us a sense. We understand that in the quarter gone by in FY25, caustic soda actually was quite volatile, but Q4 you ended caustic soda business on a strong note. FY26, how do you see pricing pan out? What is the current capacity utilization? Do you feel the need to expand facilities over here?
So the caustic soda side, it is a strong demand globally because of the alumina and the nickel, which is used. Nickel derivatives also used in the EVs and in the electronic application. So both the metal is going to remain strong, and the major consumption is caustic soda. So caustic soda, we are hoping in the current financial year, even in the next financial year, it is going to remain strong. Only the chlorine derivatives is on the downward side. That's why the chlorine expansion, we are continuously doing in-house consumption going forward. So once we expand all CPVC, ECH and everything, our 90% chlorine consumption will happen in-house internally. That's why we are able to ramp up our efficiency of the chloroalkali production close to 85 to 90%, what we are right now at 80% or 75 to 80%.
Sure. And, what is the mix between the domestic revenue as well as the exports? And is US a significant part of your exports?
So currently we are exporting majority on the European side. Currently we are exporting to only 10% of the company's revenue. We are more focused on the domestic growth, which is more on the infrastructure, windmill, the renewable energy and the automotive sector side. And that's why we are adding the chemistry, or we are doing expansion which used in this three segment currently. And long term, we are very bullish on the domestic side rather than the export side. But yeah, there is an opportunity, but I think clarity of the US on the tariff is not yet come. We cannot take a long-term call based on the current situation because many people are expecting that it will change frequently after the negotiation with the individual countries going forward. So currently we are not able to take a call based on the US, but yeah, of course, there is opportunity in the US in many chemical sectors right now, including what we are manufacturing right now. But I think it is difficult to comment on the long-term strategy about the US market right now.
Maulik, one last question. Request you to keep your answer a little short. Well, that's an evolving situation and we are all tracking it. Well, you spoke about capex for doubling, both CPVC and ECH capabilities. FY26, can you confirm if the capex required is close to 450 crore? So how are you funding this capex? What does it do to your debt? You've also given a guidance for reducing debt to EBITDA. So give us those numbers, please.
Yeah, so currently we are going to manage all the capex. What we are planning to do in current financial year is mainly from the internal accruals, and if we require for the short term, we will raise from debt from the bank. But most of it is going to be from the internal accruals only.
Sure, got that. Well, thank you so much, Mr. Patel, for joining in with us. We hope to connect with you sometime later again. But as we slip into a very short break, here is some good news for our viewers. India's business news leader is only a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen. Welcome back. You're watching Midcap Radar on CNBC TV18. From one management to another then, Techno Electric is on our radar now. Stock has been under pressure this year. They are in the news because of the launch of their new arm, Techno Digital Infra, with an investment plan of $1 billion and cumulative capacity target of 250 megawatts. To talk about more on this development and outlook here onwards, Ankit Saraiya, Director and CEO at Techno Electric and Engineering, joins us now. Well, good afternoon to you, Ankit. Let me first start off by asking about the kind of opportunity that you see in the data center space. This is a very hot market right now. So what is the kind of incremental revenues that you are penciling in from here?
Yeah, our venture into data centers started somewhere around 2021 with our first data center coming up in Chennai, about 36 megawatt. We are commissioning the first phase in a month's time, which will be approximately 5.6 megawatt. And the reason why Techno Electric got interested in this segment was obviously the potential that we see in the digital infrastructure space with growing digitization, focus on Data Protection Act by the government. And also for Techno Electric, it made sense since data centers largely run over the raw material of power. And Techno Electric understands the subject of power real well, given that the parent company has been part of power sector for almost 4 decades. And that got us excited. And we see great potential for data center industry going forward. We see it growing at least 16 to 18% CAGR, even after given that it's a high capex industry. And our program is to deploy $1 billion behind this industry, develop approximately 250 megawatt or more within the next 5 to 7 years.
Right. Ankit, thank you so much for joining us. The first thing which we want to understand is we are trying to wrap our heads around this particular announcement that you've made. Techno Digital Infra. So is this a fresh arm of the company? Does it include the already existing data center business? Like you mentioned, the Chennai data center, the first phase is coming up. And the 1 billion, does it include the capex already incurred, or is it a fresh capex? And if it includes the capex that already been incurred, what is that incremental capex that you will be putting in?
So Techno Digital is basically a platform which Techno Electric launched, which is currently an wholly owned subsidiary of the parent company, Techno Electric and Engineering Company Limited. And what we want to do is develop multiple kinds of digital infrastructure, which includes hyperscale data centers, edge data centers, and so on and so forth. And the existing Chennai data center, or the one which we are coming up with in Calcutta, or there's another one which we are planning in Noida, which are the larger data centers, will all come under this platform. And over a period of time, we would also like to see our edge data centers, which are being developed in partnership with RailTel Corporation, also become a part of this platform over a period of time, and create a massive infrastructure of interconnected, large hyperscale data centers with these edge data centers, so that we can go and bring a proposition to the end user that you can have a data center closer to the consumption point of the user, which will be edge data centers. And also we meet the requirement of large hyperscale data centers across the geography of the country.
Ankit, at the end of Q3, you had mentioned that you were in discussions with multiple international as well as domestic partners, as a tie-up into this particular data center foray. At the end of Q4, what is the status of these discussions? We also understand that you were in talks with a large domestic PSU bank, for a foray in the data center business. Has any of these talks reached a fruition?
So the talks are ongoing and very encouraging. We are in discussion with multiple strategic partners. So from very beginning of our journey, we've been very specific that we would like to engage with a strategic partner that can add value to our foray into digital infrastructure space. And that's what we remain focused on. And we continuously remain engaged with multiple such data center operators across the globe. And we feel confident that as we are growing in this space, we are creating an infrastructure which will be exciting for multiple such operators to engage with us and form partnerships of different nature which can help us continuously grow in this space.
Well, Ankit, let's also get some, guidance, some numbers out of the way. You'd shared a guidance earlier, order book of almost 10,000 crores, top line of 2,400 crores in FY25, increasing to 3,600 crores in FY26, with margins of 13 to 15%. So is this guidance still intact, or is there an upside given the kind of announcement that you made right now?
We would love to speak on it, but the problem is that we are currently under silent period, given that we are coming.
Qualitatively, you're on track?
Yes, you can say that.
Okay. Ankit, you're very much present as far as the power EPC space is concerned. And, the government has constantly been talking about an 8.5 to 9 lakh crore opportunity as far as this space is concerned. Players also have told us about significant bottlenecks, especially when it comes to renewable energy offtake. You are present in substation EPC construction. What exactly is happening on ground? Are there delays when it comes to actual execution of projects? And secondly, a lot of players have told us about a shortage of transformers. Are you also facing the same?
So, right, you may say the space is very, very exciting. Wherever there is challenges, there is opportunity. And we feel that there is immense opportunity for companies like us, which have been delivering projects largely focused on substation, because with increased renewable energy, with increased focus on renewable energy, what it does, it multiplies or exponentially grows the requirement for substations. If conventional power requires 1x of transmission capacity, renewable energy requires 4 times of it. And that's the reason why we are seeing the thrust. And also because of the sudden capex plans which have come into this sector, it has made the sector reach an inflection point where the supply chain is a big constraint, whether it is transformers or whether it is other equipments that go into a substation business or EPC business. And therefore, it is challenging to meet project timelines. But having said that, with the experience that we've come with, we try to navigate them for ensuring that the projects are delivered on time. I think there are multiple challenges in the sector which needs to be sorted out, whether it is land acquisition, whether it is supply chain, and especially if we want to deliver on the programs that we are talking. But the focus is there and positively there to resolve them and deliver what is required on the ground.
Thank you so much, Ankit, for joining us. Very good conversation. We hope to have you once again on the channel post the Q4, where we're going to quiz you a lot more on the numbers and on the guidance that you've given the street post Q3. But with that, it's all the time we have on this edition of Midcap Radar. Mutual Fund Corner when we return.
Hello, good afternoon. Welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala and thank you so much for tuning in as always. Now today we're going to be putting the spotlight on mutual funds where the cash holding, which have actually been at a multi-year high. What does this mean for you as investors? Because there are many AMCs that are sitting on this high cash piles. We'll talk about all of that and how these high cash levels will impact you. To discuss all of this, we have Rushabh Desai, founder at Rupee, with Rushabh Invest Services, joining in with us to talk to us about all of that. Rushabh, good afternoon, and thank you so much, as always, for joining in with us on the show. You know, this is something that I've seen a lot of people talk about. We've seen a lot of articles that come in on this front as well. In the recent volatility, we've seen increase in terms of cash piles. Now, specifically, if you could just start by telling us which categories of mutual funds, whether large cap, mid cap, small cap, flexi cap, that are seeing highest holding in terms of cash, and what are the specific reasons that are a possibility for high cash holding other than the volatility that we're seeing?
Hi, Vinny. First of all, thanks so much for having me on the show. I think, rather than looking at, which all categories has the highest amount of cash holding, I think the right way to look at is, which all AMCs, are holding the right amount of cash or the highest percentage of cash. I think that would be the right way to go ahead because, see, every AMC will follow a different strategy, Vinny. Now, some AMCs are comfortable taking aggressive cash holdings, and some AMCs are not comfortable taking aggressive cash holdings. Means, some AMCs will be probably fully invested into the markets, regardless, whether the equity markets are volatile or no. Now, coming to the specific details, of cash holdings, see, there are two AMCs currently are holding more than 15% cash. See, around 5 to 10% cash holdings is very normal and natural for a fund or an AMC to do. But when a fund or an AMC takes beyond 15% cash call, that's kind of a little bit aggressive in my point of view. So there are two AMCs, Vinny, at this point of time. One is Motilal Oswal and second is Parag Parikh Flexi Cap Fund. Now there are certain funds from say Quantum AMC, DSP, HDFC, which are also sitting on good amount of cash. Now, there are two things what we can make out of these cash holdings at this point of time. One is that, because the markets were quite overvalued, say last year, they wanted to book profits. This is number one. Number two, now, since the markets have turned quite volatile and there are few more uncertainties left over the next 3 to 6 months, I think the AMCs want to sit on cash and deploy it in a staggered manner so that they can buy at lower levels, Vinny.
Okay, absolutely. It does make sense as a strategy also. But, what has been the past trend, Rushabh, when you look at it, right? Like, how do these high cash levels typically correlate to the market movements that could come subsequently? Is there any historical evidence that funds with high cash maybe could perform, outperform, underperform after such period? Any such history?
See, Vinny, regardless whether an AMC or a fund is sitting on high cash or no cash, it's very natural and normal for funds to outperform and underperform from time to time. Specifically, underperformance is very natural from time to time. See, no fund is going to be at the top or no fund is going to be in quartile one consistently for a very long period of time, right? So this is number one, is that underperformance is very natural and normal regardless of cash holdings. Yes, there have been instances where a fund or an AMC is sitting on good amount of cash, and probably during that point of time, markets substantially rallied further. They missed out on that rally and the fund underperformed for short-term period. And also there have been instances where, for example, like Parag Parikh sat on cash for a good amount of time since last year, right? And now that the markets have turned volatile, the fund has actually outperformed many of its peers. So again, in today's time, dynamic management of an equity fund is absolutely very important. And number two, that underperformance and outperformance is very natural. But as long as the fund is backed by an experienced manager team, has a very good track record, I really don't think investors really need to worry about at this point of time.
Right. Rushabh, while you obviously did say that, sometimes it is going to be an investment opportunity also that comes in for these funds as well at a time when you're seeing ups and downs in the market. This cash they hold, they can use it as that opportunity that is there. But how should I differentiate, or find out as an investor if there's any other reason, maybe in terms of liquidity management, some operational reason? Is there a way that one could come to know the difference between why they're holding the cash?
That's a very great question, Vinny. I wish I had an answer to this, but it's very, very hard to say whether the AMC is taking any kind of liquidity call, but usually it's more to do with profit booking. And when the markets turn overheated and overvalued, that is the time where certain AMCs would want to get out. See, usually value pickers tend to book profit when markets are overheated, and they don't find much of value picks in an overvalued market, right? So value pickers may take aggressive cash calls, but at the same time, as we saw that, even growth strategy funds are also taking aggressive cash calls at this point of time. So I really don't think, investors should really look at the cash component. It's very simple that, if markets have become overvalued, if the price to earnings ratio is gone way above the 10-year average, then it's a clear indication that the markets are expensive. There can be further upside, but the further upside could be limited. But I think rather than looking at cash calls, looking at the price to earnings ratio and sticking to one's goals, risk appetite, time horizon, and asset allocation, I think is the right way to go ahead.
Okay, Rishabh, just want to get a bit more specific in terms of this answer. Any time that you've seen that these high cash levels, like you said, right, there is going to be a possibility if they've not invested the money, there could be an underperformance in the short term. But overall, in the long term, has there been any time where you've seen a mutual fund holding more cash has seen an underperformance? Anything that you have seen in so many years of your experience here?
See, usually value strategy funds, contra strategy funds tend to be a little more cyclical. So if a cash call, whether it has gone right or wrong, value and contra funds can be more cyclical. So the underperformance in value funds could be a little prolonged, probably 5 to 6 years or maybe 7 years as well. See, we have seen funds underperforming on a 10-year basis as well, regardless whether they are holding cash, no cash, etc. So I think, this is the right way to go ahead. Diversify well across different strategies, whether it is growth, value, contra, momentum, etc. And also, it's very important to stick with the right AMC and the fund manager. See, rather than experimenting, too much, sticking to old-fashioned, consistently outperforming funds. See, the whole point is not to be at the number one. The whole point is the fund should give you slightly higher returns than the benchmark. And as long as the fund is delivering a higher return than the benchmark, now whether the fund is giving you probably 2-3% an alpha or the fund is giving you 5-6% of an alpha, it really doesn't matter, right? Investors at this point of time, chase the number one, number two, or number three outperformance. I think that is a very wrong way to go ahead. Going for consistently outperforming funds and sticking with quality funds, with quality AMCs and managers, I think that's the right way.
Rishabh, how often do I need to check the cash that my fund is holding or the AMC is holding? How often does an investor need to check this?
Not often at all. Not often at all. I think that is something what investors really should not worry about. You leave this up to the fund manager to decide whether the fund manager wants to take cash calls or no, right? So I think the investors' job is to stay invested, right? And if the time horizon is coming near, then of course getting out of the equity markets is the wise thing to do. But I think just staying put and staying in quality funds is the job of the investor.
So obviously then you would say that, if someone is asking that should I rebalance my portfolio or switch to something else when there's high cash, would that be making sense, or that is something that you should just avoid?
See, rebalancing should be done, when a fund is underperforming, number one, and when, to reduce the risk. So for example, say if my mid and small cap allocation is 50%, which has substantially gone up to say probably 70-75% over the 5-6 year period, then rebalancing can be done because the investor may not want to take too much of a risk in the mid and small cap space. Also, if the fund is underperforming, say on a 7-year period or a 10-year period, then by a good amount of margin, then that's the right time to get out of that fund. Because let's not forget that investors are paying an additional amount of money, an additional fee for active funds to outperform. So I think underperforming funds by a decent margin has no space in your portfolio, Vinny.
Okay, and Rishabh, is there a time when you would say that, okay, if the fund is holding or the AMC is holding this percent of cash, then someone needs to be like, okay, now I need to figure out what to do. What is that percent that you would keep in mind?
Well, there is no specific percentage, Vinny. As I mentioned earlier, that every AMC will have a different strategy. Now, just because an AMC is sitting on, say, probably 25-30% of cash, it really doesn't mean much. You should really let the AMC and the fund manager do its jobs. Whether the fund is sitting on high cash or low cash, as long as the fund is giving you returns and as long as the fund is outperforming the benchmark, that's all you need to worry about.
Okay, as long as the fund is performing well, you don't need to bother about what the cash pile is lying on with the fund, because that could be their strategy. They would invest it over a period of time. So even if it's a high percent, one does not need to worry, right? I'm rounding it up well.
Absolutely, Vinny. Absolutely.
Okay, so viewers, don't worry if your fund right now is holding some bit of your cash. They have some strategy in mind where they'll be applying the cash. As long as they're performing in the medium to long term, you don't need to worry about that. That's a word coming in from Rishabh. But on that note, we're going to slip into a very short break. And now on the other side, we'll be discussing the focus that's coming in on ESG funds, the excitements that's there, and where does India stand in this story as well. So don't go anywhere. Welcome back to MF Corner on CNBC-TV18. Now we're going to shift focus and we're going to talk about ESG funds. These funds are gaining traction in India. What are the factors that are driving this surge? What are the risks that are there, limitations that are there? Should you be looking to invest in ESG funds? What are the returns here? And we still have Rishabh Desai, founder of Rupee with Rishabh Investment Services, to talk to us about that. Rishabh, this recent surge, okay, ESG has gained importance overall. That's environment, social, as well as governance has gained importance. And so have ESG funds. They are gaining traction as well. What are the factors, do you think, that is driving this recent surge? And how do you see these funds moving from here on?
Vinny, so first of all, see, ESG as a concept is fairly new in India, okay, compared to the Western countries, especially like US. The most important reason is that, India is still a very emerging and developing economy. So ESG is going to take some time to be implemented at all levels, okay? Number two is currently there is not much of interest in the ESG category. Now, there are two specific reasons for this. As I just mentioned, India is still emerging and it's going to be very growth oriented. So every company, minusing the large companies, especially like the lower, mid, and the small companies, it's going to be a difficult task for them to maintain all three segments, whether it is the environmental factor, the social responsibility factor, and ethical governance factor. This is number one. Number two is that ESG funds do have a lot of restrictions. They cannot invest, for example, in pure defense companies or like liquor or tobacco companies. So the returns what the ESG fund can deliver will be limited, or there can be negative implication to the upside potential of what these funds can actually deliver in the medium to long term. And I'll give you a very interesting data, Vinny. See, the AUM of the ESG category remains very subdued. Okay, so from March of 2024 to March of 2025, the AUM actually has not grown at all. It's remained around at 10,000 crores. So there actually hasn't been much of traction and interest shown by investors in this category, Vinny.
Okay. Rushabh, you know, what I wanted to know, you were talking about those returns, right? So I just want to follow up on that. Now, compared to traditional equity funds, since it's a more newer concept, but in the recent times, how have you seen ESG funds perform? If you could give us any data points on that one, are there any notable trends that you've seen in terms of risk profile or returns that investors should keep in mind?
Absolutely, Vinny. See, overall, out of the 45 or 46 AMCs what we have, there are only 9 funds or 9 AMCs which have launched ESG funds specifically, right? Now, if I look at the returns now on a one-year basis, the ESG category at a category average level has outperformed flexi cap, large cap, mid cap, multi caps, and small caps. The ESG on a 1 year category average basis has delivered around 7.2% returns, and other categories have delivered comparatively less returns. Now, if I look at a little bit of a broader picture, see, 1 year is a very short time horizon, Vinny. Now, if I look at a little bit of a broader picture, say like on a 3-year and a 5-year return basis on a point-to-point, ESG as a category has absolutely underperformed heavily against all of the categories what I mentioned, which is flexi cap, large cap, mid cap, multi cap, small cap. Now, on a 3-year and a 5-year basis, ESG has delivered around 13 to 19% returns. And, you know, the other categories have delivered anywhere between, say, 15 to 32% on a 3 to 5 year basis. So ESG, again, has actually underperformed even the large cap funds on a 3 to 5 year basis. So if you ask me personally, I think, you know, if someone wants upside potential returns, if someone wants aggressive returns, I think other categories like flexi cap, multi cap, mid cap, small caps, one should be focusing on at this point of time.
Okay, Rushabh, you did mention, like, right, while selecting these funds, you know, even the fund manager would have to not take some of these categories or invest in some categories as a criteria, right? Like, you cannot invest in tobacco companies because ESG rules. Are there any such criteria or screening processes that are there and, you know, that is used by fund managers to align with this ESG principle? Or if someone is investing in it, what should they be keeping on the checklist here?
See, usually when a fund manager selects a particular stock, they select based on an ESG score. Okay, now the score is actually published by research agencies like MSCI or Morningstar. Now, every agency will have a different methodology of giving a particular score for a stock on the basis of environmental, social, and governance. So I think as long as a particular stock is you know, decently graded. Now, every stock may not be qualified under the ESG report card or the scorecard. So I think as long as the stock qualifies, or which is at least, I say, for example, Morningstar gives a rating anywhere between 1, which is lowest, and 50 to be highest. So as long as, you know, a particular stock is graded about 25, I think that's a good count. So I think that's the parameter what fund managers choose based on, you know, the research organizations and what the scores are being published by them.
Rushabh, you know, like you mentioned as well, right, the category AUM has been very, very subdued. And the first question itself, you were answering about 10,000 crores, I think, is what you said is the AUM. We have not seen much of a growth also versus 24-25. Compared to this current scenario, given that it's so small as well, does it pose any sort of a challenge, you know, to invest in ESG funds? Does it make sense for an investor in India to look at ESG funds then?
See, typically in India, when an investor wants to invest in the equity markets, they want to make money, simply as that. They want high returns, right? Now, if they want high returns, if they want good amount of returns, then I think ESG is not the category to be in. Then going into flexi caps where the fund manager has the liberty to choose from a wider universe and no limitations, I think that makes more sense. Same goes with mid caps, small caps, and multi caps, where there are no limitations as such. Of course, there are limitations towards the market capitalization. But in terms of stock selection, like whether to go in a particular sector or not, there are no sectorial limitations as such. So to keep it very, very simple, if someone wants to make money, someone wants high returns, then ESG is not the category to be in. But if someone is really concerned about the environment, social responsibility, and ethical governance, then definitely that is the category where one should be in. But investors should keep in mind that if they are investing in the ESG category, then they might need to compromise on the returns, Vinny.
Okay. Surely that should be something that they should be keeping in mind as well. I just want to understand now, if someone who is, looking to invest in ESG, there are a lot of SEBI restrictions also that come in, or disclosure norms come in for especially ESG related companies, ESG related funds as well. Anything that one needs to keep in mind when investing in this fund on that disclosure front, quality front, transparency front when they're investing in ESG funds?
I really don't think so, Vinny. I think the most important thing what investors should keep in mind that, that these funds will be large cap oriented, Vinny. The reason, the very specific reason is because the large companies may not face too much of issues maintaining the ESG score. Okay, to maintain the ESG scores, companies would need to shell out additional amount of money so that they can be compliant towards the environment, social responsibility, and the governance side, right? So I think at this point of time, large cap companies and large mid cap companies would be more sustainable, or would be eventually more eligible to maintain that score based on their deep pockets. But I think in a country like India, where there is a large amount of population and there is a large amount of poverty, I think the lower end of the spectrum, which is the small caps and the micro cap space, they may face a lot of challenges, especially in terms of maintaining the environmental parameter of the ESG scorecard. So I think these funds could be more inclined to large caps, or probably little bit larger mid caps, but I don't think these funds would go more on the small cap side.
Okay, if they wouldn't go more on the small cap side, I'm just trying to understand this, right? Because when we're talking about returns, then wouldn't it be something similar to your large cap funds that you're investing in it, or something where you would see in a Nifty index fund, Nifty 50 index fund? Wouldn't that give similar returns then?
Absolutely, Vinny. As I mentioned earlier, actually on a 3-year and 5-year return basis, the ESG as a category has actually underperformed the large cap space. So if someone wants to take large cap exposure, then going into the large cap category, going into the passive or the active large cap route makes most sense. I really think, if someone is really concerned about the environment and the ESG parameters, which is the social responsibility and government, then only one should venture into these funds. But apart from that, if someone wants returns and someone wants to make money, then this is not the category to be in.
Okay, if you want to make returns, you want to make money, then no. If you're socially responsible, you can look at investing in ESG funds. And we had highlighted the returns that are there as well in the 1 year, 3 year, 5 year as well. Rishabh had mentioned. Yes, but multi-cap, large cap funds is what Rishabh is saying that you could invest in if you're interested in making higher returns. But Rishabh, thank you so much, for joining in with us on the show, explaining our viewers ESG funds. So thank you so much for that, and thank you so much, viewers, for tuning in to CNBC TV18. But don't go anywhere. Now, up next, you have a closing bell to take you through the market action.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng that's opened up with some bit of a gain as of now.
I am highly confident that we have 18 important trading partners.
The next level on the upside for the Nifty is 24,545. Nifty is up about 20 points, so it's a more settled kind of open.
Things have looked a little less, little bit more de-escalatory from that point on.
I can say that AI is an incredibly, and we all know this, powerful general purpose technology.
Both the banks filing a review petition as far as the JSW BPSL deal being termed as illegal by SEC is concerned.
This story is incorrect. Reserve Bank has not given any nod to any entity to acquire 51% stake in Yes Bank.
Personally, definitely expecting an even better trajectory than what we saw in FY25.
Half of the gains of yesterday have been given up today.
The costs of medicines and drugs, because we're being ripped off, as you know, very badly.
Read across the screen after we had an exciting session yesterday.
Well, it is very, very stock specific, I have to say that. The Nifty might be down about 88 odd points, but there is so much which is moving around. And over the next 60 minutes or so, we're going to basically talk about stocks. Lots of numbers coming through. Bank of Baroda is the latest. You had Polycab numbers which came through earlier, but there are individual stories which we want to highlight as well here on Closing Bell. I mean, is there a big dominating driver for this 80-85 point pullback that we are seeing right now in the Nifty? Probably not. There is not really one big reason why you're seeing about 1/3% cut. Market breadth is down. It's been down since about 9:30 in the morning, about 4:1 in favor of declines right now. This is, of course, Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. Reema and Surabhi are here. Guys, hi, good afternoon.
Hi.
Nigel is joining us from the newsroom floor. Guys, Nigel, good afternoon.
Good afternoon. Hi. Good afternoon, guys. You know, the sense you get actually in today's trading session is actually there is lack of buying that's causing the breadth of the market to look like this because, a lot of big investors, a lot of HNIs as well, they're sitting on the sidelines waiting for clarity on the borders. And a lot of stocks actually are falling on rather low volumes. That's my observation, at least from the broader markets. The breadth is not looking good, but it could be lack of buying that's actually pushing some of these stocks down rather than intense selling.
Do you think to some extent the fact that these mock drills are going to be held, civilian mock drills across various parts of India has made...
Tomorrow, yeah.
Yeah, tomorrow. Maybe, has that made investors a tad bit skittish? Because India-Pak tensions just get heightened when you hear something like that. So do you think on the sidelines that could be?
I think as Nigel said, and we've been highlighting over the last couple of days, the local crowd, the HNI crowd is very focused on this. You speak to anybody, they're all very focused on India. But they don't talk about the big drop in oil prices. They're not talking about what's happening in the US or Trump or tariffs or the trade deal. It is very much still India-Pakistan. So, and I think in the newsroom as well, you ask, so many people have come up and asked that question. Is something
what is happening? When is it going to happen?
Yeah. What scale? How is it going to happen? If it's going to happen. So I think that's very much there.
Yeah, so there's that element of risk premium that you have to build in. As an equity investor, you can't completely ignore that. And sitting right here, this is our home market that we're talking about. We're not talking about this happening, several continents away. So it's only prudent to perhaps build that in. By the way, we just got numbers from Bank of Baroda, and this is the other aspect that's not helping sentiment. Remember what happened with Kotak and State Bank of India there were growth concerns. Here, the NII has missed expectations as well. So banks had led the revival and the recovery in April. And now some of the bank earnings that we've started getting are patchy. The best in class, have gone, HDFC or ICICI Bank. The others are showing up some concerns. And this is a market where perhaps there is no room for any sort of a miss or a disappointment. Having said that, I mean, it's not just one sector today. Yesterday, we could have at least singled out banks, and we said that it's only banks, the rest of the market's looking very good. Today is a day of wide profit-taking. Look at the mid-cap index. It's down 1,000 points now. The advance decline ratio is extremely negative. And I guess, Nigel, as you said, this is perhaps everything to do with just, moving on the sidelines, dealing with that risk premium and seeing how the next couple of days evolve.
Well, indeed, it appears that's the case for today's trading session. But select stocks, like we've been mentioning from the morning, CCL products, Tatva Chintan, some of them have actually taken note of their numbers, and that's why they're outperforming in today's trading session. The question is, how do you position yourself? Well, we have Mitesh Thakur who joins us on the show. Hi, Mitesh. Good afternoon. A bit of a down day, but you'll still have to say that actually the trend of the market has not changed. It's still a market that ultimately will, start moving up if the lower levels are protected. Your take?
Oh, that's right, Nigel. I think, the trend hasn't changed, but this is a market, the moment required to break beyond 24,500 is missing. So I think it calls for some kind of consolidation. On the stock side, I would say a sell on IRFC is what I have 124.
Okay. I think we've just lost that line on Mitesh. We'll get back to his trading calls in just a bit. That is not looking good at all, the slippage number for Bank of Baroda. Let's see, because for some banks, we're speaking with the IOB and they could provide a very plausible explanation. For them, the slippages were higher because of one particular account, which was MTNL. But let's see what's gone on here. The stock is completely selling off. We have Mehraboon Irani now joining in. Mehraboon, afternoon. Good to have you on. Let's actually start with the banks. I mean, BOB is falling off a cliff right now. What have you made of some of the recent bank earnings that have come in and the concerns? Here, there seems to be an asset quality issue as well. But with Kotak and SBI, it was a growth issue.
Well, if you ask me, the commentary given by SBI, which is the largest commercial bank in India, was definitely not positive. In fact, I would say it was a disappointment. Maybe he was sounding realistic. I'm not pointing a finger at him. But the point is that says a lot. And for index, I'm referring to Bank Nifty, which has outperformed most other indices in the market by a fairly decent margin, a pullback in share prices was on the cards, and it is happening right now. Do I like this sector? I have liked this sector for quite some time, and I continue to like it. So I would say I would prefer to stay out right now, wait for a pullback, and possibly look at it again. The private sector banks or public sector banks, there should be a mix of both of them in an investor's portfolio, but after the sharp outperformance, a pullback on the cards, let the pullback happen, and then look at it afresh.
While the Nifty and the Sensex have erased gains, the mid-cap index has completely reversed all of yesterday's gains. Yesterday, the mid-cap index gained about 1.8, 1.9, and we've lost a little bit more than that. 1,100 points lower now on the mid-cap index. But let's talk about Exide Industries now. The management says they are in advanced discussions for battery manufacturing with two major two-wheeler companies and one three-wheeler company. Sudarshan is here joining in with the details.
So Exide Industries today held conference call on its Q4 FY25 earnings, and first talking about Q4 results, company has said that 3/4 of its total entire revenue has done better in Q4. Only 1/4 had seen a decline. And on the order wins, company is saying that it's in advanced discussion with two major players in two-wheeler space for battery manufacturing. Also, it's in advanced discussion with a three-wheeler company for the same. But the most important point was the comment that company has given about the Hyundai agreement, because there was no update after the binding agreement announcement that company had made, and there was an expectation that there might be something related to the agreement, and on which company is saying it's going as per plan and it's making everything ready for the product development, and the update is going to come very soon. On the back of that, you have seen a big uptick from the day's low, and it's currently up around 2% trade.
Okay. All right, Sudarshan, got it. Thanks very much for that. That's Exide, another stock in focus. Speaking of Exide, obviously today is also a day when Ather has listed. Bit of a, off day for the listing. But anyway, let's see where Ather is. It started the day with a gain of about 1.5% We'll just pull up the stock and see what it's doing right now.
It's down
it's
about
down 4%. It's down 4%. Ather, can we get the stock up? We'll just do that in a bit. Mehraboon, this whole EV play, Ola definitely didn't inspire much confidence for investors. Now you have Ather, you have companies like Exide talking about, going further up the EV chain. Are you? I mean, does it interest you? How would you play it through any stocks?
No, I would say that investors need to understand that there's a lot of gas and all these new stories, be it solar, be it EV. When I say a lot of gas means suddenly the valuations expand and not many can find out too much of a reason. And that exactly is what is happening in EV. So I'm not saying the story is not good. I'm saying that you should allow the story to play itself out. So there are going to be accidents, and there are accidents happening left, right, and center. But doesn't mean the story is not good. The transformation is happening. And that possibly you have to go with some of the better, bigger names in this particular sector rather than going in for some of this new players coming into this market. So while there is an excitement, while the fact is that investors like to play on theme and like to make quick money, when things get bloated, certainly the things start coming down and it takes a hit, and it gives a big hit to investors' portfolios. So I would like to stay away from most of the names in this sector, except the biggies like maybe a Mahindra or Tata Motors and such type of players.
You would Tata Motors and M&M. These are the stocks that you like in the auto pack? Okay. And you want to comment on...
I would say M&M, I would slightly...
Go ahead.
You were asking me Tata Motors and M&M. I said M&M numbers were quite impressive, if you ask me. I think there has been a healthy recovery in rural as well as the new product launches in utility vehicles and tractors. The management is confidently stating of a 15 to 20% earnings growth coming over the next 2 years, and it's also talking of a nearly 18% ROE. The possibility of any value unlocking happening in any of its subsidiaries over a period of time can only add fillip and give more revenues to its shareholders over a period of time. So I would say things going in favor of Mahindra is rural demand, new product launches, and the government's push on consumption. So M&M, after this brilliant numbers at the present price, I don't have too much of reservation. But in the auto pack, if you ask me, outside four-wheelers, outside EV, I think a name which should attract attention just because the valuations are extremely appealing is Hero Moto. I think the company has done nothing wrong, and at the present price, with the valuation going at just around 15, 16 times, the share should attract attention. And I think it is a stock in which, if you like the auto pack, this is one stock which you should go and buy. This is my personal recommendation. Clear disclosure, I'm holding this stock.
Just valuations, right, Maribon? Afternoon. Good to see you after a long time. Because if you see the last month's numbers, 3 lakh units compared to expectations of, I think it was 4.5 lakh unit expectations. Same month last year, the number was 5+. It's around 3 now.
I think, Prashant, what you're saying is right, but that is why the stock came down to this present level. I think going at around 16 times current year and around 14.5 times next year. And knowing that in the 125cc segment that the company has improved its market share to around 33%, driven by mainly a demand for HF Deluxe 125, Splendor and Extreme 125. So I think at the present price, in a market in which you very well know that is a toss of a coin over the next 1 to 3 months as far as the overall market goes, I think you need to protect yourself and protect your portfolio rather, and go in for stocks and where the downside is limited and upside will certainly come. I would give a parallel if you allow me to say this. Look at the FMCG segment. Look at numbers like Hindustan Lever which has come out. Now wherever the results have come out, the stocks have taken, even Nestle, the stock took a hit, and now the stock is saying I don't want to fall any further and they are recovering. Vis-a-vis other names in FMCG segment like say Britannia or say Imami, where we really don't know. If the numbers come a little bit weak, the stock can fall further. But there are stocks which have already fallen and where the downside may be limited. So coming to the two-wheeler segment, while what you said is 100% right, at the level at which it is, I think one can defend the valuation and say, oh, nothing much to fall now as far as Hero Moto goes.
Okay, all right, fair enough. So it's a valuation call. You know, Maribon, the next story is the insurance story, right? So I don't know if your view is on life insurance players, but the big talking point has been what is going to happen with regards to a specific channel through which banks sell a lot of the insurance policies, which is through the bank channel. We reported towards the end of last month that, and that was also an exclusive, that maybe the government is going to provide a relief. They're not going to take any action on the bank assurance channel, bringing down the share of the bank assurance channel. Now, sources are telling CNBC-TV18 that with regards to the banker channel, the insurance regulator, IRDAI, is actually proposing a major overhaul. They've sent in a proposal to the finance ministry What is the change which is being proposed? Yash has got details. Yash, take it away.
Well, that's correct, Prashant. So a major proposal has been submitted by the insurance regulator with the Ministry of Finance. And this is, as you said, with respect to bank assurance and practically suggesting a complete overhaul of how distribution of insurance works through banks. What we've been given to understand is that the insurance regulator has proposed to the Ministry of Finance to do away with the entire concept of commission altogether. Instead of that, replace that with something called as the transaction cost model. Now, what is the transaction cost model? Before I come to that, let me just put a small caveat that this particular proposal was sent under the chairmanship of Debashish Panda, the chairman of IRDAI, who retired in the month of March. The proposal was sent back then to the government, but nevertheless with the government for consideration. Now let's come to what is a transaction cost model. Here, just like a bank sells its own products like credit cards, bank accounts, FDs, and it charges a transaction cost for the same thing to be done with respect to sale of insurance policies. Every time an insurance policy is sold, no commission is to be collected from the insurer, but a transaction cost to be levied on the sale of that policy directly to the policyholder. Currently, what happens on a 100 rupees premium, if the bank is earning 18 rupees, it collects 18 rupees from the insurer and gives 100 rupees to the insurer as the premium. Now, with the transaction cost, you directly collect whatever the transaction cost is from the customer and give the premium to the insurance company. There are a list of advantages which the insurance regulator has suggested to the Ministry of Finance with this proposal, but nevertheless can be counted as a complete overhaul in terms of suggestion coming from IRDAI when it comes to the commission modeling of bank assurance channel.
Okay, all right. Yash, at a basic level, this will eventually, how this settles, first of all, this has to be accepted. We don't know it will be accepted. But if this goes through, at the very least, some disruption in the near term, right?
Well, certainly.
Because this will disrupt the way the policies are sold.
Correct. The largest banks which have the largest distribution network today, branches, are HDFC, SBI, Axis Bank, and they have exclusive tie-ups today despite of having open architecture. But that will sort of open that up, and they will be forced to tie up with more life insurance or general insurance companies if in case this gets approved.
All right, okay. I think CG Power numbers, Yash, thank you very much for that. CG Power numbers at the bottom of the screen, at least in one segment, the industrial segment, EBIT margins are down some 200 basis points, and we put out the other numbers as well. Stocks down sharply. This is the second disappointment, if this is a disappointment, in the last 10-12 minutes.
No, even the overall company margins, they were expected to increase, but forget the increase, is a small hit that's coming in. And the revenue is fine. The revenue actually is absolutely in line with street estimates, 25% growth. Profitability has risen less than expected, and margins have not expanded. In fact, there's pressure, and the stock is selling off. So
there are quite a few earnings disappointments on the mid-cap end. So Vedant Fashion, that's Manyavar, profits declined about 12-13%. That stock has fallen 6.5%. The other one is Alembic Pharma. Again, earnings miss. The stock here is down close to about 4%. And now you've got CG Power added to that list too. So these are some of the earnings misses.
By the way, Bank of Baroda is now down 9%. Market is in no mood to forgive. Definitely not on a day like today, and maybe in the environment like the one that we are in.
Even CoForge is now reversed. CoForge was in the green for a greater part in the morning. It was up 2%, 4%, but now it's in the red.
Cummins is down 5%. Cummins put out, the global parent put out, a bit of a, not a profit warning, but the commentary for the India business was not too encouraging. That stock's down 5% as well.
No, with CoForge, I was just saying that I'm not surprised. I was saying this in the morning before we started trading as well. This was very well advertised. The numbers, the expectations were super strong, and the numbers were super strong as well. So, it's actually based on numbers, it's become very, very tough now to, as I was saying, I was just joking and saying that even if I give you the numbers one day before and ask you whether the stock is going to be up or down, it's impossible because of the pre-positioning. And of course, there is, for IT companies, it is the guidance, it is the, there are so many other things which really make a lot of difference out there. So, the top 10 segment that we do in the morning, that has also become tougher. The green and the red. Sometimes green becomes red, red becomes green. But there is so much which goes into it. Merabun, just a quick word on the two things. One is life insurers. You heard Yash's story. Do you like anything here? And second, CG Power, as we were just discussing, numbers coming in.
Yeah, I would say as far as the life insurance goes, I think it's a proposal which is still to be put into place, and we very well know, without mentioning anything beyond a point, I think there has been a lot of mis-selling which keeps on happening. So somewhere the regulator is thinking of putting some curbs here and there, because we all very well know that certain banks push a particular insurance product because of the commission which they are getting. So a transaction charge possibly could put a lid on certain mis-selling which happens here and there. So I think this could be healthy in the longer term. In the shorter term, I think this would be a slight negative for the particular sector. But whether I like anything in this space, answer is clear-cut no. Coming to CG Power, I think, I was hearing the comments, Prashant, and I loved one comment which you made, that you say these are the results going to come, whether the stock will be up and down, and that is exactly how I was defending Hero Moto. The point is, are the results really bad? The point is the valuations are quite high. All the positives are in the price. I think somewhere you mentioned about CoForge. CoForge also, the positives are already in the price. People know it's one of the best companies as far as execution excellence goes. The company is talking big and has been delivering in the past. But the point is, do you go and buy in an uncertain global environment, uncertain macros? The answer is possibly no. And this is exactly what is happening. On the other hand, you also very well know that liquidity is good in the market. Oil prices come down, inflation is under control, dollar index has come down, rate cuts are happening. So India relatively stands out. Then what is the problem right now in the market? The problem in the market is retail. Look at the market over the last 10-15 days. You don't see too much negatives happening as far as the indices go. But if you see the broader market, I think somewhere is showing signs of fatigue, because the retail is slightly lightening themselves because of the aggression which could be shown by India and Pakistan. And everybody talks that. Whereas the FIs have started buying into the market. So while the index, Nifty, Sensex, remains protected, the side market is giving way, and that is why you are seeing some small accidents happening despite good numbers in the CG powers of the world right now.
Okay. All right, Meraboon, we'll leave it on that note for this afternoon. Thank you very much for joining in. Always good discussing the market mood and, of course, individual stocks with you. We do have to take a very quick break. On that note, we'll come back on the other side and we'll get you more market perspective. Atul Mehra, fund manager at Motilal Oswal AMC, will join in.
Well, not all is red in the market, though we've got way more stocks in the red compared to the stocks in the green. 1:5 is the advanced decline ratio. 430 stocks advancing on my screen versus about 2,100 plus stocks declining, and the gap between the two only widening as the mid-cap index hurtles towards a 1,200-point fall. But Polycab is holding up in the green. It's up nearly 2 to 3% after numbers beat expectations. And that's also helping RR Kabel. Their numbers were strong too, and RR Kabel is higher for the second day in a row. Upasana is here to join in with the numbers.
Well, the numbers were largely in line with our poll estimates. Now, talking about the revenue EBITDA margin, they were in line with our poll. while PAT was much above our poll estimates. Now, company has surpassed its FY25 top-line guidance of 20,000 crore, which it had said that it had guided for FY26. But in Q3, the company revised its guidance to FY25 20,000 crores, and now FY25 revenue stood at 22,408 crore with an uptick of 24% on a YoY basis. Now coming to Q4 numbers, the revenue saw an uptick of 25%, which was largely in line. EBITDA saw an uptick of 35%. EBITDA margin saw an uptick of 110 basis points at 14.7%, which was briefly driven by profitable turnaround of company's FMEG segment and also strong margins of EPC segment of the lower base also aided the margin approve. Now, coming to PAT, it saw an uptick of 33%. Now, company's cables and wires segment saw revenue growth of 22%, which was in line with the street estimates, and margins also largely remained stable. The company continued its strong growth momentum in this, and the FY25 domestic cable and wire market share also increased by 1%, that is around 26 to 27%. FMEG revenue growth strong, as mentioned earlier. It outperformed the industry growth and expectation as fan segment saw robust growth despite the delayed summers. And lastly, EPC reported a revenue growth of 47% on a YoY basis, and margins also increased sharply from 5% to 9%. So all in all, strong set of numbers for Polycab in its Q4 FY25.
All right, Upasana, thank you very much for that. That is Polycab for you. Look at Bank of Baroda, 10% knock on BOB. By the way, the PSU Bank index was the top loser in the morning as well. I think the PSU Bank index is down 4.6% now. So I think other stocks are also falling. Abhishek is going to tell us quickly what's the problem in the numbers. Abhishek.
Well, Bank of Baroda, it's an operationally weak P&L that you are seeing. The NI is below our poll. However, the PAT is ahead of our poll on account of strong other income that we are seeing across banking sector. So the NI is actually come in at 11,020 crore, down about 6.6% YoY and 3.5% sequentially. This is despite the fact that they have strong business momentum in this quarter after many quarters. So net interest margin is at multi-quarter low. Your overall global net interest margin is at 14-quarter low of 2.86%. Domestic net interest margin at 3.02% is at 14-quarter low, and foreign NIM is at 1.7%, which is a 11-quarter low. So other income grew robustly by 38% plus on a sequential basis. Treasury gains were strong at about 66.6% growth that you are seeing over there on a sequential basis. The core operating profits have actually declined by 10.5% YoY and 2.3% sequentially. The operating profits are almost flat YoY and a growth of 6% sequentially. The slippages have spiked up, and that's caused one of the triggers to stock being down in trade today. Slippages are up 8.5% quarter-quarter versus expectation of a decline in slippages. Back to you.
Abhishek, if you had to point out one reason, it would be slippages for a 10% drop?
It would be net interest margin despite strong business momentum that they had given, pre-quarter update.
Okay, all right. NIMs are the problem spot. Abhishek, thank you very much for that. So that's BOB. Atul Mehra is with us, fund manager at Motilal Oswal AMC. Atul, good to have you with us here. Thanks very much. I think you guys, at least at the asset management level, are sitting on a lot of cash, a very large level of cash, at least till a few weeks back. Is that still the case, or have you deployed?
Yeah, hi Prashant, good afternoon. So it actually depends on fund to fund. So there are some funds where we are sitting on a large amount of cash, and there are others where we are fully invested. So it's more from the perspective of an individual fund positioning than an AMC level call at this point in time.
Level, what would the cash be? Because, I mean, I'm talking about, at least in some funds, cash levels being 30-35%.
Yes, in some of the funds, cash is around closer to 30%, and in some of the funds, cash is 0.3% as well. So it's a mixed bag.
Okay. Average? You have the average number?
So average actually would depend on the AUM in aggregate. So because say some of the larger AUM funds are sitting on larger cash, so hence at the AMC level, you would find that the cash level is on the higher side. So I think on an average from that perspective, it would be around 20% or 15 to 20%, but it's an aggregation of like fully invested funds and funds sitting on a large amount of cash.
So at an AMC level, the view is that markets will come down.
So that's what I was mentioning, Prashant. So it is the way it works is it's individual fund manager call, and hence you are seeing in terms of very different cash levels across funds. So there is nothing to be read particularly about the market as a house. It is an individual fund manager call.
I have a feeling you're not bearish.
Investment.
You're not, right?
No, I'm not. So
You're not.
the fund that I manage is sitting on less than 0.5% cash, and it's fully invested.
Okay, fully invested. So what have you bought? Do you want to tell us, say, in the last 2 weeks, as the earnings have been coming through, trickling in, which stocks or themes have you been purchasing?
So largely, I would say portfolios have remained more or less similar. I think overweights on financials, overweight on telecom. Slightly, we've been increasing allocations to consumers over the last, I would say, 2-3 months. So those have been the incremental allocation increases. Also, I would say in the recent times when IT has corrected, we've added to the positions because the valuations in some of the IT names are quite reasonable. And FCF yields are closer to 4 or 5% in many of the names. So those have been the more recent additions and weight increases primarily.
Okay, hi Atul, good afternoon and good to see you, Ben. I think private banks is something that you liked. You made this point for the last many times you've spoken as well. Suddenly out of the blue, you had a Kotak Mahindra Bank's numbers that weren't too good. Now you have a PSU name that just came out of the set of numbers not too good out there. Banks were very, very cheap. They had a good run. They actually led the market higher. But in the recent past, the last few weeks, actually, they seem to be consolidating and some of them pulling back. Is private bank still the top theme for you?
So, hi Nigel. Yes, so the private banks as a theme still looks quite good. Overall, as a basket, if you were to look at the result season so far, I think it's been largely fine in line. And although, in the recent times, they've kind of taken a breather, but if you look at the last 12 months, these have been the biggest sources of outperformance at overall market level. And some of the larger ones are still, if you were to look at it, holding out very well. So I think what has really happened in the last few weeks is, as we can see in the numbers, foreign flows have turned for the better. And hence, you will see that the more FI-dominated sectors like financials, large banks, etc., they have basically tended to outperform in this in terms of FI buying that we've been seeing. So I think that is what is getting reflected in some sense.
Atul, hi, good afternoon. Now, just going back to some of the earnings that we've got this afternoon, CG Power is one where there's a disappointment on margins. That could be maybe one-off or a company-specific issue. How are you positioned on industrials? Or basically, whether you call it capital goods, industrials, some of these stocks which are part of the manufacturing chain, given the global uncertainties?
Sure. So industrials, I am underweight in industrials as a space overall. And primarily it's to do with, I would say that in the last 3 or 4 years, you've seen a massive re-rating in some of these names. And the valuations have been on the higher side with respect to the expected growth that these companies are expected to deliver. And hence, even though earnings growth is higher than the market, but the stocks are not doing as well because valuation correction is something that is really playing out in some of these names. So overall, as a sector, I remain underweight in industrials, primarily led by higher valuations.
You said that you added to IT stocks in this recent round of correction as the free cash flow yields turned fairly attractive. You're talking about large cap names or some of the mid cap names where there is growth but stocks have corrected in tandem with the rest of the sector?
So it's been primarily larger names. So there, if you look at it, many of the names are now trading at 20 times forward P multiple, and they're trading at the lower end of the 3 to 5 year valuation range. And like we've seen, I think in the past, the sector tends to be quite in terms of impacted by global macro, what you see in terms of US news flow, etc. And they tend to give you those opportunities when the bad news is very much in the face. So hence, I think at the kind of valuations they're trading at and the cash flow these companies deliver, and a lot of it, 90% plus, is paid out as dividends or in terms of buybacks. So there is a valuation floor on some of these names. And hence, some of the larger cap IT is something that we've added to the position.
Okay, all right. Good conversation, Atul. By the way, are you worried about the India-Pakistan tensions, Atul? What's the view?
So the view is obviously it's something to be kept on the radar. We don't know the extent of in terms of escalation that could happen on this particular thing. But the base case is, in my opinion, I would say a much more measured move because in terms of so that is the general expectation that it would be a measured move and it will not go out of hand. Yeah, let's see. Fingers crossed.
Got it. Atul, thank you very much. Good speaking with you. Appreciate you joining us here, as always, on the channel. What we'll do is we'll take a quick commercial break here. As always, we'll get you what are the sort of here and now kind of ideas coming through with our technical experts. We'll also have Jay Bala join us in a bit from now. Stay with us.
Investing.
Welcome back. Well, as you speak, actually, I think CCL Products today deserves a special mention because the stock opened up with a big gap up and it's continued to hold on to those gains. So I think that's one stock really that deserves special mention today. The management as well joined us and they sounded quite optimistic. Mitesh Thakkar is back with us. Mitesh, what are your buy or sell trades?
Not much happening on the index, so we'll keep the index view on hold, but we stop specific guidance. So STMT on emphasis with the stop at about 2381 for targets of 2330, 25 or thereabouts. And the other one which I like that's come to some kind of support level is Power Finance Corporation PFC. BTST here with the stop just below levels of 393 for targets of 402.
Okay, Mitesh, I wanted to ask you about Indian hotels. If you could just have a look at that chart. The numbers were very, very good. Good, strong numbers. The management, Mr. Puneet Chatwal, joined us and said, remember, I'm telling you this, the best is yet to come. The problem is the stock has already seen a big run. And that's why it's now moved to the low point of the day. On the charts, though, how's it looking?
So, if you look at Indian hotels, I think, the stock had a very good rally. And now I think, is showing signs of correction. The 200 average is at about 740. My worry would be if it starts breaking below 200 average, then I think I'll turn negative. So, and the structure is negative. So I think I don't want to take a buy over here. But in case you get a closing or a signal of move below to 740, then I think a 700 target would be tested easily.
Okay, all right. Mitesh, thank you very much for that. Well, the top story, of course, has been the tensions with regards to India-Pakistan. The Home Ministry has called for civil defense mock drills to be held across the country. Parikshit is here to give us details of what this would really mean at a ground level in terms of preparedness. And is this some sort of an indication about what is to come? Parikshit, take it away.
We're going to see mock drills in 244 districts across the country. Now, why are these drills happening? Well, the objective is to test the preparedness of our civil defense teams all across the country, see how these civil defense teams operate in collaboration with the local police, anti-terror squads of different police forces, the fire department, ambulances, and the Army, Navy, and Air Force as well. Now, the last time that such nationwide drills happened was perhaps during the 1971 Indo-Pak War and also during the Kargil War. But during the Kargil War, we possibly saw such drills only in Jammu and Kashmir and limited border areas. Perhaps this is the first time that it's happening on a pan-India basis. Why? Because there is a feeling that currently, due to the suspension of the Indus Water Treaty and all the action that India has taken against Pakistan, Pakistan may carry out a preemptive strike on India and a war cannot be ruled out. These are the words of General Malik, who led India during the Kargil War. He says that currently you cannot keep the war off the table. India may come up with a very strong kinetic response to Pakistan because of the Pahalgam attack, and that could be bigger than what we had done during Balakot. In fact, such a retaliation could lead to an escalation, with Pakistan taking things up a few notches higher. So we have to be prepared in any eventuality. Our forces are prepared. According to General Malik, we are 10 times stronger when it comes to comprehensive national power compared to Pakistan. But at the same time, the civilians across the country need to be prepared in case there is a hostile attack or war. We've gone out of practice, according to him, as civilians, and we need to understand what goes through and what goes into preparing the country for the highest level of national security. So you need to work with the security forces. You need to know what happens when there is an air raid siren that goes off, for that matter, or local officials warn you to go down, take shelter somewhere. Civil defense officials need to be prepared in terms of creating awareness among students and civilians to protect themselves as well.
Okay, no, absolutely. That's a very, very interesting story and something we will continue to focus on. What we'll do now is welcome in somebody who joins us from London usually, but he's now with us here in the studios. Jay Bala, CMT, cashthechaos.com. Jay, great to have you with us here.
Good to be here.
And good to see you in person. So what brings you to Bombay first up? And
there's a wedding happening in the family. So I'm on the way to Goa. So I thought I'll take a day's break here and meet a lot of friends.
Destination wedding.
Yeah, that's right.
It's going to be hot though in Goa.
Yeah, it is. Goa is hotter than Mumbai.
But I'm glad that while on such an exciting family event, you've decided to take that pit stop. It's very welcome. Actually, let me start with this. Sometimes they say charts predict things before they happen, right?
Yeah.
I don't know if there's any build-up anywhere that you're seeing, because this whole talk of war, it's clearly making people very, very circumspect.
Yeah.
Is there anything right now in any of your indicators that could suggest what's coming?
I don't know how much time we have. Maybe I can give you an anecdote and then come back to you. When I was doing work for a boutique research firm, which for the Far East markets, frontier markets, I had called for the outperforming market then was Karachi 100. I'd called for the markets to decline to about 7,000 points. The head of sales over there, they said there is no war happening between India and Pakistan, so this is not likely to drop 8,000 points. And so I checked with my channel sources, with the Defense Ministry and all that. And it was exactly at the time the depeg of Swiss franc against the euro happened. So the best performing fund was a Swiss-based fund. So they came and sold the markets. So
Which year was this when you called for this decline?
This was 2015.
2015.
The high of KSE 100 was 35,000. I called for a 7,000 points drop, and they said that's not going to happen. So when the markets is not afraid of what's happening now, it has some wisdom that we don't know. So trust the markets. I'm bullish on the markets.
Okay.
I've been bearish on the markets for several months. Yeah. I turned bullish a few weeks ago. So I think I trust the markets.
Okay.
What we're going to do is, Jay sent us some charts, and he sent us 7 charts, Jay.
Yep.
You sent us 7 charts, and we want to show your method, right? We get the views, but I think you'll be able to show the method in terms of how you look at these charts, how you study them, and then the view comes out. So let's start with the Nifty. These are all based on Elliott wave studies.
Absolutely.
So Nifty weekly, Nifty daily, and then how does the view crystallize? The charts will come up. Go on.
Sure. See, if you look at the Nifty's move from the pandemic low, we evaluate markets as how far it goes in 5 steps and how far it moves in 3 steps. That defines a trend or a counter trend. The 2021 high of the Nifty, we have labeled that as a first wave, and the 2024 high of 26,277, labeled that as a third wave. The low the market registered recently in April was very close to the June 4th range that I was projecting for several months. The closing low was 21,800. The intraday low was 21,280. The markets hit 21,700 and change. So it came into the June 4th range. But when I was calling for the October 1st on here on this channel, for it to decline to the June 4th low, it looked outlandish. But the markets got there. Likewise, it is seeming outlandish to me. And but I trust whatever the market says. Even if I sound silly, I completely trust the markets. And right now, it's saying that that was a deep correction, and the markets are possibly going for record highs. But still, a little bit of work needs to be done. The markets needs to take out the 24,858 high that registered in December. Once that's cleared, the markets will signal all clear for the bulls. If that happens, we are looking at record highs for the market. Right now, the bearish case has not yet been eliminated. It's still developing, but the overwhelming odds are that the markets will clear 24,858.
All right. Hi, Jay. Good to see you in the studio. I think you should come to Mumbai more often. I'll tell you why. You're sounding far more bullish than I've ever heard. For the last,
That's true.
That's because he's headed to Goa.
many months, a lot of people are messaging and they're saying, pop the champagne. This is the first time we've heard Jay. And I was waiting for you, because I was not sure whether or not it's correct that the markets are trending up. The charts are sensing that. Very, very good, Jay. Good to see. Now you're in the bullish camp, it seems. But the other big point is the Nifty Bank. That was the leader. And that was, that batsman that was holding one end up, scoring all the runs. And suddenly that's gone into a quiet mode. Even in today's trading session, as we speak, the Nifty is staging a bit of a fight back. But the Nifty Bank is at the lows of the day. Where do you see this index move? Where does it take some support? And then I believe we're looking at higher targets out there.
Yeah, as you rightly pointed out, it's the batsman that's played the night watchman, and it's not gone below the April lows, and the decline was quite slow. And as the markets are placed right now, the higher highs for the banking index is due, but it looks like it may not be too much higher. We've been, since May 2022, I've been projecting a long-term trend line at CNBC-TV18. For that trend line hits about 58,500, 59,000 for the banking index. So the upside for the banking index is slightly limited, but it's still bullish. As long as the banking index can stay above the March high, I think that's about 51,000 and change. I think it's 52,063. If it stays above it, it maintains its bullishness. The risk for the market come from HDFC Bank. It shouldn't drop into 1880 and the previous high range. If it doesn't do that, I think we can still say convincingly that the banking Nifty will give a lift for the overall markets.
Jay, the other big story this week was the plunge in crude oil prices as OPEC Plus decides to ramp up production. What are the charts telling you?
Yeah, we look at the long-term charts, and if we look at the crude's move from the pandemic low, it's gone up to the record highs before the Ukraine crisis in 5 steps. And it's pulled back recently to its low of about 55 and change in 3 steps. And we label this in a complex Elliott wave pattern as a WXY. So it's very close to bottoming around 55. If it breaks the recent low of 55, it's probably getting to 48, but that'll be a very, very significant bottom. And it will probably, from a 12 months to 24 months time frame, it'll head somewhere close to 170 at a minimum, possibly much higher later on. But right now, we have a bearish crude.
Sorry, so it goes down to 48.50 and then snaps back up to 170.
Yeah, that's
117.
170.
170, but 1 to 2 years.
Yeah, 1 to 2 years. Yeah,
1 years, okay.
170.
But the next low will be a very significant low. And I mean, I don't want to sound overly bullish. This might probably be an opportunity for people who trade crude futures to make millions over there. So it'll be a very significant low. I've been waiting for this low for several months now.
So you're saying first down?
First down.
First down.
And that's a significant down?
Yeah. Not significant down, just slightly below 55, or the 55 has possibly already clocked an important low. I will know as the markets unfold over the next few weeks.
And then you're saying 170 happens over how long a time frame?
About 12 months plus time frame.
12 months.
Yeah.
So now I'm going back to the Nifty call. Because typically, I mean, if we're expecting such a massive surge on crude, but at the same time you're bullish on Nifty. You said we've just completed 3 waves. And then you're expecting fresh highs. But elaborate on that. So what next for the Nifty, say 12 to 15 months?
Yeah. So the thing is, I think we are going back to the earlier, market correlations that existed. When crude surge, it's because of all asset classes move in tandem. So
oil and market surge together.
Exactly. Yeah. And we have put this and discussed these charts for several times over here. And I think that might, initially, people will not be worried about inflation. They'll be more worried about growth. So when the inflation lifts all asset classes, it'll lift Nifty, Bank Nifty, and crude and other asset classes.
We've got a couple of more charts to go. So gold, Jay, a very, very closely watched commodity.
Yeah.
What's the view?
See, gold is behaving, sentiment is a very important aspect of a market structure. And gold sentiment is right now, it's a very blunt measure, but it's behaving very typically towards, as it was behaving in 2011. In 2011, when gold hit about 1900 and change, people were calling for 10,000 as the fair value for gold. Right now, gold has hit record high at 3,500. People are calling for 30,000 gold. And it's not just that alone, it's occurring right at the possible five-way move for gold. So right now, the trailing stops for me for gold is about 3202 on London bullion gold, not futures. If 3202 were to get taken out on the lower side, I will anticipate at least a decline to the previous fourth wave low shown on the charts at about 2600. So that is, but it's not yet there. It could go one more high, but right now it's still bullish. We want the low of 3202 to get taken out. Once that's taken out, I'm convinced that it's heading lower. There is excess sentiment built in gold, and there is a five-wave structure which is pointing to at least a medium-term top.
And when does it top out? At 3,500?
It's already registered a high at 3,500. It needs to break 3,200 to confirm the high registered at 3,500 and change is an important high. We can go higher, but we don't know what's happening. Right now, sentiment is pointing to that, and market structure is pointing to that. We want a support to get broken. So that's the final step that needs to happen. The third step hasn't happened. So once that happens, we see the market will surprise a lot of people.
Fair enough. Jay, good conversation. Thank you very much for dropping by to our studios, and enjoy your time in Goa.
Thank you. Thank you. Good to be here.
We'll be speaking from Goa or London?
We'll speak from London. I'm going back the following Sunday.
Okay. All right.
Yeah. Thank you.
Thank you very much.
Thank you.
Appreciate it. What we're going to do is we'll take a quick commercial break here. There's about 10 minutes, 11 minutes to go for market closing. The index is down 90 points, 92 points, 24,368 is where we are trading at. So take that break. See you on the other side.
Welcome back. Well, yes, the markets are nervous, but a few stocks are really standing out. RR Cabell, yesterday the stock burst away. The management is very, very optimistic on the future. They've laid out a capex plan as well. Take a look at that stock as we speak at the high point of the day. Similar is the case with CCL Products as well. Good set of numbers. Stock started gap up. It's going to go home with a final tick actually at the high point of the day. The street really likes these numbers. And Safari, well, the numbers are a little bit softish, but I think the street was bracing for these soft numbers. So that's why quarter four's numbers are a little bit softish. But Safari actually from the lows of the day has seen a bit of a recovery, telling you now the street is looking ahead. They're counting on the first quarter of this new fiscal being relatively better for these luggage makers. Could explain why the stock, after being down close to 4%, has recovered. But MGL, that's expected to report its quarter four numbers today. Sudarshan joins us to run us through more details. Sir?
So after IGL reporting a strong set of earnings, we are expecting MGL to report the strongest set of earnings amongst all the city gas companies. We might see an improvement in the margin on the back of the price hike, and the price hike taken by MGL was the most amongst all the city gas companies. So on the back of all these factors, also remember that like all these oil marketing companies, internals for even city gas companies, if you compare with Q4, now in the last 1 month or say 1.5 months of Q1 FY26, internals have improved. Crude has fallen, rupee has depreciated. So all these are like going to benefit city gas companies, not in the results of Q4 FY25, but going forward. Now coming to the headline numbers, profit may fall by 6%. Revenue is likely to come almost unchanged around rupees 1,784 crore. EBITDA may increase by 2%, and margin too can see a minor expansion and can come around 18% or might be more than that. Now coming to EBITDA per SCM, which is one of the most important metrics for city gas companies, also known as the realization or say margin. EBITDA per SCM for MGL is seen rising 5% sequentially, but year on year it might see a big fall. But more than year on year, what would be tracked closely is the growth that might see on a sequential basis. Now in absolute term, EBITDA per SCM can come around rupees 8.73 versus rupees 8.30 that company had reported last quarter. Now, what exactly we would be looking in the management's commentary? First, if you remember, recently Maharashtra government has announced EV policy. Now, we'll have to see if there is any update that MGL has heard from Maharashtra government, and if government is taking any action related to transition, like what we have been hearing from Delhi government. Again, Delhi government is also draft, and after that minister had said that all these details that have been out in public domain are not correct. So we'll have to see what's the update from Maharashtra government. And second, if companies planning to take another price hike to protect the margin, we'll have to see that. And what would be watched very closely, that after price hike that MGL has taken of rupees 3, has it managed to control the volumes, or has it managed to see the volume growth despite that?
Okay, all right. Thanks a lot for that, sir. Well, CG Power, that's the one that reported its quarter four numbers. Vamakshi joins us to run us through with those details. Vama?
Well, Nigel, it's an operation-led miss. The revenue more or less in line with what the street was anticipating. The EBITDA margin, however, contracted by 35 basis points. The contraction in the gross margin was, however, higher by almost 150 basis points. Net profit too saw an uptick for almost 16%, but came in 7% below our own expectations. Let's look at how the different segments of the company performed. Power systems, the revenue growth came in much softer than Nomura estimates. Revenue growth was up nearly 21%. The EBIT margins too saw an uptick of 250 basis points. The industrial segment, on the other hand, which is a major contributor to the company's revenue so far, saw a revenue growth of almost 28%. This is higher than the Nomura estimate of around 17%. The margins on the industrial business, however, saw a contraction of over 200 basis points. The semiconductor.
Okay, all right. Thanks a lot for that, Vamakshi. Well, the market's clearly going into, into closing on a bit of a softish note. And what's happened in the last few minutes, joining the Nifty Bank on the downside is another heavyweight. Pull up the intraday chart of ITC. Well, that stock actually has slipped in the last few minutes, so just keep an eye out on that one. The other one is L&T. That in fact is trying to lend some support. So that's popped up in the last few minutes. A few more stocks actually that deserve special mention. The ones that have slipped actually is Tejas Networks. The stock is showing signs of fighting back, but now it's coming for some selling pressure. and Central Bank of India as well, currently at the low point of the day. So mid-cap index down 2.5%, headline index down 100 points, and the Nifty Bank down close to around 700 points thereabouts. Guys, take it over.
Okay, all right, got that. So right now, the mid-cap market correction is absolutely showing no signs of stopping. It's now almost 2.5%. That's the kind of decline. PSU Bank Index down about 5%. But today is not the day where anything else is coming in support either. Real estate down quite a bit. By the way, the small cap index is down about 2.5% in step with the mid-cap index as well. So it's pretty weak, the trends out there. That's what we have going. Let's actually, we're 2 minutes away from the closing, so let's start recapping the day as it is. 100 lower on the Nifty, and leading those declines today are names like Adani Enterprises. Adani is ending down about 4.5%. So a lot of yesterday's exuberance or yesterday's rally, it seems to be reversing today. Jio Financial 4% lower, Eternal about 3% lower, Trend 3% lower. Both these stocks started the morning quite positive, but then they completely fizzled out. SBI sees more follow-through selling after its numbers. Even today, stocks down 2.5%. HDFC Life, IndusInd Bank, Bajaj Finance, Axis Bank. Gives you a sense that financials is where the pain is. The Bank Nifty itself is down about 1.3%. So plenty of weakness here. And unlike yesterday, today the heavyweights couldn't come in support of the market. ITC, HDFC Bank, Reliance itself down 1%. All these big boys have been falling. What kind of stood out, relatively speaking, was M&M. With some follow-through buying after yesterday's good performance. Q4 performance came through. Hero Moto up about 2.5% as Ather lists. Bharti Airtel 2% higher. And then it fizzles out. A little bit of FMCG play today. Nestle and HUL. Two FMCG names that have found some buyers. But that's the Nifty, and that's only half the story, Prashant. The bigger issue with the market was the mid-cap unwinding today, and lots of it.
No, absolutely. Bank of Baroda was, of course, the big earnings-led loss. Indian Hotels was down 6.5%. Sonata Software down 7-8%. Godrej Properties down 6.5%. Railtel, Bank of India, Reliance Infra, I can go on. Capacite Infra, Manyavar, Aventil was down sharply. Skipper was down about 5.5-6%. Bombay Dyeing, and so on and so forth. I mean, only the not the good part, but maybe the silver lining at the margin was the fact that you had, although numerically more down than up, but it's not a big volume-led sell-off on the downside. You start very heavy with Bank of Baroda, top of the list, and then you kind of peter out very quickly within 8 or 9 names. Bombay Dyeing, and then, volumes really taper off. Bombay Dyeing 6, and then volumes really taper off after that. So, I think that is something to take note of. I think we'll wrap up this edition of Closing Bell here from all of us. Goodbye. Thank you for staying with us, but don't go anywhere because Markets Forward is coming right up. Dalal Street reverses Monday's gains as US tariff worries resurface. India-Pakistan tensions also weigh. Sensex and Nifty end with minor cuts. Broader markets underperform.
Banks led by SBI and PNB are likely to file a review petition on Supreme Court's order scrapping JSW Steel's acquisition of Bhushan Power and Steel. IOB tells CNBC-TV18 that all options are on the table and a final decision is likely in a few days.
Pharma stocks slip after US President Donald Trump signs an executive order to boost domestic production by asking the FDA to speed up approvals for local units and increase fee and inspections for foreign producers.
Ather Energy makes a subdued entry on the bourses, listing with a small premium. By the end of it, that premium also fizzled out. The offer price of 321 rupees per share. The EV maker remains confident of growing volumes, market share and margins in FY26.
Hello and welcome to a fresh new edition of Markets Forward, your go-to program where we aim to get you everything you need to know as you gear up for the next trading session. I am Prashant, with me, Surabhi. Surabhi, hi.
Hi, Prashant. I think the only place we saw green was in what I was wearing today, because we started quite okay in the morning. Global cues are very decent, and we'll run into the Fed announcement tomorrow. Yeah. But the colors suddenly changed, and there was no buy on dips. It was just a sell all the way kind of a day today.
I think it'll be interesting to see the total volumes traded today, because it looks like maybe it's a lower kind of a, if you compare it to the 30-day average, etc. It'll be a lower volume day. We'll have to do that. The reason I'm saying that is because if you advanced decline was poor. For every stock which was up, there were 5 which were lower. But, 8, 9, 10 names on the downside which had volumes. That's it. Otherwise, lesser traded names, not very well owned. So there wasn't very much by way of volume on the downside. Not that there was huge volume on the upside as well. So I think, a bit of a stay away kind of a session maybe. Not so much in terms of determined selling which is going on or anything of that sort. So maybe indifference more than anything else, if you want to use a word to describe what really happened. And we kind of drifted lower throughout the day. Where there was, I think, determined kind of action was, individual stocks. And lots of them came. And, we've got what? I think about less than 200, around 200 earnings so far in this earnings season. This is, of course, a longer earnings season. And my guess is, and again, we'll look this up over the next couple of days, disappointments, I think, exceed beats. And this, of course, even as expectations were running pretty low. So even on low expectations, I would say, generally what we are seeing so far, the color is quite negative and on the red side. Surabhi.
Yeah, absolutely. And this sort of risk-off sentiment continued to play out today, particularly in the broader market. And this mock drill, the nationwide mock drill that the market is sort of awaiting, that continued to be a chatter point in dealing rooms as well. And we saw that play out. I mean, and that was one part of it, why there was a general sense of risk off, get on the sidelines, take some profits. And the other was some earnings disappointment. Case in point being, say, stocks like Bank of Baroda or even a CG Power, even Indian hotels where the numbers seemed to be okay. The market was just in a complete risk-off mode. By the end of it, the PSU banking index ended down with a cut of almost 5%. So it wasn't just BOB. A lot of other stocks, plus the continuing overhang from SBI's numbers and commentary yesterday, that kind of led to the sharp drop on the PSU banking index. So overall, a fairly cautious day for the market. Let's go on. Lots to cover over the next 20 minutes. Lots of developments to track as well. We'll, of course, kick off by, looking at the blow-by-blow account in terms of individual stocks, all the movers and shakers coming up with Vivek. Some of the stocks in focus today's listing, of course, Ather Energy, Polycab and JSW Steel. We'll talk about all these stocks, why they were buzzing today. And then, of course, dive into the key events to watch, the key results to watch tomorrow as well. But first up, Vivek, over to you. Down day today.
Absolutely right. More declines than advances, like you put. And overall, advance decline ratio was quite weak. But quite a few stocks on the radar. Let's start off the list of gainers first. Polycab, the CNW pack or the cable and wired companies have actually done quite well. KEI was a very good set of results. Polycab to join the list. Good set of numbers. FMEG segment actually saw a bit break even. First profitable quarter for that particular segment after almost 10 quarters. Our stock ended higher by over 2%. Godrej Agrovet was the other stock in focus. A Kotak Institutional Equity upgrade coming in. They believe that the recent sell-off was slightly unwarranted.
printed, and stock ended higher by over 3.5%. One stock, from the coffee producing pack, that is CCL products, very strong margin expansion. Street clearly like that, over 300 basis points margin expansion, 16% higher from the broader markets for CCL products. And Tatva Chintan Pharma, although the results were quite muted, very good management commentary in the conference call. Also an order win coming in, something that the street liked, over 4% higher for Tatva Chintan. On the other hand, a list of negative stocks, the entire pharma pack on the back of the executive order that was put up on the White House website. You actually saw the entire pack reeling under quite a bit of pressure. Aurobindo Pharma almost 3% lower there. Bank of Baroda came out with results during market hours. PPOP miss. Abhishek tells us NIMS at a 14-quarter low. Stock ended lower by over 10%. CG Power, again, slight miss to what the analysts were estimating. In this particular name, stocks saw very sharp sell-off in the last hour, over 6% low. And lastly, Indian Hotels, good set of numbers, but profit booking coming in after that set of numbers, over 6% low even for Indian Hotels in trade today.
Okay, all right, got it. Vivek, thank you very much for that. Let's, quickly move on and talk about some of the key newsmakers of the day. We also have our guest joining in, Sudeep Bandyopadhyay of IndiTrade Capital with us. Sudeep, first, just a very quick overall sense on, the market sell-off today. Do you read anything more into it? Is it just some profit-taking, some caution? Or are you taking a slightly different view now for the next couple of days or perhaps weeks?
Well, Subi, I think what we need to read is, the India-Pakistan geopolitical tension is making the local market bit nervous. Local investors and even, for that matter, FPIs are being a bit cautious. So some risk off the table is what they're doing. And I think this mood will persist if this tension continues. We are holding a mock drill after what? Almost more than 50 years. I think the last time it was when the Bangladesh war happened. So this is something which the investors are a little worried about. And that's why I think we did see the sell-off later in the day. And I think we may see more of it unless things cool down on the geopolitical front. Of course, we will also wait to see the Fed chair's commentary on US economy. And that will be very important for tomorrow.
No, absolutely. And I think something we'll pay attention to in terms of the commentary on Thursday morning. Aether Energy is the next one that we're going to talk about. Of course, listed today. It was a bad backdrop with the markets off. Stock, of course, was slightly higher at first when it listed, but then it sold off with the rest of the market. So Darshan is here with the listing, where valuations are now compared to other players, I should say, because there aren't that many pure EV players. But, and of course, the commentary from the management. So take it away.
So it was a muted listing by the second EV player, that is Aether Energy. On the board says that it has got listed today, and after the IPO, which had got subscribed 1.4 times. I remember it was the last day that company had managed to get its subscription entirely fully subscribed, and it was majorly led by retail and QIB. QIB subscription was around 1.7. It was a similar with retail as well. And if you talk about the outlook, company is saying that as of 9-month FY25, total volume growth that company had seen, that was in the range of 45%. But going forward, company is expecting that in FY26, volume growth would be much more than FY25. And this is going to be one of the important metrics which is going to lead profitability going forward. Also, talking about the store expansion, company is saying that it has been taking place rapidly, but focus majorly will be on distribution level going forward. And he has also talked about the capex heavy as well as the cash flows, and he said that current capacity is currently at 35,000 units, but at the same time he's adding 2 or 3 more facilities, and gave an example of Aurangabad where the phase 1 expansion is going on, and he said that once it's completed there will be a major boost to capacity. But on the first day of the listing, after it got listed at the price of ₹328 per share against issue price of 321, it closed with a cut of more than 5%, almost 6% on the first day of the listing.
Oh, indeed it did. So quiet start for Aether. Thank you for that, Sudarshan. Let's talk about pharma stocks now. They were actually largely lower after US President Donald Trump signed an executive order to encourage US drug manufacturing. Ekta is here with more details. Ekta, this has been making the Indian pharma space quite nervous for weeks now. So what's the latest and how should we read it?
Well, yes, absolutely. Now, the executive order mainly focused on the fact that the US wants to increase domestic manufacturing. So they fast-tracked approvals for the US-based manufacturing plants. They've increased inspections and fees for foreign facilities. They've mandated public disclosure of API sources and public disclosure of non-compliant overseas plants as well. Now, overall, what analysts say about this entire thing is that it's not really a disincentive to overseas manufacturing. So it's not really intensifying, companies which are manufacturing in India. What they are trying to do is accelerating US-based approvals. The larger picture is the more concerning fact that they're looking to shift the balance of global pharma production. So you've already seen the likes of J&J, Roche, Eli Lilly, Novartis, all of them announcing investments in the US. In fact, all of them to the tune totally of around $100 billion plus. Now, again, the larger picture, which is probably going to play out in the next couple of weeks, is pharma tariffs could be announced in the next 2 weeks, specifically from the US government on pharma companies. And the US government is close to concluding Section 232 in terms of an investigation which examines the national security implications of importing drugs and APIs. So as of now, maybe companies which have a little bit of a base in the US could be probably a little more resilient eventually, such as Aurobindo, Cipla, Lupin, Glenmark. But one would have to really see how things play out at this point in time.
Okay, all right, got it, Ekta. Thank you very much for that. Let's quickly go back to Sudeep for a perspective. Sudeep, pharma stocks, are you buying any or are you totally staying away till there's clarity?
Well, I've been avoiding pharma stocks for quite some time. In fact, what I've been doing is I've been focusing on domestic pharma stocks. So, as mentioned earlier, I think in your program, Mankind Pharma has been my favorite, and I've been recommending that. Also, pharma companies having a significant domestic component can be looked at, and pharma companies having US manufacturing. So let's say Piramal Pharma has a huge facility in US. So if I have to buy a CDMO player, maybe Piramal Pharma would be my choice.
Okay, Piramal Pharma would be the choice there. Insurance is the next story that we want to highlight. The IRDAI, the insurance regulator, has proposed a major overhaul of the bank assurance model itself. This is all source-based information, CNBC-TV18 exclusive. We put this out during market hours. Stocks did react. Yash is going to explain. Yash, over to you.
Well, Prashant, as per this particular proposal, which has gone from the insurance regulatory body to the finance ministry, it seems like it's a complete overhaul of how distribution of insurance channels through banks, that is bank assurance, really works. What has been proposed is essentially changing the whole commission-based bank assurance model to a transaction cost or a transaction fee model. What happens under commission-based model? I'll give you an example. If 100 rupees is the premium which the insurance company collects, 18 rupees is the commission which banks takes, to sell that particular policy. The cost to the policyholder is 118 rupees, under which 18 rupees is kept with the bank, and then 100 rupees goes to the insurance company. That is the commission-based model. Now, what the proposal seems to suggest is that a shifting to transaction fee-based model where nothing will be given from the insurance company to the bank, but the bank can put a transaction fee on the sale of every insurance policy to the policyholder itself. Now, this particular transaction fee won't have any limits on either sides, the lower side or the upper side, and it will be determined by market forces. This is as per the proposal submitted by the regulator. Now, let me just put a small caveat. This particular proposal went under the chairmanship of Debashish Panda as IRDAI chairman, but he retired about a month and a half ago. So we'll have to see how Finance Ministry really takes up this particular proposal. But there are various benefits which have been, put down by IRDAI along with this proposal. Like this will force insurers and banks to have more tie-ups, essentially giving customers or policyholders more varieties in terms of insurance policies. This could bring down insurance premiums, curb mis-selling, also reduce dependency of insurance companies on their parent banks, and have a more diversified mix itself.
Okay, all right, got that. Thank you very much, Yash, for the details there. So ever-evolving policy landscape for insurers. Let's see what eventually comes out on this bank assurance front. Speaking of financials, let's move to the other topics today. Banks led by SBI and PNB are likely to file a review petition on the Supreme Court's order, which had scrapped JSW Steel's acquisition of Bhushan Power and Steel. Meanwhile, Department of Financial Services Secretary has said that the government has already reviewed the order with all the lenders, and they are also they've also taken a position and will approach the judgment based on that. That's not all. IOB CEO Ajay Kumar Srivastava told us that all options are on the table and a final decision on this potential review petition is likely in the next few days. Listen in to what he had to say.
Discussions are going on since the time the order came out, and the plan is yet to be finalized, and all the options are being discussed, and those options are on the table. Maybe in a couple of days the action plan will be finalized. But having said that, from IOB side, what I have to say is that the 760 crores we did get. And in the worst case scenario, even if we are supposed to refund it, I have to say that we are having sufficient cushion in the balance sheet, and this can be handled very efficiently without creating any adverse impact on the balance sheet.
Would you consider, Sudeep, JSW, would you look at it as a bit of an opportunity? It's down 6.5% after that news flow.
Well, I don't know as far as this entire scenario is concerned, because normally review petitions are very dicey. I don't know how this will get resolved. This is definitely a messy scenario. However, fundamentally, JSW does look good, and the correction has been already affected. So yes, if you are a bit of an aggressive investor, JSW Steel may be worth looking at current levels.
Okay, that's a call on JSW Steel coming in. By the way, Sudeep, we didn't ask you about today's listing, I think, Aether, right? I don't think we got your view there. Of course, today was the market environment and mood itself was off. But otherwise, what do you think of the company?
I think, very honestly, this is probably a better company than the other listed EV company, Ola Electric. They have the systems and processes in place. They have been growing in a much more systematic manner. May not be that aggressive, but I think it's a much more structured organization. So, if somebody has to bet for long term, this is probably a better bet on an electric vehicle business rather than Ola Electric. Of course, the valuation is rich. It is not cheap, and one needs to be very careful if you're taking a position. Current level, maybe we'll wait for some more correction here before we recommend a buy.
Okay. All right, got it. Sudeep, thank you very much for all the perspective today. You have a good rest of the evening. We'll take a short break, come back on the other side with the top corporate voices of the day along with the key events to watch. Welcome back. Here with us on Markets Forward. Let's talk to you about some of the key corporate commentary that we picked up today. Indian Hotels is eyeing a top-line growth of 12 to 15%. That's the word coming in from Mr. Puneet Chhatwal, the MD and CEO of the hotel chain. He adds that the company is expecting a 35 to 40% growth from newer brand properties in the current fiscal.
We are looking for anything which is between 12 to 15% top line growth, obviously very strongly driven by the Taj brand, and also a strong contribution, anything between 35 to 40% from the new businesses, which is Reimagined Ginger, the Tree of Life, Ama and Cumin.
Well, let's hear it from Sudhir Singh, CEO at CoForge as well, the best performing IT stock in this current environment.
FY26, we believe, is likely to be another exceptional year. We are extremely strongly poised. At this point in time, our 12-month signed order book is 47.7% higher than at the same time a year back. And you might have noticed that through the year, which was FY25, the total order book came in at $3.5 billion. We'd be very disappointed if all that we did in FY27 was just hit $2 billion. We believe we have a shot at doing slightly more than that.
All right, that was CoForge. Now to some more corporate voices. CAMS is guiding for early teens revenue growth in FY26. The company expects EBITDA margins to be in the range of 43 to 44% in the current year. Also guides that the non-MF revenue will be in the range of 17 to 18% by FY27. Next up on our list, OneSource Specialty. The management expects the margins of more than 40% from FY27 onwards. The company reaffirms its midterm guidance as well.
Okay, well, before we wrap, let's just quickly run you through some of the key events to watch out for as we come back tomorrow. Winnie standing by. Winnie.
Hi, so in terms of events on the global front, tomorrow evening we'll have the US Fed rate decision, so keep an eye out of that. Consumer credit will also be coming out in the US market, so that'll be important to watch out from data point of view from the United States. Eurozone, keep an eye out on the retail sales numbers that will be coming out for the company, so that'll for the country, so keep an eye out on that. China Forex reserves data, that will be important from China front. Now, other than that, global earnings are also there that we are keeping an eye out on. The pharma company Novo Nordisk will be reporting their numbers, as well as Disney is also expected to report the numbers, so keep an eye out on that. Now, moving on to India, we have Q4 earnings coming in from Coal India and the Nifty 50. Other than that, other than Nifty 50 companies, we do have Blue Star that will be reporting numbers, Dabur, UBL, Route Mobile, Tata Chemicals, MRF, as well as Sapphire Foods, some of the other companies that will be set to report their numbers tomorrow, so we could see some bit of a move coming in for these companies. Corporate action, keep an eye out on InfoEdge. There's a stock split of 1:5, so that's important. PNB board also will be meeting, other than their earnings, will also be meeting for a fundraising plan. So that is important to keep an eye out on. And other events, what we're keeping an eye out on, Vatican conclave is starting where they'll be electing the new Pope, as well as Ministry of Home Affairs has ordered a nationwide mock drill in India that will be beginning tomorrow. So keep an eye out on that.
All right, Vinny, thank you very much for that. So, I mean, that's a big one, right? And we'll, of course, get you updates on that starting tomorrow morning. It's a wrap on this edition of Markets Forward from Surabhi and me and the team that put this show together. Thank you for staying with us. More comes up in just a bit.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty close with minor cuts, reversing yesterday's gains. Mid-caps and bank stocks see a sharper sell-off. Indian pharma stocks decline after President Trump signs an executive order to boost domestic production by fast-tracking approvals, tightens the rules for foreign producers, including an increase in fee and more frequent inspections. India proposes zero tariffs on steel, pharma and auto components on a reciprocal basis as trade negotiations with the US continue. Bloomberg reports India offered zero duty up to a certain quantity of imports. The US Treasury Secretary Scott Bessent says China tariffs are not sustainable, hints at substantial progress in the coming weeks, also says he's highly confident of clinching more deals with other trading partners. Lenders to bankrupt Bhushan Steel are likely to file a review petition after the Supreme Court scrapped JSW Steel's acquisition and ordered liquidation. The Union Banking Secretary Nagaraju says the government will finalize a decision soon. Nationwide civil defense security drill tomorrow. Such an exercise was last carried out before the Indo-Pak War of 1971. The United Nations Security Council grills Pakistan at a closed-door meeting. Members expressed concern that Pakistan's missile tests and nuclear rhetoric were escalatory, advised them to sort issues out with India bilaterally. Asset declaration of sitting Supreme Court judges made public for the first time. 21 of the 33 sitting judges, including the Chief Justice Khanna and CJI designated Gavai, have declared their assets. Advocate turned Judge Justice Vishwanathan, with investments worth over 120 crores, is the richest. The Apex Court also publishes the entire process of appointments to the High Courts and the Supreme Court on its website. Union Bank of India faces the heat for spending 7 crore rupees to buy a book authored by K.V. Subramaniam, the former executive director at the IMF. The government terminated Subramaniam's services at the IMF 6 months ahead of his schedule. Was supposed to end. All India Bank employees call for a probe into Union Bank, citing wasteful expenditure. The government issues fresh stringent guidelines for satellite internet players like Elon Musk Starlink to get a license in India. Want essential functions to be located within India, citing tensions with Pakistan. The Minister of State for Communications says satellite players will have a minuscule role compared to traditional systems. Well, let's start with the market action for the day. The Sensex and the Nifty closing with marginal losses, reversing gains that we saw yesterday. Mid-caps and bank stocks, though, did see sharper cuts today. The Nifty Bank Index was down 1%, a 640-point cut there, and the mid-cap index down over 1,000 points, so a 2% cut there on the mid-caps. Sensex closing 150 points low, and the Nifty closing flat as well. So the pain really being seen today in the bank stocks and the mid-caps. In the commodity markets, oil prices rebounded after plunging to 4-year lows in the previous session. This, as technical factors and bargain hunting spurred a recovery. Now, the earlier decline followed an OPEC Plus decision to accelerate output increases, heightening concerns over a potential supply glut amidst weakening demand due to US tariffs. That has been impacting the crude oil markets. Meanwhile, gold prices surging to a 2-week high. This was driven by safe haven demand amidst Trump's tariffs and the uncertainty around Fed's upcoming meeting. Now, President Trump has signed an executive order to boost pharma manufacturing in the United States by reducing regulatory barriers. This announcement comes as a bitter pill for stocks of Indian pharma companies. On an average, top pharma companies export 40 to 50% of their medicines to the U.S. Now, speaking to reporters in the Oval Office, Trump said that he would make announcements in the coming weeks on the cost of drugs as well as on tariffs on pharmaceuticals. Take a look.
That's what it's all about, right? Very important. We're going to have a big announcement next week on some of this kind of thing, but more related to costs, the costs of medicines and drugs, because we're being ripped off, as you know, very badly, being ripped off compared to the rest of the world.
President, on the pharmaceutical side, have you made any determination on kind of what those tariff rates may look like and the timing of those?
I have. I'll announce it over the next 2 weeks.
Indian generic pharma companies are in the crosshairs as US President Donald Trump has signed an executive order to boost domestic drug manufacturing. The order directs the US FDA to fast-track approvals for US-based manufacturing facilities, ramp up inspections of overseas plants, and increase inspection fees for foreign drug makers. It also mandates the public disclosure of manufacturing sources for APIs and names facilities that fail to comply with the US standards. The Trump administration has called the 5 to 10 year timeline to build new US pharma manufacturing capacity unacceptable, citing national security risks from dependence on foreign supply chains. While not explicitly a disincentive to overseas manufacturing, analysts say the move is a clear attempt to accelerate US-based approvals. The larger picture is to aim to shift the balance of global pharma production. Multinational giants like J&J, Roche, Eli Lilly and Novartis have already pledged significant investments in the US manufacturing as well. The bigger threat looms in Trump's warning that pharma tariffs could be announced in the next 2 weeks. This comes even as the US government nears the conclusion of a Section 232 investigation examining the national security implications of importing drugs and APIs. Analysts believe companies like Aurobindo, Cipla, Lupin and Glenmark may be better positioned given their existing US facilities, but one really needs to see the cost in terms of manufacturing eventually as well. Those with a stronger branded portfolio, for example, Ajanta Pharma, Torrent, Alchem, could also weather the shift, according to analysts. However, uncertainty around tariffs is expected to keep valuations under pressure, at least in the near term.
All right, Ektan, we haven't heard the last from President Trump on the issue of pharma tariffs. U.S. Treasury Secretary Scott Bessent has said that many trading partners have approached the U.S. with very good trade deals, and some could be done as early as this week. Speaking to CNBC on the sidelines of the Milken conference, Bessent reiterated that China tariffs are not sustainable, but also clarified that both sides have not been talking yet. Take a look.
I think we're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week. So when you think about uncertainty, uncertainty, a lot of it is generated by, I have asymmetric knowledge, so I'm not uncertain because I think it's going well. Other people don't know what I know. So
you'd have to share that with us then.
Well, I can say that I am highly confident that we have 18 important trading partners. We'll put China to the side. The 17 other partners, many of them have approached us with the very good trade proposals.
Well, that is the U.S. Treasury Secretary Scott Bessent. But speaking of uncertainty, auto major Ford, which did beat Wall Street expectations in Q1, has suspended its guidance for 2025 amidst a possible $2.5 billion impact on account of President Trump's tariffs. Ford cited that near-term risk in the supply chain was also one of the reasons for pulling its guidance. The automaker expects to offset $1 billion of those costs via remediation actions. Now, as India and the U.S. negotiate a bilateral trade agreement, India has reportedly offered zero tariffs on auto parts, steel and pharmaceuticals. According to a Bloomberg report, India proposed this on a reciprocal basis, but for a specific import quantity. Now, import of goods beyond the specified threshold, which is, of course, finally agreed on, could attract the regular level of duties. Of course, this is source-based information. The Indian government has issued fresh stringent guidelines for satellite internet players like Elon Musk's Starlink to get a license. The telecom department issued new security parameters mandating essential functions to be located within India, citing tensions with Pakistan. These include the ability to intercept communications and monitor user activity. The Minister of State for Communications, Chandrasekhar Premasani, says satellite players will have a minuscule role compared to traditional systems. Remember, Reliance Jio and Bharti Airtel recently announced tie-ups with Starlink to bring its services to India, subject to government approval.
Starlink, all these international ones, have a very minuscule role in connectivity compared to what the traditional systems that we have. As I said, around the world, Starlink only has less than 50 lakh connections. Okay, and it is mainly, the speed is much lower. Third, it's quite expensive, both for installation as well as monthly payment. This is mainly for maritime, people who are really remote, where traditional networks cannot reach. So I would not give that much importance to those things at this time.
Well, that's the Minister of State for Communications. Now, lenders to bankrupt Bhushan Steel are likely to file a review petition after the Supreme Court scrapped JSW Steel's acquisition and ordered the liquidation of the company. Banking Secretary Nagaraju has said that the government will finalize the decision soon. Sapna standing by with details. Sapna, take us through what is being assessed at this point in time in terms of the impact and the possible way forward that the government could take.
Well, you're given to understand from sources that most likely Punjab National Bank and State Bank of India are going to file a review petition in the Supreme Court on the JSW order. Having said that, probably there's a consensus among lenders to follow this route in the coming days. Of course, earlier on, the DFS Secretary himself, Mr. Nagaraju, was very clear that the matter has been discussed with the lenders. The government has studied the judgment and a position has been taken after consulting their advocates. And probably in the coming days, a plan will be finalized soon, or as to how they plan to approach the judgment and what the legal options are. That's the position as of now. Most likely this week is going to be devoted in terms of understanding the pros and cons, and maybe from the next week onwards or the coming week onwards, some action is likely that can unfold. But having said that, down the line, it may also be possible that, a larger policy review may be required in terms of the NCLT's efficacy, the questions raised by the Supreme Court order, what happens to the IBC process, what happens to the timelines, all of that. But maybe for that, we'll have to wait a bit more. Down the line, that could be possible as a proper serious 360-degree policy review on the IBC and the NCLT and the cases. But as of now, it's the most likely, it's the review petition route for the banks.
Discussions are going on since the time the order came out. And the plan is yet to be finalized, and all the options are being discussed, and those options are on the table. Maybe in a couple of days, the action plan will be finalized. But having said that, from IOB side, what I have to say is that the 760 crores we did get, and in the worst case scenario, even if we are supposed to refund it, I have to say that we are having sufficient cushion in the balance sheet, and this can be handled it very efficiently without creating any adverse impact on the balance sheet.
Well, that's the latest there in the JSW matter. A review petition is likely to be moved. Now, nationwide drill exercise will be conducted tomorrow to strengthen civil defense preparedness. Now, the drills will be conducted in 244 districts across states and union territories. And this comes at a time when tensions between India and Pakistan have been rising after the terror attack in Pahalgam. These are the first such drills to be carried out in over 50 years. Such an exercise was last carried out before the Indo-Pak War of 1971. The government's order to states makes no explicit reference to tensions with Pakistan. The primary object of such exercises are to strengthen defense preparedness among civilians. My colleague Arunima joins us from New Delhi. Arunima, take us through what we can expect through this drill tomorrow.
There are four main points on which the focus is currently in this mock drill. Number one, the air siren. If the Indian Air Force identifies that there is a threat from the air to any district, then the air siren will be sounded off, and the civil defense volunteers will then ensure that the civilians take cover. Second will be blackout siren. Blackout siren would mean power cut. So if you are in a forward area and your civil defense volunteers have asked you to prepare for a blackout siren, prepare to have candles or matchsticks or torch with enough battery power around you so that you can navigate this phase when blackout is announced. Third thing is, again, if you are in a forward area, you might have to prepare an emergency kit because possibility of evacuation to a community bunker might arise. So there are a number of forward areas. For example, in Rajasthan, Jaisalmer, Barmer. In Punjab, there's Amritsar. In Jammu and Kashmir, there's Uri, Arnia. In Gujarat also, there are forward areas. In Kutch, if you are in any of these areas, prepare an emergency kit. If you have a child or a baby, have dry baby food, a sanitary kit for women, essential medicines, etc., and some cash to be carried immediately when you are being evacuated. Fourth, if you are living near a vital installation, a defense installation or a nuclear installation, your civil defense volunteer and your district administration might prepare you in a different way to take cover. All of these will be part of the drill that is carried out from 7th of May. What the government is saying is do not panic. This drill does not mean we are going to war, but it does mean that we are preparing our civilians for any eventuality since they are not aware of any warlike situation since 1971.
All right, many thanks, Arunima, for joining us. As Arunima was pointing out, not to create panic, but to be prepared for any eventuality. Santhya joins us now from outside Mumbai's Chhatrapati Shivaji Maharaj terminus. Santhya, take us through what we can expect in Mumbai tomorrow. What kind of planning is being put in place?
So Shireen, as you mentioned, we are standing outside Chhatrapati Shivaji Maharaj Terminal in Mumbai. It's a key location and one of the locations which was targeted during 26/11 attack. From 1993 bomb blast to 26/11 terror attack, Mumbai has faced multiple terror attacks over the years. That's why there'll be special focus on the city. Mumbai is a city which anyway by default remains on high alert, will witness special readiness by the forces. Maharashtra Civil Defense Department has claimed that all the agencies, including Civil Defense, is prepared to face any situation, any scenario. Tomorrow, if we talk about Mumbai, strategic locations will be focused on by the agencies, civil defense agencies, fire department agencies. Of course, Mumbai police will be a huge part of it. Other than Mumbai, there will be 10 districts in, other than Mumbai, there will be 9 more locations in Maharashtra where mock drill will take place. Shireen, over 10,000 people are likely to participate in these mock drills. Civil Defense has said that all the air sirens have been activated and all these citizens will be educated and informed on how to behave, what to do and what not to do in a war-like situation or a terror attack like situation. The idea here is to ensure that everybody is ready and prepared and not to create any kind of panic. Coastal areas in Maharashtra will witness special focus. We all remember how the coastal area sea was used during 26/11, so coastal areas will witness special focus. Other than that, whether it's the railway station part of mock drill, your metro stations, your bus stations, your schools and colleges, there also targeted mock drills will take place. All the air sirens have been activated. Coastal belt, southern Konkan and North Konkan, both these regions will be focused on by the agencies. And tomorrow, along with 200, across nation, 244 districts will witness mock drills, and 10 districts of Maharashtra will be a part of that list. Shireen.
Santya, many thanks for joining us. So that is the situation in Mumbai. Back to the markets. Ather Energy made a debut on Dalal Street today. Shares listed at a premium of 2% over its IPO price, but then fell by about 6% later. The company's CEO Tarun Mehta told CNBC-TV18 he remains bullish on the company's near-term growth prospects.
We are extremely bullish about the near-term growth because of distribution, because of how Rista, a new family scooter, is landing in the market, and generally how well the India premiumization story is really taking off, where Ather really plays in the center of it. Overall, I think both margins and volume and market share, all three should trend really well this year. I am personally definitely expecting an even better trajectory than what we saw in FY25.
Well, that's Ather Energy. Now, shares of Housing Development Corporation slipped in trade today. This comes after the company's board approved raising 2,190 crore rupees. The base issue size of the fundraise is 500 crores and the remaining amount includes a green shoe option of 1,690 crore rupees. Earnings. Polycab reported strong numbers in Q4, beating street estimates on all fronts. Net profit up 33%, revenue jumped 25% on an annual basis. Margins expanded by 110 basis points from last year to 14.7%. And staying with earnings, Bank of Baroda reporting a weak set of numbers for Q4. The bank's net interest income dropped over 6% on an annual basis. The bank's net interest margin slipped to a 14-quarter low to 2.86%. Asset quality narrowed marginally on a sequential basis. Union Bank of India is facing the heat for spending 7 crore rupees to buy a book authored by K.V. Subramanian, the former executive director at the IMF. The government terminated Subramanian's services at the IMF 6 months before his tenure was supposed to end. Now, the All India Bank employees has called for a probe into Union Bank, citing wasteful expenditure. Ritu joins us now with more. Ritu, what does this mean for the bank now?
Well, Shireen, no good for the bank. And as you said, Union Bank is facing heat for spending a staggering 7.25 crores on buying nearly 2 lakh copies of former Chief Economic Advisor Krishnamurthy Subramanian's book, India at 100, even before the book had hit the shelves in August last year. Now, this has raised eyebrows, especially in light of the government prematurely terminating his term as the executive director at the IMF recently, with reports even suggesting some alleged impropriety, including the promotion of this very book as a potential reason for his abrupt departure. Now, an internal memo from Union Bank of India, which we have accessed, shows that the bulk order was placed in June or July of last year, with the bank buying nearly 2 lakh copies of this book. And this memo cited, and I quote, the desire of the top management as the reason for the purchase, calling the book invaluable for anyone interested in the rise of India's economy, and stated the bank wished to distribute copies of this book to its customers and to corporates, supposedly to tap into future business opportunities. And it gets even more bizarre because the bank said it also intended to widely distribute these books to schools, colleges, libraries across the country to showcase India's potential as an economic leader. The advance payments, though, for this book were made through this, vague category labeled miscellaneous under the bank's revenue budget. Now, our sources indicate some of the senior bank management did raise concerns over this internally in the bank's December board meeting, following which Union Bank brought in KPMG to examine the matter. But so far, the only visible action appears to be the suspension of a general manager who merely oversaw the support services department. In the meanwhile, All India Bank Employees Association has also now called for an official investigation into this issue, branding that spending as wasteful expenditure and questioning the benefits Union Bank achieved by spending crores of rupees to buy a book.
All right, Ritu, many thanks for joining us. Now, electronic giant LG will set up a manufacturing plant in Sri City in Andhra Pradesh with an investment of 5,000 crore rupees. According to Money Control, the facility will manufacture refrigerators, air conditioners and washing machines. It will also produce components like compressors, motor compressor and a heat exchanger manufacturing facility. Production is expected to begin by December 2026 and the plant is expected to create nearly 1,500 direct jobs and 10,000 indirect jobs. We will head into a break, but up next, 21 sitting Supreme Court judges disclose their assets to the public for the very first time. That and more when we return. In international news, Israeli forces have stepped up their offensive in Gaza. At least 54 people were killed in the enclave yesterday. Israeli forces have also attacked parts of Yemen, Lebanon and Syria. Prime Minister Netanyahu said that more than 2 million people in Gaza will be moved into a new ground offensive after Israel's total blockade completes 65 days. The Hamas-run Gaza Health Ministry has said that hospitals are just 48 hours from collapsing and lives of thousands are at risk. From one war-torn region to another, Russian officials have said that Ukrainian forces launched drones at Moscow for the second night in a row, forcing the closure of 3 major airports in the capital. Officials claim that 19 drones approached Moscow and its debris post-interception fell on a key highway. Ukrainian forces also attacked a power substation in Russia's western Kursk region, injuring 2 people and destroying 2 transformers. Ukrainian commander-in-chief said that the Kursk offensive had achieved most of its goals. U.S. Defense Secretary Pete Hegseth has ordered 20% cut in senior ranks of the military. He's also ordered a 10% reduction in the number of general and flag officers. According to the U.S. Department of Defense data, the U.S. military had 38 4-star generals or admirals as of the 31st of March 2025. American food delivery platform DoorDash will acquire British rival Deliveroo for nearly $4 billion. DoorDash will acquire a stake in the company at 180 pence per share. That marks a 44% premium to Deliveroo's previous closing price. This will boost DoorDash's international expansion plans. Now back home, 21 sitting Supreme Court judges have disclosed their assets to the public for the first time. These include Chief Justice Khanna and Chief Justice Designate Gavai. Ashmit standing by with the details. Ashmit, this is pretty historic. Take us through the asset declaration by the judges and the significance of this move.
Well, let's begin with the significance. Quite important, this landmark judgment coming at a time that there was increased scrutiny and outcry against judicial appointments on two counts. One, of course, the Justice Verma incident of cash being found in gunny bags at the residence, his Delhi residence. The other, of course, is questions being raised by the executive over the judiciary crossing the Lakshman Rekha and then dictating terms to the legislature and the executives. On both these counts, the mantra that the CJI, Justice Khanna, appears to be going with is that sunlight is the best disinfectant. Let's disclose all, let's share those details. Now, as a result of that, for the very first time, we have as many as 21 of sitting 33 judges disclosing their assets and investments as a part of the Supreme Court website. There was a Supreme Court website release as well, which the press release said that there'll be, in fact, more disclosures going ahead as the judges bring on board their data about their assets. Now, what's important is that as many as all five judges, top five judges of the Supreme Court, including the CJI, as well as the CJI designate, have revealed their data. As far as Justice Khanna is concerned, he's revealed two houses, investments of 3.38 crore rupees, and one Maruti Swift. As far as CJI designate Justice Gavai, well, he's mentioned that he has as many as 3 houses, 2 in Maharashtra, 1 in Delhi, 3 land parcels, all of them in Maharashtra, investments of about 1.15 crore rupees. Justice K.V. Vishwanath, a distinguished lawyer till very recently, was elevated in 2023, has come across as the most affluent of the judges. He's come in with investments of 120 crore rupees, has 4 houses and paid as much as 91 crore rupees in taxes in 15 years, ending with FY25. That's not all. There were also questions that the Supreme Court has tried to answer in terms of how judges are appointed. Very detailed procedures have been listed out on the Supreme Court website, disclosing the number of judges that have been recommended by the collegium, the parameters on which they're assessed, including the parameters of how many pro-government or pro-tax department judgments have been authored by a particular judge. All these parameters listed out in the hope that as Justice Khanna gets ready to leave, he's retiring shortly in this month itself, as he gets ready to leave, perhaps this exercise and disclosure will restore some confidence back in the judiciary, back in the tallest judges of the country.
All right, Ashmit, appreciate you joining us. That's the big story there coming in from the Supreme Court. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. For now, from all of us, thanks very much for watching.
I think all of us who were in any form or fashion related to the markets in 2008, that would be a firm imprint on our minds for the rest of our lives.
It changed us forever.
Forever, It's a ghost of 2008, which gives us all that.
It
would never leave you. We have this, meeting of investors, and one of the investors mentioned this is worse than GFC because of XYZ reason. Everything, something props up, it becomes worse than GFC. Obviously, COVID one could have legitimately said it's worse than worse than GFC. So far, it's been moving along as Trump had planned. And I think the worst is behind as far as the markets are concerned. There were some pockets within small caps and mid caps, certain segments which did build some excess. And the last 6 to 12 months, that froth has been to a great extent fizzled out. Post-COVID 5-year fantasy run is over. I'm not calling that we would have an environment like 18 or 19. If you'll very well recollect, January 2018, small caps peaked and there was a 40% drawdown in small caps. And that was a time when most retail investors lost a ton of money. I think a 10 to 11% return from equity markets over the next 5, 10, 15 years is a reasonable base case expectation.
10 to 11%. When people hear you say that, half of them will be pulling their hair out saying,
Pre-tax.
Prashant, what is Prashant saying?
10% is very good, meaning you can double your money in 7 years.
Okay, so now let's come down to the brass tacks questions as to what we should be doing as investors, where we should be looking. My first question, starting point, is going to be on the leaders of the run up until now, whether we need to reset, their prominence in the portfolios. And I'm talking about industrial stocks, defense, PSUs, railways, capex, capital goods, etc. Do you think their best is over, and should investors be lightening up on that side if they've not done it already?
Certainly. So I assume by investors, you are talking about not professional investors, but those who are investing retail.
Who are managing their portfolios either through direct stocks or maybe overexposure through funds in this part of the market.
Excellent. So I would say those who have time to do research, they should spend time managing their portfolios in individual stocks. Those who don't get time to research are better off hiring a financial advisor and then go that way. But now we'll talk about, and the financial advisor, based on your risk profile and whatnot, would recommend
what. You can be in a PMS, you can be in a, you can leave it to an expert. Correct.
Now for someone who's doing on their own and are able to spare the time and effort to do the research, obviously can only suggest the way we do things. So the way we do things is we don't take thematic bets or sectoral bets or forget big, even small macro calls from a making money perspective. Macro sectors, themes, these are all from a risk management perspective. Going back to the experience I talked about at State Street Global Advisor, I used to go home after setting a few quant models to work through the night, crunch the data to provide results next morning, what macro or sector or other fundamental bets, high ROE, low volatility, high sales growth, high margin, what can work and predict returns. Believe me, nothing works on a forward-looking basis. So no point in taking such big risks or big bets in your portfolio. Have a broadly diversified portfolio across sectors. Try and identify winners in each sector. Money is made, I often say, money is made in diamonds business as well as in coal business. One might be more flashy and glittering, but actually more money has been made in coal business than in diamond business. Nowadays, more particularly so with all the lab-grown diamonds in fashion. So you have to identify the best of the diamond companies and the best of the coal companies, if you will. Meaning across sectors, you identify companies that can deliver superior performance both on business front as well as then over time from the market.
Okay. So that actually brings me to the question on your own personal investing style and how it's evolved over the years. When you decide to pick a stock for the portfolio, where do you start? Is it you look at a broad top-down theme that you're convinced about, and then you look at companies there? Do you look at management, valuations? How does it work?
No, excellent. So our team's approach is very stock selection driven, as I've repeatedly said. We aren't of the kind that will ignore macro. And then macro are of several kinds. There's one is structural macro, like Indian demographics, per capita incomes, urbanization. These are all structural macro that you have to factor in your bottom-up thinking and analysis and valuation of individual stocks. But then there is conventional macro, like interest rates, inflation, these, that, and the other. There we don't see any opportunity to make money or, necessarily differentiate ourselves from what the consensus is and make money. And then there is this tactical or sporadic macro, like Trump tariffs.
Renewables is a theme, or exports is a theme.
So all those
all
themes
that,
you have to be very careful, because themes are not, by the time something becomes a theme, it's very well known and well followed. There's cult following in the market. A lot of themes have had very bad endings in the market. If you look back during our own experience, infrastructure was a big theme during 03 to 07, and so was real estate. Both had very bad endings. So I'd say one needs to be very diversified across sectors. Each sector in a way is a theme on its own. Some may be more in favor, other times they might be out of favor. So broadly diversified from a risk management perspective. From a stock picking perspective, what we as a team focus on, I would say the organizational culture as it pertains to execution and governance. Then, superior returns on capital. Not necessarily today. I often get asked, because we are very cash flow centric and there are loss making companies in our portfolio as well. So how do you talk about superior returns on capital for a loss-making company? Some of the new age companies that our team very much likes and owns for several years. So it is superior returns on incremental capital. Looking forward many years, value of, oftentimes, people take this lightly, but value of any business is present value of future cash flows. It's not necessary you have to make cash flows in year 1, year 2, or even year 3. Whether the cash flows that you are expecting over time.
I remember this categorically because I remember doing a show when Zomato was listing with some of your team members, and there was a massive debate there about whether this whole price to sales, there's no earnings, how can you value a company like that? And of course, White Oak took early calls, big believers early on.
Absolutely, and we've owned, its parent company since much longer, ascribing value to these investments that the parent company has made. This is one of the lessons I learned, I would say, early in the TMT bubble, .com bubble, when in my US portfolio, I never could buy Amazon. Thinking that it's not making money. And at that time, it was also an assessment that it can never make money. I did own telecom companies or wireless companies which weren't making money. But I guess in wireless companies, it was very well accepted that for several years, they would make cash losses at least. And then later on, they'll generate cash flow. But new age companies, because there isn't an established business model to look back onto, people often just ignore them or write them off as something they won't look at. And that's the opportunity for investors like us who are willing to take a closer look.
This is a bit of a deviation, but a great one. Since we're on the subject, I have to ask you this, because we've reached that point again for these new age internet stocks where the debate is back on. They're investing a lot in dark stores, they're expanding in tier 2, tier 3. So suddenly some of them are saying that they reach profitability, but maybe, at least in quick commerce, it can get delayed because of this expansion.
Yes.
What do you think about these businesses as of now?
See, the same way we've looked at these businesses, there'll be winners and losers. Not everyone's going to be, the next whatever of India. See, we do benefit having invested during the .com bubble through the late 90s and 2000s in US, where these kind of companies first came to market. Having made mistakes there, both of commission and omission. Amazon is a mistake of omission, if you will.
Missed opportunities.
Missed opportunity. Then as on the EM, while in India, a lot of these businesses might be developing for the first time. That's not true globally. In China, this story has played out a decade ago, right? The Alibabas, the Meituans, the Tencents, those all also have had the opportunity to participate in several of them in the IPO. Just like Google in US was an IPO company invested in my portfolio. Similarly, Alibaba and others were IPO companies. In Korea, you have similar companies who are leaders. They're just further along in the journey to profitability than some of the Indian companies are. And if you study the the US, the developed markets, the emerging market companies in similar businesses, how they've progressed, how they now have come to a stage where they are throwing up tens of billions of dollars of cash flow.
Yeah.
You know, the Mag 7, there's a cult-like following amongst Indian investors for the FANG. FANG was very widely followed 2 years ago.
Absolutely.
Majority of those FANG companies weren't making money or cash flows
When they started
when
off.
they were $100 billion in market cap
Yeah.
or more. Yeah, obviously Microsoft was making money and some others might have been making money. Google was making money early on. But others, Amazon wasn't making money, Netflix wasn't making money, yet they were so loved.
Sure.
Yeah, so
So you have to be a patient investor if you're going to be on
patient
this
and
ride.
selective. You can't
Patient
have a
and selective.
spray and pray approach
Not everything
across
would
all
become
the.
an
Not
Amazon.
everything would become a Amazon or a Facebook or something.
Absolutely,
But you can't write off.
The whole
Otherwise,
sector.
you'll end up
You'll end up
investing
missing the
if you
opportunity.
absolutely
Got
you'll
it.
come in much later.
What about renewables? Similar. I mean, before this market correction set in, any company that was talking EV or renewable stocks were shooting through the roof.
Certainly.
Right? What is your take on the Indian RE renewable/EV space?
Certainly. So again, here also there'll be winners and losers, and you have to identify, work, and it's a similar job to any other sector. I would say the froth in this segment has considerably come off. This was one of those segments of the market where valuations had gotten way ahead. For a renewable utility,
Sure.
there is a certain IRR and ROE. Let's call it mid-teens, maybe a point lower or a point higher. That has to be valued commensurate with that level of profitability. That level of profitability is very good, pretty decent for that kind of business and predictability. But it can't have the kind of valuations it got, say 6 to 12 months ago. And now I think the valuations are more in a reasonable zone.
Let's talk about what excites you the most. Right now, I've been throwing some sectors and themes at you. And when I say excite, it means where you see growth visibility, you see valuation comfort, where you're convinced that next 3 to 5 years there's serious money to be made.
So see, what excites us the most always, Surbi, is mismatch of fundamentals and valuations. So we're looking for the undervalued companies relative to the fundamentals.
Sure.
Now that is there across market cap segments, large, mid, small, and across sectors. Yeah? Having said that, inefficiencies are higher in small caps and mid caps. So even for a fairly valued small cap or overvalued small cap sector of the market, the inefficiencies being higher, you're likely to find more opportunities where there's a bigger mismatch of fundamentals and valuation in smaller caps than it would be in larger caps. So think of the largest of financial sector companies and the smaller NBFCs or banks or whatever. There is likely to be greater inefficiency in the valuations of the smaller, and there are some beautifully run small cap NBFCs, just as there are beautifully run large cap banks and NBFCs.
When you say inefficiencies in valuation, you think the price has not fully captured the potential?
Yes, very true. So across sectors those exist. So we tend to have always higher allocation in small and mid cap. Now in certain sectors, there's just a greater availability of small and mid cap names than other sectors. So energy as a sector tends to have only the largest cap companies.
Big companies,
yeah. Think of how many companies in small cap energy can you, you would not run out of your fingers counting small cap companies. Whereas in consumer discretionary or healthcare, in healthcare, there are dozens and dozens of small and mid cap companies, be it in pharmaceuticals, be it in diagnostics or hospitals and whatnot. So it's an alpha rich segment of the market.
And you've liked pharma earlier as well. Does that view still hold, irrespective of tariffs are there, not there, and whatever's happening in the US?
I think again the view is because you are able to, it's a very rich hunting ground, fertile hunting ground, or it's part of the pond where there are a lot of fishes to fish. And that's why it's likely to be higher allocation in our portfolio, not because from a top-down view perspective, we believe pharma is going to outperform. Even if pharma over shorter time periods underperform or whatnot, we believe over time, over the cycle, because it's so alpha-rich segment of the market, our portfolio or our component of the portfolio that's pharma or healthcare should be able to outperform the overall market, even if pharma underperforms in the market, if that makes sense. Yeah? So right now, if you see in the portfolio, besides small and mid-cap pharma or healthcare more broadly, we have mid-cap IT services, something that we discussed. We have in consumer, across small and mid-caps, a lot of opportunities. In financials, we've tended to find a lot of large-cap opportunities as well. When we compare large-cap Indian lending institutions to anywhere else in the world, be it emerging markets or developed world, they seem to be very well priced for the, very attractively priced for the quality of balance sheet and the growth prospects that they have. So these would be the few categories besides chemicals, industrials, and other segments where we selectively find a lot of opportunities.
Just to round up this part of the conversation, you said selective industrials. And I started with asking you this question.
Yes.
Do we need to, change our approach towards industrials? So which parts of industrial / capex, economy-facing stocks, which part of that are you still happy
So within
holding?
industrials, if I look at, obviously there are many, industrials is a catch-all sector.
It's a
just like a
massive word.
Yes. So if the benchmark makers don't understand where to put a company, it neatly doesn't fit in any sector. If it is consumer oriented, they throw it in consumer discretionary. And if it is B2B oriented, they throw it in industrials. Yeah. So within industrials, where we have a big chunk of our team has big chunk of allocation is in equipment makers, intellectual property products. So the industrial equipment makers more so than infrastructure developers or EPC players or so on.
PSUs?
We do have some PSUs more so from a risk management perspective. Their operational performance certainly has improved over the last several years. Question still that we have, and we are not convinced of whether it is sustainable through different governments.
Yeah. This government had a very clear approach of sort of pushing forward. Yeah.
Absolutely. And if you go by, you are from the school where you believe value of any business is present value of future cash flows. Those future cash flows are accrued over decades. So present government may be doing, or PSUs might be doing a fine job under the present government, but can the same be extrapolated or expected over many decades? So that's where some of the concerns are, but we do own some PSUs as well.
Okay, fantastic. I think that's been really exhaustive and very comprehensive. So I have to start coming down to some final thoughts. I want to ask you, what would be, since we're talking about a new market and a post-COVID, getting over the hangover, getting ready for a new phase, what should be the, let's say, top 3 mistakes that investors need to avoid?
Certainly. I think at any time, and this has been true over the last 40 years and true, I think, over the next 40 years as well. 2 of these 3 mistakes I've made repeatedly. 1 mistake I've never made, which is trying to time the market. There's a most important mistake that, or the biggest mistake that investors make, they try to time the market.
Yeah.
Going into cash, going back into market, and so on and so forth. And not every time, but you'd be fortunate to get it 50% of the time right. So if you got worried from media headlines about Trump tariffs and whatnot, and you get out, or worried about COVID headlines and you get out, no, that's not going to pay off. So this, fortunately, I've never fallen in the trap of. So timing the market is a big mistake. Second, leveraging is a huge mistake.
Okay.
Never important for investors to not lever up and invest in the market. We've seen or heard anecdotally several instances of people leveraging. It is a mistake I've made because when you have less money and you want to make more money, it seems very easy to lever up.
Borrow and then
invest because you're always confident that equity markets would, in this, as you were saying earlier, people have become confident of earning 20 to 30% return.
Yeah.
And they can borrow money in 10 to 15%, and they feel, that's the easy way of multiplying the wealth. And third big mistake is getting too concentrated in your portfolio. As an individual investor, you're often prone to, and I've heard just very recently, one of the coaches of my student, my son, the coach said, I've always been 100% invested in biotech companies in the US.
Okay.
He's just big fan. He has very little. He's not from the field, has no specific expertise in biotech. He's an individual investor. He coaches sports, is a sports coach, but just has a fancy for biotech. But that's like, in a way, buying lottery.
Really risky.
You're waiting for lightning to strike in the spot that you've picked. Typically doesn't work that way, right? So having excessive concentration in very few stocks or in a theme or two, like a lot of people during 03 to 07, and again maybe in the recent years, had high concentration in deep cyclicals or industrials and infrastructure, defense, PSUs and whatnot. Again, it's a recipe for disaster sooner or later.
If you're very concentrated.
Very concentrated. So avoid market timing, avoid leverage, avoid heavy concentration.
Over concentration. Got it. I think that those are great 3 nuggets to keep in mind. Finally, when you're not picking stocks and forever studying balance sheets and companies, how do you keep yourself sane in this very noisy and very volatile market?
So I'm certainly a fan of cricket, as most of us are, and watch that with my kids. And second is of chess, so play quite a bit of chess with kids. And after Gukesh's win, World Championship a few months ago, 4 or 5 months ago, I've really taken to watching chess as well.
Okay.
Obviously the fast version, rapid fast forward version, these matches can last 5 hours. But on YouTube, there are certain websites where you can watch a whole match in 22 minutes and you can play double the speed.
Wow.
So in 10 minutes, you can watch. And if Gukesh and Ding played some 14 games, you can within 2 hours complete the whole championship.
Wow, look
And
at
it's
that.
great fun to watch.
The benefits of technology, right?
Absolutely.
So as we get ready to sign off, I have just 3 simple rapid fire questions, rapid fire off the cuff.
Bring them on.
The highest moment of your career so far?
Oh boy. It's yet to come.
Wow, yet to come. Nice one. The one thing that you would have done differently in your career?
You would have taken the risk earlier on.
The Amazon call.
Or I was saying more the entrepreneurial risk.
Oh, okay, okay. Would have started entrepreneurship early, got it. The biggest lesson that the market has taught you?
Don't have too much confidence in subject matters which don't lend themselves to any degree of predictability. To give a analogy, a coin flip, let's say, there's no, and I might be carrying one, there's no point in having strong confidence in when I flip a coin that it's going to be heads or tails.
True.
Yeah.
It's
the nature of the beast is such that you can't have confidence.
Yeah.
So that's a very important lesson that I've learned over time, where I've had confidence in hindsight when it turned out that these were clearly subjects where I shouldn't have had confidence in.
Very interesting thought, and something for us to take home, think about, chew over, ponder over, and then take the benefit from. It's been such a pleasure listening into you. It's been a very, very insightful conversation. Thank you so much for taking out the time and doing this. Thank you very much.
Thank you, Survi. My pleasure.
Look forward to more of this in perhaps the months and years ahead.
Same here.
Well, viewers, it's a wrap then on this edition of Market Cafe. Remember, this is Season 2, Episode 2, and you can find all the seasons, even the previous ones, on our YouTube handle. See you with another conversation, another guest very soon.
Hello and welcome to News Center. I'm Parikshit Luthra. The top story we are tracking this evening. States are bracing for a pan-India mock drill exercise, the first of such a scale since before the India-Pakistan War of 1971. The Home Ministry has directed states to conduct mock drills across the 244 categorized civil defense districts tomorrow to strengthen civil defense preparedness. The mock drill comes amid worsening ties with Pakistan on the back of the Pahalgam terror attack last month. The primary objective of the drill will be to assess the effectiveness of air raid warning systems. Civilians and students will be trained in defense aspects and also protect themselves. This will be done to ensure that people can protect themselves, safeguard their property, their families in the event of a hostile attack.
Our team of reporters gives us a sneak peek on what we can expect tomorrow.
There are four main points on which the focus is currently in this mock drill. Number one, the air siren. If the Indian Air Force identifies that there is a threat from the air to any district, then the air siren will be sounded off, and the civil defense volunteers will then ensure that the civilians take cover. Second will be blackout siren. Blackout siren would mean power cut. So if you are in a forward area and your civil defense volunteers have asked you to prepare for a blackout siren, prepare to have candles or matchsticks or torch which enough battery power around you so that you can navigate this phase when blackout is announced. Third thing is, again, if you are in a forward area, you might have to prepare an emergency kit because possibility of evacuation to a community bunker might arise. So there are a number of forward areas. For example, in Rajasthan, Jaisalmer, Barmer. In Punjab, there's Amritsar. In Jammu and Kashmir, there's Uri, Arnia. In Gujarat also, there are forward areas. In Kutch, if you are in any of these areas, prepare an emergency kit. If you have a child or a baby, have dry baby food, a sanitary kit for women, essential medicines, etc., and some cash to be carried immediately when you are being evacuated. Fourth, if you are living near a vital installation, a defense installation or a nuclear installation, your civil defense volunteer and your district administration might prepare you in a different way to take cover. All of these will be part of the drill that is carried out from 7th of May. What the government is saying is, do not panic. This drill does not mean we are going to war, but it does mean that we are preparing our civilians for any eventuality, since they are not aware of any warlike situation since 1971. We are standing outside Chhatrapati Shivaji Maharaj Terminal in Mumbai. It's a key location and one of the locations which was targeted during 26/11 attack. From 1993 bomb blast to 26/11 terror attack, Mumbai has faced multiple terror attacks over the years. That's why there will be special focus on the city. Mumbai is a city which anyway by default remains on high alert, will witness special readiness by the forces. Maharashtra Civil Defense Department has claimed that all the agencies, including civil defense, is prepared to face any situation, any scenario. Tomorrow, if we talk about Mumbai, strategic locations will be focused on by the agencies, civil defense agencies, fire department agencies. Of course, Mumbai police will be a huge part of it. Other than Mumbai, there will be 10 districts in, other than Mumbai, there will be 9 more locations in Maharashtra where mock drill will take place. Over 10,000 people are likely to participate in these mock drills. Civil defense has said that all the air sirens have been activated and all these citizens will be educated and informed on how to behave, what to do and what not to do in a war-like situation or a terror attack-like situation.
To take this discussion forward, we are now joined by General VP Malik, former Chief of the Indian Army. General Malik, thank you very much for joining us on the program. Let me begin by asking you, what do you think is the reason why the government is going in for these civil defense training and mock drills across the country?
Good evening, Prakshit. I think it's a very important and an essential step that has been taken by the government, because the kind of circumstances we have, the kind of tension that prevails between India and Pakistan, we can expect some preemptive from that side, as well as we have to be prepared for a retaliatory action from that side in case we take the initiative. So under both circumstances, it will be important for our citizens to realize what kind of a security environment is there, and also to take proper protective measures. Now, we have not taken any of these steps for a very long time, as you said, since 1971. And therefore, some of our drills would probably either not known to people, or they would have become rusty, even amongst the people who are supposed to organize this. So it's a good step that has been taken, both as a protective measures in case Pakistan decides to take an initiative, preemptive action, as well as in case there is a retaliation to whatever we do to them in the near future.
Right. So one would want to understand, is this because we have to get ready for war? Is a war or a full-blown conflict on the anvil, on the cards? How would you explain this to a layman, sir?
Look, it shows that there may be a war. Because after all, wars are decided by the governments, and I'm not in a position to say that, but the fact is that the circumstances today are such that both parties can take an initiative. Pakistan can take preemptive action because of what we have done already, particularly on the Indus Water Treaty. We have stopped water going into their side. That itself, people have been declaring from the other side that if this is done, it means waging a war. So they can also take a preemptive strike in case it comes to their mind. They decide to do that. And similarly, for us, we are still progressing with our actions, with our retaliatory action that we, after the horrific incident that took place in Pahalgam. And some actions we have taken, but some actions are still up our sleeve if we have to take that. And in case there is any kinetic strike from our side into Pakistan, we should also expect some retaliation from the other side. So for that also, this kind of a protective measure will be essential. So the circumstances that prevail today, strategic security-wise, between India and Pakistan, I think it's the right step to take so that we are not surprised and so that people know what to do in case some action, this kind of an action takes place from the other side.
Right. What is different about the current situation, sir? You said that there were some similar mock drills carried out during the Kargil attack and before that, but that was limited to Jammu and Kashmir. What is the difference in circumstances today which warrant such nationwide preparedness and nationwide mock drills?
You know, this time the whole approach has been quite different. We have now, India has taken the whole of the nation approach, and we have started with both political as well as diplomatic as well as economic measures against Pakistan. And we have also got ready in case there is any kinetic action required. And I think people are preparing themselves for that. So where it happens, when it happens is not known. In the meantime, there is a lot of suspense on the other side. And so is, I would say, some of our own people also. We do not know when that kinetic action is taken and where it is taken. Now, the difference is that Kargil war was a limited war, and it was kept limited because we were told not to cross the line of control. Now, it can be quite different. As you know, that we have already taken certain steps to go across the line of control during surgical strike as well as during Balakot strike. So I think people expect this will be a very strong measure this time if we take that step or take kinetic action, probably much more severe than even Balakot strike. And where it may happen or where and when it can happen, that is still to be decided by the government and the military. That is the right step to take also.
Right. But considering, sir, that India is a responsible nation in the world today, our economy is one where nations want to invest in, they want to diversify away from China, keeping our priorities in mind. And the way India has behaved in situations like this earlier in history, what do you think are the options available for India right now? When you say that the response will be stronger than Balakot, what possibly are some of the options that we're looking at?
Look, the fact is that despite all the action that we have taken earlier, and yet Pakistan continues to follow its strategy of proxy war. And the proxy war has become, I would say, from bad to worse. I'm sure everybody realizes that the action that they took, the terrorist action that they took in Pahalgam, was the most horrific that we have seen. Selecting people who have come there, asking them for their religion, and then killing them in front of their wives and children. That has, it cannot go down in any civilian, in any civilized mind, I would say. So therefore, while war is always the last resort. And I'm sure even now the government is looking at it as a last resort. But over the years, we have seen that Pakistan has not mended itself. It has continued to follow this strategy of proxy war. Perhaps we are left with no choice. So if we have to take action against Pakistan, a kinetic action, as I said, last resort for us, then, well, so be it. It has to be done that way. And there are examples, I mean, nobody wants to hurt our own economy, but then when it becomes absolutely necessary, then there is no other alternative.
Right. How do you think the Indian forces are prepared this time around? Of course, clearly, the Prime Minister in a meeting with the service chief said that you have the operational freedom to decide a response with the time and place of your choosing. Do you feel that the armed forces have been given time to prepare themselves with whatever responses that they need to keep in mind, sir?
Firstly, war is not only a military effort. War today is a national effort. So while our Prime Minister has given that kind of a statement in public also, but the fact is that if war takes place, then there will be very close coordination amongst all the elements that we have in our government. I'm talking of the diplomacy, the domestic side, the finance side. All of them will be working together under the CCS, which is headed by the Prime Minister. So it's a national effort. And as far as our strength is concerned, Parikshit, today, I think we are 10 times more than their total national comprehensive national power. We call it comprehensive national power. So today our strength is 10 times more than them. And therefore, I think we do not have to worry about our strength part. We are quite strong. And that is one of the reasons why these people have started running around and asking for the world community to check us from taking any kinetic action.
Right. I'd like to ask you about the civil defense training that is going to be taking place, the efficacy of air raid sirens, of evacuation measures, control rooms, all of that is going to be assessed. But how, in today's day and age, can we make this exercise stronger and more successful as a measure? Because civil defense teams have already existed in the country for a long time. We see them during disasters, during certain VIP arrangements. We see people wearing a yellow vest, and there's a cap as well. But how do we make sure that this is a successful exercise, keeping in mind what's happening geopolitically right now?
Oh, I think these are very important exercises that have to be done. And we have to be prepared, prepare ourselves in case of such contingency that is happening today. And therefore, as I said earlier, that when we don't do such exercises for a very long time, then people get out of practice. People did not know what to do. So I think it's an essential element, and we should keep exercising ourselves. And now that everybody has been alerted, our National Disaster Control Organization and all the states have been warned. So it will be a good thing to carry out this kind of an exercise. Incidentally, even on cyber war, for example, I'm sure all the business people on your channels, they would be realizing, and they are already taking such measure to ensure that they are not their IT is not hacked by them. All the management issues, they're not hacked on the cyber war. So this is also, cyber war also is part of this kind of civil defense that we have today. So I think it's a good thing that people have been warned and they are now getting ready for it.
Right. Would you also say finally, sir, that as a part of the civil defense training, because they would be taking inputs from the Army, Navy and the Air Force, it will be a collaborative effort when the civil defense mock drills happen. But do you feel that at some point civilians or maybe a select set of civilians must be trained to defend themselves also with arms training? We've seen that in places such as Taiwan. We've seen that in Ukraine also, for that matter. Do you feel that the current situation calls for that?
look, it's a national effort. So all organizations, part of the government, they will be taking steps, and they will be making sure that the others who are not aware of them, they follow it. They would be advised to follow it. And it's an important step. And as far as the armed forces are concerned, at the moment, their primary responsibility will be on the border or to go across the border if told. But they will help out. It's primarily a civil effort, civilian effort. And wherever the help is required, it will be given by the armed forces. So that is a collaborative effort for everybody in this respect. And it's a good thing that is happening after such a long time.
Right. Welcome move. And like you also said, it is important for people to understand what goes into securing a nation and what our armed forces have to go through as well. And it makes you realize the gravity of the situation and what we're going through as well. Thank you very much, General Malik, for joining us with that important perspective.
Thank you. Thank you.
Thank you, sir. Time for a short break here, but coming up, the Supreme Court has published the assets of judges on their website. A special discussion on the other side.
India is the most expensive market in the world, most expensive. And that's where what is the starting point for us. This rally in India has been driven by the need to find a place to hide. It is not a rally which is being driven by some kind of a beta where you are playing for the excitement of things continuing to get better from very good. That's not what is the foundation of this rally. There is going to be trade deals. Now, if trade deals really play out, which is the other side of the coin of, this being only a temporary trade war caused by humans so that someone could get a better deal. If that is the angle, then suddenly the next leg up in the market will come from people who are part of global trade or countries who benefit from global trade coming back on the table. So I think that's a nuance that one needs to kind of think through. Kind of IT services, the big view is, since we are in a headline driven market, for us in India, these are the stocks which will be the headline driven stocks, because if something goes wrong with global growth and with US growth, then this is where people will actually be finding their ways to exit or to kind of go short of the ones who can. So that top down setup isn't great.
Welcome back. You're watching News Center. 21 out of 33 Supreme Court judges made their assets public today. This comes a month after the Apex Court decided that the statement of assets of judges shall be placed in the public domain on the official website. Chief Justice Sanjeev Khanna and CJI designate Gavai are among the judges who declared their assets so far. As per the declarations, Justice Khanna has 2 houses, a car and investments worth over 3 crores. Justice KV Vishwanathan emerges as the richest judge in Supreme Court. He has disclosed investments of over 120 crores. Justice Vishwanathan had a thriving career as a senior advocate before being elevated to the Apex Court. To join us and speak about the significance of this exercise is Sandeep Parekh, Managing Partner at FinSec Law Advisors, and Supreme Court Advocate Rekha Agarwal. Thank you very much for joining us. Rekha Agarwal, how important do you think is this move in our judicial history, judges declaring their assets publicly on the Supreme Court website?
I think I welcome, personally speaking, it is a very welcome move, because it is high time that the society at large, the public at large, got some confidence in the judicial system. It is very sad that more and more judges are coming in the limelight, and for all the wrong reasons, as that happened very recently in the case of the Delhi High Court judge. So I think that when the public image has taken a beating where the judges are concerned, and more judges get accused, for corruption and other, differential treatment. I think that if the judges make though of course they have a right to privacy, every human being has got a right to privacy, and he has a right to conceal his assets, whether they're movable or immovable. But if the judges, who are basically public servants, they have an image, as in Hindi, basically Panch Parmeshwar. So in fact, a judge is like a god, when he's deciding a case. So I personally feel that this is a very good move, a very positive move. And if the public reads about this, or sees this in the media, they will realize that the judges have got nothing to conceal. They're making a clean breast of whatever they have. So why not? I think that all the judges should voluntarily come forward and disclose whatever they have.
Right. Sandeep Parekh, what would be your expectation? Now, this has happened after the Yashwant Verma controversy, where we had seen allegations of corruption in the judiciary. So here you had the Supreme Court saying that we are going to go ahead and voluntarily, every judge who is ready to declare the assets, those assets can be made public. What more needs to be done in order to have more confidence in the judiciary to ensure that things are more transparent as well?
So I think this was not done as out of the goodness of their heart or out of transparency. This was a result of the shame which came out of, bundles of cash burning and, videos of that circulating. So it's really kind of a damage control for the judges, really. In fact, there was a website all these years which remained completely blank. Not a single judge of the Supreme Court think it was important to disclose their assets. Whereas in 2002 and 2003, they asked every single, not just member of parliament, but anybody who wants to contest any election at all in India is required to find financial disclosures. So, the medicine they've been distributing to everybody about transparency, they have not been consuming at all. So I think it's only 1% of what they really need to do, if you ask me, in terms of transparency, because transparency is only the beginning. You also need accountability, and today judges have almost all the constitutional judges have no accountability in terms of what their disposals are. What are the kind of cases they're deciding? What is the process? So I think besides just personal assets, I think a lot more qualitative transparency is also required. And when I say that, I mean not just personal assets, but also, what are the disposal rates? What are they kind of doing in the job? What are the pendencies? Is it 10 years, 20 years, 30 years? I think those kind of figures will also kind of help improve the confidence of the public in the judiciary.
Right. Do you also believe that this move to reveal assets, Sandeep Parekh, should be made mandatory? It's not a voluntary exercise. When you're becoming a judge of either a high court or Supreme Court or even a trial court, your assets should be public. Then you're no longer a private individual, so to say.
Absolutely. I think it should be mandatory. And it's, in fact, the National Judicial Accountability Law, which is again and again being kind of thrown out by the Supreme Court on multiple grounds, should be brought back. And in fact, it should be part of the law itself, that transparency of assets, of criminal records, also of, all the things which they've been telling the members of parliament and people who are fighting for election should apply to them for sure. And it should not be out of the goodness of their heart. It should be because the law mandates it.
Right. Ms. Rekha, to speak to you about the second aspect, the Supreme Court has also released for the first time a list of all candidates proposed to be elevated as High Court judges since November 2022, mentioning whether the candidate is related to any sitting or retired judge of a High Court or the Supreme Court. How important this is in terms of justice delivery and disposing of petitions filed by the public and industrial houses?
Again, I would say that this is a very positive step that has been taken, because this allegation of favoritism is always there, because when High Court judges don't always get appointed by way of promotion, they can be appointed directly. So as far as this is concerned, there's always a doubt in the minds of the public that this particular judge has got appointed as a High Court judge because of his connection, because of his lineage. That uncle syndrome always remains, particularly as I've seen in Delhi. In the Delhi High Court, this allegation has always been there, and moreover, in fact, and this allegation was true to a great extent, because I myself have seen how a particular youngsters, I would say, would get appointed as judges just because so and so's father or uncle himself was a High Court judge or at a superior post. So I think that there should be transparency even where as far as direct appointment of judges to the High Court is concerned, and so that the public has more faith in the judicial system, and the judge, a particular lawyer, gets appointed as a judge only because of his caliber, not because of who he is or who she is, or because his father is a sitting judge or his father has been a sitting judge, etc. So I think that this will give more opportunity for the youngsters also, who are now hoping and aspiring that they may be elevated at some day or the other. Yes, they do also have a chance. And this misconception, or rather this fear that is always, this kind of phobia that is always there in the minds of the public at large and even lawyers at large, this can be eliminated. And slowly, I think that we could move in the direction of having a more transparent appointment system. Very recently, there has already been a controversy in the Delhi High Court about the appointment of designation of lawyers, of advocates as senior advocates. So there was probably an element of transparency was missing in that also. Now, if everything was made more transparent, I think there would be no disgruntled elements anywhere, and there would be more voluntary, positive acceptance of whatever the results are, whether it is in the appointment of advocates, a designation as senior advocates, or as judges of the High Court.
All right. Sandeep Parekh, as Rekha was also pointing out, a lot of these things about the affiliations, about the family linkages, these were things that were always known in the bar circles. Now the Supreme Court has released this list of 221 candidates, and these were approved by the Supreme Court Collegium for appointments as High Court judges between the 9th of November 2022 to 5th May 2025. Of these, 14 candidates are related to sitting or former judges of the Supreme Court or the High Court. What question does this raise actually, and how do we now go ahead in addressing this issue?
So see, I think there are much more important things which need to be done if you want to look at reforms in the judiciary. I think there's a very, very small part of it, which is, it also has false positives. And when I say that, I mean that, you may have, whole lineage of lawyers and judges in your family, and therefore, you're more inclined towards the judiciary. So I don't think by itself it kind of shows up some level of nepotism. I think there may be a little bit of nepotism for sure, but by itself it doesn't show nepotism. Like I said, I think I would be a lot more worried about disposal of cases, the pendency that we have, the non-transparency of the transfers and the elevations which occur, etc. And I hope kind of there's a whole complete relook at accountability of the judiciary that we've needed. And, as you know, we rank one of the worst countries in the world with the bottom 25 with respect to enforceability of contract. Nobody really trusts the judiciary. So I think till the time, we wake up as a nation and say that judges also need to be accountable. They're not above the law. If you find cash in a judge's, house, that person should be in jail, not be transferred to another high court. But till we get these basics right, I think, we kind of not going to improve things.
All right. Sandeep Parekh, Rekha Agarwal, thank you very much for joining us on this very important day when the Supreme Court has revealed assets of judges on their website. But clearly, much more needs to be done in terms of judicial reform and accountability. With that, we come to the end of News Center. Thank you for watching. Goodbye.
Well, the Supreme Court has had the world in a tizzy, so to speak. India Inc. and lawyers have been in a state of shock since May 2nd, when the Supreme Court rejected the 4 years ago acquisition of Bhushan Power and Steel by JSW Steel and ordered the liquidation of Bhushan Power. The court has severely pulled up all parties for flouting the bankruptcy rules. It says the resolution professional didn't adhere to the mandatory timelines, did not provide mandatory evidence of the eligibility of the bidders, especially JSW. It has pulled up the bankers, or what you call the committee of creditors, for quietly accepting the delayed payment of the upfront money by the winning bidder, that's JSW Steel. The court has also pulled up JSW Steel for revising the resolution plan with an addendum after it was approved, and for delaying the implementation, what it calls inordinately, by 2 years. The government, on its part, is currently worried that the reversing of an acquisition of a sick plant 4 years after it has been revived very successfully by the acquirer can scare away India Inc. from applying in the future for reviving bankruptcy cases. Primarily, it seems a pity that a company whose output has been doubled since its acquisition is again being sent for liquidation. That seems to have taken the entire India Inc. and the legal community and the government by a state of shock. To understand the judgment and its implications, likely future options available to the government, to the bankers and to JSW, I am being joined by a top panel. Joining me are Mr. M.S. Sahu, former chairperson of the Insolvency and Bankruptcy Board of India, one of the authors actually of the Bankruptcy Code. Actually, most of my guests are authors of the code. Behram Vakil, founder partner at AZB and Partners. Nalin Kohli, senior advocate at the Supreme Court. And Harshvardhan, a senior advisor at Bain and Company. Gentlemen, thank you very much indeed for your time. Mr. Sahu, if I may start with you, would you say that, I mean, what are your first comments on this judgment of May 2nd judgment by the Supreme Court?
Yeah, this is absolutely legally sound, but completely economically hollow. This is an economic law. It must embed both economics and law. But it has been a very fact-intensive, detailed, marked with legal precision, exposes a series of irregularities and lapses, and some of them deliberate, some collusive, and in fact, some of them that occurred after the appeal was filed. It has identified a set of people who have been responsible for this, but refrained from issuing any directions, remedial, preventive, penal action against any of them. But it has effectively penalized the company and the broader economy.
Okay, actually, I think that's very nicely summarized, perhaps the point of view which the government is coming with. But let me take it clause by clause. We are first, of course, interested in JSW itself because, they have, even if they have not put in their money, they have put in their time. They have put in money also, 19,700 crores, which will perhaps be returned by the bankers, but you won't get the interest on it. You still lose 3 years of interest on that money. So commercially, that's also questionable. Well, Behram Vakil, on that point, the winning bidder, JSW, delayed because the ED attached the assets. So do you think that the court is amiss for not looking at that point? If the ED is attached, how will they implement?
Yeah, thanks, Lata. I think that that's a very fair point, that there was some amount of justification in the delay. But I think, Dr. Sahu has been very generous. I have to be careful in my comments for the court. But I'm not sure that they, it just the balance of the three biggest violations that they found, the remedies are not in balance. They are commercially, almost I can use the word absurd. So if I quickly run through the three biggest grievances they had, 29A, I think that they could easily have sorted that out by having whoever they wanted to, whether it's the COC, whether it's the RP, whoever, do a further diligence, give a certificate if they were not happy with what was already done. Delay, I mean, again, there are to a fiscal problem, there's a fiscal remedy. You don't have this completely unpractical remedy, of unraveling, as you said, an acquisition 4 years down the road. And also, in some ways, again, with all due respect, the 2 years, arguably because of the ED, you had some justification, but the court takes 4 years. So again, it's a difficult thing to say that you are very upset with the delay. And we all know that there are solutions for delay. I don't want to get into what is the right solution, but there are solutions. If you don't receive money, the normal solution is you charge some kind of fee for the delay. And the last one was the operational creditors, where also there was concern. And again, this could have been fixed, that if you think that the split between FCs and financial and operational was not good, you could have passed an order to that respect. But this was a really drastic and strange decision.
I take your point. This is like, I flout a traffic law, I do some lane cutting or take a wrong turn. The result cannot be death sentence or, taking away my right to drive for life or something like that, which would tantamount to taking away my livelihood. It looks like the punishment is not entirely commensurate with the crime committed. But Harshvardhan, you're kind of an outsider because you're not in the legal community. So what are your thoughts? Is there any of all the faults pointed out by the court, is anything very sanguine, very serious?
Yeah, so I think as Sahu sir and Mr. Vakil has pointed out that they have laid out clear procedural violations which were either intentionally done or unintentionally done, okay? But I think between the line, there are also some serious strictures against NCLT and NCLAT. And I think I'm hopeful that one of the outcome of this is that there are some reforms to these two tribunals. I mean, we've been arguing that, they need to have higher capacity, greater capability. They deal with complicated commercial issues. So I think that I noted that also, while, it's not sort of direct, but clearly the Supreme Court has come down very heavily on some of the decisions that the appellate tribunal made, and even LCLT made. So I think that's one thing you have to really glean from the order. And so I think as an implication, as you mentioned, this would make future participants in the insolvency process very cautious. Because the remedy just, it's just not excessive in my opinion, but also in many ways impractical. I mean, you have a 25,000 crore revenue asset which is profitable that you are going to put into liquidation. Makes very little sense, to be honest, commercially.
Yes. No, for all you know, it will be bought over by somebody at perhaps double the price. But that's not the point. The point is whether, you have scared away India Inc. and therefore destroyed bankruptcy code in future cases. Nalin Kohli, what would your observations be? One of the big things is delay, which the court has, written a lot about. Who has the right to extend the effective date? And when? Is that, what does the law say and what actually happened? Is there a breach there?
Lataji, let me give an alternative point of view. First, let's look at the background. The IBC, when it came in, and Mr. Sahu has been part of that as the architect of that process. When the IBC came in, it recognized that there was a problem with the promoters and there was a problem with keeping the management in the hands of the debtors. So in effect, the IBC reverses the control into the hands of the creditors, in this case, primarily the financial institutions, which becomes the COC or the Committee of Creditors. Second, the IBC was seen to be a resolution process for recovery, not for destruction of assets. The whole idea of the IBC is that the company must be resolved finally to operationalize it as a going concern through the process, and then its resolution through a successful resolution applicant at the end of the process to keep it alive. Liquidation is putting it on the death block. which is per se not the intent of the IBC. It is finally the outcome if the resolution fails. So, I mean, these are critical, fundamental points to bear in mind.
Okay.
Let's move
Mr.
to the
Kohli,
next thing.
1 minute, sir. Sir, 1 minute. I want to ask you, what is the court's role normally? Is the court only to say legal, illegal, or does it have, is it incumbent on the court to take a holistic view of public interest?
So,
how should the court approach it?
You will have to give me the indulgence for another 2 minutes.
Sure, by all means.
It must lay down the lay of the land, and I will certainly answer what you're saying. So I made my first point, shift the control of the management from the promoters or the debtors to the creditors. The second point being resolution or its resurrection is the idea, not its death, which is what liquidation in a sense would qualify to be. The third point is to plug the loophole. There was the ordinance route which introduced 29A. And Section 29A of the IBC, in effect, made sure that a promoter cannot continue to come and take over the company in the resolution process, which means it recognizes the promoter is the problem. You have now prevented him or her from coming back and taking the company over through a haircut. So this is the broad principle. The fourth is the legal argument, is that what is the scope of an appeal? Because ultimately now we need to look at the Supreme Court judgment in terms of what was before it. So here you have a case, as I see as a lawyer practicing in the court, that the promoter's appeal has got through. The ED, which was responsible for the delay in the process, gave up its appeal in December 2024. So, I mean, I really ask myself that the impediment to the entire process for a long time was the attachment of the assets. The provisional attachments stayed by the court, but nevertheless under the threat of an attachment pending, which was why the ED was the worry, and they withdraw in December. So, I mean, in a way, if I look at it from Jindal's point of view, they've given 19,000, some 400-500 crores. The banks have taken the money. The company, as is reported publicly, has doubled its, and you said it also, from I think 2.5 million tons
to 5 million tons.
The number of employees seem to have gone some 2.5 times, from 8,000-9,000 to some 20,000, which means this is not just a healthy, but it's a growing asset. Now, at the end of it, I have to ask myself that what have we achieved? Have we undone the code? Number one, are we sending a message that irrespective of what the code and the process of the code does, finally, this process can be turned off, or that entire process can be brought to naught after 7 years? And let's not forget, Bhushan Steel is one of the 12 dirty dozen, which the RBI identified among many others. And basically, it was the first of its kind in the dirty dozen. For these companies, it was very, very new. IBC was young. The process couldn't understand the scale of what had to be done. Here you are talking of thousands of crores. And therefore, handling it, it had to be time consuming. Now, finally, the role of the courts. Now, this is critical because this will bring up the point, what are the next steps? Now, I really can't speak for what the government would decide, or the affected party being Jindal, who have invested the money in that sense and are now left with a situation where the asset is threatened under a liquidation process, or the banks. The government is as one, as the upholder of what the economic activity should be. The banks as the people who have received that money, which is ultimately public fund. And then a question will arise that ultimately whose appeal has succeeded? The appeal of the ex-promoter, whom the entire process is geared up at.
1 minute. Mr. Kohli, I should hold you on that. Actually, even the ex-promoter has not succeeded. He has only succeeded in thwarting the acquirer from acquiring, but he cannot acquire in any case. So I won't say he has succeeded, but clearly everybody has lost. In the process, the economy has lost. And actually, the court is a little upset that people are presenting them with a fait accompli, to be fair to them. You know, you're so convincing in your arguments as to the early teething troubles of the bankruptcy process. I'm surprised the court was not convinced by what you said. At least I am. But I have to take a commercial break, sir. I'm coming back and going to ask my experts, what are the options going forward? We have what we have, but now we have to try and do the best for the economy. Those questions after the break.
The impact of Pakistan's airspace closure isn't just limited to Indian airlines. Several foreign airlines are also choosing to avoid flying over Pakistan, even though the restriction officially applies only to Indian carriers. So as we have been reporting that international flights from North India are the most hit, as they now have to travel to Mumbai and Ahmedabad and then proceed to their journey. We learned from airport officials that Mumbai ATC is now handling nearly 135 more flights of Indian as well as foreign airlines ever since Pakistan closed its airspace. Many flights operated by foreign airlines like Lufthansa's Delhi-Frankfurt flight, British Airways' Delhi-London flight and Air France's Delhi-Paris flight have chosen the longer route, avoiding Pakistan airspace. There are others like Etihad's Delhi, Abu Dhabi and Oman Air's Lucknow-Muscat flight, sometimes avoiding the Pak airspace, meaning there are days when they fly over Pakistan and then there are days when they fly over Mumbai and Ahmedabad. Now, interestingly, not all foreign airlines are avoiding Pakistan airspace. American Airlines, for instance, then United Airlines, KLM, these three airlines are mostly using the Pak airspace to enter India. So why are some foreign airlines taking the longer routes, even when they are allowed to use Pakistan's?
Welcome back to Indianomics and to our discussion on the May 2nd judgment of the Supreme Court, where it held that Bhushan Power should be liquidated after it was acquired by JSW Steel 4 years ago and brought back to life, doubling its profits and revenues. So clearly, India Inc. is in a state of shock, the government is in a state of shock, and bankers and JSW are twiddling their thumbs as to how to take this forward. I have been speaking with Behram Vakil, Dr. M.S. Sahu, Nalin Kohli and Harshvardhan of Bain & Company. Gentlemen, thank you very much for your patience and for staying on. Well, Dr. Sahu, what are the options going forward? Reviews, we are told, don't succeed. But if the government were to implead itself, do you think it stands a better chance?
I think I am least concerned about this specific case or whether a process results in resolution plan or liquidation. My concern is supposing this transaction had resulted in liquidation and the Supreme Court now finds out that it has been tainted, the decision underlying the liquidation was wrongly, illegally done. Would the Supreme Court have undone this transaction? The whole issue is about the finality of the transaction, and it is not limited to insolvency and bankruptcy code. This is telling that any commercial transaction, no matter how long it has been implemented, and no matter how many layers of approvals, state approvals it has got, it remains vulnerable to being overturned ex post. And this creates the uncertainty, and no one would like to invest in a transaction which can be undone by any state agency years or decades later. So the lessons for public policy is actually there are two structural asymmetries. First is the asymmetry about the timeline. Commercial transactions require multiple parties to interact, what they need to do with urgency and coordination. IBC expects that it assigns the COC and the resolution applicant the role of decision maker, entrusts a hierarchy of adjudicating authorities, NCLT, NCLAT, and Supreme Court with approval functions, with resolution professional acting as sutradhara. This prescribes timelines for the participants, and courts have held this to be mandated. But most of the laws do not prescribe timeline for the state agencies or court, and whenever they do, these are considered to be directive.
Yes.
If the market people are required to act swiftly, on time, and bear all the consequences of the decision, penalized for the delay, why can't state agencies be subject to same time discipline?
3 cheers for that.
In this matter, the market participants, under the oversight of NCLT and resolution professional, completed the transaction in 18 months, submitted the resolution plan to NCLT.
Yes.
Thereafter, NCLT, LAT, and Supreme Court have taken 6 years.
Yes.
So market gets 18 months and it will be penalized for every mistake. And the hierarchy of agencies, layer after another, can afford to commit mistakes. NCLT can commit a mistake, NCLT will rectify, NCLT can commit mistakes, Supreme Court rectify, and Supreme Court can commit mistakes also, but it is final, not that it is right.
No,
So
I take your point. Yeah.
State agency,
Sir, yeah, the asymmetry is absolutely blinding and the consequences are very, very severe. As you put it, for JSW, it's a question of losing like thousands of crores. But for the governmental authorities, whether it is ED or whether it is the courts or the tribunals, there is no loss at all. I take your point about the longer term consequences. I'm just worried about the next steps. Mr. Kohli, that is what I want to know. Is it a review is the only option available, and is that even a hopeful option?
So, I often say as a arguing counsel that, I'm like a surgeon in a court. It's a life and death situation for the litigant. Yes. And I often say that, even if you have a 1% chance and if you don't take it, then it's as good as zero. So till a chance exists, you take a choice that I'd like to take the chance or not. So review and curative are the other chances that are there. But they have, the chance of success is limited. However, not impossible. And I'll give you a case. Take the DMRC or the Delhi Metro case and the arbitration that took place with Dample, the airport line. You had an arbitration award upheld in the 34 by the single judge of Delhi High Court, overturned by the 37 appeal by Justice Sanjeev Khanna when he was in the Delhi High Court, upheld, and then the 37 reversed. The award comes back into existence in the Supreme Court, and finally, much later, a 3-judge bench of the Honorable Supreme Court in the curative overturns the award. So therefore, people would have argued that, excuse me, there's no chance in a review and no chance in a curative. Finally, the curative changed it. So logically, this is a call that only Jindal can take, or the banks can take, or the government can take, whoever. Do they wish to file a review or not? I would give it a fair chance that they may take a shot at review. Fair chance. The second aspect is what would happen at the NCLT. That's the adjudicating authority. Because if the liquidation is kicked in, that is something that is bound to now turn the wheels there, and therefore there will be a set of litigation that has to take place. My third comment, beyond the legal process, and to build on what Mr. Sahu said, business and the wheels of economy, and also of a civilized society that runs on rule of law, is based that the rules of the game are understood and they're not going to change midstream, and therefore predictability for business environment is critical. At the end of 8 years, the outcome is successful in terms of the running of Bhushan Steel, its acquisition, it's doubling its output, people, etc., is very good. If that is changed and brought to naught, it shakes investor business confidence. So that is something which frightens people, and the litigation system is therefore will have to also, while rule of law has to be there, weigh in the consequences of the outcome.
Yeah. No, fair point, sir. I think India's ranking in ease of doing business by this single case perhaps will go down, both in terms of enforceability of contract and in terms of litigation. No two ways about that. But sir, out of time, sorry. I just want to know, Mr. Harshvardhan, God forbid if it is liquidation indeed, could it not go for higher than 19,700 crores? I mean, will the banks really lose?
We don't know. Remember, these appeals and all will take time, and in that time period, the asset would be in limbo. So I don't know when the appeals will be over, because you can't start liquidation until the appeals are over. So I don't know what that timeline would be. There is one way out of the company law, and maybe Mr. Vakil can comment, under a scheme of compromise under 230, Section 230 of company law. I don't know whether it can work here. And there is a debtor-creditor compromise, which again has to go to NCLT. I don't know whether that will work here, but I see that as also one way of probably resolving this.
Okay. Vakil, clearly ball is in your court. You think an out-of-court settlement is a way out?
I think very unlikely. I wish, but I think very unlikely. I think Dr. Sahu and Nalin have put it so well. Basically, just want to wrap up by saying this is a very severe blow to IBC. And in some ways, as Dr. Sahu said, to the M&A, situation or ecosystem in totality. If 4 years down the road, this can happen to you, then it really shakes confidence. And if you are a bidder, Lata, domestic or foreign, would you go in for this? Last two quick points. This morning itself, client came in and said, they are about to close in an IBC bidding situation. Said, I need an undertaking that if it's overturned, like what has happened in JSW, I get my money back with interest. In this case, of course, there is no interest undertaking.
Yes.
But now you can see the fear that in every transaction, people are going to ask for undertaking, give me all my money back with interest. And the last thing we have not discussed, but this unraveling, the banks coming back with 19,000 crores, the debt funds, some of them which may have expired by now, how they are going to get the money, the OCs, operational creditors, employees, state corporations, electricity boards. I mean, how can this ever work? It has not been thought through with all due respect.
Okay, fair points, gentlemen. I won't even try to summarize because you guys, you have been so evocative and vocal and convincing in your arguments. Yes, the Supreme Court has to ensure that the law is not disobeyed and taken liberties with impunity. Yes, but at what cost? The court has to take a public interest view, and let's hope that the options that are on the table in terms of review and curative petition are able to salvage the situation. That's it on this edition of Indianomics. Thanks much for watching.
The question. So as expected, when we asked these airlines, they said this is a precautionary measure keeping in mind passenger safety. There are two main concerns behind this rerouting of flights. First, since tensions continue between India and Pakistan, any sudden retaliation from either side could leave these foreign airlines stranded in the sky if they don't have enough fuel to divert to another airport. And second, in case they are forced to do an emergency landing at a Pakistani airport, then that could jeopardize the security of Indian passport holders on board the flight and lead to a risky diplomatic problem. So to prevent these unwanted consequences, some foreign airlines that we mentioned have voluntarily decided to take a longer route for Indian flights, although it will have an impact on their cost of operations.
Look, when we look out at the world, Samir, we look for partners. We don't look for preachers. Particularly preachers who don't practice at home what they preach abroad. And I think some of Europe is still struggling with that problem. Some of it is changing. So, the issue for us, I mean, in many ways, Europe, I think, has entered a certain zone of reality check. Now, whether they are able to step up to it or not, it's something we will have to see. But from our point
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty close with minor cuts, reversing yesterday's gains. Mid-caps and bank stocks see a sharper sell-off. Indian pharma stocks decline after President Trump signs an executive order to boost domestic production by fast-tracking approvals, tightens the rules for foreign producers, including an increase in fee and more frequent inspections. India proposes zero tariffs on steel, pharma and auto components on a reciprocal basis as trade negotiations with the US continue. Bloomberg reports India offered zero duty up to a certain quantity of imports. The US Treasury Secretary Scott Bessent says China tariffs are not sustainable, hints at substantial progress in the coming weeks, also says he's highly confident of clinching more deals with other trading partners. Lenders to bankrupt Bhushan Steel are likely to file a review petition after the Supreme Court scrapped JSW Steel's acquisition and ordered liquidation. The Union Banking Secretary Nagaraju says the government will finalize a decision soon. Nationwide civil defense security drill tomorrow. Such an exercise was last carried out before the Indo-Pak War of 1971. The United Nations Security Council grills Pakistan at a closed-door meeting. Members expressed concern that Pakistan's missile tests and nuclear rhetoric were escalatory, advised them to sort issues out with India bilaterally. Asset declaration of sitting Supreme Court judges made public for the first time. 21 of the 33 sitting judges, including the Chief Justice Khanna and CJI designate Gavai, have declared their assets. Advocate turned Judge Justice Vishwanathan, with investments worth over 120 crores, is the richest. The Apex Court also publishes the entire process of appointments to the High Courts and the Supreme Court on its website. Union Bank of India faces the heat for spending 7 crore rupees to buy a book authored by K.V. Subramaniam, the former executive director at the IMF. The government terminated Subramaniam's services at the IMF 6 months ahead of his schedule. Was supposed to end. All India Bank employees call for a probe into Union Bank, citing wasteful expenditure. The government issues fresh stringent guidelines for satellite internet players like Elon Musk Starlink to get a license in India. Want essential functions to be located within India, citing tensions with Pakistan. The Minister of State for Communications says satellite players will have a minuscule role compared to traditional systems. Well, let's start with the market action for the day. The Sensex and the Nifty closing with marginal losses, reversing gains that we saw yesterday. Mid-caps and bank stocks, though, did see sharper cuts today. The Nifty Bank Index was down 1%, a 640-point cut there, and the mid-cap index down over 1,000 points, so a 2% cut there on the mid-cap. Sensex closing 150 points low, and the Nifty closing flat as well. So the pain really being seen today in the bank stocks and the mid-caps. In the commodity markets, oil prices rebounded after plunging to 4-year lows in the previous session. This, as technical factors and bargain hunting spurred a recovery. Now, the earlier decline followed an OPEC Plus decision to accelerate output increases, heightening concerns over a potential supply glut amidst weakening demand due to U.S. tariffs. That has been impacting the crude oil markets. Meanwhile, gold prices surging to a 2-week high. This was driven by safe haven demand amidst Trump's tariffs and the uncertainty around Fed's upcoming meeting. Now, President Trump has signed an executive order to boost pharma manufacturing in the United States by reducing regulatory barriers. This announcement comes as a bitter pill for stocks of Indian pharma companies. On an average, top pharma companies export 40 to 50% of their medicines to the U.S. Now, speaking to reporters in the Oval Office, Trump said that he would make announcements in the coming weeks on the cost of drugs as well as on tariffs on pharmaceuticals. Take a look.
That's what it's all about, right? Very important. We're going to have a big announcement next week on some of this kind of thing, but more related to costs, the costs of medicines and drugs, because we're being ripped off, as you know, very badly, being ripped off compared to the rest of the world.
President, on the pharmaceutical side, have you made any determination on kind of what those tariff rates may look like and the timing of those
I
tariffs?
have. I'll announce it over the next 2 weeks.
Indian generic pharma companies are in the crosshairs as US President Donald Trump has signed an executive order to boost domestic drug manufacturing. The order directs the US FDA to fast-track approvals for US-based manufacturing facilities, ramp up inspections of overseas plants, and increase inspection fees for foreign drug makers. It also mandates the public disclosure of manufacturing sources for APIs and names facilities that fail to comply with the US standards. The Trump administration has called the 5 to 10-year timeline to build new US pharma manufacturing capacity unacceptable, citing national security risks from dependence on foreign supply chains. While not explicitly a disincentive to overseas manufacturing, analysts say the move is a clear attempt to accelerate US-based approvals. The larger picture is to aim to shift the balance of global pharma production. Multinational giants like J&J, Roche, Eli Lilly and Novartis have already pledged significant investments in the US manufacturing as well. The bigger threat looms in Trump's warning that pharma tariffs could be announced in the next 2 weeks. This comes even as the US government nears the conclusion of a Section 232 investigation examining the national security implications of importing drugs and APIs. Analysts believe companies like Aurobindo, Cipla, Lupin and Glenmark may be better positioned given their existing US facilities, but one really needs to see the cost in terms of manufacturing eventually as well. Those with a stronger branded portfolio, for example, Ajanta Pharma, Torrent, Alchem, could also weather the shift, according to analysts. However, uncertainty around tariffs is expected to keep valuations under pressure, at least in the near term.
All right, Ektan, we haven't heard the last from President Trump on the issue of pharma tariffs. U.S. Treasury Secretary Scott Bessent has said that many trading partners have approached the U.S. with very good trade deals, and some could be done as early as this week. Speaking to CNBC on the sidelines of the Milken conference, Bessent reiterated that China tariffs are not sustainable, but also clarified that both sides have not been talking yet. Take a look.
I think we're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week. So when you think about uncertainty, uncertainty, a lot of it is generated by, I have asymmetric knowledge, so I'm not uncertain because I think it's going well. Other people don't know what I know. So
you have to share that with us then.
Well, I can say that I am highly confident that we have 18 important trading partners. We'll put China to the side. The 17 other partners, many of them have approached us with the very good trade proposals.
Well, that is the U.S. Treasury Secretary Scott Bessent. But speaking of uncertainty, auto major Ford, which did beat Wall Street expectations in Q1, has suspended its guidance for 2025 amidst a possible $2.5 billion impact on account of President Trump's tariffs. Ford cited that near-term risk in the supply chain was also one of the reasons for pulling its guidance. The automaker expects to offset $1 billion of those costs via remediation actions. Now, as India and the U.S. negotiate a bilateral trade agreement, India has reportedly offered zero tariffs on auto parts, steel and pharmaceuticals. According to a Bloomberg report, India proposed this on a reciprocal basis, but for a specific import quantity. Now, import of goods beyond the specified threshold, which is, of course, finally agreed on, could attract the regular level of duties. Of course, this is source-based information. The Indian government has issued fresh stringent guidelines for satellite internet players like Elon Musk's Starlink to get a license. The telecom department issued new security parameters mandating essential functions to be located within India, citing tensions with Pakistan. These include the ability to intercept communications and monitor user activity. The Minister of State for Communications, Chandrasekhar Premasani, says satellite players will have a minuscule role compared to traditional systems. Remember, Reliance Jio and Bharti Airtel recently announced tie-ups with Starlink to bring its services to India, subject to government approval.
Starlink, all these international ones, have a very minuscule role in connectivity compared to what the traditional systems that we have. As I said, around the world, Starlink only has less than 50 lakh connections. Okay, and it is mainly, the speed is much lower. Third, it's quite expensive, both for installation as well as monthly payment. This is mainly for maritime, people who are really remote, where traditional networks cannot reach. So I would not give that much importance to those things at this time.
Well, that's the Minister of State for Communications. Now, lenders to bankrupt Bhushan Steel are likely to file a review petition after the Supreme Court scrapped JSW Steel's acquisition and ordered the liquidation of the company. Banking Secretary Nagaraju has said that the government will finalize the decision soon. Sapna standing by with details. Sapna, take us through what is being assessed at this point in time in terms of the impact and the possible way forward that the government could take.
Well, we're given to understand from sources that most likely Punjab National Bank and State Bank of India are going to file a review petition in the Supreme Court on the JSW order. Having said that, probably there's a consensus among lenders to follow this route in the coming days. Of course, earlier on, the DFS Secretary himself, Mr. Nagaraju, was very clear that the matter has been discussed with the lenders. The government has studied the judgment and a position has been taken after consulting their advocates. And probably in the coming days, a plan will be finalized soon, or as to how they plan to approach the judgment and what the legal options are. That's the position as of now. Most likely this week is going to be devoted in terms of understanding the pros and cons, and maybe from the next week onwards or the coming week onwards, some action is likely that can unfold. But having said that, down the line, it may also be possible that, a larger policy review may be required in terms of the NCLT's efficacy, the questions raised by the Supreme Court order, what happens to the IBC process, what happens to the timelines, all of that. But maybe for that, we'll have to wait a bit more. Down the line, that could be a possible as a proper serious 360-degree policy review on the IBC and the NCLT and the cases. But as of now, it's the most likely, it's the review petition route for the banks.
Discussions are going on since the time the order came out. And the plan is yet to be finalized, and all the options are being discussed, and those options are on the table. Maybe in a couple of days, the action plan will be finalized. But having said that, from IOB side, what I have to say is that the 760 crores we did get, and in the worst case scenario, even if we are supposed to refund it, I have to say that we are having sufficient cushion in the balance sheet, and this can be handled it can be handled very efficiently without creating any adverse impact on the balance sheet.
Well, that's the latest there in the JSW matter. A review petition is likely to be moved. Now, a nationwide drill exercise will be conducted tomorrow to strengthen civil defense preparedness. Now, the drills will be conducted in 244 districts across states and union territories. And this comes at a time when tensions between India and Pakistan have been rising after the terror attack in Pahalgam. These are the first such drills to be carried out in over 50 years. Such an exercise was last carried out before the Indo-Pak War of 1971. The government's order to states makes no explicit reference to tensions with Pakistan. The primary object of such exercises are to strengthen defense preparedness among civilians. My colleague Arunima joins us from New Delhi. Arunima, take us through what we can expect through this drill tomorrow.
There are four main points on which the focus is currently in this mock drill. Number one, the air siren. If the Indian Air Force identifies that there is a threat from the air to any district, then the air siren will be sounded off, and the civil defense volunteers will then ensure that the civilians take cover. Second will be blackout siren. Blackout siren would mean power cut. So if you are in a forward area and your civil defense volunteers have asked you to prepare for a blackout siren, prepare to have candles or matchsticks or torch which enough battery power around you so that you can navigate this phase when blackout is announced. Third thing is, again, if you are in a forward area, you might have to prepare an emergency kit because possibility of evacuation to a community bunker might arise. So there are a number of forward areas. For example, in Rajasthan, Jaisalmer, Barmer. In Punjab, there's Amritsar. In Jammu and Kashmir, there's Uri, Arnia. In Gujarat also, there are forward areas in Kutch. If you are in any of these areas, prepare an emergency kit. If you have a child or a baby, have dry baby food, a sanitary kit for women, essential medicines, etc., and some cash to be carried immediately when you are being evacuated. Fourth, if you are living near a vital installation, a defense installation or a nuclear installation, your civil defense volunteer and your district administration might prepare you in a different way to take cover. All of these will be part of the drill that is carried out from 7th of May. What the government is saying is do not panic. This drill does not mean we are going to war, but it does mean that we are preparing our civilians for any eventuality since they are not aware of any war-like situation since 1971.
All right, many thanks, Arunima, for joining us. As Arunima was pointing out, not to create panic, but to be prepared for any eventuality. Santhya joins us now from outside Mumbai's Chhatrapati Shivaji Maharaj terminus. Santhya, take us through what we can expect in Mumbai tomorrow. What kind of planning is being put in place?
So, Shireen, as you mentioned, we are standing outside Chhatrapati Shivaji Maharaj Terminal in Mumbai. It's a key location and one of the locations which was targeted during 26/11 attack. From 1993 bomb blast to 26/11 terror attack, Mumbai has faced multiple terror attacks over the years. That's why there'll be special focus on the city. Mumbai is a city which anyway by default remains on high alert, will witness special readiness by the forces. Maharashtra Civil Defense Department has claimed that all the agencies, including civil defense, is prepared to face any situation, any scenario. Tomorrow, if we talk about Mumbai, strategic locations will be focused on by the agencies, civil defense agencies, fire department agencies. Of course, Mumbai police will be a huge part of it. Other than Mumbai, there will be 10 districts in, other than Mumbai, there will be 9 more locations in Maharashtra where mock drill will take place. Shireen, over 10,000 people are likely to participate in these mock drills. Civil defense has said that all the air sirens have been activated and all these citizens will be educated and informed on how to behave, what to do and what not to do in a war-like situation or a terror attack like situation. The idea here is to ensure that everybody is ready and prepared and not to create any kind of panic. Coastal areas in Maharashtra will witness special focus. We all remember how the coastal area sea was used during 26/11, so coastal areas will witness special focus. Other than that, whether it's the railway station part of mock drill, your metro stations, your bus stations, your schools and colleges, there also targeted mock drills will take place. All the air sirens have been activated. Coastal belt, southern Konkan and North Konkan, both these regions will be focused on by the agencies. And tomorrow, along with 200, across nation, 244 districts will witness mock drills, and 10 districts of Maharashtra will be a part of that list. Shireen.
Santya, many thanks for joining us. So that is the situation in Mumbai. Back to the markets. Ather Energy made a debut on the Lal Street today. Shares listed at a premium of 2% over its IPO price, but then fell by about 6% later. The company's CEO Tarun Mehta told CNBC-TV18 he remains bullish on the company's near-term growth prospects.
We are extremely bullish about the near-term growth because of distribution, because of how Rista, our new family scooter, is landing in the market, and generally how well the India premiumization story is really taking off, where Ather really plays in the center of it. Overall, I think both margins and volume and market share, all three should trend really well this year. I am personally definitely expecting an even better trajectory than what we saw in FY25.
Well, that's Ather Energy. Now, shares of Housing Development Corporation slipped in trade today. This comes after the company's board approved raising 2,190 crore rupees. The base issue size of the fundraise is 500 crores, and the remaining amount includes a green shoe option of 1,690 crore rupees. Earnings. Polycab reported strong numbers in Q4, beating street estimates on all fronts. Net profit up 33%, revenue jumped 25% on an annual basis. Margins expanded by 110 basis points from last year to 14.7%. And staying with earnings, Bank of Baroda reporting a weak set of numbers for Q4. The bank's net interest income dropped over 6% on an annual basis. The bank's net interest margin slipped to a 14-quarter low to 2.86%. Asset quality narrowed marginally on a sequential basis. Union Bank of India is facing the heat for spending 7 crore rupees to buy a book authored by K.V. Subramanian, the former executive director at the IMF. The government terminated Subramanian's services at the IMF 6 months before his tenure was supposed to end. Now, the All India Bank employees has called for a probe into Union Bank, citing wasteful expenditure. Ritu joins us now with more. Ritu, what does this mean for the bank now?
Well, Shireen, no good for the bank. And as you said, Union Bank is facing heat for spending a staggering 7.25 crores on buying nearly 2 lakh copies of former Chief Economic Advisor Krishnamurthy Subramanian's book, India at 100, even before the book had hit the shelves in August last year. Now, this has raised eyebrows, especially in light of the government prematurely terminating his term as the executive director at the IMF recently, with reports even suggesting some alleged impropriety, including the promotion of this very book as a potential reason for his abrupt departure. Now, an internal memo from Union Bank of India, which we have accessed, shows that the bulk order was placed in June or July of last year, with the bank buying nearly 2 lakh copies of this book. And this memo cited, and I quote, the desire of the top management as the reason for the purchase, calling the book invaluable for anyone interested in the rise of India's economy, and stated the bank wished to distribute copies of this book to its customers and to corporates, supposedly to tap into future business opportunities. And it gets even more bizarre because the bank said it also intended to widely distribute these books to schools, colleges, libraries across the country to showcase India's potential as an economic leader. The advance payments, though, for this book were made through this, vague category labeled miscellaneous under the bank's revenue budget. Now, our sources indicate some of the senior bank management did raise concerns over this internally in the bank's December board meeting, following which Union Bank brought in KPMG to examine the matter. But so far, the only visible action appears to be the suspension of a general manager who merely oversaw the support services department. In the meanwhile, All India Bank Employees Association has also now called for an official investigation into this issue, branding that spending as wasteful expenditure and questioning the benefits Union Bank achieved by spending crores of rupees to buy a book.
All right, Ritu, many thanks for joining us. Now, electronic giant LG will set up a manufacturing plant in Sri City in Andhra Pradesh with an investment of 5,000 crore rupees. According to Money Control, the facility will manufacture refrigerators, air conditioners and washing machines. It will also produce components like compressors, motor compressor and a heat exchanger manufacturing facility. Production is expected to begin by December 2026 and the plant is expected to create nearly 1,500 direct jobs and 10,000 indirect jobs. We will head into a break, but up next, 21 sitting Supreme Court judges disclose their assets to the public for the very first time. That and more when we return.
If we are to develop a partnership, there has to be some understanding, there has to be some sensitivity, there has to be a mutuality of interest, and there has to be a realization of how the world works. And I think these are all work in progress to differing degrees with different parts of Europe. So some have moved further, some a little bit less.
In international news, Israeli forces have stepped up their offensive in Gaza. At least 54 people were killed in the enclave yesterday. Israeli forces have also attacked parts of Yemen, Lebanon and Syria. Prime Minister Netanyahu said that more than 2 million people in Gaza will be moved into a new ground offensive after Israel's total blockade completes 65 days. The Hamas-run Gaza Health Ministry has said that hospitals are just 48 hours from collapsing and lives of thousands are at risk. From one war-torn region to another, Russian officials have said that Ukrainian forces launched drones at Moscow for the second night in a row, forcing the closure of 3 major airports in the capital. Officials claim that 19 drones approached Moscow and its debris post-interception fell on a key highway. Ukrainian forces also attacked a power substation in Russia's western Kursk region, injuring 2 people and destroying 2 transformers. Ukrainian commander-in-chief said that the Kursk offensive had achieved most of its goals. U.S. Defense Secretary Pete Hegseth has ordered 20% cut in senior ranks of the military. He's also ordered a 10% reduction in the number of general and flag officers. According to the U.S. Department of Defense data, the U.S. military had 38 4-star generals or admirals as of the 31st of March 2025. American food delivery platform DoorDash will acquire British rival Deliveroo for nearly $4 billion. DoorDash will acquire a stake in the company at 180 pence per share. That marks a 44% premium to Deliveroo's previous closing price. This will boost DoorDash's international expansion plans. Now back home, 21 sitting Supreme Court judges have disclosed their assets to the public for the first time. These include Chief Justice Khanna and Chief Justice Designate Gavai. Ashmit standing by with the details. Ashmit, this is pretty historic. Take us through the asset declaration by the judges and the significance of this move.
Well, let's begin with the significance. Quite important, this landmark judgment coming at a time that there was increased scrutiny and outcry against judicial appointments on 2 counts. One, of course, the Justice Verma incident of cash being found in gunny bags at the residence, his Delhi residence. The other, of course, is questions being raised by the executive over the judiciary crossing the Lakshman Rekha and then dictating terms to the legislature and the executives. On both these counts, the mantra that the CJI, Justice Khanna, appears to be going with is that sunlight is the best disinfectant. Let's disclose all, let's share those details. Now, as a result of that, for the very first time, we have as many as 21 of sitting 33 judges disclosing their assets and investments as a part of the Supreme Court website. There was a Supreme Court website release as well, which the press release said that there'll be, in fact, more disclosures going ahead as the judges bring on board their data about their assets. Now, what's important is that as many as all 5 judges, top 5 judges of the Supreme Court, including the CJI, as well as the CJI designate, have revealed their data. As far as Justice Khanna is concerned, he's revealed 200 houses, investments of 3.38 crore rupees, and one Maruti Swift. As far as Justice CJI designate Justice Gawai, well, he's mentioned that he has as many as 3 houses, 2 in Maharashtra, 1 in Delhi, 3 land parcels, all of them in Maharashtra, investments of about 1.15 crore rupees. Justice K.V. Vishwanath, a distinguished lawyer till very recently, was elevated in 2023, has come across as the most affluent of the judges. He's come in with investments of 120 crore rupees, has 4 houses and paid as much as 91 crore rupees in taxes in 15 years, ending with FY25. That's not all. There were also questions that the Supreme Court has tried to answer in terms of how judges are appointed. Very detailed procedures have been listed out on the Supreme Court website, disclosing the number of judges that have been recommended by the collegium, the parameters on which they're assessed, including the parameters of how many pro-government or pro-tax department judgments have been authored by a particular judge. All these parameters listed out in the hope that as Justice Khanna gets ready to leave, he's retiring shortly in this month itself, as he gets ready to leave, perhaps this exercise and disclosure will restore some confidence back in the judiciary, back in the tallest judges of the country.
All right, Ashmit, appreciate you joining us. That's the big story there coming in from the Supreme Court. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. For now, from all of us, thanks very much for watching.
राष्ट्र के रूप
Hello and welcome to Startup Street. I'm Arundhati Ramanan and joining me from Bangalore studio is Ritu Singh. These are the top headlines from the startup world.
5, 4, 3,
Ather Energy makes a tepid debut on the Lal Street. Shares list at a premium of 2% over its IPO price, but ends with cuts, the management tells CNBC-TV18. Ather Energy remains bullish on near-term growth.
Struct, a skincare brand, records double-digit EBITDA positivity with a 10 times growth in revenue in FY25, achieving annualized net revenue of 200 crore rupees. The D2C startup now targets 500 crore rupees annualized net revenue by FY26.
Celsius Logistics secures 250 crore rupees in a round co-led by Eurozeo and Omnivore to expand its cold chain network to 1,000 cities and enhance its tech platform, with plans to scale operations, including its rider fleet, while focusing on climate-resilient logistics.
Gut health startup The Good Bug raises 100 crore rupees in a new funding round that was led by Suskena Asia VC with participation from existing investor Fireside Ventures. This fresh capital will be used to accelerate its research and development efforts.
Government issues fresh stringent guidelines for satellite internet players like Elon Musk's Starlink to get a license in India. Wants essential functions to be located within India, citing tensions with Pakistan. Minister of State for Communications says satellite players will have a minuscule role compared to traditional systems.
OpenAI is set to buy artificial intelligence-assisted coding tool Windsurf for about $3 billion as per a Bloomberg report, thus making this deal OpenAI's largest acquisition to date, and that will complement ChatGPT's coding capabilities.
Swiggy exits private label business by entering into a strategic agreement with food service platform Cuisina for the exclusive license of its digital-first food brands. This comes a day after Money Control reports that Swiggy ends its hyperlocal delivery service, Genie. Those were the headlines that we're tracking for you this evening. But on what's brewing today, Celsius Logistics has raised 250 crore rupees in an oversubscribed Series B round. The round, which was a mix of equity and debt, was led by Eurozeo and Omnivore, with continued support from existing backers like IVCap Ventures and key debt partners, including Trifecta Capital and Black Soil. The funding will power Celsius's expansion into over 1,000 cities, strengthen its technology platform, and scale its growing presence in critical sectors like pharmaceuticals and food logistics. Joining me now to discuss this further, Swaroop Bose, the founder and CEO of Celsius Logistics. Swaroop, thank you so much for taking time out and being here with us on Startup Street. You know, you are addressing this big gap in India's cold chain industry, right? So if you could take us through what you have on offer and the kind of efficiencies that you're bringing in for your clients and the sectors that you're currently focused on.
Thanks for having me here. And it's been a big day for us after announcing our fundraise and closing our Series B. With the new investors, Eurozeo, Omnivore, and existing IVCap coming in, we have been building a cold supply chain network across India for the past 4 years. Now, we are concentrating on segments like pharmaceutical, dairy, F&B, quick commerce, e-commerce. In fact, we have started working with new age brands, which are smaller startups. They are the small companies that are trying to scale up across different cities. We have been working with them, creating a smaller logistics network for them. And this year, we are concentrating heavily on this, whether it be the new age business or the pharmaceutical or creating a railway network for our entire supply chain. Celsius is very aggressive on our expansion plans across 1,000 cities by this year end.
Right. So very aggressive on your expansion plans. If you could sort of, break down how the 250 crore rupees that you've raised will be allocated across your core areas like technology expansion and cold storage infrastructure.
So most of our money does go into the technology expansion. We have been creating our own business platform, our own transport management software, warehouse management software. These are dedicated directly to the cold chain. These are one of a kind, which is handling the entire cold supply chain on our platform. We also use the money to expand into more warehousing, more cold chain touch points. We onboard more vehicles. We go to other cities, tier 3, tier 4 cities, and we make sure that we create a cold chain network where our clients can then step in.
Right. And, how does Celsius Logistics, you said one of your big plans is to aggressively scale and reach 1,000 cities, right? If you could sort of tell us what your current presence is and what challenges do you anticipate in expanding to, less penetrated or rural markets?
Today, we are in more than 600 cities. It has taken us 4 years to reach that scale. And now we are looking at 1,000 cities where we are expanding into places like Siliguri, Guwahati, Kashmir. We are looking at going into Visakhapatnam. So you see our expansion is pretty much even across India. The biggest challenge that we face is getting the right partners in such areas who can then grow with us. We always expect a local partner to tie up with us, help us with the assets, and then we take over the management of the entire asset. But we have been very blessed to get the right kind of partners across India. People are very confident now that we have stepped in about investing in cold chain, which has helped us to scale up to here.
Right. So meeting the right partners is essential there in your expansion plan. Now, let's get into numbers then, right? With a reported 2.5 times year-on-year top-line growth since 2021, what are your revenue targets over the next 2 years? What are you currently clocking? And what segments do you expect to drive the most growth?
We are currently clocking about 300 crores in ARR. We are hoping to continue our 2.5x growth over the next couple of years. The segments that keep giving us more and more revenues are our transport division, which is our oldest division. Pharmaceutical is something that we are betting on huge this year. We started pharma division only about 5 months back, but we are getting a lot of positive response from the market. And you will see a lot of news coming out of Celsius this year when it comes to the pharmaceutical division. And the new age division, which is working with the new age brands, the startups, the smaller entrepreneurs, that division is also seeing a lot of growth. That's our D2C Connect, where Celsius will be connecting directly with the consumers for the businesses which want to expand. So these divisions, we are expecting that a lot of revenue will be generated, and obviously quick commerce. One of our biggest play in the market is quick commerce today, where we are working with companies like Zepto, we are working with Zomato, Blinkit. We are hoping to expand that network. We are hoping to onboard a few new clients who are just entering the quick commerce market. So overall, all these divisions together will be fueling our growth.
Right, absolutely. And you were talking about a pharmaceutical sector, which you just launched about 5 months back, right? So what strategic steps is Celsius taking to deepen its presence in the pharmaceutical logistics sector? And how does it plan to meet the stringent compliance and safety standards that are required for transporting critical medical supplies? Also, any other new sectors on the radar?
Celsius was formed in the middle of the COVID pandemic. In fact, the first transport we ever did was vaccine. So we have been very conscious about the SOPs and the IOPs required by the pharma divisions. We have not touched the pharma divisions in our first 4 years because we were building up the systems to meet the strict compliance that you're talking about. We, in fact, wanted to get ready, make sure that the compliances are in place, and then enter the pharmaceutical division. Today, we have created a very big team of pharma sales and operations who have been trained. Our software has been upgraded to accommodate whatever the pharmaceutical divisions need, and that is what we are launching in the market as a pharma division. So we are looking forward to a lot of interaction with the pharmaceutical companies and hoping to align our services to them.
Right. And with increasing investor focus on climate resilience and sustainable infrastructure, how do you plan to evolve your technology and operations to align with decarbonization goals and energy efficiency mandates?
See, the company by itself is a sustainable company. We are working in food preservation, food security, food safety. We are looking at creating smaller entrepreneurs in our transportation program. Going ahead, we are looking to adopt a complete EV solution in our last mile, which is across India. We are handling last mile in more than 50 cities across India. And we are hoping to completely turn that over into an EV kind of infrastructure. We are just waiting for a few tie-ups, a few technology to catch up so that we can launch that. On top of that, whenever we are opening a new cold storage, now we are doing that across India with a lot of partners. Our first bet is always solar. We always push that cold storage has to be solar oriented. We make sure that the compliances are in place. And with every step that we take, we are always looking at sustainability. The whole company drives around the idea that we have to create a sustainable future.
All right. And if before I let you go, if you could sort of point out to us what the key goals for this year will be for Celsius going forward, and what are the targets you hope to hit?
One of the key goals is, like we announced, 1,000 cities. Now, the idea behind the 1,000 cities is not just to blindly expand into it. The idea is that we open up the market, we open up the cities to many more brands that can then cater to these cities. They can sell their products there. We can have a supply chain. These cities open up a whole revenue market, not just for us, but for our brands. Even the larger brands in India today are not able to penetrate into the rural market simply because there's no supply chain system to hold it. This is a perishable industry. Making sure that the temperature controlled products do not go to waste, they are used properly, they are kept properly, is a big challenge which Celsius is answering. So our focus always has been to make sure that our clients get the best service, and we are able to expand into markets which were untouched before. That's driving our growth now.
All right, Swaroop, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best going forward.
Thank you so much.
All right, we'll move on to what else is brewing today, and that is Stimula, which is a voice-first AI tutor for English as a second language users, and they've raised $3.75 million in a pre-Series A funding round that was led by Lightspeed, SWC Global, and other investors as well. Now, these funds will be used by the company to scale their in-house AI infrastructure, grow their technical team, and accelerate user acquisition, which is aimed at increasing monetization by over 5 times in the next 12 to 18 months. Now, founded in 2022, the platform claims to have more than 4 million app installs, which is a 5-fold increase in the past year, and has more than 45,000 paying users across Android and iOS. On that note, let me invite Akshay Akash, who is the CEO of Stimula, for more on the company's fundraising and their plans ahead. Akshay, welcome to Startup Street, and thank you very much for your time here today. Before we get to that funding round, briefly tell us about Stimula and the market gap that you saw, which you're solving for, and why the Square focus only on the English language.
Hi, super nice to be here. I think I have seen quite a few episodes of the series, and it's great to be here. Honestly, in terms of what we are trying to do at Stimula, Stimula is a voice AI mobile app, which, as you say, helps English as a second language speakers improve their conversational skills. And the reason we focus on English as such is because English is very different when compared to other languages like Spanish or French, etc. Right? So when you are learning a Spanish or a French, it's okay to learn the language as a hobby or learn just words in there, just vocabulary in there. But English is always linked to career and job. So you need to actually speak English fluently to get the outcomes of learning the language. And we believe that there's a wide gap in the market where you don't really have a solution which can help you improve your speaking skills particularly. And I think that's the right for Stimula to exist today.
Okay, Len, let's get to that fundraising. $3.75 million in your pre-Series A round. How exactly are you going to deploy this for growth? And, how will you ensure that you achieve this kind of monetization?
I think primarily, we believe we are an AI-first company. We started like a year back, and all of us have sort of grown into this world. And we started in college, so this is our first job outside college. So I think we are very, very clear that we want to build an extremely high-density talent team. We have a team of 9 people today, including the 4 founders. So one of the major goals for us is hire 5 to 6 engineers over the next year and maintain the talent density out there. Then the next goal for us, second goal for us is on the AI infra side, invest in GPUs, invest in stuff. So we are very clear that we want to own our in-house AI stuff. So we want to own our models, we want to own our infrastructure, and we just don't want to be a consumer of AI, but we want to make sure that all the tools we are using, all the architecture we are using, we are controlling that and we are building a differentiation over that. And I think finally just growing the distribution network. So most of our distribution today happens via TikTok. And I know it's banned in India, but most of our user base is outside India, in Latin America and Indonesia. So just expanding the TikTok network.
But what we wanted to understand, what will really aid this 5x growth in monetization, which is currently at 45,000 of your total user base. And also the majority of your paying user base today comes from outside of India. Is that correct?
Yes, most of our users come from Latin America, which is Mexico, Colombia, etc., followed by Indonesia, followed by India. In terms of what will aid, it's primarily product development. I think Stimula is by far the best product in the world today when it comes to this huge need of speaking English fluently. I think over 1 billion people need that. So it's just about getting the product better, making sure that the product is even better than all the other competitors combined, and then sort of just increasing the distribution capability so that more and more people know about it. So I think this is more of an awareness problem alongside sort of just making sure that the product is continuously getting better every day. As long as we are able to do those things, I think the product will definitely grow.
All right. Which are the markets that you anticipate are going to be the fastest growing for you? Whether that is India, Latin America, Southeast Asia, and which regions are going to drive that next leg of growth for the company? Will there also be new markets that you're looking to enter?
I think we are very clear today that LATAM and Indonesia are our 2 priority markets. I think we have a sizable presence in these 2 markets. So it's just making sure that we are number 1 in those markets and that's just growing our positions. That being said, India is also a huge market for us, and we're also running experiments in other parallel geographies like EU or Middle East, just to see if the need is really strong here, because it's a global problem, like almost every single country. So our 45,000 paying users today come from 175 different countries. So which means that like there's a need in every single country. It's just about focusing. And for us today, the focus is LATAM and Indonesia, by just making sure that we are still continuing experiments in different countries.
Okay, and a quick word on your business model as well. What kind of average revenue per user are you generating across these paying users you have? And what sort of top line and bottom line is the company currently clocking?
So we are over $1 million in top line currently, but it's very early numbers today. But in terms of like how much we charge, differs a lot country by country because of the diverse user base. I think roughly we get $16 to $20 on an average across our user base on Android and iOS.
All right, and finally, Akshay, just to confirm, I know you spoke about why English, but to diversify. In the future, do you have plans of foraying into other languages? And what sort of diversification plans do you have in the medium to long run? On one hand, you have, of course, AI, generative AI, that can help users learn languages better than before. And then you, of course, have established players like Duolingo and so on that are also catering to the same market. So do you have longer-term diversification plans for the company?
I think immediately no. We want to make sure that we are the #1 player in English. English drives 70% of language learning revenue. So I think that's the biggest market. That being said, if we are able to solve that playbook for English, it's very easy for us to expand to any other languages we want to. But if you talk about next 3 to 4 years, geographical distribution and making sure we are #1 in our target geographies, that's more important for us compared to expanding languages.
All right, so the focus will remain squarely on English. Thanks very much, Akshay, for your time here today. It's been a pleasure speaking with you. Thank you.
Thank you so much.
On that note, it is time for us to head into a short break. But coming up next, RestroWorks unveils the Restro Next CX Suite at the NRAI Food Delivery Summit 2025, aiming to transform restaurant customer experiences. What does this mean for the industry? We find out on the other side. Stay tuned.
स्वरूप की सुरक्षा हमारे वीर सैनिकों ने हमेशा की है। तो वहीं पर दूसरी तरफ भारत के आध्यात्मिक स्वरूप की रक्षा हमारे ऋषियों और मनीषियों ने की। जहां एक तरफ हमारे सैनिक रणभूमि में लड़ते हैं, वहीं दूसरी तरफ हमारे संत जीवन भूमि में लड़ते हैं। साथियों, एक रक्षा मंत्री के रूप में मेरा दायित्व है कि मैं अपने सैनिकों के साथ मिलकर देश की सीमाओं की सुरक्षा सुनिश्चित करूं। और मेरा यह दायित्व है कि अपनी सेना के साथ मिलकर देश के ऊपर आंख उठाने वालों को मुंहतोड़ जवाब दूं।
Welcome back. You're watching Startup Street. Now, Ather Energy made a tepid debut on Dalal Street. The shares listed at a premium of over 2% over its IPO price, but they fell by about 6% later in the day. The company's CEO, Tarun Mehta, told CNBC-TV18 he still remains bullish on their near-term growth.
We are extremely bullish about the near-term growth because of distribution, because of how Rista, a new family scooter, is landing in the market, and generally how well the India premiumization story is really taking off, where Ather really plays in the center of it. Overall, I think both margins and volume and market share, all three should trend really well this year. I am personally definitely expecting an even better trajectory than what we saw in FY25.
The Indian government has issued fresh, stringent guidelines for satellite internet players like Elon Musk's Starlink to get a license. The telecom department issued new security parameters mandating essential functions to be located within India, citing tensions with Pakistan. These include ability to intercept communications and monitor user activity. Minister of State for Communications Chandrasekhar Pemasani says satellite players will have a minuscule role compared to traditional systems. Reliance Jio and Bharti Airtel recently announced tie-ups with Starlink to bring its services to India, subject government approval.
The global news that we're tracking for you today on Startup Street: American food delivery platform DoorDash will acquire British rival Deliveroo for nearly $4 billion. DoorDash says it will acquire a stake in the company at 180 pence per share. That marks a 44% premium to Deliveroo's previous closing price. This is going to boost DoorDash's international expansion plans. But back home in India, 197 Communications, which is Paytm's parent company, reported losses which widened, a net loss of 544.6 crore rupees for the quarter. The company also reported a net loss despite its other income increasing by nearly 100 crore rupees from last year to 223 crore rupees a share. The reason for the loss, of course, is an exceptional one-time item that included the ESOP cost that the company had to account for in the quarter. Paytm had reported another income of 131.7 crores in the base quarter. It reports an exceptional loss, like I said, of 522 crore rupees.
At the NRAI Food Delivery Summit 2025, restaurant tech firm RestroWorks unveiled the RestroNext CX Suite, and a new all-in-one customer experience platform designed to modernize how restaurants serve guests. For more on the launch and what it means for the industry, Aishwarya Anand caught up with RestroWorks co-founder and CEO Ashish Tulsian. Take a look.
That your food could order itself? Well, the future of dining is here, and it's smarter, faster, and completely in your hands. We are coming to you straight from NRAI Food Delivery Summit 2025, where restaurant tech got a massive upgrade. RestroWorks, the brains behind restaurant tech for brands such as Nando's and Taco Bell, has launched RestroNext CX Suite, an all-in-one platform which will redefine how you order, eat, and repeat. From self-order kiosks to custom inbuilt apps, this is built for speed, control, and no middlemen. Well, let's check it out and see how it works.
RestroNext, with our CX Suite, we are aiming to empower restaurants not to just fit in one mold, that this is how your menu is going to look like, it is going to be straight, but how can you customize your experience for your patrons, for your customers, in such a way that it's unique and yet quite usable.
Can restaurants fully customize the user interface and ordering flows using the app?
Almost. I mean, so there is a method to the madness. At the end of the day, today Swiggy and Zomato have really created a great, I would say, a do-it-yourself culture where every consumer is willing to pull out their phone and, do the order themselves, right? So if you take it really far away from that, it's going to be trouble. So we still feel that that's the benchmark. But yes, restaurant owners can customize almost every other living element without fiddling too much with the flow.
All right. And what will be the average implementation time when the entire suite goes live?
Oh, well, we are scarily fast on that. And I think this sounds like a brag, but, for example, we are at NRAI right now, and, there are 7 brands who are displaying who are doing their food here. 4 of them are not even our customers, but we were able to set it up for them in few hours. So our implementation timeline for new customers is less than 72 hours for the entire sign-up to deployment of the suite.
Give us a sense of how many customers do you currently have, and of that, what percentage have you already onboarded for this, and how many have shown interest?
Oh, well, we currently work with 23,000 plus locations across the world, but the suite is just launched. We are already live with Taco Bell and Subway, 2 iconic brands in India. We are live with a lot of Middle Eastern brands and a few brands in the US. Still early days. I think from our overall estate, less than 1,000 stores are live on the CX suite, but I think 2025 and 26, we want to achieve almost 80% coverage within our customer base.
I also want to understand that how are you ensuring profitability? While eliminating third-party aggregator dependency for, your restaurant partners. How does that work?
I don't really look at our CX suite as something that is going to remove aggregators or third-party delivery. I think third-party delivery is a consumer's choice. Honestly, I think the most success that I've seen with a brand's own customer experience part is not more than 30% orders in their entire delivery suite coming from that. So 70% market of the delivery is going to remain with aggregators, and I believe, correctly.
That's the right way to
that's the right way to look at it.
All right, on that note, we're going to wrap up this edition of Startup Street. From Arundhati and me, it's a goodbye, but stay with us. More news and updates will continue on the other side.
We are committed to take firm and decisive action against terrorists and those who support them. We thank Angola for their support in our fight against cross-border terrorism.
Angola foi das primeiras a reagir.
Angola was one of the first countries to react after the sad events that happened in Kashmir region, killing a number of human lives. And in due time, the Angolan authorities sent to the Indian people and authorities the heartfelt condolences due to that event of terrorism. And terrorism is something that Angola condemns wherever it happens, no matter where it happens, but Angola does condemn.
E Angola, obviamente, que condena qualquer tipo de terrorismo, não importa onde ele seja cometido.
But because of what Palantir represents, which is, I mean, basically the very tip of the spear of that tireless retail trader enthusiasm bid, I think it's an extraordinary split between professional sentiment and retail sentiment on Palantir. It's been stoked by the company itself. They kind of mock Wall Street and play to the retail.
India is the most expensive market in the world, most expensive. And that's where what is the starting point for us. This rally in India has been driven by the need to find a place to hide. It is not a rally which is being driven by
Welcome to Indianomics. Today's debate stirs
or questions the very heart of Indian policy and Indian economy. A 60-year-old trend of greater globalization is set to take a U-turn because of President Donald Trump's tariff war. So far, state-of-the-art consumer products like, say, iPhones or iPads or semiconductor chips were designed in the West, manufactured in emerging economies and marketed again in and by the West. Now every country, including India, has to...
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The big story coming in this evening. India and the UK have sealed a free trade agreement after negotiating for over 3 years. Prime Minister Modi calls the deal ambitious and mutually beneficial, invites British Prime Minister Keir Starmer to visit India. Indian pharma stocks decline after US President Trump signs an executive order to boost domestic production by fast-tracking approvals, tightens the rules for foreign producers, including an increase in fee and more frequent inspections. India proposes zero tariffs on steel, pharma and auto components on a reciprocal basis as trade negotiations with the US continue. Bloomberg reports India offered zero duty up to a certain quantity of imports. US Treasury Secretary Scott Bessent says China tariffs are not sustainable, hints at substantial progress in the coming weeks, also says he's highly confident of clinching more deals with other trading partners. Nationwide civil defense security drill tomorrow. Such an exercise was last carried out before the Indo-Pak War of 1971. The United Nations Security Council grills Pakistan at a closed-door meeting. Members expressed concern that Pakistan's missile tests and nuclear rhetoric were escalatory, advised them to sort out issues with India bilaterally. Lenders to bankrupt Bhushan Steel likely to file a review petition after the Supreme Court scrapped JSW Steel's acquisition and ordered liquidation. Banking Secretary Nagaraju says the government will finalize a decision soon. Asset declarations of sitting Supreme Court judges made public for the first time. 21 of the 33 sitting judges, including the Chief Justice Khanna and CJI designate Gavai, have declared their assets. Advocate-turned-judge Justice Vishwanathan, with investments worth over 120 crore rupees, the richest. The Apex Court also publishes the entire process of appointments to the High Courts and the Supreme Court on its website. Ather Energy makes a tepid debut on the Dalal Street shares list at a small premium over the IPO price, but end with cuts. Ather's management remains bullish on the near-term growth. Union Bank of India faces the heat for spending 7 crore rupees to buy a book authored by KV Subramanian, the former executive director at the IMF. The government terminated Subramanian's services at the IMF 6 months before his tenure was supposed to end. All India Bank Employees Association called for a probe into Union Bank's expenditure. The government issues fresh, stringent guidelines for satellite internet players like Elon Musk's Starlink to get a license in India. Wants essential functions to be located within India, citing tensions with Pakistan. The Minister of State for Communications says satellite players will have a minuscule role compared to traditional systems. Well, let's go straight to the top story tonight. This is breaking news. India and the UK have successfully sealed a free trade agreement after negotiations that lasted well over 3 years. Prime Minister Modi and Prime Minister Keir Starmer have described the pact as a historic milestone. Now, the FTA would include a double contribution convention. What is that exactly? Well, it's designed to prevent individuals from being subject to double social security contributions when they work or live in both countries. So essentially, you're not going to have to pay towards social security contributions if you are working in the UK for a limited period of time. Parikshit standing by now to take us through this big development. Parikshit, there's been a lot of back and forth over the last 3 years on getting this deal done. Rishi Sunak was hoping it would have been done in his tenure. It's now happened under Keir Starmer's watch. The Prime Minister, of course, tweeting about this historic milestone. But what does this now mean for India and UK as far as our bilateral relationship is concerned?
Well, this indeed is a historic moment in the relation between the two countries. We have been negotiating an FTA for the last 3.5 years. Let's not forget Boris Johnson, when he was in Prime Minister, he came to India and made a statement that we are looking to get a deal done by Diwali. Now, that had become a joke in UK circles, but finally this deal has been done. It got impetus with the visit of Minister Piyush Goyal to the UK. He visited the UK twice in the last few weeks to get this deal done. And now what we're getting to know from sources right now is that 99% of Indian exports will benefit from zero duty. This also opens up export opportunities for labor-intensive sectors such as textiles, marine products, leather, footwear, sports, goods, toys, gems and jewelry, and other sectors such as engineering goods, auto parts and engines and organic chemicals. We're also going to see an agreement on services as part of the trade agreement. And the initial word that we're getting in is that there will be a boost for trade and services such as financial services, professional services, and in education as well. Stronger strategic alignment with greater mobility for Indian professionals. So we'll have to see what is the arrangement on mobility for business visas, for working professional visas under this. Are we going to get more working visas for Indian professionals? And we are also seeing a 3-year exemption. Now, this is important because the Prime Minister had announced that along with the FTA, we've signed a double contribution convention. Now, this means a 3 years exemption from social security payments for Indian employees working in the UK. So if you're working there for about a temporary period of about 3 years, then you don't have to make social security payments in both countries, and you will be exempted from social security payments in the UK while you're working there. So this was a big ask on the part of the Indian government. Having said that, a couple of things that we'd like to wait and see. What happens to the carbon tax? This was a bit of a sensitive point in negotiations. In fact, the minister had gone on to say that if countries impose a carbon tax on us, then we will retaliate. So what has happened on that? Has India been given a carve-out? That remains to be seen. We're also trying to see what has happened to the bilateral investment treaty. That was also being negotiated because the UK was very clear that all investments coming into India have to be protected, and all businesses will have to get guarantees that in case that there's anything goes wrong, their investments won't get impacted in any sort of a way. So let's see if that bilateral investment treaty has also been signed. But for the moment, net, the big word is 99% Indian exports to benefit from zero duty.
Well, Parikshit, many thanks. And of course, we do await more clarity. The details are sketchy at this point in time. The news has just broken and we will keep coming back to you. But let's go across to Anup Vadhavan, the former Commerce Secretary. He is with us. Mr. Vadhavan, many thanks for joining us. You were in office when the negotiations were being thrashed out. Mr. Vadhavan, to start with, the fact that it's finally done, your first reaction?
Shireen, it's certainly a great achievement. These are very, very challenging negotiations. There was huge ambition on both sides, particularly on the British side for various products which were sensitive for India. So it's a huge achievement. And of course, details are few, but if we are finding that 99% of our exports are going to be covered, that's very good news for our labor-intensive sectors, textiles, leather products, gems and jewelry. So it's a great achievement. And then, of course, those social security contributions for 3 years being, excused is a great achievement. Hopefully that will lead up subsequently to a totalization agreement, which will resolve that issue completely. Services are included significantly. That, again, I think is to India's advantage. Even, to the extent we open our market to British service providers, it involves huge employment opportunities for our professionals. And those can be opportunities which will, be global. So I think because ultimately, British firms in the services sector will have to depend on Indian professionals while providing services in India or anywhere else in the world. So I think it's a great achievement, and there's a lot of, skepticism and concern whether we would be able to overcome certain stumbling blocks, including those carbon taxes. But I'm very delighted to note that the negotiation has concluded successfully. Let's await the details. I'm sure there'll be more good news when those details come.
Yes, Mr. Vadhavan, we are, of course, awaiting the details, but this is, of course, preliminary information that's coming in, courtesy the tweets that the Prime Minister and the UK Prime Minister Keir Starmer have put out. Of course, we will have to pore over the fine print, so to speak. But I know you're short on time, Mr. Vadhavan, so before I let you go, as the immediate next steps and as the immediate impact, what do you believe Indian industry stands to gain or stands to benefit? You very comprehensively explained to us the impact and the implications on the services side. But from a manufacturing perspective, especially in the world that we live in today, as this reorganization of global supply chains takes place, what do you see as the immediate impact, the net gain for Indian industry?
Yeah, I think the Indian industry on the manufacturing side will gain even before the services sector, benefits from this agreement. All these duties are going to come down to zero on 99% of our exports. That means a huge, commercial advantage, because UK duties on the average are low, but they have tariff peaks, in textiles and leather products and other products of interest for our industry. So there immediately there'll be a 5 to 10%, perhaps even slightly higher advantage our exporters will immediately have, and there'll be a competitive advantage over, rival exporters, whether it is Vietnam or Southeast Asian countries or China. So Indian manufacturing will see the impact very, very quickly, and I think they'll stand to gain a lot from it.
Well, stand to benefit both on the manufacturing as well as the services side. Mr. Vadavan, we will, of course, check back in with you as the details emerge. But we do appreciate you joining us on the fly with a very quick reaction to something that has been long anticipated, much awaited, and it is now finally done. That is the India-UK Free Trade Agreement. Anand Iyer, Director General Confederation of Indian Alcoholic Beverage Companies, is also with us. Anand, many thanks for joining us. This has been, of course, one of those hot-button issues on the spirit side, so to speak, but the spirit is high today as the FTA has finally gone through. Explain to us what the impact and the implications are going to be.
Yes, while we await further details, we are obviously, disappointed with the drop from 150 to 75. We had recommended to the government that from 150 it should come down to 100 in the first year, and then over a period of 10 years come down to 50%, which is the resting rate. The 50 has been brought down to 40 and 150 has come down to 75. Now, we are not aware of the fact that they have put a minimum import price. Now, if there is no minimum import price, you can be rest assured that there will be a flood of cheaper Scotch imports. As you rightly, just to inform you, as it is over the last 2 months, the Scotch industry in the UK has, I think, come down by over 11% in terms of, their production and exports, basically because of the tariffs imposed in the, in America, in US. So obviously they are looking for business elsewhere, and there are a whole host of cheaper Scotch brands which can make merry. That's one. Number two is that we had also asked for some non-tariff barrier restrictions to be removed. I only hope that in the tough negotiations which our government has done, they have had UK accede to them, because that would then, increase our exports.
What were the specific non-tariff barriers?
What we are asking them is to remove the restrictive definitions on whiskey. We were prepared to call it Indian whiskey and just not whiskey. Okay. And we said we want access to UK markets for Indian whiskeys.
Right.
Now, if that non-tariff barrier has not happened, then obviously it's a win-win for UK and not a great, it's not a win for the Indian industry at all. I heard, Mr. Vadavan say all the good things. Yes, I know other sectors have, may have benefited, but I think that has been at the altar of the loss of the Indian industry in spirits. The other issue also out here is that there's a similar FTA being now discussed with the EU, as also with the US and with Australia and New Zealand as we speak. Now with 75 and 40 without any MIP, the Indian wine sector, which is also growing, that itself will also get impacted because, these countries have excess wine. production. They get a lot of state support. So they have a lot of price advantages, and that would work in their favor. The other thing which we had also spoken to the Commerce Ministry and even through our nodal ministry, that's the Ministry of Food Processing Industries, and they had, I think, also gone and given our concerns to the Ministry of Commerce, which were negotiating with the UK and the EU for the FTA. We had also said that there are a number of states like Maharashtra, Kerala, MP, West Bengal, Haryana, even Delhi for that matter, where all bottled in origin brands, which are imports, whether wines or spirits, all of them have much cheaper duties, much cheaper levies. Now that still continues, so it's sort of a double whammy in some of these markets for Indian brands, both in spirits and in wines. So I don't think it's a great situation.
Well, I have to say, Mr. Iyer, that
spirits are concerned.
I have to say, Mr. Iyer, that consumers may not choose to agree with you on this one. You're probably going to have to sit this round out as far as the consumer is concerned, because it does, as you point out, open up the doors for the import of alcohol from the UK. And of course, it also gives India the opportunity to look for global markets as well. I mean, our spirits have been doing well. We've been winning some big competitions globally, so perhaps the time is right to make that pivot as well. But appreciate you joining us here on India Business Hour with your first reaction to the news that's just come in. So it's high spirits, as I pointed out, for the India-UK FTA, but not necessarily, as we just heard there, from the alcobev industry in India. That is their take. We will head into a break, but up next, nationwide civil defense security drill tomorrow. Such an exercise was last carried out before the Indo-Pak War of 1971. That and more when we return.
India is the most expensive market in the world, most expensive. And that's where what is the starting point for us. This rally in India has been driven by the need to find a place to hide. It is not a rally which is being driven by some kind of a beta where you are playing for the excitement of things continuing to get better from very good. That's not what is the foundation of this rally. There is going to be trade deals. Now, if trade deals really play out, which is the other side of the coin of, this being only a temporary trade war caused by humans so that someone could get a better deal. If that is the angle, then suddenly the next leg up in the market will come from people who are part of global trade or countries who benefit from global trade coming back on the table. So I think that's a nuance that one needs to kind of think through. Kind of IT services, the big view is, since we are in a headline driven market, for us in India, these are the stocks which will be the headline driven stocks, because if something goes wrong with global growth and with US growth, then this is where people will actually be finding their ways to exit or to kind of go short of the ones who can. So that top down setup isn't great.
India and the UK have sealed a free trade agreement. Joining me now is Rami Ranger, member of the House of Lords, with us. Thanks very much for joining us. It's a big day today after years of negotiations. A deal between India and the UK being inked. The free trade agreement is now done. Your first reaction on this?
My first reaction is I'd like to congratulate 1.4 billion of us scattered all over the world. A colony has joined you on an equal term to do business with you. So that means you are so special. Your Sanatani roots have brought more fruit for you that you are now an equal trade partner with the oldest democracy, with the largest democracy. Together, we share each other's values. We are both secular, democratic country with the rule of law at the heart of governance. Diversity in our country is accepted, respected, and protected. So therefore, there is no way you have to be scared of each other like you have to be with China. You have to watch your back and front when you do deal with China. But with India, this is a trade deal made in heaven. This is a good for the humanity, good for the world security, good for the poor people of the world, because India is a force for good. And the economy of India is growing at the rate of 7 to 8%. By plugging into Indian economy, Britain can move out of the sluggish growth. So therefore, it's a win-win situation for both the countries. We need the technology, they need the market. You can't get bigger market than India. The middle class is growing so rapidly, thanks to Prime Minister Modi. And we all aspire to buy the best in the world. So therefore, big market for Scotch whiskey. A lot of Punjabi like me will be celebrating. So therefore, it's a very, very good news that, the two countries sharing each other's value have joined hands. Indian defense industry is growing, whereas the British defense industry is contracting. Together, they can produce things in India like the JCB does and export to developing countries. JCB is now exporting to 90 countries and able to compete with the Chinese, who dump their product by manipulating the currency and keeping the labor forces at very disadvantage. So therefore, we are now going to give each other a strength which has never been given to anybody before, because you can have a small trade deal with small country with 20 million, 30 million people, but this is a mother of all trade deals with 1.2 billion of us. Therefore, you have to really celebrate, enjoy, and वो बोलते हैं ना, अब दिल्ली दूर नहीं, so अब London दूर नहीं for Indian people. So therefore, we are going to have a huge economic boom in India, and a lot of industries will come up around the corner in your part of the world, and it is going to benefit the entire world. Believe you me, it is the best news. I've been waiting. I have been working behind the scenes with the Conservative government, making the case for India that it is a stable democracy. There are no coups or upheaval like the one we see in many countries. So it's a very stable country. We have a philosophy, Vasudeva Kutumbakam. For us, the world is our village. For us, everybody is equal. For us, we have the positive values, and as a result, you can see the Sanatanis are running all the blue chip companies, because we compete with the best in the world, because we have been taught to use merit, not to use religion to devalue our fellow citizens. And just like people want to do in Kashmir, but we want to rise above the rest on merit. And that is what is the good day for us, because we do not need any special favors. All we need is an equal opportunity. And as you can see, the Indians all over, Indian diaspora all over the world is shining for Mother India. I'm here, although I'm now a bit old, but in my youth, I won an unprecedented 5 consecutive Queen's Award for trade in international trade by competing with the best in Britain. The Prime Minister came personally to give me the 5th Queen's Award. He said, never been done. I said, we are Sanatanis. When we set our mind, ambition, then nobody can stop us. I mean, Modi ji has proved it.
Well,
I mean, look at that. From number 10th economy to number 4th economy, soon to be number 3. So therefore, you stay united. When we were not united, we received onslaught of invaders, one after the other. But now, under Prime Minister Modi ji, I appeal to you, remain united. You are number 4 economy, number 3rd defense. Everybody wants to invest in India because of the positive attitude of the workers. They're highly motivated. They're very loyal. They really want to work and give the best to their children. So therefore, it is a great day for all over the world. We are not a small number. We are 1.4 billion.
No, we're not, Lord Ranger. It is a large market, as you point out, and you've called it the mother of all trade deals, and I would imagine that celebrations are probably underway. Is it Scotch whiskey time already?
Well, this time, although I drink whiskey, but I'm going to open a champagne just to have a few bubbles, bubble of celebration. So it is a good day for everybody. Good day for humanity.
Well, we wish you the very best of luck with that, and we hope you enjoy your evening. But thanks very much for joining us on what has been a significant milestone that's been achieved in the bilateral relationship between India and the UK. Well, let's now talk about the market action. The Sensex and the Nifty ending with marginal losses, reversing gains from yesterday. Mid-caps and bank stocks saw a sharper sell-off, and the Nifty Bank Index was down over 600 points. The Nifty mid-cap index lost about 1,200 points. That's the stock market action for you. In the commodity market, oil prices rebounded after plunging to 4-year lows in the previous session as technical factors and bargain hunting spurred a recovery. The earlier decline followed an OPEC Plus decision to accelerate output increases, heightening concerns over a potential supply glut. Amidst weakening demand due to US tariffs, gold prices meanwhile surging to a 2-week high, and this was driven by safe haven demand amidst Trump's tariffs and uncertainty around the Fed's upcoming meet. President Trump signed an executive order to boost pharma manufacturing in the US by reducing regulatory barriers. The announcement came as a bitter pill for stocks of Indian pharma companies. On an average, the top pharma companies export 40 to 50% of their medicines to the US. Speaking to reporters at the Oval Office, Trump also said he would make announcements in the coming weeks on the cost of drugs as well as tariffs on pharmaceuticals.
That's what it's all about, right? Very important. We're going to have a big announcement next week on some of this kind of thing, but more related to costs, the costs of medicines and drugs, because we're being ripped off, as you know, very badly, being ripped off compared to the rest of the world.
President, on the pharmaceutical side, have you made any determination on kind of what those tariff rates may look like and the timing of those?
I have. I'll announce it over the next 2 weeks.
And Treasury Secretary Scott Bessent has said many trading partners have approached the US with very good trade deals, and some could be done as early as this week. Speaking to CNBC on the sidelines of the Milken conference, Bessent reiterated that China tariffs are not sustainable. He also clarified that both sides have not been talking. Take a look.
I think we're very close to some deals. As President Trump said last night on Air Force One, maybe as early as this week. So when you think about uncertainty, uncertainty, a lot of it is generated by, I have asymmetric knowledge, so I'm not uncertain because I think it's going well. Other people don't know what I know. So
you have to share that with us then.
Well, I can say that I am highly confident that we have 18 important trading partners. We'll put China to the side. The 17 other partners, many of them have approached us with the very good trade proposals.
And back home, lenders to bankrupt Bhushan Steel likely to file a review petition after the Supreme Court scrapped JSW Steel's acquisition and ordered the liquidation. Banking Secretary Nagaraju said the government will finalize a decision soon. Here's former Bankruptcy Board Chairman MS Sahu on the top court's verdict.
This is absolutely legally sound, but completely economically hollow. This is an economic law. It must embed both economics and law. It has identified a set of people who have been responsible for this, but refrained from issuing any directions, remedial, preventive, penal action against any of them. But it has effectively penalized the company and the broader economy.
A nationwide mock drill exercise will be conducted tomorrow to strengthen civil defense preparedness. The drills will be conducted in 244 districts across states and union territories. This comes at a time when tensions between India and Pakistan are rising after the terror attack in Pahalgam. These are the first such drills to be carried out in over 50 years. Such an exercise was last carried out before the Indo-Pak War of 1971. The government's order to states makes no explicit reference to tensions with Pakistan. The primary object of such mock exercises is to strengthen defense preparedness among civilians. We'll head into a break, but don't go anywhere. A special discussion on the UK-India trade deal coming up. We've got big corporate leaders joining us. We're back in 2. The big story tonight, India and the UK have successfully sealed a free trade agreement after negotiations that lasted over 3 years. Prime Minister Modi and Prime Minister Keir Starmer have described the pact as a historic milestone. The FTA will include a double contribution convention. Now, essentially, that is designed to prevent individuals from being subject to double social security contributions when they work or live in both countries. And there is a time period that's been specified. It's for 3 years. So if you're working in the UK for 3 years, you will not need to pay social security contribution. Parikshit is standing by now. Parikshit, it's been a long time waited and a long time in the making as well, but a big step coming in for both nations, especially in this globally volatile world.
Well,